हेलो एवरीवन, गुड मॉर्निंग टू ऑल ऑफ यू। वेलकम वंस अगेन टू दिस लाइव एनालिसिस। स्टार्ट करते हैं आज का सेशन। क्रूड ऑयल को देखोगे, कल एक बुलिश मोमेंटम आया था, ऊपर एक रेजिस्टेंस था फॉरेक्स में। रेजिस्टेंस एरिया से सेलिंग आ गई थी तो हमारे वहाँ सीधा गैप डाउन ही ओपन हुआ, विच इज़ गुड। एंड नेचुरल गैस भी कल मोमेंटम में था, ऊपर एक रेजिस्टेंस था, कल हिट नहीं किया था, आज अर्ली मॉर्निंग ओपन हुआ, फॉरेक्स में गया था। एमसीएक्स में भी वीक बना के नीचे सेलिंग में आ गया है, तो कल वाली लेवल है, कुछ खास चेंज नहीं हुआ है। सिल्वर और गोल्ड थोड़ा सा इंपॉर्टेंट है। सिल्वर वापस प्लंज कर गया कल। एंड इवन दो अगर आप नेस्डेक भी काफ़ी गिरा था, नेस्डेक के स्टॉक्स भी काफ़ी डाउन थे। बट ओवरऑल सिल्वर वापस से आप कह सकते हो वही 76 $74 के अराउंड आ गया है। देखते हैं अब ये ब्रेक करता है नहीं करता। बाकी जितना मुझे लग रहा है अब 70, अब मान के चलो 75 4 आवर टाइम फ्रेम पे यू कैन मार्क दिस लेवल इन सिल्वर फॉरेक्स चार्ट। अगर अब ये क्लोजिंग देता है, ठीक है, बहुत सारे लोग सोचेंगे यहाँ पर डबल बॉटम बन सकता है। चांसेस मुझे तो कम ही लग रहे हैं कि डबल बॉटम बना के ये ऊपर जाएगा। ठीक है, हो सकता है थोड़ा बहुत यहाँ पर कंसोलिडेशन करे, थोड़ा बहुत ऊपर जाए। बट अब जब तक इस स्विंग के ऊपर नहीं सस्टेन करता है $91 के ऊपर, नॉट बुलिस। ठीक है, यहाँ पर थोड़ा बहुत बुलिस थे, तीसरी बार आया था। यहाँ पर एक हेड एंड शोल्डर जैसा पैटर्न भी बनने वाला है ये, अगर ये ब्रेक डाउन करता है तो नीचे। ठीक है, डायरेक्टली नहीं करेगा क्योंकि डायरेक्टली आया है मार्केट। थोड़ा बहुत पुल बैक या कंसोलिडेशन होना चाहिए तभी सस्टेन करेगा। बट या $75.50, $75.50 के नीचे अगर ये दो 4 आवर की कैंडल क्लोज करता है, एक के नीचे एक, मतलब एक कैंडल यहाँ पर क्लोज हो गई, उसके नीचे एक और कैंडल क्लोज हो गई, तो ये ब्रेक डाउन है। फिर सीधा हम एक्सपेक्ट करेंगे नीचे $54। तब तक पॉसिबल इट विल कंसोलिडेट और मूव बैक फ्रॉम हेयर। ब्रेक डाउन अभी भी नहीं हुआ है, होल्ड कर रहा है, ध्यान रखना। 75.50 इसके नीचे 4 आवर टाइम फ्रेम पे दो कैंडल एक के नीचे एक क्लोज किसी भी तरह से हो जाए, ये ब्रेक डाउन पे जाएगा। ठीक है, बाकी जिस तरह से देखो यहाँ पर फॉल आया है, नॉर्मली इस तरह के ब्रेक डाउन सस्टेन नहीं होते हैं, तो बेस्ट के सिनेरियो है कि थोड़ा कंसोलिडेशन करे इस तरह से और फिर प्लंज हो, अगर वापस प्लंज हो रहे हैं तो। ठीक है, ऐसा भी हो सकता है एक कैंडल इसके नीचे क्लोज तो दे दे, दूसरी कैंडल विक बना के वापस ऊपर आ जाए। तो ब्रेक डाउन बड़ा इंपॉर्टेंट है किस तरह से होता है। यहाँ पर अगर हुआ तो हम एक्सपेक्टिंग $53 प्राइस सुट को, वही एक लेवल है जहाँ पर फिर हम नेक्स्ट एक्सपेक्ट करेंगे सिल्वर में जाना चाहिए। ठीक है, विच इज़ अप्रॉक्सीमेटली, अगर यहाँ से देखोगे मार्केट ऑलरेडी यहाँ पर 38% टू 40% का फॉल दिखा चुका है, वहाँ तक जाता है तो विच इज़ 55%, विच इज़ नॉर्मल। वहाँ पर एक मल्टी ईयर्स का ब्रेकआउट का रिटेस्ट जोन भी है, तो मुझे लग रहा है वो बहुत अच्छा सपोर्ट मिल सकता है प्राइस को। गोल्ड उतना नहीं गिरा है, विच इज़ गुड साइन। ठीक है, नॉर्मली कम ही गिरेगा गोल्ड। ओवरऑल मैं कह सकता हूँ बुलिश ही रहेगा आने वाले टाइम में, तो गोल्ड पे ज़्यादा इन्वेस्ट करने की सोचना। ओवरऑल वैसे फॉल है बट उतना नहीं जितना एक्सपेक्ट करा था, सो विच इज़ अ गुड साइन। ऑल टाइम हाई से वो भी आप चेकआउट करोगे तो करीब 20-21% गिरा है मैक्सिमम। मुझे लग रहा है गिरता है तो 30% और गिर सकता है, इससे ज़्यादा तो एक्सपेक्ट नहीं है। इसमें भी एक रीटेस्ट था, इसमें तो रीटेस्ट करके गया था मार्केट जब ब्रेकआउट हुआ था, तो इसमें ज़रूरी नहीं है रीटेस्ट करने आए प्राइस। गोल्ड में सपोर्ट है मेजर, फॉरेक्स चार्ट में अगर चेकआउट करोगे तो 4700 750, उसके नीचे ब्रेकडाउन नहीं होता अब तक, ये भी होल्ड ही है सपोर्ट पे। सपोर्ट होल्ड होना चाहिए गोल्ड में 4700 टू 750 इज अ गुड वेरी स्ट्रॉन्ग सपोर्ट। नीचे गया तब थोड़ा सा प्रॉब्लम हो सकता है इंट्राडे में। बार लेवल रिफ्रेश कर देते हैं क्रूड ऑयल और नेचुरल गैस में भी अब वापस से। बाकी अगर कोई सेलिंग में है क्रूड ऑयल में तो मेरे अकॉर्डिंग प्रॉफिट बुक कर लेना चाहिए। सेम फॉर नेचुरल गैस, अगर कल सेल करके रखा हुआ है आज अर्ली मॉर्निंग पे हाई रेजिस्टेंस जोन्स के अराउंड, बीच में एंट्री मत करना।
Now to the programme, Hakan Samuelsson, the CEO of Volvo Cars. Good morning to you. Thank you for making time.
Morning.
Just walk us through, please, the challenges that you've had in the past quarter and whether you're optimistic that things could improve.
Yeah, I mean, we have a very tough market. I mean, we see that everywhere in China, especially. We have incentives for electrified cars has been discontinued in US and China. So a rather tough headwind on the market. But I think what is important for us during this year, we have really made a reset of the company. We have been really good in lowering our cost position. We have been reducing 3,000 positions in our white-collar organization. We have a leaner organization and really did the very challenging cost and cash action program we announced. We really finalized basically a year ahead and encouraged us to continue in the next year. So really good internal work, tough external. And at the end, we landed at a result that, of course, we are not satisfied with, but still, I would say, looking at the severe external factors is a reasonable result. And I'm really good. We are back to positive cash flow for the year. Was really the main number one objective we had with the year.
OK, so a really challenging backdrop, I understand. Specifically, how much has recent dollar weakness affected you?
Very severe, of course, for the U.S. markets. I mean, the profitability money coming in from the U.S. market took a big hit, of course, from this currency effect, and also with the discontinuation of the incentives we had earlier in U.S. So U.S. has lost profitability with the currency.
But I know that you are moving output of your bestseller, the gasoline-powered XC60, to South Carolina. I know you have a plant there. You're already producing the XC90 and the Polestar 5. How much can that help to offset that dollar weakness?
It will, but it will take some time till we will ramp up that volume. But I mean, that is really the reaction to say discontinuation of globalization. We're going into a more regional world, and then we have a more locally adapted products in China, and we are moving this car to South Carolina. We will introduce a second car later on in South Carolina. So we will go produce more where we sell cars, and I think that's really the right way to tackle currencies long term, as we need to have much more natural hedging. We cannot solve this with financial hedging.
I mean, you've also just unveiled a new long-range EV, the mid-size EX60 SUV. How have initial orders kicked off across Europe?
Very successful, and that's really a very important factor looking ahead. As you know, we have the ambition to really be an all-electric company. We should be ready around 2030. We will have, of course, hybrid versions for customers still not ready, but really a car for the most important segment is really the EX60, and it's also introducing some groundbreaking new technology. It really has a central compute we call the Hugin core computer. We have mega casting, we have battery cells directly to body, and we are also, I listened to your program about Google Gemini. We will be the first car launching that when this car goes into production. So that will also be part of this new car. So it's a really new beginning for us in the all-electric field.
You've alluded to it several times, Hakan, but of course every CEO that we talk to this earnings season is having to contend with this difficult geopolitical backdrop. I wonder, when it comes to the supply of chips, how you're preparing and protecting your supply chain against risks there.
I think we learned a lot during the pandemic, and it's really chips that we buy from, so to say, tier 2 suppliers. You cannot just rely on the first tier 1 suppliers that they will have the chip. We have to go down all the way to the supply of the chips to our suppliers and really understand the whole supply chain. And that we learned, and I think that's the best way also to secure this. And of course also being sure that we have a good firewall between East and West when it comes to more advanced chips, because that's where the world is going into more and more technology restrictions, as you know.
And to what extent are you exempt from the rare earth supply concerns because your owner is Chinese?
Yeah, that could be an advantage. I wouldn't point it out as a significant advantage. I mean, we are using that in e-motors mainly, so permanent magnetic motors, but we also have other type of motors that does not require rare earth. So that is something I think we share with all other automakers. But of course, being owned by a Chinese is definitely not a disadvantage.
Something of a silver lining. Hakan, thank you so much for bringing us those results, talking us through them this morning. That's Hakan Samuelsson, CEO.
up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Earnings season is here.
Europe's most valuable companies kick off earnings season.
Bloomberg is first to break the numbers.
Some breaking news from First Abu Dhabi Bank.
So Shell, SAP, Total's in the mix there.
You're bringing all the fun today, Guy Johnson.
With the smartest insights.
How are you feeling going into earnings season?
We are still confident that we can deliver to that acceleration of total revenue growth.
Give me a sense of what you're most optimistic about.
I really expect a very strong Q4.
Continuing coverage on Bloomberg.
Welcome back to Bloomberg Daybreak Europe, live from Frankfurt. Now, oil is falling for the first time in 3 days after Iran confirmed that it will hold negotiations with the US, easing the immediate risk of military strikes against the OPEC producer. It comes after President Trump sent this warning to Iran's leaders as US military forces amass in the region.
I would say he should be very worried, yeah, he should be. As you know, they're negotiating with us.
I know they are, but the protesters have said, you know, where are the Americans? You promised them we would have their back. Do we still have their back?
Well, we've had their back, and look, that country's a mess right now because of us. We went in, we wiped out their nuclear.
So that's the question. If we wipe them out,
we have peace in the Middle East.
Yeah.
If I didn't take out their nuclear, think of it. If we didn't take out that nuclear, we wouldn't have peace in the Middle East because the Arab countries could have never done that. They were very, very afraid of Iran.
Yeah.
They're not afraid of Iran anymore.
For more, let's bring in Bloomberg Horizons Middle East and Africa anchor Jemana Versace. Jemana, it seems like traders are looking past that tough talk and focusing instead on the Oman talks tomorrow. What are the talks going to centre on?
Well, yeah, that's true, Lizzie. There's been a number of provocations this week, and at least the shooting down of that Iranian drone that approached the U.S. aircraft carrier, the Abraham Lincoln, a couple of days ago. And at some point, it did seem like it was touch and go whether these talks would actually take place. There was speculation they were going to take place in Istanbul, in Turkey. It looks as though Iran pushed back and actually demanded that they take place in Oman. And they've been pushing for the scope of the discussions this weekend to be centered more around their nuclear program as opposed to a broader portfolio of other items that the U.S. also wanted to bring to the table, including their arsenal of ballistic weapons and their funding of proxies around the region. But the fact that the talks is still taking place, they are scheduled to take place tomorrow, that's Friday, in Oman. The foreign minister will be there, the Iranian foreign minister, and there you have it. It's a post that he's put up on X saying nuclear talks with the U.S. are scheduled to be held around this time tomorrow in about 24 hours in Oman. On the U.S. side, it's been reported that Steve Witkoff is going to be flying to Qatar today to have talks with the Qatari Prime Minister and Jared Kushner as well. Unclear whether they're going to engage in talks directly with Iran, because so far, even last year, in the run-up to that U.S.-Iran confrontation, the talks were indirect. And so as we head into the weekend, you could say that the window for diplomacy is open, but I think expectations that this is going to yield anything substantial are also quite low as well.
Well, if they can't find a solution, Jemana, where does it leave oil? We're also, of course, keeping an eye on the Ukraine peace talks this week.
Absolutely, and there's a lot of geopolitical premium that is being priced in to oil right now. On one hand, you've got the fundamentals that would point to lower pricing because of this supply glut that so many analysts have been talking about, and the fact that Chinese demand seems to be somewhat leveling off, or at least their stockpiling activity. But the reason we're back up here, very close to $70 again, is this geopolitical premium. And the real risk that if these talks don't yield anything, which again is a low likelihood at this point, then the U.S. could go down that kinetic option, so to speak, and go for a military strike. And certainly the evidence is there because they've built up this quote-unquote armada in the region. The aircraft carriers are there, F-35s, F-15s. They're building up troops in the region as well. And President Trump is warning the supreme leader himself to be very, very worried about upcoming steps. So perhaps all of this is just a means of buying time, of building up reinforcements in the region. Again, we don't know what the U.S. is planning, but you have to think, given the positioning of the military assets in the region, that a military strike is not completely off the table, hence why you still have that embedded premium in oil. But heading into the weekend, I think a bit of a breather, a relief coming through that at least the two sides are open to negotiations. And let's see whether Iran actually will make some concessions on their nuclear program, because they're coming at it from a position of weakness with their proxies around the region eviscerated, with their nuclear existing stockpile, as we know, taking a big hit last year, and then the economy also in a downward spiral. So there's a lot of pressure on the Iranian regime to come to a deal. We'll see if there's any daylight between the two sides.
Well, of course, you'll be across those talks for us in Oman tomorrow. Jumana, thank you so much. That's Bloomberg's Jumana Basechi, and she'll be back with Horizons Middle East and Africa at 5 a.m. London time tomorrow. Well, coming up on Daybreak Europe, the Prime Minister, the UK Prime Minister Keir Starmer, facing anger in Parliament, including from his own lawmakers. We'll get you the details next. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Now to some of the top stories we're following for you this morning. Prime Minister Keir Starmer faced anger in the UK Parliament yesterday over his handling of the appointment 18 months ago of Peter Mandelson as the UK ambassador to Washington, amid scrutiny of Mandelson's relationship with Jeffrey Epstein. Starmer was questioned about how much he knew of the relationship when he picked Mandelson for the job, with Labour members of Parliament describing the mood in the governing party as febrile and mutinous. Elsewhere, President Trump says he would not have nominated Kevin Warsh to lead the US Federal Reserve if Warsh had expressed a desire to raise interest rates. Trump told NBC News that Warsh wants to lower borrowing costs regardless of his own view. The comments could come up during Warsh's confirmation process, where the Fed's independence is likely to be a central topic.
Let's get to the Fed. Is there any doubt in your mind that interest rates are going to be lowered?
Not much.
Why? How can you say that?
I just think they're going to be lowered. I mean, they should.
Is your new Fed pick on board with that?
We're way high. Okay, we're way high in interest. We have now, with me and with all the money, I've always been good at money. And with all the money coming into our country, we're a rich country again. We have debt, but we also have growth. And the growth will soon make the debt look very small.
Meanwhile, President Trump has spoken with China's Xi Jinping in a call that covered trade and geopolitical flashpoints, including Taiwan, as both sides prepare for a planned summit in April. Trump highlighted new Chinese commitments to buy more US soybeans, energy and airplane engines, while Xi urged caution on Washington's planned arms sales to Taipei. Speaking with NBC News, Trump framed the call positively.
Is there any doubt in your mind that interest rates are going to be lowered?
Not much.
Why? How can you say that?
I just think they're going to be lowered. I mean, they should.
Is your new Fed pick on board with that?
We're way high.
And staying with geopolitics, European Union member states have reached an agreement on the framework of how to provide a €90 billion loan to Ukraine. EU leaders agreed in December on the broad outline of the loan, which included requiring purchases using the money to be made within the bloc unless the equipment could only be sourced elsewhere. Well, those are some of our top stories this morning. Just checking in on these markets. That tech sell-off has been around the world now. The Nasdaq having its worst two-day rout since October, yesterday breaching its 100-day moving average. And that really is a level that some analysts see as a harbinger for more losses. So let's take a look at the futures picture. We are pointing lower on S&P E-minis and in Europe on Eurostoxx 50 futures. But Nasdaq futures are now in the green, higher 0.1%. Already, though, we've seen hundreds of billions of dollars wiped off the value of stocks, bonds and loans of companies across Silicon Valley. But also here we look at the currency picture. Of course, we've got two rate decisions today from the ECB and the Bank of England, both this afternoon. The pound and the euro a touch lower against the dollar, both expected to keep rates on hold. But euro strength recently likely to be a discussion point at that press conference with President Lagarde. Just keeping one eye on Bitcoin here, we are edging towards the 70k a token mark. It's down more than 42% from its peak in October. So the risk-off mood spreading across asset classes. Next up, we'll preview those ECB and BOE decisions with Callum Pickering. This is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
bringing you up to the minute news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
Live from Frankfurt ahead of today's European Central Bank decision, this is Daybreak Europe. I'm Lizzie Burden with your top stories. The trillion-dollar tech wipeout. Alphabet, Qualcomm and ARM all slide after earnings as concerns mount about the sector's massive spending on AI, with one tech ETF losing $1 trillion in the past 7 days. Elsewhere, oil tanks on easing geopolitical risk. The US and Iran confirm talks, but President Trump warns the supreme leader should, quote, be very worried. Plus, rates on hold. The ECB and Bank of England both expected to leave interest rates unchanged, with the focus now on the forward guidance. We'll bring you full analysis. Well, a very welcome to Thursday. It is 7:30 a.m. here in Frankfurt, and the picture in markets looks like this. That tech sell-off has been around the world. It continues in the Asia session, and we have futures lower in Europe as that momentum trade unwinds. But as you can see here, Nasdaq futures are now in the green. Outside of tech, though, silver is joining the sell-off and pairing earlier losses, but plunging nonetheless. We're down 10% now. So going back to that historic market route that started on Friday, even if we had a breather for 2 days. But with the geopolitics in mind, you're looking at Brent there at $68 a barrel, down for the first time in 3 days. And this after Iran confirmed that it is going to have talks with the US in Oman. That's tomorrow. But traders really latching onto that rather than the tough rhetoric that we played you earlier from President Trump. Now, on the front pages this morning, in the UK, we have The Guardian leading on the crisis engulfing the Labour Prime Minister Keir Starmer. MPs saying that his days are numbered amid this fury over the former UK ambassador to Washington, Peter Mandelson, and his links to the late paedophile financier Jeffrey Epstein. One minister, in fact, was telling Bloomberg that it was only the fact that Starmer's best-placed rivals have reasons to hold back from a challenge that Starmer's actually still in post in Downing Street. And this story is on the front page of the FT as well. They lead on one Labour MP describing the affair as the beginning of the end for Starmer, saying the mood in Westminster is toxic, and speculation mounting as well that Starmer's chief of staff, who promoted Mandelson's bid to become ambassador, could himself be ousted soon. If we flip over to the Wall Street Journal, finally, they've got Elon Musk's SpaceX seeking an early boost for shares. This after the rocket and satellite business makes its stock market debut later on this year. Now that it's merged with XAI, they're hoping they can skirt the traditional rules and be included in a major index a bit faster and get access to more capital. You can get a roundup of all the stories you need to know to get your day going in today's edition of Daybreak, which as ever, terminal subscribers can find by going to DAYB Go. Well, let's get back to the tech story, that global rout in tech stocks snowballing into Asia. Let's get the view now from Hong Kong with Winnie Xu. Winnie, what are you watching?
Yeah, morning, Lizzie. You can see that Asian stocks down for a second day, still that rotation away from technology shares, and hence Infotech here sector down about 3%. Leading losses also are the Korean stocks, with the Kospi down about 4%. So really overall quite risk off in our region. Also just want to flip the board and take a look at the broader market in Japan, because surprisingly that the topic's actually doing better than some of the other markets in our region. And that is partly helped by some positive earnings coming through from trading houses, pharmaceutical companies, as well as from Sony here. They saw shares jumping as much as 6% earlier today when they announced a profit margin jump of 22%, and also raising full year forecasts on the solid demand when it comes to their entertainment offerings. And Japanese yen here stabilizing a bit after 4 weeks of decline. And also the 30-year yield down about 7 basis points after some solid demand coming through from the auction earlier today, signaling that the yields at these levels are still quite attractive. But we will be closely watching out for that election this weekend. Also flip the board and take a look at some of the Chinese stocks, because interestingly, we are seeing that consumer names PopMart and also local cosmetics brand Maogeping doing quite well amid this whole tech sell-off, and also helped by some expectation for more spending during the upcoming Chinese New Year. When it comes to the darker picture here with gold miners dropping and really dragging down the overall benchmark that is coming off that big sell-off that we're seeing in the precious metals today. Back to you, Lizzie.
Winnie, thank you for the snapshot of Asia markets there. That's Winnie Su in Hong Kong. Now, we're looking ahead to the rate decisions from the European Central Bank and Bank of England later on today, both widely expected to keep interest rates on hold. And for analysis, I'm pleased to welcome Callum Pickering, Chief Economist at Peel Hunt. Morning, Callum. So it looks like we're going to get a hold. Let's start in Frankfurt from the ECB. But what's more likely this year? Are we going to have a cut more likely or a hike?
My base case is still for the ECB to hold this year, but I think markets are right to sense this sort of about turn in the ECB's guidance. So late last year, we had policymakers suggesting, well, if markets are expecting the next move to be up, perhaps in 2026, that sounds about right. But then more recently, there's been some concerns about some disinflation coming through as a result of the strong euro. And I would keep in mind here, the Eurozone is still a very industry-heavy, export-oriented economy. You see the weakness still in Germany. We've had a long period of deindustrialization. And so I think if the ECB can start to form an argument that inflation may undershoot, exports are going to be weak, the euro strength is a problem, I think they might just be gently signaling to markets that if this story unfolds the way I just mentioned, they should be ready perhaps for a rate cut.
Well, yeah, when does the ECB undershooting its inflation target become a problem? How much does the euro need to appreciate for it to change the ECB's rate path?
Well, in my view, markets will sort of do most of the job. Policy is probably neutral to slightly easy in the Eurozone. There are no significant inflation concerns on the horizon, so bond markets will just adjust to changing inflation expectations. That on its own helps with easing financial conditions. The other thing just to keep in mind here is that if you get strong demand for Eurozone exports as part of a global upswing this year, which I think is probably base case for me, I don't see why euro strength on the back of demand for Eurozone exports should be a problem for the ECB. Put this a different way. If European consumers suddenly have rising purchasing power and European businesses see increased demand for their wares, why should the ECB try to stimulate against that? And I think this is going to be the internal logic. The point you make about how far does the ECB need to undershoot, I think if markets start to see inflation expectations, say, fall below 1.5%, I think then the ECB will be prepared to move. But I think close to 2% or slightly below, which is probably where we're going to be, I think that's going to be enough to keep the ECB on hold.
So that's exports, but Callum, what about Chinese imports? Are we likely to see inflation divergence across the euro area economy if you see different levels of Chinese trade diversion and on top of that, different levels of fiscal spending?
Well, this is again where I see the point narrowly from the monetarist point of view to say, well, look, we at the central bank care about inflation at 2%. If it falls below, we should lower rates, fine. But we need to factor in what's actually driving these trends. If we've got some positive supply-side dynamics coming from, say, a flood of Chinese imports or even a diffusion of AI, and we know that governments in the Eurozone are creating demand, principally in Germany with this 1 trillion stimulus, which of course was delayed last year, but we're still all looking forward to. Like, why not just let this story play out? Why not let fiscal policymakers just stimulate a little bit? Why not just let this supply side story play out and then see where things land? I think that's where the ECB probably is right now. The danger is if you start to see weakness in inflation linked to weakness in demand expectations. But so far this year, actually, the data on the PMIs, the GDP data we've seen so far, have all surprised slightly to the upside. So I don't think the ECB is going to be in a hurry here to lean against this story.
And Callum, let's turn to the Bank of England, because the UK economy seems to be both strengthening and losing jobs. You've got unemployment at a 5-year high. Yeah. Surely, is this a time the BOE should be cutting rates?
Well, the two things that I would just point to is, yes, growth is improving, but it is below potential. That is to say, even at these rates of growth, we will be seeing an opening up of spare capacity. We see that in the labour market. The second thing is we've had so many huge base effects in the UK coming from external prices, coming from domestic policy choices, that the headline rate of inflation, which is currently above 3%, is not giving us a very good picture of underlying inflation dynamics. If I take a look, for instance, at monthly inflation prints over the past couple of months and I annualize those, the central bank is basically at its target of 2%. And with a bit of a lag, we're going to see headline inflation come down pretty quickly. The Bank of England itself is signaling that by summer we'll be at 2%. So for me, the danger is if you let this story of opening up capacity, weakening labour markets, inflation at target play out for too long, you're going to find that you undershoot into next year. I wish the bank actually had a little bit more courage to go a bit quicker. I think today they're on hold, but I think they'll signal the next cut comes in April.
Yeah, traders only fully pricing in one further cut this year, but you see 2 cuts. But I also, Callum, want to turn to the politics. We've got to talk about the politics. It looks like Keir Starmer is hanging on by a thread right now by the looks of the polls and the talk in Westminster. We've got a fantastic write-up about it on the terminal. Would any of the potential candidates to replace Starmer boost growth? I'm thinking about Wes Streeting talking about offering a more pro-EU stance. Does that strike you as something that would really move the needle?
The two things holding the UK economy back today, this government is not prepared to address. The first thing is a chronic shortage of supply, which is holding back investment, it's holding back exports, it's holding back AI diffusion. That is a long-lived problem that we need to completely reorient our approach to energy to fix. The second thing is markets are not convinced that policymakers in the UK are sufficiently disciplined when it comes to sound money policies. This is why interest rates in the UK are higher than in any other country in the G7. The 10-year rate is 4.5. It's crept up over the last couple of days on this political story. Until we bring interest rates down to a normal level, that is, we get this so-called more on premium out, and until we fix this supply problem, we won't go back to sustained, healthy economic growth. Whoever replaces Keir Starmer, I don't see among the roster anyone seriously considering these two problems.
Well, would any of them bring about so much fiscal slippage, Callum, that the BOE couldn't cut rates further?
I mean, the challenge with fiscal policy is, what's the problem that markets are concerned about? Is it the overall level of debt and the deficit, or is it the inflation risk? In my view, it's the inflation risk. And so whoever replaces Starmer, if we just persist with these anti-growth policies, but they're not inflationary. What are the anti-growth policies? A badly designed tax system, over-regulation in labour markets. That on its own shouldn't spook bond markets so long as inflation stays under control. The danger is that if you lurch, let's say, left, if you replace Starmer, you'll find then that more inflationary policies will get priced into bond markets, and then the Bank of England will have to offset this loss of credibility, these worries about inflation, by staying even more hawkish. Put this a different way, if we would have got the income tax cut that markets had expected back in the November budget, that would have been a very strong signal from this government that we really care about bringing inflation down, and we would not be talking today about whether the Bank of England cuts, say, twice this year. We'd be asking the question, can the Bank of England cut 4 or 5 times?
Easy for an economist to say, hey? Difficult when you're the politician. Callum, thank you so much. That's Callum
right.
Pickering, Chief Economist at Peel Hunt. So glad to have you on the programme. Well, that Bank of England policy decision is coming at 12 p.m. London time, followed by the press conference at 12:30 p.m. And we'll bring you special live coverage of all of it on the terminal, online, and for viewers in the UK and Europe on Bloomberg Television. Do also catch our interview with the BOE Governor, Andrew Bailey. That's coming at 4 p.m. London time. And here in Frankfurt, we'll bring you full coverage of the European Central Bank decision. That's at 1:15 p.m. And Christine Lagarde's press conference comes half an hour later. But coming up right here on Daybreak Europe, as AI concerns spark a $1 trillion tech wipeout. Mixed earnings from Alphabet, Qualcomm and ARM also hit sentiment. We'll bring you all the details next. This is Bloomberg.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now these 2 fingers, top of the bottom, make the sushi shape the more beautiful. 3. Then, I'm not, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is the 1 to 6.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Welcome back to Bloomberg Daybreak Europe. I'm Lizzie Burden in Frankfurt, where it's 7:46 a.m. Well, AI angst has helped wipe hundreds of billions of dollars off the value of tech stocks, not just in the software sector, but across the board. And sentiment was further hit as Alphabet, Qualcomm and Arm all reported mixed earnings. I'm joined now for analysis by Matt Bloxham, senior analyst for Bloomberg Intelligence. Matt, we've had mixed results, as I say, from Alphabet, Arm and Qualcomm, but what are the big takeaways for investors? Good morning.
Yeah, good morning. Also a better reaction to the Alphabet results, obviously parent of Google, compared to Qualcomm and Arm. And I think two different things going on there. Obviously, the really big news with Alphabet was the massive increase in capital spending for 2026, potentially $175 to $185 billion. So that would be essentially about double what they spent in 2025 and 3 times as much as the last 3 years combined. So huge increase. So the AI land grab or arms race is still very much on between the likes of Google and Meta and Microsoft and others. I think in contrast, what the weakness we saw in Qualcomm and Arm reflects softness in the smartphone market, which is being heavily impacted by supply constraints in the memory space. And obviously both of those companies heavily dependent on the smartphone market for their revenue. Arm is pivoting into AI, but is still kind of taking time for that to kind of to crank up, really.
Now, Matt, I need you to play the referee here. We've had the NVIDIA boss, Jensen Huang, saying that the software sell-off is the most illogical thing in the world. Who's right, the market or Jensen Huang?
I have to say that probably in balance, I'm with the market right now. I mean, I think I saw the comments that Jensen made, and I kind of think it's a little bit the other way around. He was kind of saying that that these AI doesn't use the tools use AI, and I think he's kind of underplaying the kind of really quite profound kind of changes we're seeing in how AI is actually shaping the tools that everybody in your own personal life and in business are using, and how that does create quite a big threat to even kind of relatively new software companies. And this kind of full industries, anything that's kind of human capital intensive, service intensive, is really exposed. And I think it's not surprising that investors said, hang on, we're having to rethink our AI thesis again, and the best thing to do whilst we figure out the next kind of part of this story is to take risk off, figure out a new strategy, and then come back into the market. Clearly, this sell-off is too broad, but I think it's going to take a while for us to kind of see markets pick their new winners.
Matt, thank you so much. That's Matt Bloxham from Bloomberg Intelligence. And we're going to be getting more insights on these tech earnings at 4:45 p.m. UK time when we speak to the Qualcomm CEO on the Bloomberg Tech Show. But now to some other top corporate news this morning. Bloomberg has learned that SpaceX held meetings last month with banks from outside the US as it targets a listing this year. Sources say one group was made up of European banks, while another included firms from around the world in other regions. We're told that Wall Street giants Bank of America, Goldman Sachs, JP Morgan and Morgan Stanley are already lined up to lead the listing. Elsewhere, Bloomberg understands that the biggest US lenders are pushing for a loosening of the European Union's cap on banker bonuses. Firms including Goldman Sachs, Citigroup and JP Morgan are pushing the cause during the EU's upcoming review of its banking rulebook. The UK has already dropped the restrictions which cap bonuses at 2 times fixed salaries in the spirit of freeing the industry from unnecessary burdens. Now, Danish shipping giant Maersk is expected to release its fourth quarter earnings before the market open today. The company's plans to resume shipping in the Red Sea will really be the focus here as markets assess the impact. For more, I'm joined by Stefan Kovacev, who is Senior Credit Analyst at Bloomberg Intelligence. Stefan, good morning. Just walk us through how the Red Sea situation is impacting Maersk.
Good morning. I think the Red Sea situation has been a big positive for the industry for the last couple of years, but now more and more companies are going back into the Red Sea. So the big question is it safe for container shipping companies to go back in the Red Sea or not? Or will it be in the next 6 months, 12 months? Because when it does happen, we estimate that the available capacity in the system will increase by about 7 to 8%, because currently ships are busy going around Africa. They will have a direct route via the Red Sea. So more capacity can lead to lower freight rates and more headwinds for the industry and Maersk.
And how is the tariff story going to feed into these results today?
Tariffs are clear negative for the industry in general, but it's a very fragmented industry, and Maersk actually is a big player. They're number 2 in the industry with a market share of about 15%. And also their exposure to the US-China route is very small. It's about 5% of volumes for them. They also have a very strong balance sheet. They have about $26 billion of liquidity as of Q3. So I think they're very well prepared and well positioned, at least relative to peers, to face more geopolitical headwinds and tariffs this year.
Stefan, thank you so much. That's Stefan Kovacev, the Senior Credit Analyst at Bloomberg Intelligence. Well, you can watch the Maersk CEO Vincent Clerc unpacking the firm's fourth quarter earnings. That conversation on the opening trade at 7:30 a.m. London time. But we've got plenty more coming up right here on Daybreak Europe, so don't go anywhere. This is Bloomberg.
To-the-minute global news whenever and wherever it happens. I'm Anne-Marie Hordern in Davos, Switzerland, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
In our last few minutes here, a few terminal charts to set you up for the day ahead. At 12 p.m. London time, of course, we've got the Bank of England rate decision expected to keep interest rates on hold. And let's take a look at the unemployment backdrop, because the Bank of England really is in a tricky spot here. Policymakers weighing contradictory signs that the economy is both strengthening and, as you can see here, losing jobs. Unemployment at a near 5-year high. But then in the afternoon as well, we're turning our attention over to the European Central Bank, also expected to hold rates. You remember not so long ago there was talk of hikes after comments from Isabel Schnabel, the market reacting to that, but now it's faded for various reasons. So flip the board over. First of all, we've had inflation dipping below the 2% target. Second, we've seen euro strength on the flip side of dollar weakness, so the euro briefly pushing past that 120 threshold last week, and the danger here being that it could damp exports or embed the inflation undershoot more permanently. And then, of course, thirdly, since the last policy meeting, you've had the Governing Council having to consider President Trump's tariff threats over Greenland. So if we flip over one more time, you can see the top two lines on the next chart. Here we go, reflecting that heightened uncertainty around US policy and geopolitical risk in the eyes of economists. So given all of those downside risks, I doubt President Lagarde's going to be adding fuel to the fire with any hawkish rhetoric today. Turning to the other risk events on the docket today, aside from those two rate decisions, we've got earnings from Shell and Maersk in just a few minutes' time. Shell, like the rest of big oil, under pressure from weaker oil prices, and Maersk, the commentary will be focused on the reopening of the Red Sea and how it impacts freight rates. Of course, they've already started to plunge. And the CEOs of both of those companies are going to be speaking to Bloomberg TV later on, so don't miss those. But also stay with us for special coverage of the Bank of England decision, the press conference, and straight after that, the ECB decision and President Lagarde's comments. But that does it for Daybreak Europe. The opening trade's coming up next. This is Bloomberg.
You don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It is Thursday the 5th. Good morning. On today's agenda, the tech sell-off expands, the shiny stuff slumps again, and it's another blockbuster earnings day.
OK, Tom, let's talk about the volatility we're seeing. It continues in so many asset classes. And you wonder whether or not this starts to connect, whether or not the overall volatility story becomes a problem for markets. Silver's down 11%, completely reversing some of the positions we saw earlier on in the week as we bounce back. Bitcoin's approaching 70. Strategy reports numbers after the close today. Keep an eye on what it has to say later. It's down by 2.5, Bitcoin. The European equity picture looks quite muted at the moment, a sea of calm, you could argue, in what is otherwise a very volatile picture at the moment. Can you, at the moment, are you trading this as a sort of bottom-up earnings story, or is it a top-down kind of strategic story? I think that tension's going to become really clear as we work our way towards the opening bell this morning. Euro Stoxx 50 futures currently down 0.1%. The countdown to the opening trade starts right now.
Good morning, everybody. This is the opening trade, just gone 7 o'clock here in London. Let's start with the tech sell-off. We've got plenty of earnings here in Europe to get to. We'll do that in a moment, but we'll start with the negativity around tech. Another day where software was under pressure. It was big tech, it was small tech, a lot of it being sold off, and rotation into value seemed to be the theme of yesterday's session. But there's no shortage of voices lining up to say, hang on a second, has this sell-off in software gone a little bit crazy? JP Morgan saying this is as if the whole sector has been sentenced before it's been tried. Jensen Huang saying this makes no sense. AI will use software as a service. It's not going to be reinventing it. And Sundar Pichai saying over Alphabet saying that AI is going to be an enabler of SaaS. So suggesting there is some symbiosis between software and AI. Where exactly that falls is really the question the market is asking.
Don't know. That's the problem, isn't it?
That is the problem, and I think what really was in focus yesterday was this spread from the software to the chip makers. For the last few weeks, it's all about software versus the chip makers. The chip makers have held up until yesterday. AMD tumbled double digits. You saw pressure for Nvidia. You've seen a similar picture over in South Korea. The SK Hynix obviously under pressure today, and the South Korean Kospi, I should say, with SK Hynix in the mix. So the chip makers are now under pressure as well. This has spread. I think Alphabet's earnings were really important. We seem to be in a moment where investors are a little bit like Goldilocks and the Three Bears. It's either too hot, the AI story, or too cold. Maybe where it's just right is with Alphabet. And you could make the argument, given what's happened with the cloud business, up 50%, given what's happening. Yes, the CapEx spend, $185 billion, more than the previous 3 years combined, but cloud is working for them, advertising is working for them, they're selling chips, and they're using their chips for Anthropic, they're selling their AI into Apple. Is Anthropic where you want to be in this AI trade?
I mean, Alphabet has had a really special place, hasn't it, in the performance of the markets recently, because Alphabet's been up 25% over the last 3 months, when a lot of the other Mag 7 have been falling over. So interesting to see where this one goes. And to your point, maybe flat performance after hours is a win in this current environment.
The big fear is that we are seeing this rotation out of tech into value. And you've seen that before.
Isn't that a healthy dynamic for the market?
Could be. Happened just before the year 2000 massive sell-off. So that's a fear. That's a worry. Is this a repeat of what we're seeing there? Can the index level maintain the position that it's at if the big tech sell-off continues? That's a problem for US consumer spending, for US consumer confidence. That's a macro theme that starts to work its way through as you see the wealth effect being hit. Kind of all of, there's a ripple that comes out of this. What stays in the software sector does not stay in the software sector for long. Let's talk about where else we're seeing volatility, and that is precious metals once again. So let's talk about dead cats. Dead cats have bounced, and now they are falling once again. And that seems to be the narrative coming out of the silver market. It's a very, rubber cats. And that's what we're seeing right now. Silver had this big retreat. It bounced. There were people that wanted to get back in, the people that thought that it was a trade that they could get back into at a better price, and now it's fallen again. This kind of volatility Does it stay in the precious metals market, or is it we're seeing a series of volatility events? Are they connected?
Well, yeah. We've talked about precious metals a lot and the way that it's traded, and it's really interesting because, yes, it can be a haven, but on days where you see it fall a lot, it doesn't necessarily. It can be also a very risk-off signal, and maybe that is what we're seeing. But the size of the silver move leads some to suggest that this is quite specific. Gold is also in the mix as well, but silver is so outsized. It is in danger of unwinding everything it's done in January, which has been a huge amount.
Can I just because I know you want to talk about oil, let's just talk briefly about Bitcoin as well in the mix. The retail trade in America. The retail trade around the world, how much is it hurting right now? And again, I bring this back to consumer confidence. This has been an area of consumer confidence that has driven consumer confidence. The ability for these markets to go up has had a massive impact. Bitcoin's not doing that again. Strategy's going to report numbers after the bell. Pay attention to that as well.
And the fact that both are down, because there have been a narrative that maybe some of the money in Bitcoin had been moving into gold. Instead, of course, gold is under pressure. It's paired some of the heavier losses. But Bitcoin now down 2% at around 70,000, that level. We haven't seen these kind of numbers for Bitcoin since around November of 2024. You pointed out Michael Saylor and the Treasury effect there and whether or not that will came through in the earnings for that business later. But where is the support for Bitcoin is another factor. And to your point, Anna, oil is under pressure, now down about 2% as well.
Yeah, been a wild ride in 24 hours for that one. A momentum unwind, it seems, on lots of different assets this morning. Let's talk about Shell, shall we, Tom? We've got numbers coming through there. Adjusted profit coming in below estimates, actually, but announcing a share buyback of $3.5 billion. The
share buyback is there, $3.5 billion. There's been some questions over the analysts as to how much they can support the buyback. There's a big focus, of course, in terms of how much they have in the pipeline going forward for Shell. So that's going to be part of the question, certainly, when we speak to the CEO later. But what we're talking about in terms of free cash flow, you're seeing fourth quarter cash flow from operations of around $9.44 billion. That's above the estimates. Dividend per share, that's coming up a little bit on the estimates, 37.2 cents. That's dividend per share. Adjusted earnings, 57 cents. So below the estimates pretty significantly on the adjusted EPS. We've got a print there on debt coming in slightly below than the estimates. But it's the buyback, and to your point, Anna, it's the profit, of course, coming in below the estimates as well. $3.26 billion for Shell.
We'll talk to Maersk in a few minutes' time. Underlying EBITDA, the range for 26, 4.5 to 7. The estimates, 5.76. So basically, big range. They're kind of the estimates right in the middle of it. But this is based on a gradual reopening of the Red Sea. We are going to speak to Vincent Clerc very shortly.
Yes, and Maersk saying they will focus on cost discipline, which takes us to our next story, another company that is focusing on costs. Turning to another earnings story from a different sector, BNP Paribas has reported a beat on fourth quarter profit and raised some mid-term financial targets. France's most valuable lender also disclosed new plans to focus on costs. Cost savings of €600 million in the current year is now the focus. Joining us now, Lars Machenil, the CFO of BNP Paribas. Lars, really nice to speak to you. Thank you so much for joining us this Thursday morning. So, revenues better than expected, net profit the same, loan loss provisions coming in lower than expected, raising midterm targets. All sounds pretty good in terms of those numbers. What is driving the confidence that enables you to upgrade guidance for the second time in just a few months?
Yes, good morning. As you mentioned, the synthesis is we're really strongly delivering on growth. If you look at the bottom line, it grew by 28%, so it's almost $3 billion in profit, a record for fourth quarter. So what's driving this? It's basically the pivot. The first, if you look at our three divisions, the CPBS, which are our networks, we basically reached a pivot. We spoke about this pivot as we are operating in a fixed rate environment. So we said it will take some time before the pickup in rates translate. Now they are translating. That's the pivot. And that pivot is there to stay for several years. And so we really have that strong growth. And then there is the other department, which is called IPS, which is Asset Management Insurance, which is also pivoting, but pivoting in scale. It has bolted on the AXA IM and now is becoming a global asset manager, and the top line is up 40%. So those are the things. So our businesses are delivering as we planned. And then we've also announced that as we come out of a series of integrations, that we have to review the setup end-to-end of our functions. And so that will further upgrade our service and optimize our costs, and all things together lead us to upgrade our 28 targets.
Okay. So interest rates flowing through with a bit of a lag, Lars, and some expansion in some parts of the business, increasing scale. But let me ask you about the cost side and how technology can help you here. We spend all day, every day, it seems, talking about AI now. I noticed that you've got new cost-saving targets. I wonder how much is is going to be driven by employing new AI technologies?
Yeah. We have been bolting on AI, let's say the machine learning aspect has been in, and it's one of the drivers why we operate at positive jaws, right? The thing is, what we will do in the years to come is that we will further step it up, in particular now also the generative part, where we can look at some end-to-end processes that we will optimize. So today, the main impact, the main improvements that we have on AI are in the revenue department. What we now see in the process review that we will launch is that there will also be an impact on cost and cost of risk. Yeah, the underwriting process, by injecting AI, can be further updated. So those are the levers that we anticipate to capture in the years to come.
Lars, how many jobs within BNP Paribas do you think can be done by AI right now? How many jobs going forward? The fear in the market right now is that white-collar jobs are going to disappear. Do you agree with that view?
Listen, if you look at the overall setup, what we have today, and for the numbers you will have to come to our Capital Markets Day next year, but if you look at it, the overall setup will be modified end-to-end. But don't get me wrong, you know our approach, that what it basically means is that we will use natural attrition to get to optimized levels. So yes, maybe the overall staffing requirement will be less. We will get there through natural attrition. But then if we look at the overall economy, those jobs will be redeployed in other activities because the AI will also generate totally new activities. I mean, let's go back. It's what the internet did. It's whatever, all of these things that we've seen, it leads to a change in kind of activities. And that is what we anticipate.
We are seeing huge amounts of volatility in the market, the silver market, the gold market, the rates market, equity markets, tech stocks. Lars, is that a benefit to BNP, or do you worry about that? Is that good for your traders? Is it bad for the business? I'm wondering how you're looking at the volatility that we're starting to see in 2026.
Yeah, well, I take your question along two axes. If I look at the traditional kind of business, yeah, you look at the corporates and the institutionals, for them intrinsically, and we are serving Europe. Europe overall is bouncing back. You see the growth is there, inflation is where it should be, rates are where it should be, Europe is investing. So overall, maybe one country, maybe one sector, but for a bank like us, which is diversified, this is basically very fine. So intrinsically, that uncertainty is overall in Europe delivering growth. But then you look indeed on the activity, which is then more the trading activity related on how people want to hedge and how they want to do. And there is indeed some uncertainty that you see. But that is a bit a generic uncertainty that you typically have. People are thinking in what Forex should I be, what commodity should I be, and these kind of things are an overhang. But this overhang is basically triggering demand because one day it's going in this direction, it's going into another direction. So looking from the stance of what our clients need, be it corporate, be it institutional, be it trading, we see a very positive demand. And so that is why we feel comfortable accompanying that growth and therefore growing ourselves.
Specifically, I was just pushing on that. The trading business is set up well with this volatility then in the quarters ahead.
Listen, with what we see today and the demand that we have, there is an uncertainty. But you know how it goes with uncertainty. Uncertainty drives the demand. If there is too little, there's basically nothing. And there can be occasionally too high volatility. Such a volatility intraday that basically nobody dares to move. The volatility we see today is in that right middle. So from that point of view, it is positive.
You talked about Europe being back in terms of the growth pitch. Is France back as well? Is the relative political stability in France going to be a benefit for your business going forward?
Don't get me wrong. And I have this gimmick of saying we have twice Paris in our name. And yes, we're domiciled in France, but we are basically a European bank, right? 70% of our earnings are Europe. There's only 10% of our pre-tax that is in France. But we see positive things in France. Yeah, there's a positive momentum when we look at household consumption. It's expected to grow. The business climate is rebounding. Moreover, France has a budget. It's going in the right direction. I'll put it in another way. Yeah. If I look at our commercial bank in France, revenues are up by 5% in the fourth quarter. Yeah, just to show you how we read that improvement.
Can I just pick up on that? French PMI is below 50, CPI way below target, consumer confidence is pretty on the floor at the moment, fiscal drag is coming. If you could pick up the phone to Christine Lagarde right now, would you say that France could do with lower rates at the moment?
The thing is, if you look at, I agree when you observe the indicators. However, you should look at the derivatives. Yeah, as I said, the pivot is there. The pivot is what we basically see that is happening at this stage. Should there be a lower interest rate environment? I think the logical numbers, what you see, there is a bit of a trade-off. Is the pickup strong enough or not, or will it be a support? Listen, we'll see this afternoon, but it's not unlikely that this would hint at a slightly lower rate environment.
OK, well, we'll keep that in mind. Lars, just to finish off, going back to the business of BNP specifically, we know, of course, that the case that started in Sudan is being heard by a New York court, and there's an appeal process underway. What is your attitude to taking provisions ahead of a verdict on that?
Listen, the decision on January 8th, basically the court allowed us to appeal. And that will be filed by Monday, February 9. And so we are fully prepared for it and confident in the strength of our arguments. So that's basically where we stand. There is no change. We'll take it now in the months to come.
So no provisions as yet?
Indeed.
OK. Lars, on that note, we will leave it. Great to catch up with you as ever. Thank you very much indeed, Lars Machenil, the BNP Paribas CFO. For the eagle-eyed amongst you, you may have spotted a little graphic appearing at the bottom of the screen that says that BNP's cost savings will be €600. That's a very small number. The actual number is actually 600 million euros, which seems like a more realistic number and one that might actually move the dial.
Yes, sounds a bit more convincing. Coming up on the programme, another day packed with earnings interviews, of course. Shortly, we'll be speaking to these CEOs, the CEOs of Maersk, of Shell, Saab and DNB. So lots to stay with us for. We'll also not lose sight of broader investment strategy and a tech theme. So we're going to be speaking to Shanti Kellerman from 7IM. That's at the Open. Where does she think the software sell-off goes next? And we'll also be talking AI and that software sell-off with Anish Acharya, who is from Andreessen Horowitz. Great conversation to fit in this morning, Thursday, 5th of February. Up next, a look ahead to today's central bank decisions from both the ECB and the Bank of England. If you have questions, please get involved. IB plus BBTV Go. That is the function to use today and every day on the Bloomberg terminal. This is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. The Bank of England makes its next interest rate decision. As inflation rises and the labor market cools, investors will be looking for clues from Governor Andrew Bailey on the pace of rate cuts for the year ahead.
With every cut in bank rates, how much further to go becomes a closer call.
Tune into Bloomberg for live coverage of the BOE decision and press conference. It all starts today at 12:30 p.m. on Bloomberg. Context changes everything.
After nearly 5 years of above-target inflation, it is essential that we maintain our credibility by returning to a disinflationary path and achieving our target in the relatively near future.
Fed Governor Lisa Cook. Important statements. She is so important to the future of the Fed right now. It feels not only on the policy front, but also on the relationship with the White House front. It's going to be very interesting to watch what she says and does over the next few weeks and months. Turning to Europe now, we've got key central bank decisions that we need to watch here as well. The ECB is going to deliver its decision on whether to keep interest rates on hold a little bit later on today. We just heard the CFO of BNP Paribas maybe hinting at the idea that France could do with lower rates. Does Europe need lower rates? Let's find out. Lizzie Burden is in Frankfurt. Lizzie, what do we need to know?
Well, I don't think he's going to get them anytime this year or next. At least that's the expectation among economists and analysts, Guy. The ECB keep rates on hold today at 2%. And that latest growth figure for the fourth quarter giving cover for the Governing Council to stand pat here. If you think back to all of that hawkish hype that we had from the Isabel Schnabel comments and the market reaction to it just a few weeks ago, that has faded now for 3 reasons. First of all, you've seen inflation undershooting the target. Secondly, you've seen euro strength past the $1.20 mark briefly last week, but that, of course, is the level that the Vice President Luis de Guindos said complicates matters for the ECB. Those comments, surprisingly frank comments, last July. And the Bank of France Governor François Villeroy de Gallo actually saying that it is going to be one of the factors that will guide monetary policy. And, of course, the danger being that it damps exports or embeds the inflation undershoot. And then, of course, thirdly, you've got the geopolitics and President Trump renewing the tariff threats on those opposed to his Greenland plans, even if those threats were walked back. But there remains this lingering trade uncertainty that could weigh on consumption and investment in the euro area economy. So all 3 of those things are downside risks. I wouldn't expect Christine Lagarde to be leaning into the hawkish side of things today. I spoke to the Austrian Central Bank Chief Martin Kocher last week. He says they need full optionality to be ready to act when needed. So that is the tone I would expect to hear from President Lagarde today, Tom.
OK, Bloomberg's Lizzie Burden on the ground for us in Frankfurt ahead of the ECB meeting, of course, and that ECB rate decision at 1:15 p.m, followed by ECB President Christine Lagarde at 1:45. And at 12 p.m. UK time, the Bank of England will announce its rate decision with BOE Governor Andrew Bailey speaking at 12:30.
Yeah, I'll be here with that special coverage of the Bank of England rate decision. Now let's talk about the markets in 3 minutes. Joining us live, our Markets Live executive editor, Mark Cudmore. And boy, where to start, Mark? I mean, let's start with the sell-off in tech, shall we? Sell-off in tech, sell-off in software specifically, but also some of the big tech names, a move into value, ending some winding back some momentum trades. What was your take on what we've seen over the last few days?
Yeah, the price action's really been quite remarkable. I think there are a few kind of tangents to get about this. First of all, the price action so far has seemed very much like a rotation in stocks. There's been some really dramatic moves globally. But overall, most risk assets, and there are some notable exceptions, have traded relatively okay. I wonder whether that starts morphing into a bit more broader risk aversion. I think what we might see is the hardware AI names catch down to the software AI names rather than AI software catch back up. So I think it might turn a little bit more negative. Two concerns there. I think, suddenly private markets might come back into focus. We saw a little bit of that yesterday, but that software bit is getting people more scrutiny of what's happening on the private equity side, private credit side, private debt side. So I think people are going to get a little bit more worried there. And the retail names are just getting destroyed between what's happening on precious metals, the big favored tech names, and of course in crypto as well.
Mark, can I connect the dots? I've got a series of big volatility events that are happening at the moment. Metals, as you say, what's happening in the energy complex, what's happening in the software space. Can I connect these events? Do they form a bigger picture at some point, or do they remain isolated?
You might be able to connect them. I'm struggling to. I'm trying to.
Yeah.
I think that obviously there's always some interrelation between price action in markets. I don't think there's one overriding theme. As I said, there's the kind of what's happening in the software space, which is really about the evolution of the AI trade. At the same time, there's the kind of the retail sector momentum stocks that just are momentum trades that just got so kind of overextended, and that kind of led in the precious space. Now, I think both these are probably weighing into what's happening in crypto and stuff. So there's some interrelations, but I don't think there's one overriding theme. I think into next week, this might all evolve into one overriding theme of just a bit of risk aversion, not a bigger panic, but just a bit more of a correction than we've seen more broadly.
Okay, that sounds easily managed. Mark, thank you very much indeed. Mark Cudmore, our executive editor on the Markets Lime team. Coming up, we're going to turn to navigation of a different sort. Maersk CEO Vincent Clerc is going to be joining us to discuss
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Welcome to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Welcome back. We are 30 minutes from the start of the opening trade. Let's check in on futures then after another rough day in terms of the tech story over in the US. That rippled across to Asia as well, particularly over in South Korea. The costs will be down heavily. Today, futures in Europe looking a little bit more stable. Year to date, you're still seeing gains of around 4% for the European benchmark. 50 futures then pointing a little lower by 1/10 of a percent. FTSE 100 futures pointing lower by 19 points, down 0.2. We keep an eye on oil, of course, under pressure in the session, as are the precious metals. Nasdaq 100 futures, though, seemingly turning around again after a lot of selling yesterday, kind of pointing up by 0.3%.
Yeah, another day where the overall market moves perhaps don't do justice to the news flow. That's the thing with rotations, I suppose. Let's have a look at the bond markets, and we are seeing yields a little bit higher across these European bond markets. Yes, we haven't got gilt markets open yet. We will certainly tune in for those, or tune our antennae into those in around half an hour's time, of course, given the political movements around Peter Mandelson and all the impact that he's having on the UK political landscape. A lot of drama yesterday, and we saw some of that playing out in gilt markets. We were up by 6 basis points at the long end of the gilt curve yesterday on, should we say, it's not expectations of a change at the top for the leadership in the UK, but there is that theme rumbling about in markets, and so we'll certainly keep an eye on how that develops.
OK, let's talk about navigation and figure out exactly what is happening on that front. Maersk out with numbers this morning. The full-year EBIT number looks pretty much in line. The Q4 numbers, there's areas of weakness, there's areas of strength. But what really stands out is the guidance going into 2026. So Maersk sees 2026 underlying EBITDA, 4.5 billion to 7 billion. That's a dollar number, I think. And it's got a 2026 underlying EBIT loss of 1.5 billion to a profit of 1 billion. Those are really big ranges. Let's talk about navigation with the company's CEO, Vincent Clerc. He joins us now. Vincent, those are really big ranges. Why are they so big?
I think the reason why the ranges have to be so big when you look at 2026 is still the big amount of uncertainty that there is around a couple of key fronts. And it all revolves around shipping rates, so the prices that we will be able to take. After a few years following COVID of bumper profits and historically high freight rates, we're seeing a normalization now, with big investments in tonnage coming online ahead of supply, and as you mentioned, the Bab el-Mandab Strait reopening, and we expect more and more services to go through the Red Sea again, which will free further capacity, and we expect will create a pricing environment that will be under pressure for the shipping division. So that and the uncertainty that there is around the timing of how this is going to play out means a pretty large range, as you said. The rest of the business, though, continues to progress. Underlying demand for the services that we provide, whether it is in shipping, in terminal, or in logistics, remains strong. There's good opportunities for growth. There's good opportunities also for further margin progression. The one thing that is a big question mark is the freight rate environment, the pricing environment in the shipping. OK. And that's going to be determined by, amongst other things, the Red Sea, as you say. What's your level of confidence that the Red Sea is going to continue to reopen? We've got Iran-US talks taking place over the next few days. Huge amounts of tension in the region. We've got a carrier group from the US that's just arrived. What is your level of confidence that that Red Sea story is going to evolve kind of as anticipated right now? Yeah, so I think let me start with the situation in Gaza, which clearly is making progress. We've seen the reopening of Rafah, and we seem to be moving into the next phase of the reconstruction there. So clearly the temperature has come down, and there has not been any attack for quite a few months now. That's why we have re-announced, after a few trials and a few ships sailing through the Bab el-Mandab Strait, we have announced that we are going to have services now returning permanently through normal sailing routes The first two with a date on them, the next two have been singled out, and the dates will be communicated shortly. So that will actually put a significant amount of our deployment back through the normal sailing routes. And we do this because we actually believe that the direction of travel, first of all, today is safe. And second, we believe that the chances that this will continue to move in that direction are much higher than the opposite. Now, as you rightfully point out, there is also a new situation playing out between the US and Iran, which we are following very closely. And we're going to act very prudently. If this was to evolve in a negative way, we can undo some of the decisions we have made so far. But overall, after a few years of absence from the Red Sea and sailing through the Suez Canal, we believe that the time has come now. The conditions are in place for a return.
Okay, the conditions are in place. Good morning, Vincent. You touched on the supply-demand dynamics, more tonnage coming on. Can you give us more details into how you see that story evolving? How much more tonnage and what does that do? You talked about the uncertainty around pricing. When do freight prices start to find a floor?
Yeah, so we've seen them erode actually over the past 2 quarters, and that has been one of the key features in, if you look at the year, for why the first part of the year has been actually much stronger than the second part, and we're obviously headed into a 2026 with that background. Even though market demand and global trade, despite talks of trade war and so on, has shown incredible resilience, with markets growing 4 to 5% during last year and continue to expect to grow 2 to 4% in the coming year. We're seeing capacity coming online at the clip of 5 to 6% during 2025 and another 4 to 5% in 2026. And if the transition back to the Red Sea happens, you will see another 4 to 5% being released. So you will get a significant overcapacity, which we expect will put temporary pressure on the freight rate. Shipping is a cyclical business. After very strong up cycles, you have to get through a few adjustments, and I think this is what is going to play out, or what we expect in our guidance to play out already in 2026.
Does that significant overcapacity lead to consolidation in the sector?
I think the first thing that is going to lead to is more discipline when it comes to capacity management. No ship has been scrapped for the past few years because of the incredibly high prices that we could get. It made sense to sell everything. As a consequence, a lot of the fleet is old today, needs scrapping. So I think there is a lot of that needs to happen. We can also invest more into cost efficiencies through deployment of slow steaming and so on. And we might see a bit of consolidation, although I don't think that it is immediately in the cards because of the strong balance sheet that most of the carriers are heading into this down cycle.
Vincent, good morning. Let me ask you more about that cost-cutting measure, or those self-help measures that you can put in place. What is it that you can try to do to insulate Maersk from this volatility? We've seen that you've talked about cost-cutting and job cuts.
Yeah, so we've done a few things already. So we feel we're very prepared to whatever is going to come at us. The implementation of a new network during 2025 has meant that we can generate cost savings close to $1 billion a year on the shipping network that we're deploying today, because of the increased asset intensity we can generate and the increased also quality of service that we can provide to our customers. We're going to continue to work on this. There is more work that can be done. The other thing that we do always is a very, very sharp focus on productivity, deployment of new technology here under also some of AI, which means that we can accelerate some of the productivity gain we've been on path to do already for the past few years, and that continues to be a focus also in there. So I think we have quite a lot of opportunities still on the cost to do more, but we also get into this down cycle in very strong shape, and with other businesses in logistics and in terminal that have been extremely strong and will continue to provide very strong financial cushion as we head into this down cycle on shipping.
Yes, let me ask you about that land-based business, Vincent, because we've spoken to you about that in the past, and we spoke to your predecessor. Over years, we've spoken to Maersk leadership about the build-up in the land-based side of the business. So how big can that become, and how much of an asset will it be at this time of volatility on the sea?
Well, I think that the logistics market in general is a $2 trillion business if you look at the world. So there is a lot of potential when your base is 15 billion. Some of it can be achieved organically. Some of it might be achieved inorganically. I think the rejigging of the supply chain that you're seeing now as a consequence of the weaponization of trade, some of the trade wars that we're seeing, and countries becoming more worried about their supply chain, it just underlines the importance that there is for us to play a role with our customers, and not having just one product that we're dependent on, but having a broader palette of products that we can actually sell to our customers. So I think it's something that has a lot of potential that we can continue to work on for many years to come. And we can see already in the results of 2025 how much this is contributing to stabilizing actually the performance, together with also our terminal business, when the shipping goes into down cycles, which is likely to continue to happen in the decades to come.
Vincent, great to catch up. Always a pleasure. Great to get your views on what is happening out there. Vincent Clerc, the Maersk CEO. OK, let's get back to the other big story that we're watching this morning outside of European earnings, and that's the tech sell-off that we've been watching. Alphabet, though, having none of it, doubling down on its AI spend.
Revenue from AI solutions built by our partners increased nearly 300% year over year. And commitments from our top 15 software partners grew more than 16x year over year.
He's not backing down, certainly not. We're going to check on what impact the
tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the US, or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back. Let's get back to the earnings conversation with a focus on big oil. This is Shell. Profit missing. There is price pressure, of course, in terms of what's been happening with oil generally over the quarter. The trading business as well, not punching higher than maybe some had hoped for. The chemicals business arguably under a bit of pressure as well. So net income coming in at $3.26 billion, down 11% from a year earlier. Let's bring in the CEO of that business right now, Wael Sawan. Wael, good morning. Thank you for your time. I can ask you about oil prices, though those are pretty difficult to predict in the current environment. Let me start on the trading business then. When does that start to turn around? Is that a 2026 story?
I'd say we've had a strong 2025 trading overall. The fourth quarter typically is softer when it comes to both products and crude trading. But we've had, by and large, another strong trading year. And I would say at the end of the day, our ability to be able to create value through trading depends on, of course, macro conditions, depends on fundamentals. It is one of the strongest differentiations in Shell, I think, compared to our peers, and one that we continue to see a lot of running room. But beyond trading, I would say this was also a very strong operational year for us overall. If you look at the entire year, we delivered $43 billion of CFFO in what was a $10 drop compared to 2024 in oil price. And we've been able to really do what we had promised to do, take out costs, $5 billion plus of structural cost reductions, continue to be disciplined in capital spend and high grade our portfolio. So overall, a very good year.
Do you share the view that this is an oversupplied market and that dynamic continues this year?
We see that there is indeed a bit of oversupply at the moment, but that I would say is balanced with the significant uncertainty that we are seeing because of the geopolitical challenges, whether it is earlier in the year Venezuela, more so now Iran, the instability with the Russia-Ukraine crisis that continues to play out, and so on and so forth. So there is a premium with that uncertainty and volatility. At the end of the day, the one thing we do know is we have no clue where oil prices are going to go. So we really focus on our fundamentals, on the cost structures, on how we allocate capital, on how we continue to build that performance muscle. Because the last 3 years has been all about creating that performance culture. Now we need to step it up a gear and make sure that we take it to the next level of excellence.
Good morning to you, Wael. And as a result of all of that, you plan to return cash to shareholders. You're announcing $3.5 billion in a buyback today. How should we think about your strategy around buybacks? Because might you be challenged in getting to your return to shareholders targets for 2030? And if you are challenged, would that be because of weaker oil prices or because you want to do other things with the money? Maybe there's more focus on portfolio exploration.
Yeah, great question. I'd say we start off by not being dogmatic on where our capital goes. We really want to unlock maximum value for our shareholders. And what we see at the moment is that from a distributions perspective, we are preferentially allocating capital to buybacks because we still see a very attractive buyback in Shell. Our free cash flow yield continues to be very attractive. We see a great runway. We have a line of sight to 10% free cash flow per share growth every year between now and 2030. So being able to buy back Shell, in my mind, is a very, very good investment. To give you a sense, over the last 4 years or so, we've bought back a quarter of the company at an average price that's around 20% lower than where we are today. That doesn't mean that we don't continue to look at opportunities to be able to also invest, and that's what we did last year. $2 billion of our capital budget went into M&A, into what we would call bolt-ons in our deep water space, that contributes to our production growth in 2030 and beyond. So this is a very, very focused allocation of capital in pursuit of long-term shareholder value.
Wael, can you tell me about the conversations you have with your shareholders about gearing? Is the focus on, because for years the conversation was about keeping gearing under control for you and others in the sector. Has it pivoted? Has it changed to thinking more about portfolio longevity and investment in exploration and production? Or is it still about debt and control of debt?
I'd say it's a very balanced set of discussion. So, of course, when our net debt is where it is today, so just north of 20%, if you exclude leases, it's actually below 9%. That's a very strong balance sheet. And we like that strength, in particular, as you go into an uncertain macro in the coming years. At the same time, we're having good discussions around distributions, as I've just mentioned, and the balance of capital spend. But that capital spend has to be in pursuit of value accretive opportunities at the right points in the cycle. So I don't sense at all in my discussions with the investors that there is an anchoring on one of these three, but it's a balanced financial framework that allows us to be able to, over the long term, create value.
Well, good morning, it's Guy. Just following up on Anna's question.
Morning,
Guy. Is the reserve life of the portfolio long enough? Do you need to improve it? You're at the bottom of the pile when it comes to that metric on which oil companies are increasingly being judged. Do you need to fix that, and how do you fix it?
Yeah, I'd start by saying when we look at the growth, and just in Capital Markets Day 2025 a few months ago, we outlined actually very transparently exactly what our production profile was between now and 2035. And so I'd make 3 points around growth. I think firstly, we had identified that we needed to fill some of the gap up to 2030. And I'm pleased to say already in 2025, through some of the acquisitions we've made, plus improvement in productivity of our existing reservoirs, we have largely filled the production gap to 2030. That buys us significant time to be able to fill the gap to 2035. I'd say secondly, we had also talked about delivering 1 million barrels per day of new production between now and 2030. And this, by end of 2025, we had already delivered a quarter of that. And thirdly and finally, I think what is different about the Shell investment thesis, and this is what I very transparently talk to our investors about, is we are not just a liquids production company. If you look at our projections to 2040, we will grow our integrated gas and marketing free cash flow significantly between now and then, going from around $20 billion last year to close to $25 billion of CFFO by 2040. And that is what underpins the cash flow growth for us as a company.
Okay, kind of a little bit of a kind of follow-up, but a bit of a tangent. On that line, when are we going to start to see Shell producing in Venezuelan waters?
I hope soon. You know, we have been working previously under OFAC licenses, so a U.S. sanctions permit, to be able to look at developing offshore gas resources that potentially would be linked back into Trinidad and Tobago, into an existing LNG facility that has capacity to take that gas. We are awaiting at the moment those OFAC licenses from the US government. And within a relatively short time, we believe that we could potentially get to a final investment decision and production a couple of years after that. So I am hoping within the next 3 years, we can see some of that flow. It'll be good for the Venezuelan people. It'll be great for the Trinidadians. And I think it's very much in line with the policy of what the US is trying to do. So on balance, we think we can play an important role in that space.
Well, before we let you go, the 1.5-degree Paris target is almost certainly going to be missed. Do you accept that the oil and gas industry bears responsibility for that failure?
Look, I start with the fact that to be able to achieve the Paris target that the nations of the world signed up to, it was fully recognized that we need governments, we need consumers, and importantly, we need companies to be able to play their role. We are focused on the role that we can play. So we just announced today, for example, that we are already 75% of our way towards our target of reducing our own emissions by 50%. We have made investments, and we committed to make investments between $10 to $15 billion in low carbon opportunities, and we have reached that target. Our focus now is to make sure we can deliver a return on some $20 billion of capital that we have in that space. That is the objective that we have to be focused on. But that should not detract, I think, people's energy around it. We just need to continue to double down on creating opportunities that make it investable and scalable. And we see scope in multiple countries to be able to do that.
Wael, thank you very much. Thanks for your time. The Shell CEO, Wael Sawan, thank you so much for joining us. 7:53 here in London. 7 minutes until we get the opening of these European cash equity markets. Let's get to Jennifer Creary. She's got a preview of what could be on the move. Jen.
Good morning. We've got a lot of earnings to get through, and we start with Maersk this morning. The Danish shipping company reporting fourth quarter earnings and forecasting a drop in underlying EBITDA going forward. In 2025, that number stood at $9 billion. It's forecasting a drop to as much as $7 billion as well, and that's because of worsening freight rates, but also the reopening of the Red Sea channel that could upset the balance between supply and demand of shipping containers. Next up, we've got Shell. We just had the CEO on just a moment ago. Shell reporting results that disappointed analysts, reported adjusted fourth quarter net income that fell 11% versus a year ago. ago. If you look at Shell's share price compared to BP, they're tracking fairly in line with each other. And we have an analyst saying that going forward, investors will be looking for signs of portfolio longevity. Finally, we're going to flip over to European tech. We saw a sell-off during US hours that bled into Asia hours, and that could whip around the world to Europe as well. ASML, Infineon, and also some other tech shares as well. They could have a knock-on impact from that sell-off that we saw in other parts of the world going forward.
OK, Jennifer, thank you very much. Jennifer Creary there. We will also keep an eye with London in mind on anything to do with the metals, with silver dropping quite so much, Fresnillo certainly in focus. Saab, we're going to speak to them. That share price could be volatile at the start of trade.
It's really hard to know whether you judge today on a kind of bottom-up corporate earnings point of view or whether it's that kind of top-down macro volatility which is going to drive markets. Europe may end up netting both of those two stories out. Anyway, that's the futures picture. This is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Thursday morning. A couple of minutes to go until the start of cash equity trading here in Europe. What is it going to deliver, I think, is a really interesting question. Single stock's going to be super important. What's the top-down tech story going to be feeding in to this market looking like as well? What's going to be the metal story? This is what the S&P looked like yesterday. We were down by around 0.5%. What is interesting is the equal weight actually was a big outperformer yesterday on the S&P, i.e. the rest of the market outside of tech did really well. The Nasdaq got battered yesterday, down by 1.5%. What impact is that going to have into Europe this morning? Let's see what futures look like.
Yeah, at the benchmark level, to your point, Guy, you've seen resilience across European stocks. Today, futures pointing a little lower by 0.2%. We focus on the earnings story. We focus on the Shells of the world, the Maersks, with concerns for both of those companies. BNP Paribas in the banking space coming through the beat. The FTSE 100 with that focus on miners and silver and gold, but also oil, currently pointing lower by 0.4%. NASDAQ 100 futures then, after the big losses of yesterday, currently pointing to a little bit of a revival, but not anywhere close to making up for those losses, pointing higher by 0.2%. If you put money in the NASDAQ 100 year-to-date versus European stocks, you'd be down 5% or up 5% on European versus NASDAQ 100. Anna, what are you looking at on a stocks level?
Yeah, let's have a look at some of those. I'll start from the bottom of this list. Let's go with defence, because we've had numbers out from Saab. There's record order bookings in 2025. They're upgrading guidance, and the numbers came in above estimate. But some of the expectation is that this share price will drop at the open. So we'll dive into the detail there. We'll be talking to the company a little bit later on. Miners will certainly be in focus. We've seen spot silver down by down by 17% at one point, down by 9% now. Platinum also weaker. Oil prices have been on a wild ride over the past 24 hours, so we'll watch energy and miners. We'll also keep an eye on tech as a result of all of that tech selling that we saw yesterday. Will we see the likes of Relics and the advertising businesses once again in the AI focus, Guy?
Equal and opposite forces. Let's talk about that. Is the bottom-up story going to counterweight the top-down story, the macro story, the tech story versus what we're seeing in terms of earnings? This is what the open looks like this morning. So the FTSE 100 is going nowhere in a hurry. Down a little bit. There's going to be some stories around what's happening in the mining space today. There's going to be an oil story around Shell. The stock 600 is barely budging. We're down by 0.1%. Opposite and equal forces. Are they counteracting each other today? Are we seeing actually as a result lower volatility? It's really interesting to see what the single stock story development is going to be today. The CAC is up in positive territory. What's happening in the banking space? You've got BNP out there. The IBEX is down by 0.6%. Net, it comes to a very stable 600, but within the indexes across Europe, within the sectors across Europe, within the single stock story across Europe, there's quite a lot of volatility working its way through these markets. Tom, let's kind of peel the onion a different way. Sectors, what are they looking like?
Yeah, on your sectors so far, interestingly, it's tech on the upside, up 1.2%. There's an argument you can make that ASML and others, in terms of the supply, will get a lift given the spending plans for Alphabet, 185 billion potentially by the end of this year. On the downside, basic resources, not a big surprise there, given the pressure that we've seen, as you said, around copper, gold, and most significantly in the session today, silver. So that sector down 2%. Banks also under pressure, 0.6%. On banks, it's worth noting, I think, Anna, HSBC, the redhead crossing the terminal right now, that HSBC will cull some underperformers. Cull is an unpleasant word, isn't it? Will be culling some underperformers as some bankers face zero bonuses.
Yes. Indeed. So no surprise, as you say, that basic resources, the worst performing sector. We do seem to be seeing, as you've alluded to, Tom, a bit of a bounce back in technology, and that's taking along with it some of the AI losers that we've seen over recent days. So media is also a bit stronger. So WPP and Publicis are both up by 2-3%. We see some of the names like Relics, Experian, LSEG, all three of those up by more than 2%. And this is not in any sense unwinding the losses of the last couple of days, but it does look different to the last couple of days.
SAP's up 1.5%. You're seeing some of the tech stocks in Germany doing okay. Infineon's up by 0.9%, had numbers out yesterday. So yeah, maybe there is the sign of stability. Is it derived from maybe that strong story that comes out of Alphabet? It's going to spend a huge amount of money. Yeah. Does that calm nerves? That actually maybe even just the hardware story is a little bit more positive, and therefore you can maybe calm off your nerves in the software space as well. I don't know, but maybe we are getting to the point at which some of these stocks are
is very positive. He's seeing it working for advertising. He's seeing it working for cloud. He's seeing it working for demand for Gemini. 750 million users, and that was just from December, so that number would have gone up as well in terms of the Gemini product. So yes, there's going to be some nuance here. Not every software company is going to fold in the face of AI. Some will be empowered. That is the view, at least for some.
Yeah, and that's what the line out of Alphabet yesterday. Yeah. They were giving that line. Jensen Huang kind of giving that line, pointing to some symbiosis between the two. And the market has not been trading on a symbiotic relationship between software and AI over the last couple of days.
I tell you what's getting crushed is AP Møller Maersk. The stock is down nearly 8%. It is down 8%, 7.7, 8%, down 8% this morning. Just they don't know. Vincent was quite clear about it. The huge range in terms of what they're operating with at the moment. If the Red Sea continues to open, freight rates are coming down. But they have a real lack of clarity in terms of what that story is going to look like. Geopolitics is going to interfere hugely. And in that kind of situation, do you just do you sell the stock?
Yes.
Is that the easiest kind of route if you have that kind of uncertainty?
Right, yeah, huge amount of uncertainty. So that's weighing on that stock. Political uncertainty is affecting the gilt market. Let's go there. The UK 210 yield curve has steepened to the most since 2018. And we are seeing yields at the 10-year horizon going up in the UK, up by 3 basis points. And in fact, that extends across the longer part of the curve, 30s and 40s as well. We see those yields going higher. And all of this very much attached to questions around Keir Starmer's leadership and his judgment, which we will continue to monitor.
Well, this relates to the Peter Mandelson situation.
Yes.
You've got to assume that if Starmer goes, does Reeves go? Do they come as a package? I think
that's been the assumption from the lobby journalists.
But I think it's also interesting detail in our colleagues' reporting of this story. The 3 names that are often mentioned as possibly wanting to take over, are they going to be well positioned after this story? Not necessarily. Wes Streeting, big Mandelson ally. Rayner still dealing with the issues surrounding her housing declarations and taxes paid on there. So there's not necessarily the sense that all those who've been waiting in the wings, and Ed Miliband was the other one they mentioned, but he's been very supportive of Starmer. So there isn't necessarily a sense that there's a coalition around another character.
No.
I mean, of course, Andy Burnham couldn't get into Parliament.
But the feeling is that if it's not now, it will be soon that Starmer will go. The May elections are coming up fairly shortly. If Labour does not do well, then there will be a growing sense. And they do seem to come as a package. So you've got to assume that the Chancellor will be changed as well. And therefore, you end up with a potentially different sort of outlook in terms of what you could be expecting in the UK.
Bottom line for the markets is you're pricing in more risk premium.
Precisely.
You've been bouncing around 440 on the 10-year, and now we're above 450, and pretty significantly so. So that starts to be locked in again in terms of the risk premium for UK assets.
Risk of more borrowing, at least. Let's get another view on UK assets and what's driving them. Shanti Kellerman joins us, Co-Chief Investment Officer at 7 Investment Management. Really nice to have you with us, Shanti. So the politics will do what the politics is doing. It creates uncertainty. It creates nervousness in gilt markets that maybe we will see more borrowing if we saw a change of leadership, perhaps, or maybe even just to placate that part of the Labour Party. How are you viewing the UK political story as it pertains to markets and what it does to gilts, to sterling?
So I think the market actually quite likes Rachel Reeves. Like, you look in the press loves to hate her, but the few times where we've had sort of wobbles about her leaving, we've actually had quite strong reactions with gilts going up. So there is that stability angle. I think the other part we have in the UK is inflation hasn't been coming down quite as quickly as some other markets. December was a bit of a higher reading. So, you have the Bank of England potentially more on hold. And probably one of the bigger risks for UK investors is rates stay up and sterling stays strong. And that makes it difficult, to get your equity market returns like we saw last year with the dollar weakening. So it's definitely something we keep an eye on. I think it's hard to see, gilts going to 5.5%, 6%. So there's kind of limited downside there in the gilt market for investors.
OK, let's turn to some of the other areas of volatility in these markets. And one of those certainly is around software stocks being sold off and all that we've seen in technology. Are you ready to ditch all software stocks, Shanti? Is this the end of software and AI is just going to do everything?
No, but I think so. What we've seen in some of the big tech companies, we've started to see lots of layoffs. And they recognize that software is getting cheaper to develop because of all these tools. I think you'll probably see some of that start to filter down to those software companies. We're realizing they actually probably need reduced workforces. I think for companies that have very complex needs, regulatory needs, financial services companies, there is going to be a place for those software systems to do those complex things that we need that aren't simple. So probably we've had kind of indiscriminate sell-off. I think we'll probably see people picking through the wreckage, and some stuff will come back up. Other things will stay down. So it's the start of the losers from AI to some extent, which we all said we knew were coming, but then somehow we're surprised when it happens.
So it's been indiscriminate. Where are there are opportunities in software now then, given that the indiscriminate nature of the sell-off that we've seen over the last few days?
I think where the market will be is businesses that are really able to align their software offerings to tailor them to customer needs, and particularly in those more complex sectors where you can't, it's too risky to have the AI where it is at this stage go, for example, produce a customer valuation in financial services. We probably can't rely on that being accurate, and you need those, or do the tax stuff. So I think you'll see that, and also healthcare stuff where there's a lot of regulations around it. You'll see the software companies that can do those really detailed things will still have good markets, and they should be able to reduce their costs. It's going to be cheaper for them to develop and maintain their offering.
At a higher level, do you expect the rotation from growth into value to continue?
Yeah, I think we've seen that this year, and I think we don't see it as like a big plummet in tech stocks. We see it more as the rest catching up in terms of earnings. And I think we've kind of seen that with earnings season. The big Mag 7 has been, some up, some down. I think it's a bit of a fallacy to look at those like one unified group of companies because they have such different business models. And then we're starting to see, other, places like small caps do a bit better. We all know we're on like 23 times earnings in the U.S. Growth is going to come from earnings growth, not multiple expansion. So it makes sense that if we're not seeing, huge beats in earnings, we won't see huge outperformance.
The problem is, though, that if tech comes down, is the rest of the market going to be big enough in its upswing to keep the index level static?
I don't think you're going to see tech have a big fall. I think it will be, up slightly this year, probably not a 20-30%, but I think
So the indexes can go higher?
I absolutely think so, yeah. I think this is going to be another good year for equity markets.
OK. And am I going to do better in Europe or in the United States? Is the tech story going to keep me out of the United States? Is that where I want to kind of... If I'm not seeing outperformance from tech, do I want to be there?
Yeah. So I think our markets we prefer, I think, UK, Europe and Japan, I would think will outperform the US this year. Those are some of the areas where we have more in our exposure. Relative to that market.
Are you hedging that position? Are you taking more defensive positions elsewhere? Does it feel like the risk is growing? You think equity markets are going to do well this year, but the probability's got to be getting harder and sort of tougher and tougher to make those kinds of numbers.
It is, but I think we will have drawdowns. So right. and a lot of it...
It's going to be bumpy.
Yeah, and we had, S&P down 0.5% yesterday. So, was that what it was? So, let's have a bit of perspective.
Nasdaq was down 1.5%.
Well, Nasdaq was 1.5%. So there is that element of we forget what it's like to wake up and have those days where the market's down and see those valuations. We will have, I fully expect we'll have drawdowns this year, but it doesn't mean, we do most years in markets.
Yeah. And are you expecting that the interest rate environment stays supportive, either where it is or reduced rates from here?
I think we'll have some slight rate reductions. I think most of it's priced in, and it's probably not going to have...
So it's a bit of a side story for 2026. Mostly it's fiscal, and it's the tech story, broadening.
Yeah, it's hard to see. It's hard to see getting big compression in spreads for corporates. Maybe we get a little bit of an uplift in government bonds. Probably EM debt is probably a bright spot, and high yield, you're still earning a very good clip on that coupon, and the default estimates are pretty reasonable in that space.
OK. Shanti, thank you very much indeed. Shanti Kellerman, co-CIO of 7 Investment Management. Guy, you're going to have a look at your...
So let's have a look at what is happening in European equities this morning. We're going to start with the single stock story. We'll kind of work our way from there. You've got defence stocks actually under quite a lot of pressure. We're about to talk to Saab, so it'll be interesting to get its take on what we're seeing here. Chip stocks are actually doing well. ASML is up on a big spending story coming out of Alphabet overnight. That feeds through as well into Schneider, which provides obviously kit for the data centre build out. Elsewhere, Novo is soft after its big drop. No bounce back there, which I think is interesting. Lilly did really well yesterday in terms of its statements versus what we heard from Novo, which does slightly make me wonder whether or not Novo's there is this idea that Novo is kitchen sinking its numbers a little bit here, maybe, because Lilly's numbers certainly look very different in terms of what it sees in terms of its outlook. Anyway, that's the picture. Novo not bouncing back this morning. Jennifer Creary is here with more. What do you got?
Good morning. We're looking at Maersk, starting with Maersk, really slumping this morning, slumping 7%. That's after the company reported fourth quarter results, but also lower underlying EBITDA in 2026 guidance versus EBITDA in 2025. And that's really weighing on shares this morning. Next up, we've also got Volvo. Volvo's fourth quarter results missed estimates, and that's really weighing on shares as well, down 18% this morning. The company blamed weakness, particularly in North America, but also because of volatile freight rates and also concerns over tariffs as well. Next up, we're flipping over to Nordic Semiconductor's fourth quarter results actually beat estimates, up 13%. Investors really boosted by those results, shaking off some of those concerns over the longevity of AI spend and also tech valuations going forward. Finally, we're ending on BNP, the French lender, reporting fourth quarter results also that beat estimates. Those shares are up 3.5% as a result. It also raised its 2028 profitability guidance, and that's really boosting confidence this morning. Back to you.
Jennifer Krug, thank you very much indeed on some of the individual names on the move. We'll get more on the defence space as well, because Saab is coming up, posting record fourth quarter order bookings. We're going to have an exclusive interview with the Swedish defence giant's CEO. A lot to talk about there, with the defence spend coming through, of course, from Germany. The continued
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up to the minute global news whenever and wherever it happens. I'm Anne-Marie Hodern in Davos, Switzerland, and this is Bloomberg.
Welcome back. This is the opening trade. 17 minutes into our session, and overall, the overall number for the Stoxx 600 tells no story whatsoever. But there's plenty to talk about. We see the French market really outperforming this morning. We're up by 0.5% there. The DAX pretty flat. The FTSE 100 underperforms. Weakness in basic resources, not a surprise there. The tech sector bouncing back pretty strongly today. As a result, the AEX is up by 0.5%.
Let's talk about what's happening in the defence space this morning. Saab, the Swedish defence company, maker of the Gripen fighter jets, amongst other things, reporting fourth quarter operating profits this morning. That beat the street's estimates. We've got record bookings coming through. The Swedish aerospace company also raising its medium-term organic sales growth target. We've seen that upgraded. This is 23 to 27 to 22% from 18%. Michael Johansson is the CEO of the company and joins us now. Good morning, Michael. You've raised your outlook. You've delivered quite good numbers this time round. I say quite good. They're strong numbers, and you've raised your outlook. In terms of that outlook raise, what are you assuming in terms of the current orders that you are going to see in that number? Is the risk actually that number could be higher?
Well, it's three components to it, I would say. I mean, obviously, we have generated growth now. The first 3 years of the 5-year plan averaged 24%. And now we have a great order backlog of 275 billion Swedish almost. And of course, that gives us confidence in generating 22% over the 5-year period, but in average 20% the last 2 years, 26 and 27. So that is sort of components in why we are raising it, the backlog as such. But still, high intensity in the market, a combination of good sort of growth on the product side, but also now success stories on the platform side. I'd like to say that the platform decisions on the contracts that we have, campaigns that we have, of course, quite political. So even though we have great offers, that is still political decisions and hard to say exactly when they come into play. But we see a good market trend. So all in all, great backlog, good market trend drives our growth.
We're really watching Canada and trying to figure out what's going to happen in Canada with the Gripen jet and whether or not we are going to see some success for you there. Can you see yourself building the Gripen in Canada?
Absolutely. I mean, we are, if they decide to go dual fleet in Canada, we are prepared to do tech transfer to Canada the way we've done it and even more, like we've done it in Brazil. And there are great industries that we can work with in Canada. So, of course, we can create a hub in Canada, but it's up to Canada to decide whether they want to go that way and create more sovereign capability in the aerospace sector. But we're giving the information that they ask for, and then it's up to them to actually take a decision on that going forward. But we could, absolutely.
So just pushing on that point, in your conversations with the Canadians, and good morning, Michael, it's Tom, are you hearing from them? Do you get any sense that they are moving towards that mixed fleet with the F-35s and the Gripens?
I wouldn't say I can sort of judge I guess it's a very high-level political decision on the Prime Minister level. Of course, lots of discussions are going on in there. Stakeholders with the stakeholders locally. What we do is, of course, have discussions on what do they need in terms of information to make the proper decision. And that we provide continuously. So there are discussions, but it's on that level. I can't judge which way it will go, honestly.
And you produce about 20 Gripens a year? Can you ramp that up? What are the challenges to ramping up that production?
No, we could. I mean, absolutely. We're ramping up in Sweden as we speak, since we have then 3 contracts to work with. I mean, Sweden, Brazil, and Colombia. And then, of course, we have a Brazilian entity that we can ramp up a bit further. And then if we get Canada to do dual fleet, we will have another hub. And that's good because we also hopefully will get into more of a contracted discussions on Ukraine, where an LOI was signed between Sweden and Ukraine in November. So we need to ramp up. We can do it, obviously, absolutely.
Good morning to you, Michael. Can I ask you about another side of your business on the surveillance side and GlobalEye? Can you talk to us about, you've won a contract in France. Can you talk to us about the potential for other customers? Who are you talking to?
No, I think it's a great potential pipeline of interested customers for the GlobalEye. And right now, it was a great win and a great collaboration will now take place with France and Sweden on that side. And I think what is imminent is, of course, to see whether there is a need for a common NATO capability, which we call the IFSC. And that is being now assessed by the acquisition authority within NATO, what to do now when E7 didn't sort of provide the right schedule and capability going forward. So we have, of course, offered our GlobalEye to NATO to see if that can come into play. That's a big potential great thing that can happen, but I can't judge exactly when and if it will happen. But that's an example of an interesting customer. Then we have the Nordic perspective, of course. How do we combine Sweden, Denmark, Finland in terms of airborne early warning capabilities? And there are, of course, other countries as well, also in the Middle East, that's looking into this capability. And we have it in operation in UAE, as you know.
Michael, we were just showing an incredible chart showing your surge in orders, which maybe we'll put up again. And it's not hard to think of the reasons why we've seen that surge in orders from what we've seen in Ukraine over recent years to Germany ramping up its spending, President Trump calling on NATO members to do more and to spend more themselves. I wonder if conversations have shifted at all around what we saw from the Trump administration around Greenland. What's the response been, the conversations that you've been having with those who buy defence kits around that kind of drama that we saw play out in January?
I wouldn't say I see any connections to what we're doing in the European perspective to that right now. I think it's already been sort of concluded that we have a great sort of journey to do in Europe to actually increase our deterrence and defense capabilities, and every country is spending more money according with the NATO alliance commitment and what have you. And we'd started on a low level. So it's more that Europe has to take a bigger responsibility. Many countries have to spend more money on defense capabilities, and we have gaps. And it's right that Europe has to take a bigger responsibility and take care of the threat to the east. So that's what we're working with. I can't say that sort of the discussions that are going on related to control and capability at Greenland is affecting this. But I, of course, would think, can I say that the NATO alliance can do more in Greenland, and we would be prepared to, within the alliance, to provide capabilities in that sense.
Michael, just looking forward to what happens next on the fighter jet front. Everybody's trying to figure out what capability Europe is going to need and get. Got two kind of big competing consortiums in terms of providing that next fighter jet. The FCAS program, though, is the one that a lot of questions are being asked about. That is the consortium between Dassault and Airbus. Have you had can you just update us on what your current thinking on that is? Do you see that program going ahead? Have you had any conversations with Guillaume Faury over at Airbus on the Germany side recently? Do you see a better combination maybe to produce the next generation fighter jet than the ones we're currently working with?
We're monitoring what's happening, of course, and we're looking more at what capabilities will be needed. We have our own sort of local FCAS program together with the Swedish customer, and we are investing in autonomous capability, what we can call collaborative combat aircraft, on our own, because I think that is going to be needed. Whether that will in the future be in a partnership with a European country, I don't know. We have doors open, but right now we're pushing ahead on our own to see what happens. I have no clue what is going to happen between France and Spain and Germany in that sort of FCAS program. And I'm not intervening or trying to influence that at all. We do what we have to do, but the capability is going to be needed. And first it will be autonomous capability like a collaborative combat aircraft with the fighters that we have. And beyond that, in 2060, of course, we need something after the Gripen E, and that we're looking into already.
Michael, thank you very much. The Saab CEO, Michael Johansson, with the latest on the earnings story, the orders story. Quite phenomenal growth there for geopolitical reasons that we understand. Really interesting conversation. Thank you, Michael, for joining us. Coming up on the programme, we'll pivot back to the banking sector. We'll be joined by Kirsten Bruthen, who's the CEO of DNB. We will be talking about the earnings story, the European rates environment, a couple of big rate decisions from other geographies, of course, due today. But we will be talking about the broad banking landscape here in Europe. That's next. This is Bloomberg.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, you know, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, you know, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, you know, basically are gonna like unleash this with a bunch of creators, and they're gonna go figure out stuff that we didn't even imagine that they can do with that interactivity.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
This is the opening trade. We are 30 minutes into today's session. Given the selling pressure we saw overnight on the US Nasdaq 100 closing lower by about 1.7%, the selling that we've seen over in Asia, a bit of resilience really relatively in terms of European stocks, just down 0.1% across the benchmark. The DAX is flat. The auto sector is under a bit of pressure. We're seeing pressure again in terms of energy. Interestingly, technology is one of the sectors near the top of the list. Last time I checked, the Dow current is up 0.3%. And here in the UK, the FTSE 100 are currently down 0.2, a bit of political risk. You're seeing that in the gilt markets, down 17 points so far. Guy?
Europe feels like a kind of beacon of calm for now, but as you say, political risk may be creeping back onto the agenda here in the UK as it goes off the agenda in France. Let's talk about what we are seeing, though, in terms of the market internals. Higher 221, down 364. Tells you a little bit about the weightings and what we're seeing on the upside, because the market is fairly flat. Volume's actually fairly high, understandably, given the volume of earnings we're seeing coming through the market this morning. ASML benefiting, it seems, from the Alphabet Google story and the big spend, the huge spend, the ginormous spend. I run out of superlative spend on what we're seeing coming out of Google. ASML is a beneficiary of that. Saab's up. We just spoke to Michael about what he's seeing in his business. Extraordinary pickup in volumes. BNP Paribas as well. We spoke to Lars a little bit earlier on in the programme. BNP numbers good. Stock up and being rewarded for that. Are we going to creep towards a ratio of 1 on that stock? BVA, though, it's not all good news out of the banking sector. It is down by 4.5% today. Shell is down by 1.85. We spoke to AL a little bit earlier on. But the standout story on the downside, actually, I think, is AP Møller-Mærsk. Huge kind of variance in terms of what they see going forward from here. Really big spread in terms of the outlook. We just don't know what's going to happen in areas like the Red Sea, the Panama Canal. Those issues really affect that business, and the market just doesn't like that uncertainty. The stock we marked down by 5.5%, Anna.
Yeah, Guy, let's get an update on some of the geopolitical news flow, some of which could influence that sector. The US President, Donald Trump, has sent a fresh warning to Iran as US military forces amass in the region. Trump told NBC that Iran's supreme leader should be, quote, very worried ahead of talks with the United States tomorrow. In a post on X, Iran's foreign minister said that discussions between the two countries are scheduled to be held in Muscat on Friday morning. Prime Minister Keir Starmer faced anger in the UK Parliament yesterday over his handling of the appointment 18 months ago of Peter Mandelson as US ambassador amid scrutiny of Mandelson's relationship with Jeffrey Epstein. Labour members of Parliament described the mood in the governing party as febrile and mutinous. The UK Prime Minister is due to speak once again later today. And HSBC is preparing to hand some bankers little or zero bonuses as the bank seeks to emulate his Wall Street rivals with a more hard-edged stance around bonuses. Bloomberg has learned that the bank also plans to encourage underperforming staff in divisions including investment banking and wealth management to depart following bonus payouts in the coming weeks.
OK, let's stay on the banking space then, because DNB has had its price target raised by Danske Bank this morning. This after the Norwegian bank reported a fourth-quarter net profit beat and announced plans for a new share buyback programme. Joining us now is Kirsten Brathen, CEO at DNB. Kirsten, good morning. Thanks for coming to the studio. Is this as good as it gets in terms of profitability for Nordic banks, or is there further to go for 2026?
Well, I think there are many drivers for further growth in our business. What stands out for us this quarter is a 40% growth in fees and commissions. So we have an increased diversity in earnings. And there's certainly more to build on in our investment banking and wealth management arm, where we've recently merged in Carnegie. As for NII, we expect one more rate cut, and we expect to continue to grow. We showed growth this quarter, growth in all sectors last year.
You mentioned some of the potential catalysts for this year then. What do you think is going to be the key catalyst? Is it volumes? Is it fees? Is it cost efficiency? What kind of stands out to you?
Well, I think growth in lending, for one, but we are targeting always to grow more on the fee side, and having a relatively recent merger with Carnegie taking a leading investment bank position in the Nordics, this is our expectation to be the fastest growing area.
Do you get a sense that clients are backing away from the United States? And is that a benefit for a Nordic bank?
I wouldn't use it as strongly to say that they're backing away from the United States. There is increased uncertainty around renewable projects in the US. But there has also been incentives to build activity in the US. In the beginning of last year, we saw investors turning a little bit to Europe. So I think maybe that's more the question. Can we attract more investor interest and more capital into Europe? I think yes. I'm hopeful that yes. There is a lot of investment programs in Europe, and the landscape is a bit changing, but I think US is still going to be very, very important.
Is that a home bias? Do you think your clients, both on the investment side and on the corporate side, have an increasing feeling that there is a home bias, that they should diversify back home? I'm wondering what the catalyst for that is.
Well, it's important to say that Europe is Norway's most important trading partner.
Yep.
2/3 of our trade goes to Europe, and we are Europe's most important supplier of energy. So there's a very strong interactivity and interdependence between Europe and Norway. US is less so. The biggest good that we export to US is seafood. We expect that to continue. The corporates, we see them still being active in the US. We don't see them shying away. If there's anything that we find a bit concerning, is that the level of uncertainty is pushing investments out in time, more maybe than switching it from one geography to another.
Where do you see evidence of that, Kirsten? Are CEOs just reluctant to commit on capital expenditure, or is this sort of a sense you get, or anything you can point to more specifically?
It's more a sense we get in the dialogue with customers. They need to figure out what is noise and what are actual signals, and that is a difficult thing to do these days. So it does point to maybe a little bit wait and see. On the other hand, you have very strong drivers in Europe related to security, still related to climate, also related to digital and technology. So it's really a matter of figuring out which of these drivers are going to have the largest impact on the economy. We believe the Norwegian economy will continue to do well.
OK, so a lot of need for investment, but just needing a bit more clarity. Let me ask you about the cost side of your business. We were just talking about bonuses in the sector as a whole. Citi was talking about how your costs were maybe a little higher than expected. Jefferies was talking about staff costs on the rise. Is that an area that you're looking to take some action around?
We have taken action in this area. For the fourth quarter, it was very much so activity related. So costs were up in the quarter, partly of it related to the quarter, but also partly of it related to what has happened throughout the year. If you look at our cost for the full year as such, and we look at it pro forma ex Carnegie, our cost development is actually lower than inflation. So we have taken out 650 FTEs during the course of the year. We're working very hard on cost efficiency, and even with an increasing level of fee and commission, our cost-income ratio stays below 40. So efficiency, I think, is something that
Okay, so if you strip out Carnegie, which is the M&A, obviously, then there isn't a cost story that you're worried about then?
No. Even with Carnegie, we're not worried about cost.
How much are you spending on AI in 2026, and is it working?
We are spending a lot on AI. We are seeing promising results.
A lot is how much?
Well, I don't have a number for you. We're spending $7.5 billion on tech, and we're diverting increasingly more on that on AI. But I don't think for us as a bank it is about spending the most money. It's about building competence in the organization. We have 3 sort of flagship projects where we're using this towards customers. We are exploring how to innovate in the KYC area. But we're also focused on where are the bottlenecks and what will be difficult. And number 1 is data quality. We're putting a lot of effort into that, so you could call that AI spending. And also culture and people and leadership and leading change.
Because, Guy, we were talking to BNP Paribas CFO, and he talked about know your customer and using AI for that as well. But arguably a little bit more definitive in terms of his view, in terms of the efficiencies that might come through from AI. But it's really interesting to hear how
it's a series of banks that talks about KYC as being an area they see. Actually, it's that kind of matching, that kind of due diligence you have to do. Maybe AI solves some problems there. The bigger picture around all of this is, are white-collar jobs safe? Like, what is happening? Are you going to change the way you spend on software? Are you going to spend differently in terms of people? Are the traditional white-collar jobs that society has relied on going to be there going forward? As you think about the bank, not now, but in 5 years' time, in 10 years' time, how different does the employment picture look?
I think it can be extremely different, and I believe the transformative power in this is very substantive.
For the good or for the bad?
Well, I think for the good and the bad, but I think AI needs to be regulated, and I think one of the uncertainty is what will be the pace of change in the employment market. We've talked about not making changes to our hires of young people, because I think that is one of the starting trends that we see, and I think as a society we need to engage in going after the productivity gains, going after the customer value, but we also need to be mindful of what will be the impact of society. It's not easy to regulate, but our desire is that we have competent authorities that actually manage to regulate, because this is powerful.
So aside from the regulation, Kirsten, but in terms of the implementation in a bank, you've talked about data quality, and clearly you need the data to be of a quality to be useful to AI. You work in a very regulated industry as well. Do you think that the market sometimes overestimates how quickly change can come in industries that are very regulated, operating often on quite legacy systems?
I think regulation is one thing, complexity is another, and banking is quite complex. And I think, as usual, there might be a risk that we overestimate in the short term and underestimate in the long term. We work on the longer term, and building competence, preparing our people is part of that. But of course, what we can do now is working with unstructured data. So what we have done on KYC so far is to double the productivity in the last year. Now we're looking at it completely fresh. How would we do this today? And then you can start questioning, do you actually need the software? Do you need the processing tools? Maybe not, because if your data is good enough, you can module and create the layer on top with AI, which completely transform the process. But that isn't done in 3 months or 5 months. But that is more what we're looking for. Well, my team is telling me that we will have promising gains and impacts during the year of 2026. We've been at this for a couple of years already. But I'm more thinking about 3 to 4 years to really start seeing the bigger impacts, because I think you have to do the groundwork. And I think it's interesting also talking to the larger tech companies when they talk about what is the most difficult things. It's people and culture. So this is no magic dust either, even though we might sometimes like to talk about it.
Yeah,
like
people
that.
and culture, and that can be quite nebulous, can't it? DNB CEO, thank you very much indeed, Kirsten Brathen, on the earnings story, but also the AI impact as well. That stock currently down a little over 1%, but up about 30% in the last 12 months. Coming up, what has Alphabet got planned in terms of capital expenditure for this year? It is a big number, we'll reveal. And if you've been listening at the top of the show, you should know the answer, but we'll give it to you again after the
Ask
break.
AI.
This is Bloomberg.
A cidade estava sitiada.
Isso ao começo eu também não sabia o que fazer. Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back. Now, before the break, we asked what is Alphabet's planned capex spend for this year? At the top of the range, the answer, as much as $185 billion US. The Google parent company, of course, expecting to spend for the year a total that's more than it spent in the previous 3 years combined. $185 billion. They are not retreating from the capex spend. It comes, of course, as Alphabet's fourth quarter sales, excluding partner payouts, hit more than $97 billion, beating the estimates. Alphabet CEO Sundar Pichai says his company's success is being fueled by demand for AI products, including its Gemini search assistant.
Today, more than 120,000 enterprises use Gemini. Gemini Enterprise managed over 5 billion customer interactions in Q4, growing 65% year over year. Revenue from AI solutions built by our partners increased nearly 300% year over year, and commitments from our top 15 software partners grew more than 16x year over year.
Okay, we were just debating as to whether or not Sundar sounded a bit automated in that response. But look, the numbers were good for Alphabet. The market response was a little choppy. The cloud unit doing really well, growth of almost 50%. They're supplying the TPUs, their own chips, to Anthropic. They have Gemini, of course, and what they're seeing is 750 million customers. They seem to be hitting the mark. Alphabet. It sounds like I feel like Guy wants to jump in at this point.
No, I think just having the stock flat last night was in some ways an amazing performance.
Yeah, absolutely. I mean, given what we've seen in the rest of the tech space of late, and let's get to that to talk about AI, tech investment, what we're seeing in software stocks, the VC landscape, importantly. And let's bring into the conversation Anish Acharya, who is general partner at Andreessen Horowitz, and we are very pleased to have you with us today. Fantastic that you're here this week because there's so much to talk about.
Perfect timing.
Yeah, absolutely.
Yes.
So we seem to have spent the last few days thinking about what AI means for software. Yes. The market has spent the last few days thinking about that. Right. The market has decided very quickly to sell software stocks.
Yes.
Has the selling been too indiscriminate? How would you characterize it?
Absolutely, it's been too indiscriminate. The market has oversold software. So if you look at it, number one, nobody is vibe coding their payroll. That is a future we're not going to live in. 8 to 12% of enterprise software spend today is on software. That is not going to be subsumed by vibe coding. The stakes are so much higher for the rest of the spend, number one. Number two, if you look at prices for SaaS companies, 75% of the public names have raised prices since ChatGPT was released. So all the signs, and then Google's quarter, which was exceptional. All the signs are proving and sort of indicating that we're oversold software.
Okay, so they're not vibe coding. So you're saying
correct.
There's a room
not their payroll.
There's room for specialist software that's dedicated to the job at hand. Is that what we take away from the year?
I think that the incumbents are highly capable in many of these markets. CrowdStrike is a very capable incumbent. ServiceNow is a capable incumbent. They have the right to win and deploy AI within the workflow and the customer base that they have today, and I think the market's missing that.
Does it help or does it hinder your ability to pick winners and losers in this environment?
I mean, we're in the job of the micro, and a lot of the things that we think about are new emerging markets versus what's going to happen with established markets. If you look at the entrance of Google, that did nothing to Microsoft in terms of their dominance with their Office products, right? Search was a completely new category. So often when we have these product cycles, what we see is that the incumbents do better in their existing markets and they're irrelevant in emerging markets. We're mostly focused on the emerging markets.
There's been a long debate amongst VCs and founders about what happens when the models start to push higher up into the verticals. And we got a reminder of that with Anthropic and the plug-in in terms of legal services this week. What does that mean for the companies the startups that do the wraps around the models? How defensible are those kind of businesses?
I think the wrapper story is overtold. So if you look at the labs today, they've done a formidable job of building out their models, but there are many categories in which you want to be multi-model. That is number one, right? Number two, if you take a look at the feature surface that's implied by many of these software products, so you can do meeting transcription with AI, and many AI companies do that, but the correct product is to build spreadsheets, to build a word processor, to build a slides product. So there's just an enormous amount of software to build around the capability, and I don't believe the labs are going to prioritize both the capability and the software stack.
Let's go back to the beginning. Your sense is that the markets have overdone it? That we've pushed too far on the downside?
I believe so, yeah.
Okay. Isaac Kim over at Lightspeed. Technology private equity in its current form is dead.
Yes.
That's
totally disagree. We've said this so many times. We said that new media was going to kill old media, yet we're sitting here today, right? Yeah. How many 30 years after AOL Time Warner? We said the PC was going to kill the mainframe and data centers. More data centers than ever, and guess what? Mainframes are still relevant.
Okay.
Yes.
You don't think private markets haven't over-allocated to software?
No. I don't believe so.
100% sure on that.
There's going to be an enormous flood of software. In fact, the world is short software today. Look at all of the industries in which software has not been a relevant player. Look at legal, for example, right? We've got maybe a $50 billion software market. We've got a $550 billion overall market. Yep. Legal is infrastructure for capitalism. There's no way that is one-end market.
Why so worried?
Well, I mean, I'm not going to talk about day-to-day stock prices, but I think the market has overreacted to the perception that vibe coding is going to cause enterprises to rip and replace their SaaS spend. They're just not.
Just on the legal piece, so the Legoras and the Harveys of the world, these companies that build these legal options with AI embedded, they are defensible from the kind of product that Anthropic's putting out? That moat is deep enough?
I absolutely believe they are. I think what Anthropic is doing is product marketing more than delivering product capabilities that are vertically oriented to that market. And if you look at legal, look, it's an industry, not a market. It is too small to say that this is just one end market. This is an industry that's going to have many winners and many sub-markets within it.
Does this also mean that the infrastructure spend that we're seeing and those commitments around CapEx, that's all rational, that all makes sense as well?
Look, without speaking to specific companies' infra spend, what I will say is look at OpenAI's announcement this year, right? They said that they tripled capacity, they tripled revenue. So what we're seeing is every time they bring supply online, you're seeing 100% of it allocated by demand.
Do you worry about OpenAI, given the progress that Anthropic's made on enterprise and the progress that Alphabet's made in general? They're invested in, of course, by Andreessen.
Look, so far what we're seeing is prices are going up, not down, and we're finding all the foundation models are finding their own directions to specialize in, right? So Google's done a really nice job on their multimedia models. Nano Banana is excellent. Anthropic's done a nice job on coding models. And OpenAI, ChatGPT's 950 million weekly actives. It
wins on consumer.
So far.
And they'll pay. And will they pay? How much will they pay and when will they pay?
I mean, if you look at the top SKUs of these companies, right, Gemini Ultra is $250 a month. The top ChatGPT SKU is $200 a month, right? Grok Super Heavy, $300 a month. We've never seen consumers paying these prices for software before.
So whilst we're busy talking about software and worrying about software going out of business and white-collar jobs, what should we be thinking about? What is the tech story that we are missing because we're too busy talking about this?
Look, I think the world is short software. Software is a huge both productivity driver and it's a deflationary force. This is how we get to 10% GDP. That sounds wild, but I think that it's possible.
Sounds exciting.
It
when you say the world's short software, you mean something else other than that.
That's right. I mean, it's oversold. There's not enough software in the world, and we're going to see more of it. Yes.
Data center build out.
Yes.
Too much of it. We're going to end up with a glut. The prices need to come down. What's your view?
All I can tell you is that the biggest sort of companies that are investing in data centers so far are seeing 100% of the supply they bring online be allocated. So far it seems like a wise investment.
So far. That's now. What about going forward?
I mean, what is the sort of market and demand that is latent today for intelligence? That's what we're talking about. So I don't see a slowdown in the near-term future.
Okay.
Anish, thank you very much. Really great, well-timed conversation. Anish Acharya, General Partner at A16Z. I'm supposed to say Z, I'm sure, aren't I? I really can't. I really can't. Let's pretend I didn't say it. Thank you very much for joining us, however it's said. Let's talk about what is coming up in your trading day ahead. Bloomberg's Skylar Montgomery-Koenig joins us, and the daybook shows lots of central bank decisions, Skylar, neither of which are expected to generate a move in interest rates. So what will we be watching for?
Yeah, I mean, particularly the Bank of England is usually more likely to generate excitement than the ECB. And the contrast today is also that we'll get forecasts from the Bank of England and we won't get them from the ECB. For the Bank of England, we're really paying attention to what's the vote split. So the expectation is 7-2. If you have more voting for easing than that, it'll likely be taken as dovish, especially given that you only have 5 basis points priced in for March. So that can certainly rise. And you're also looking at the forecast, whether or not that big inflation fighting measure we have from the budget in November feeds into those forecasts and to what extent.
How are you feeling about tech?
I mean, I'm not as negative, I think, as the market is. It's been really interesting because you've had tech come down at a time when earnings have actually been quite strong. So the net impact is, as you've had tech not do very well, derating. So on a multiples basis, you're something like 6 points down from around a year ago. And at some point, you'd think that there will be buyers for that market.
You think?
You're coming from a place of over-positioning. So we're seeing a rotation. And that certainly could extend, given that it was quite a long stretch that we had tech outperformance. But I think generally for the equity market, it's encouraging that you do see rotation, not just broad sell-off.
Is silver a new risk barometer for the broader markets?
I think it's something we certainly need to be paying more attention to because it has ricochet impacts everywhere. And so when you have something that's super over-owned, particularly when it involves retail, what you'll see is if there's a sell-off there, it starts to impact other markets that are retail-oriented. And I think today, too, with the tech market, you're seeing specific stocks that are more retail investor based. And so, the silver sell-off might be a precursor to that, or it might just be people going, I need to sell this because
Bitcoin kind of used to play that role. For a period of time, we watched it as a risk barometer, risk on, risk off. It's not and Bitcoin's not playing that role.
Yeah, I mean, I think it's a question of where do people want to be putting their money now, because Bitcoin didn't protect you on a number of big sell-offs or with a number of big events where they're going, there needs to be another way to position, and silver and gold have kind of risen to that role. Gold in particular, it makes sense from a historic perspective.
Yeah.
Silver, it seems like it's more of just a spillover from what can't end up in the gold market.
Okay, Bloomberg Online, Skylar Montgomery-Koenig, thank you very much. Indeed, it's been a massive week, a massive day and a massive week for earnings. We're going to get more in terms of the CEO reaction. We're going to be speaking and hearing from Qualcomm's CEO. A bit of pressure on that stock around some of the pricing concerns and smartphone delivery. 4:50 p.m. UK time, so stay tuned for that conversation.
Absolutely. Again, what have we learned today? AI is, they're talking about it, Executives are definitely talking about the impact that it's going to have on white-collar jobs and their businesses.
And we're still talking about software a few days in, even if the market looks a little bit different on that story. Tech stocks at least higher this morning. That is it for the opening trade. The Pulse is next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Anand, only on Bloomberg.
The global tech sell-off deepens with $1 trillion wiped off the value of software stocks in 7 days. Tepid earnings from Alphabet, Qualcomm, and ARM hit sentiment further. Now, BNP Paribas reports better than expected fourth quarter profit. Shell misses as lower crude prices dent earnings. Plus, the Bank of England and European Central Bank both expected to hold rates. Will set you for a double decision day. Now, there is a lot going on in the markets. Now, arguably, we look at silver. We don't often look at silver. We all feel like we've become silver experts in the last 2 weeks. Now, the tech sell-off, again, it may be stalling a little bit, but we did see this global slump in technology stocks. Traders debating whether a sell-off had gone too far, but I would say also that the nature of the sell-off is a little bit different because this one is not about valuations. This is a lot more about whether it really changes business models, it changes industries, and therefore also hits the labor market. I'm looking at a couple of other things. Look, if you look at, outside tech, the attention squarely on precious metals with silver plummeting as much as 17%, again, struggling to find a floor below this historic route. And then European markets are kind of a little bit mixed. The CAC 40 is seeing gains of 0.1%, but it's really all about earnings. So we go to the U.S., but we also look at Shell and some of the French banks. Qualcomm falling pre-market after giving a tepid forecast, which has stoked concerns about the impact of a memory chip shortage. ARM also tumbling in pre-market trading after its sales forecast disappointed investors. The company is facing growing concerns about component shortages. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the global slump in tech stocks pauses as traders weigh whether the sell-off had gone a little bit too far. Now, the initial rout in software companies extended across the sector, including chip makers. Over the last 2 days, hundreds of billions of dollars have been wiped off the value of companies, well, stocks, corporate bonds, but also loans. We're joined by our Bloomberg senior strategist, Neil Camping. Neil, again, the nature of the sell-off is actually quite different. Will it spread further? This is about business models, not necessarily valuations.
I think investors are now making the right question, which is who owns the data? And so within AI, there are different models where some own the data, like Google's Gemini, and some don't, like Microsoft with OpenAI. But now it's spreading into other businesses that are probably, at threat because they don't own the data. They may be aggregators or data processors. And that, I think, is where the concern has been coming through during this week when you've seen new AI tools being released that's called into question many of those aspects as to how, as investors, do we apply the terminal value of some of these business models. And that's what's been coming under question and under pressure this week.
So, Neil, do you expect this to still spread?
Yes, I think that is certainly the case. We may have a respite in the short term because some things are very, very oversold on technical factors. But I do think that what happens in most technology cycles is there's a very small handful of winners. And so as that spreads and people start to apply where they think the winners and losers are, then definitely there are a lot of stocks that have risen substantially on the promises and the hopes of AI. But actually, the economic value will be probably very restricted to a very few handful of winners. And so, yes, I do think it will spread.
Neil, mixed results from Alphabet, ARM, and Qualcomm. So what are the big takeaways for investors?
The big takeaways, for one, again, AI is having a massive impact because it's creating memory shortages. These big compute models need a lot of memory, and so there's less left over for high-intensive consumer applications like smartphones and laptops. And we're hearing that message really come through in Qualcomm and in ARM. In contrast to that, what we saw, I think, within the results from Alphabet last night was actually a massive increase in CapEx spend, obviously. Now, they're justifying that because they have a 15-fold increase in customer engagements on AI. And if you look at that CapEx spend, the three companies that have reported so far of the hyperscalers, Meta and Microsoft and Alphabet, are talking now about over $400 billion of CapEx in 2026 spending combined. That's a 5-fold increase from where we were just 3 years ago. And there are winners from that benefit as well, because as that CapEx is deployed, there is a substantial amount of compute that other component companies will succeed on, especially in that Alphabet Gemini AI system.
Neil, thank you so much. Of course, that was a full roundup of everything that we've seen. Also, the NVIDIA CEO saying that software sell-off is the most illogical thing in the world. That was our Bloomberg senior strategist, Neil Campling. Now, the Bank of England widely expected to leave interest rates on hold later today, despite mounting concerns about the UK labour market. The central bank is expected to wait for more evidence that inflation is under control. With us now, Ian Steely, International Chief Investment Officer for Fixed Income at JP Morgan Asset Management, and Bruno Scarica, Chief UK Economist at Morgan Stanley. So thank you both for joining us. I mean, we have to start with AI. I know we're going to go on to central banks. But, I mean, your thoughts, again, some of these are correlated in terms of corporate bonds and things like that. Is it being sold off? Is it the realization that business models were changed? Like, what are we living through?
So I think actually what Neil said was completely right. What we've had is effectively AI jitters. We've had it for a while. Valuations are obviously very elevated, and there's big question marks around what the future holds, where's the revenue going to be generated, which companies are going to be the winners, which companies are going to be the losers. It does feel, at least the last couple of days, has been quite indiscriminate, sort of sell first and ask questions later. So there's probably is a lot of value to be had if you can get the right names. I think it's a great environment for good stock pickers who understand the kind of the bottom ups of these companies, what they're doing. And he's absolutely right. There are some companies that ultimately will be impacted by this, whereas others will be benefits. People will be able to use AI to improve efficiencies. There will still be the companies that have their own sort of data warehouses, that's their own proprietary information. AI can't get hold of that in theory. So I think it's a very interesting environment. It reminds me, we've had a few of these over the last year. I remember it was only a year ago we had DeepSeek and everyone suddenly panicked, and then everything came back. But I feel there's going to be a lot of opportunities coming out of this.
We'll talk about central banks, but Bruno, does this change actually the fabric of economies? It's unclear, and we need to talk about UK political risk. There's a lot going on in the UK right now. But actually, how does the UK economy change under AI?
Yeah, I mean, one thing that has been really interesting in UK is that we've had this ongoing decline in payrolls. I think for 18 months straight, HMRC payrolls have been negative. Over that period, actually, the economy has grown. This was not spectacular growth, but it was growth nonetheless. So about 1% decline in payrolls, about 1.5% growth. When you combine those two things, there is a bit of a cyclical productivity growth upswing. Now, how much of that is just cyclical? There's a little bit of reversal of labour shedding going on. Businesses are obviously dealing with steep labour costs. And how much of it is actual structural productivity improvement, perhaps due to investment in AI? We'll actually find out probably over the course of this year. If activity continues to improve, but hiring is sluggish, then maybe we do live in a world where businesses are becoming a little bit more capital intense. And I would expect actually the BOE to comment on this at the meeting today.
Yeah, I'm sure he'll also otherwise get pounded in the press conference, which many of us will be attending. What are you expecting from the Bank of England right now?
I can't be too excited, can I?
I think it's quite exciting. I think it's always exciting.
It's more I guess they're not going to do anything. But to me, it's more around, firstly, the voter split. Yep. How many dissenters do we get? Obviously, December was a very close call. We had Governor Bailey effectively making that kind of final decision. So do we get any excitement there? And then really it's going to be around the forward guidelines, guidance. What do they kind of, if anything, that they think they're going to happen? I mean, our base case is that actually what the market's pricing is pretty undershoots what could happen. If we do get the inflation coming down as expected in the second quarter, we're starting to, as you mentioned, we're starting to see weakness the weakness continues in the labour market, at least from sort of job growth. I think this is an environment where the Bank of England could do a little bit more, but they do need to see inflation come down.
Ian, I know one thing that they don't want to talk about will be the political risk, but actually the chances of Keir Starmer leaving is now starting to be priced in at the margins in the market. So how does the Bank of England deal with that? I think the Bank of England should continue to do what it always does, which is focus on the economy. Obviously, there will be concerns around more the long end of the gilt market. We're seeing the curve steepen up to levels that we haven't seen for a number of years. At the moment, the front end should still focus on what they're planning and what they're thinking about. And that's actually where I've got more conviction in, because I do think you're playing economics in the front end, and maybe politics might have more of an impact towards the longer end. Bruno, agreed? Yeah, I agree. I do think we need to keep in mind that monetary policy does not operate in a vacuum. It operates in conversation with fiscal policy. So if you're a policymaker, you're always thinking about what's next in terms of the fiscal outlook. But yeah, absolutely. In the very near term, it's all about that inflation coming down and the labour market. Yeah. But how does this economy grow? I mean, the million-dollar question is actually what's the real growth plan going forward? Well, I mean, I thought the two data points we got at the end of the year, so the November GDP and the PMIs, were quite interesting. Because there is a bit of a focus, especially in the PMI write-up, on the finance sector and the tech sector. So I do think there's something to be said about kind of externally oriented sectors, perhaps picking up steam a little bit faster than consumer-facing sectors. And while we're all focused on the UK consumer, it is the
2/3 of the UK economy is domestic expenditure, private domestic expenditure. Look, these white-collar services sectors are the backbone of the UK economy, and if global growth is accelerating, it is a tide that lifts all boats. And I think the answer to your question is that's really where the growth comes in this year, I would say, in the UK as well.
Yeah, I mean, given all of the kind of, geopolitics has our hearts racing, there's all this like tech. Even if you look at the ECB, I mean, they're pretty much in line with expectations. We're not expecting anything huge. I mean, it's the next big question whether we are going to see a hike as the next move.
So I would take the opposite side of that. And I think actually, if you think about what happens with the inflation numbers, what's going to happen with inflation in Europe over the next few months or so, it's going to probably undershoot their targets. And they are a single mandate central bank. It is all about price stability. And I think if you do get inflation coming down a little bit faster, or a little bit more, I should say, than maybe their forecasts are showing, there's going to be some doves on the council that are suddenly starting to ask the question, have we done enough? Against that, obviously, we know there's German fiscal spending coming. We know that we should be getting growth supportive measures out of Europe. But I do think, it's going to be in the near term, it's going to be inflation. So if I look at the pricing today, I actually think it's pretty asymmetric. My base case is they stay on hold, but I just don't see an environment where, at least for the rest of this year, they're talking about hiking rates. But if inflation does undershoot, then we could be back in the rate cut discussion.
What are the dynamics with China? Because are we kind of importing deflation from China?
Well, I think there's a few different dynamics, isn't there? Because you've got commodity prices. Obviously, they've jumped recently, but generally commodity prices. You've got the stronger euro over the last 12 months or so. You have got that question mark: where are China going to import all the goods that the US is no longer taking as much? What that should come to Europe. So there are this sort of disinflationary measures that are coming into Europe, and again, I think that's going to weigh on what is already a level that's expected to be below target over the next couple of months.
Yeah, I also want to correct myself because we had quite a lot of geopolitics in terms of trade and tariffs and tension, probably stressing out a lot of the central banks. Bruno, I mean, the dynamics for the UK are different to Europe, but we're also, on the inflation point from China, it could be similar dynamics.
Yeah, I expect trade diversion to feature very heavily today. The Bank of England had an interesting piece of research that they published, I think it was a couple of weeks ago, where they actually said some of these export prices from China in the aftermath of Liberation Day had picked up. So they're taking a slightly opposite view, but I do think the headline conclusion would be, over the longer run, trade diversion could certainly be a disinflationary factor for UK as well. I mean, UK, I would say, we import everything we consume. We import our food from Europe and we import our goods from Southeast Asia. About 25% of consumer goods that we consume in the UK, we import from China and Southeast Asia. So it really does matter a lot for the UK as well.
And I know the UK, and actually Governor Bailey specifically never wants to talk about what the Fed does, and but they're correlated. I mean, what does the appointment of Kevin Warsh mean for what the influence of the Fed could have on the Bank of England?
I mean, I think in terms of the Bank of England never wants to talk about what the Fed does. I think they talk and think about the U.S. economy, right, and the impact it has on the U.K., right? So they will think about a potential uptick in U.S. growth over the course of this year. They'll think about the dollar as well. Again, the FX pass-through coefficient in the U.K. is far bigger than it is in the euro area. So the move in sterling actually could be a bit more consequential than in the euro area as well. So these are factors that I think they'll talk about, even if they're not talking directly about perhaps the appointment itself and obviously the internal politics of the Fed. Yeah.
And what do you like in fixed income right now?
I think it's still a carry environment. Okay. I think we're in an environment where actually rate volatility has been very low. So for all the excitement that we're seeing in software and everything else, rates they've drifted a little bit higher over the course of the year, but rate vol is still low. I don't see central banks tightening policy outside of Australia over the next few months or so. So if you're in an environment where global growth looks like should be on a bit of an upswing, given some of the tailwinds that are happening, corporate credit should be great. You should be able to continue to grab that additional yield. So really, it's just kind of finding the good spots to earn the carry. And then I do think there's a really kind of interesting environment in some of the local emerging markets where the story is very, very positive. And actually, the investor base seems to be kind of picking up on that. If you look at the flows year to date, from our own fund trackers that we do internally, it's about a third of what was put into emerging market local and mutual funds last year has already gone in this year. So it really is sort of the hot place that people are looking for investment, and there's still some value to be had.
Treasuries?
I think we're in a range. I think we're sort of we're getting actually probably closer to the upper end of that range where you want to be looking at opportunities to buy.
Okay, thank you both for joining us, getting us started on a big day for central banks. Ian Steely from JP Morgan Asset Management and Morgan Stanley's Bruna Scaraka. Now, coming up, President Trump says Iran should be very worried as the U.S. bolsters its military presence in the Middle East. We'll look ahead to tomorrow's talks between the U.S. and Iran next. This is Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
The Bank of England makes its next interest rate decision. As inflation rises and the labor market cools, investors will be looking for clues from Governor Andrew Bailey on the pace of rate cuts for the year ahead.
With every cut in bank rates, how much further to go becomes a closer call.
Tune into Bloomberg for live coverage of the BOE decision and press conference. It all starts today at 12:30 p.m. on Bloomberg. Context changes everything.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, the U.S. president has said Iran should be very worried as America bolsters its military presence in the Middle East. Donald Trump was speaking to NBC as the U.S. and Iran confirmed that diplomatic talks will take place in Amman tomorrow.
I would say he should be very worried, yeah, he should be. As you know, they're negotiating with us.
I know they are, but the protesters have said, you know, where are the Americans? You promised them we would have their back. Do we still have their back?
Well, we've had their back, and look, that country's a mess right now because of us. We went in, we wiped out their nuclear.
So that's the question. If we wiped them out,
we have peace in the Middle East.
Yeah.
If I didn't take out their nuclear, think of it. If we didn't take out that nuclear, we wouldn't have peace in the Middle East because the Arab countries could have never done that. They were very, very afraid of Iran. They're not afraid of Iran anymore.
Well, let's bring in Eli Garan-Maye, Deputy Director of the Middle East and North Africa Program at the European Council on Foreign Relations. Thank you so much for joining us. Eli, what do you think the way forward is? We're all waiting for something to happen in Iran, but it's unclear what the U.S. president has in mind.
Well, good morning. Thanks for having me on the show. I think for both Washington and Tehran, we are really reaching a crunch point for decision making. Either it's going to be a military conflict that we're entering into after these talks in Oman, or that in Oman there are some serious steps made on both the technical and political sides to pave open a serious and genuine political track. And so I think right now both the leadership in Iran and President Trump will have to face the music and see whether they go for the war option or for the peace option. I don't think it's any longer viable to have the no war, no peace status quo that we've had since June and prior to that also. So it's decision time for both sides. But having said that, from everything that we are seeing and hearing, the two sides still remain very far apart regarding the scope of potential negotiations. And even, for example, the format. It's clear that the president and President Trump prefers very direct negotiations to fast-track a process. On the Iranian side, there is still too much distrust after the U.S. bombed Iran in ongoing negotiations in June. And so they want to try and do this through an indirect intermediary, which will, of course, slow the process down.
Where do you see, I mean, if Iran, what does President Trump want from Iran today, Ali?
Well, look, the end game is very unclear, frankly. We go from one day this being about not giving Iran nuclear weapons, when the president himself, since the June bombings against Iranian nuclear sites by the U.S., said that Iran's nuclear program is over, is obliterated. But now we're hearing again that the president is still focused on the nuclear issue. Then you have the Secretary of State, Marco Rubio, talking about denying Iran's missile capabilities, addressing its regional activities, and also its human rights conditions on the ground. So that introduces a whole other series of issues into the negotiations. It's clear from the Iranian side, the only thing that they are wanting to discuss with the Americans is restricted to the nuclear issue, but they have signaled openness to discuss regional issues with regional players, so Saudi Arabia, Qatar, Emirates, Pakistan, Turkey. So that may be the result of a two-track process that we end up having, one on the regional issues and one on the nuclear issues focused on the US. But frankly, it has been a lot of mixed messages from Washington with respect to what the end game is. And some might even say it may be regime change and that this military buildup that we have seen is not necessarily for strengthening the US position in negotiations, but it's basically once negotiations fail because of these maximalist demands from the US, that they basically order the strikes in Iran. But to what end, we're not sure.
If you look at some of the contrasting positions over just the parameters of the talks tomorrow, are you hopeful that something will be achieved, or are they just too far apart for any major differences to be bridged?
Look, I think if you're in the business of diplomacy and conflict resolution, you always have to have a degree of hope that a breakthrough could be made. Right now, however, I think there is quite low confidence that that breakthrough can be achieved. But Iran is constantly surprising itself in the world. The US president is constantly surprising the US system in the world. So it's not an impossibility, but right now it does seem that the two sides are frankly too far apart. They are also both sticking to this position of maximum pressure from the US side and a show of real willingness to use force again inside Iran with the type of military buildup that we've seen. And Iran is still sticking to maximum resistance. And this time they are saying they will not be surprised like the June strikes that Israel and the US conducted, and that they will regionalize this war so that it won't be restricted to just Israel or the US, but it may affect the Strait of Hormuz. It may affect all installations across the region, for example, if they want to rattle markets around the world to make this painful for the US markets as well. So I think if there is an escalation, unless it is choreographed and managed and both sides remain restrained, there's a lot of room for escalation, for miscalculation, given the amount of US military buildup now very close to Iranian shores. And we may be in for a very, very messy conflict ahead.
Ali, when you look at China, I mean, China has a huge role to play in this. Do we know what they're thinking when it comes to Iran? I think the U.S. also reached out to try and press China and others to break from Tehran.
So China, I think, has been its classic position of pretty quiet, publicly calling for de-escalation, not wanting a conflict. Behind the scenes, however, it has in the past tried to push for de-escalation, whether it's between Iran and Saudi Arabia several years ago, and to some extent between Iran and the US, because remember, if the energy markets in this part of the world are rattled, China is the first one to be harmed by this. But we have not seen any indication that China has peeled off Iran. If anything, the sort of teapot refineries that have been taking Iranian oil to Chinese refineries in circumvention of US sanctions have continued. We have seen reports that China, following the June strikes, has helped Iran restock its missile capabilities. And so this doesn't suggest that major fissures has been achieved between Beijing and Tehran.
Ellie, thanks so much. Ellie Garamaya there from the European Council on Foreign Relations. Coming up, earnings at BNP Paribas come in higher than expected. The bank tells Bloomberg that AI is helping to cut costs. So we'll have all of the details next. And this is Bloomberg.
Crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The global tech sell-off deepens with $1 trillion wiped off the value of software stocks in 7 days. Tepid earnings from Alphabet, Qualcomm, and ARM hit sentiment further. BNP Paribas reports better than expected fourth quarter profit. Shell misses as lower crude prices dent earnings. Plus, the Bank of England and European Central Bank, both expected to hold rates, will set you for a double decision day. So let's get straight to that story from Frankfurt and the ECB. Bloomberg's Lizzie Burden is there for us. So, Lizzie, if you look at the decision, we're not expecting much today, but it's really their future expectation on inflation, if it's too low, that traders will be looking for.
Exactly, Francine. The latest growth numbers kind of give the Governing Council cover to stand pat today. But as they've been saying, they're in a good place. That's their conclusion at the moment. The expectation being that they don't move this year or next. But when it comes to today's commentary, as you emphasise, remember, not so long ago, at the end of last year, there was all of this hawkish talk started by the commentary from Isabel Schnabel. You saw it in the market reaction. That's been pared back somewhat because of three things. First of all, we've seen inflation undershooting the target. Second, we've seen euro strength past, well, to the 120 level briefly last week. And Luis de Guindos, the Vice President, saying that that's the level that complicates matters for the ECB. Those comments last July. And then the Bank of France Governor François Villeroy de Gallo saying that they are going to be looking at currency moves as a factor in monetary policy because, of course, the worry is that it could damp exports and make that inflation undershoot more persistent. The third thing is the geopolitics, of course, and we've had President Trump's threats of tariffs on the nations opposed to his Greenland plans. Yes, they've been walked back, but the trade uncertainty lingers over the euro area economy. So all three are downside risks. I wouldn't expect President Lagarde to go back to this hawkish rhetoric that we heard from Schnabel. I was speaking to Martin Kocher, the Austrian central bank chief, and he was talking about the need to retain full optionality so that they can be ready to act if necessary. I'd expect Madame Lagarde to echo that and to talk again about a need for a data-dependent meeting-by-meeting approach.
Lizzie, thank you so much. Lizzie Burden there in Frankfurt. I think that's exactly also what François Villeroy de Gallo, the Banque de France, was saying in Davos. Now, BNP Paribas has raised some targets after reporting fourth quarter earnings that beat expectations. It's a boost for the chief executive and his plan to prop up the lender that has long lagged peers. Now, the bank's chief financial officer told Bloomberg that AI is helping to cut costs.
We will use natural attrition to get to optimized levels. So yes, maybe the overall staffing requirement will be less. We will get there through natural attrition. But then if we look at the overall economy, those jobs will be redeployed in other activities because the AI will also generate totally new activities. I mean, let's go back. It's what the internet did. It's whatever, all of these things that we've seen, it leads to a change in kind of activities. And that is what we anticipate.
Now I'm joined by Philip Richards, Senior Banks Analyst for Bloomberg Intelligence. Thank you for joining us. So BNP Paribas shares jumped at the open. Can the bank actually achieve its ambitious goals?
Yeah, good morning. Well, they're a challenge, I think it's fair to say. I mean, analyst estimates not even as high now as the old targets. So they're given a hike them as well. They have set the agenda quite challenging. Where's that extra upside going to come from? We know the French economy, yes, they passed the budget, but there's still quite slow growth. The investment bank, they did okay today, but they're still somewhat below what the US banks have been doing. So yes, it's good today, no doubt, but yes, some challenging targets ahead.
Meanwhile, BBVA met estimates. Has their growth since the failed Sabadell bid actually come to a close?
Well, in this quarter, we've seen actually the growth held up quite well. They actually beat analyst estimates on the revenue side. However, the problem comes through on the cost side where they came in worse, and cost of risk was also worse as well, and that's why they missed at the bottom line. And that's what the shares are reacting to today. So, no, on the revenue side, yes, it's holding up, but yes, their challenges are definitely there as well.
All right, Philip, thanks so much. Philip Richards, our Senior Banks Analyst for Bloomberg Intelligence. Now, for more on the banking space, we're now joined by Jackie Ineke, Chief Investment Officer of Spring Investments. Jackie, so good to speak to you. I mean, there's been quite a lot of bank earnings in general, so it's certainly not dull. I mean, is there, of course, it depends on whether you're more into lending or more retail or more investment bank, if there's such thing in Europe. But what's your take so far of earnings?
I think it's been a great set of earnings. It typically always has been for quite a number of quarters now. But we look at the credit side of things. We focus on bank debt, AT1s. So from that perspective, the earnings have been super. You've seen, I think the standout for me has been the talk about ROEs. particularly in the next couple of years, reaching above 20% for a number of banks, like Caixa, Intesa, Santander. So super in terms of profitability, boring in terms of asset quality. There's nothing terrible coming out anywhere. So the banks are still extremely strong quality. That seems to continue. We expect that for 2026 as well.
I mean, is there going to be a game changer at some point? I don't know whether you're expecting a big piece of M&A or a banking union to give it a kind of catalyst. Because you're right, it's fine.
Yeah.
It's just nothing huge, and the US ones could do much better in the future.
Yeah, I guess so. I think if you look at European banks versus how they were 5 years ago, it's amazing where they are now, to be fair. But in terms of game changer, yeah, we think there's going to be a lot of M&A over the next few years. The issue is it's going to be the larger banks buying the smaller banks. So in the big cap banks, there's not going to be a lot going on. But if you're investing in the smaller banks, in the smaller bank bonds that we have a lot in the portfolio, this is where you're going to get the real uplift. Yeah.
When you look at, I mean, Santander took a lot of people by surprise with the acquisition of the bank in the US for over $12 billion.
Yeah.
Is it a kind of template of things to come for Europe just because the US is more profitable?
I'm not sure. I mean, they're going for critical mass there. I mean, that acquisition makes a lot of sense. It looks quite expensive at 2 times book, but you know, that deposit base, it just makes sense for the business. I think in Europe, I don't think you're going to see those big cross-border acquisitions. I mean, still, there's so much political problems, so many political problems with that. There shouldn't be. It should be allowed to happen, but still, it's tricky. I think what you're going to see more of is things like, you know, Intesa was talking about buying networks of financial advisors, you know, not going in and buying a whole bank. So, again, in terms of acquisition targets, we're thinking about small private banks in some of the smaller countries. Those will be the cross-border acquisitions, but quite small.
Jackie, I mean, private credit seems to have been in this mix of, you know, the software shock. And so a lot of the companies, especially private equity owned or private credit fund firms, you know, trouble is not immediately obvious because you don't really what's in the books. Could that impact some of the banks or financial services in your world?
It definitely could, and obviously there's a lot of talk about it. I just don't think anything's going to happen soon. I think on the one hand, you've got very difficult reporting of actually who owns what or who's exposed to what. But it's clear that, you know, banks, I think it's like 5 times more capital intensive to lend to SMEs rather than to finance private credit funds. You know, so they're doing a lot of financing there. What gives me a lot of comfort, though, is there's so much liquidity in the market. If you look at the deregulation that's going on in the US, we think it's about $5.8 trillion with a T of balance sheet capacity that's opening up this year just from the leverage ratio changing. So that's a huge amount of cash that can go to work. You know, I don't think there's any problems with financing for this year at least. So, yeah, worry about it, but it's hard to know what to worry about, especially when there's so much liquidity.
But we saw quite a big chunk actually being wiped off credits in the last 2 days. And this is not on valuations, it's just because the business model changes. So I imagine financial companies or banks are looking at what are the things they own.
Yeah, I mean, you'd hope so, and you'd hope, you know, they have significant protections as well. I also think, you know, in terms of this whole private credit funds, it's actually very difficult for there to be any kind of run or blow up there. I mean, it's hard to get your money out. I mean, this is one of the great and the terrible things about private credit, the illiquidity. So, yeah, banks, we know that the supervisors have been all over them on this. They've been getting their own numbers. You know, sometimes I speak to the ECB about this, and they've been on it for the last 2 years. So, you know, and they can get whatever information they want from the banks and put capital charges up if they want to, and they have. So I feel relaxed, at least for this year. When there's so much liquidity, it's hard to get concerned for this year. Yeah.
Jackie, do you make a difference between some of the European, I mean, some of the French banks compared to some of the Italian banks? Like, how does, you know, headquarter matter?
Just in terms of what, valuations or credit quality?
Yeah,
or
just in terms of whether you like the banks. I mean, BNP had a good set of results.
Yeah, that's great. The problem is you can't take BNP out of France. And when you're looking at where these things are trading, every now and again they get to look cheap. There's a government headline. But we'd rather not have that volatility. I mean, we don't really own any French banks in the fund. We have a couple of very small acquisition targets that won't go with the big headlines. So that's how we play it.
Your take on UBS? We were in Zurich yesterday, actually, with the program, because we spoke to Sergio Armati. I mean, it's all about capital requirements and where they end up, whether they can even have an M&A strategy.
Exactly, and it's super if you're a credit analyst and invest in debt. The more capital, the better. So, you know, I understand the problems, though, and I'm a Swiss citizen, so maybe I end up voting on this whole capital thing. I do think it's very tricky. I mean, they've got a 14.5% core equity ratio. They're going to be asked to maybe do another 26 billion Swiss francs of equity. They're going to be way off the charts in terms of, you know, capitalisation. Capital did not help Credit Suisse. It was nothing to do with capital. So, you know, I understand the rationale behind it. You know, I was thinking there would be more of a compromise, and I think in the government there was a suggested compromise, but I think the Finance Minister, Keller Sutter, said, you know, no dilution with AT1s. So, yeah, I've got a feeling they're just going to have to go with it. The numbers by the end of June, we hope by the end of June they'll have a plan, and they're just going to have to raise a load of equity. I think that's it. Maybe a little bit less than expected, but...
Jackie, thank you so much for joining us. That was Jackie Anakia, the Chief Investment Officer of Spring Investments. Now, Shell said its fourth quarter profit slumped, undershooting expectations as lower crude prices, a weak oil trading performance, and a struggling chemicals business dented earnings. The Chief Executive, Wael Swan, spoke to us earlier this morning.
We are preferentially allocating capital to buybacks because we still see a very attractive buyback in Shell. Our free cash flow yield continues to be very attractive. We see a great runway. We have a line of sight to 10% free cash flow per share growth every year between now and 2030. So being able to buy back Shell, in my mind, is a very, very good investment. To give you a sense, over the last 4 years or so, we bought back a quarter of the company at an average price that's around 20% lower than where we are today. That doesn't mean that we don't continue to look at opportunities to be able to also invest, and that's what we did last year. 2 billion of our capital budget went into M&A, into what we would call bolt-ons in our deep water space, that contributes to our production growth in 2030 and beyond. So this is a very, very focused allocation of capital in pursuit of long-term shareholder value.
Well, that was Wael Swan, Shell CEO, speaking on Bloomberg's opening trade earlier today. Now, freight rates are under pressure in 2026 as new capacity comes online and as the Red Sea reopens to global shipping. That was among the views expressed by Maersk Chief Executive Vincent Clerc, who discussed the Danish company's outlook also on opening trade. Speaking earlier, Clerc explained why the ranges on their 2026 guidance are so big.
When you look at 2026, is still the big amount of uncertainty that there is around a couple of key fronts. And it all revolves around shipping rates, so the prices that we will be able to take. After a few years following COVID of bumper profits and historically high freight rates, we're seeing a normalization now with big investments in tonnage coming online ahead of supply. And as you mentioned, the Bab el-Mandab Strait reopening. And we expect more and more services to go through the Red Sea again, which will free further capacity, and we expect will create a pricing environment that will be under pressure for the shipping division. So that and the uncertainty that there is around the timing of how this is going to play out means a pretty large range, as you said. The rest of the business, though, continues to progress. Underlying demand for the services that we provide, whether it is in shipping, in terminal, or in logistics, remains strong. There's good opportunities for growth. There's good opportunities also for further margin progression. The one thing that is a big question mark is the freight rate environment, the pricing environment in the shipping.
Okay. And that's going to be determined by, amongst other things, the Red Sea, as you say. What's your level of confidence that the Red Sea is going to continue to reopen? We've got Iran-US talks taking place over the next few days. Huge amounts of tension in the region. We've got a carrier group from the US that's just arrived. What is your level of confidence that that Red Sea story is going to evolve kind of as anticipated right now?
Yeah, so I think let me start with the situation in Gaza, which clearly is making progress. We've seen the reopening of Rafah, and we seem to be moving into the next phase of the reconstruction there. So clearly the temperature has come down, and there has not been any attack for quite a few months now. That's why we have re-announced, after a few trials and a few ships sailing through the Bab el-Mandeb Strait, we have announced that we are going to have services now returning permanently through normal sailing routes. The first 2 with a date on them, the next 2 have been singled out, and the dates will be communicated shortly. So that will actually put a significant amount of our deployment back through the normal sailing routes. And we do this because we actually believe that the direction of travel, first of all, today is safe. And second, we believe that the chances that this will continue to move in that direction are much higher than the opposite. Now, as you rightfully point out, there is also a new situation playing out between the US and Iran, which we're following very closely. And we're going to act very prudently. If this was to evolve in a negative way, we can undo some of the decisions we have made so far. But overall, after a few years of absence from the Red Sea and sailing through the Suez Canal, we believe that the time has come now. The conditions are in place for a return.
Vincent Clerc there, Maersk Chief Executive Officer, speaking to Guy Johnson on Bloomberg's opening trade. Now, plenty more to come. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. Earnings season is here.
Europe's most valuable companies kick off earnings season.
Bloomberg is first to break the numbers.
Some breaking news from First Abu Dhabi Bank.
So Shell, SAP, Total's in the mix there.
You're bringing all the fun today, Guy Johnson.
With the smartest insights.
How are you feeling going into earnings season?
We are still confident that we can deliver to that acceleration of total revenue growth.
Give me a sense of what you're most optimistic about.
I really expect a very strong Q4.
Continuing coverage on Bloomberg.
The conversations that matter, the insights you need. This is a pulse, and I'm Francine Lacroix here in London. Now, the last major arms control agreement between the U.S. and Russia has expired, increasing the risk of a new arms race. The Strategic Arms Reduction Treaty, or START, had limited the size of both countries' nuclear arsenals and allowed for inspections. Now, in September, President Putin said he would stick to its terms if the U.S. did, but President Trump did not respond. And President Trump has also spoken with China's Xi Jinping in a call that covered trade and geopolitical flashpoints, including Taiwan. Now, their conversation comes as they prepare for a summit in April. Trump highlighted new Chinese commitments to buy more U.S. soybeans, energy and airplane engines, while Xi urged caution on Washington's planned arms sales for Taipei. And finally, speaking with NBC News, Trump framed the call positively.
Is there any doubt in your mind that interest rates are going to be lowered?
Not much.
Why? How can you say that?
I just think they're going to be lowered. I mean, they should.
Is your new Fed pick on board with that?
We're way high.
As the UK economy is in focus today ahead of the Bank of England decision, our next guest takes positive outlook of the UK's prospects. Sir Richard Harpin has amassed one of Britain's biggest fortunes through building up household repair business HomeServed, which was bought by Brookfield Asset Management in 2023. Richard is also founder of UK Family Office Growth Partners and joins us now. Richard, I always look forward to our conversations because you really have a unique viewpoint of what the UK needs to do. So first of all, how can the UK boost entrepreneurship?
I think even today that the UK is a great place for starting a business. I do think that we need to have a government that can get out of the way and let entrepreneurs just grow their businesses. And this is a place where we can, small country, but represents a global opportunity to expand internationally. And that's certainly what I did with HomeServe. Over 30 years, expanding into many countries, and we need more businesses to do that.
Richard, I mean, do you feel uneasy? There's a significant tax hike, right, that's coming in for family business owners from April, for example. Is there anything that just gets you, if not mad, just annoyed at the government for what they're doing?
We still have a low corporation tax rate at 25% for most businesses. We do need to make sure that the costs for businesses don't go up anymore. The business rates increases is not good. The employers' NI increases was a really bad thing to do. But really now we need to just focus on growth. The UK is really good at startups. We had over 350,000 last year. We have, though, only 7,500 large businesses in the UK. So we forget about those medium-sized, a lot of family businesses. There's about 100,000 of them, and we need to turn those into the next large companies.
Richard, there's a number of private equity that's looking for deals here, or private equity money that's looking for a home. I mean, is it something that you're looking at to partner with or do anything with? Because there are opportunities in the UK if done right.
Yeah, private equity is a force for good. I personally set up my own investment business, which is an entrepreneur investing in other entrepreneurs, 100 million of my own capital, another 50 million committed, and that's to try and help businesses to get more capital, to de-risk, and then to grow quicker.
When you look at the next couple of quarters, what are you most excited about? I know look at the markets, and I know at private dinners, people think about UK political risk. They think, look, is Starmer staying because of this unease in the labour markets? Are you having similar conversations, or do you think this is being overblown?
I think it's been overblown. I think it is really about whatever the difficulties in an economy, really important that those mid-sized entrepreneurs, chief execs, founders, just focus on growth. We do have 56 businesses in the UK that have achieved a value of $1 billion or more, where the founder's still involved. There are 94 FTSE 350 chief execs that have added more than $1 billion to their businesses since they took over as chief exec. So we need to do more of that. With my organisation Business Leader, that's about saying, how can we help mid-sized businesses to scale? I look back on my 30-year career at HomeServe and said, there's 9 things I know now that I wish I'd known at the start of my entrepreneurial journey.
Your top 3, what are they?
They are get some investment to grow. Second one would be get a coach or mentor. Most entrepreneurs don't look for that free advice that a mentor could bring. I got one Nigel Morris that helped me to conquer America when the model was wrong, and he helped me to really sort that out. We need more businesses to expand, and then it's really about getting the right team in the business.
But Richard, I mean, when you look at, what's the most common mistake? Is it not enough risk-taking, or is it actually not getting enough advice? Because they kind of, the two go hand in hand, right? You have to be bold, but if you're too bold and maybe become big too quickly, then a lot of companies fold because of that.
The biggest issue with entrepreneurs is we're foxes. We're always looking for the next opportunity, and we need to be really focused on a simple business model and then scale it with the right people and avoid those other distractions.
Richard, you have your book, which I love because it's actually in the Pulse colors. It's like you did it for the show because it's exactly the colors. But there's not enough optimism in the UK about entrepreneurship. Who needs to change that? Is it the government, policymakers, entrepreneurships?
I think it's up to entrepreneurs like me and others to celebrate entrepreneurship more. There's a big conference taking place on March the 26th here in London. 750 entrepreneurs running mid-sized businesses. Every week I run a 2-hour workshop helping entrepreneurs avoid all the mistakes that I made and embark upon a Business Leader 9 Steps growth program. So we just need more of that. If I was saying, are there a few things that this government could do to help business? Then number one would be let's get more investment to scale. We're doing that with the British Business Bank. Let's do more. Let's sort out apprenticeships. We need many more of those. Checker Trade is a business I invested in. We need another 1 million tradespeople in the UK in the next 10 years.
Well, hopefully someone from the government is listening. Otherwise, we're speaking to Governor Bailey a little bit later on. That was Richard Harping of HomeServe. This is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. The reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. A global tech sell-off stalling now as silver and gold continue their downward slide. Investors punishing Alphabet on its capex plans, ARM and Qualcomm on their forecasts. Amazon on deck today. And geopolitics in focus as Iran confirms Friday talks with the United States as a second day of tripartite peace talks continues in Abu Dhabi. Let's take a look at these markets. We have futures really just deciding on a direction at this point. Nasdaq 100 futures up about 0.1% right now. This, of course, after we erased all of our gains and more on the Nasdaq 100 yesterday. A really tough day for tech stocks. It's been a tough month, really, for tech stocks. And we have more earnings on deck today. It seems investors' bar is so high for these tech stocks. Anything displeases them. CapEx plans, for example, if they're too high. Memory problems are the latest thing that came out in ARM and Qualcomm results yesterday. Russell 2000 futures just hanging on in there. Let's take a look at bonds because we got the refunding announcement. It looks like it might be back-end skewed and that might cause the steepener trade to continue. The 30-year yield, as you can see, close to 4.92. But that 2-year yield is down to 3.54 at the moment, and that 10-year yield sort of hasn't decided on direction yet. Does it want to go back to 4.20 or does it want to break out of those ranges? Let's take a look at precious metals because we had that 2-day halt of the slide. In fact, we had a little bit of a recovery even. Looks like the slide is resuming, particularly for silver. Now, we're still at nearly $79 an ounce, albeit, but still, we're down 11%. Gold firmly back at the 480 level, which, you know, would have one time have been a, very, very strong gain for gold, but at this point it does seem to be a decline. And the dollar index is strengthening once today. We're seeing yen weakness again. All right, let's get to some individual movers now. For that, we'll go over to London and Chloe Malley. Chloe.
Good morning, Bonnie. Alphabet is looking a little weaker this morning. Revenue came in ahead of expectations, but the problem here is that the forecast for capital expenditure was way ahead of what investors had expected. So some analysts are saying this is good news, a sign that the company is really confident in AI. But then some are saying that this massive spending is maybe a little bit concerning. And we are seeing that reflected in those shares, down a little over 2% this morning. On the other hand, the fact that Alphabet is going to be a big spender is seen as a big positive for those companies within the AI infrastructure space. And we are seeing names like Broadcom, which is Google's chip-making partner, for example, move higher this morning in pre-market trading. The fact that companies are unleashing this AI spending means more business coming their way, and therefore this is green across the screen for those AI infrastructure stocks this morning. And finally, e.l.f. Beauty is also in the green after boosting its profit guidance. It said that the performance at Rhode, which is Hailey Bieber's skincare and beauty brand that it just recently acquired, had been particularly strong, and so we are up actually almost 8% this morning for this consumer brand.
Definitely a good acquisition there for e.l.f. Chloe, thank you so much. And coming up in this hour, we're going to be speaking with Kit Jukes of SocGen on the weakness we're seeing in the dollar. Our top story then, a sell-off in tech stalling as shares of Alphabet fall in the pre-market after outlining an ambitious capital spending plan to win AI customers.
Revenue from AI solutions built by our partners increased nearly 300% year over year, and commitments from our top 15 software partners grew more than 16x year over year.
Joining us now is Tom McKenzie, host of Bloomberg Tech Europe. So the Alphabet story is always a little bit different because Alphabet has its paws in so many things, right? Tom, what were investors not happy with when it comes to CapEx plans, given that it has a lot to spend CapEx on?
Well, indeed, and to your point about having its fingers in lots of pies, this is a diversified business everywhere from the chips that they produce, the TPUs, through to the data centers, to the AI models themselves, in which they now are arguably leading, to that touch point with consumers as well. And that's why Alphabet has outperformed some of the other mega cap tech names that we've seen, certainly year to date, more than that, in fact, over the last 6 months or so. So maybe it's a bit of profit taking from investors, because top line was this is a solid set of numbers coming through from Alphabet. Yes, the CapEx is huge, and certainly that is one of the headlines and one of the attention grabbers. $185 billion potentially at the up end of the forecast for 2026. That's more than the previous 3 years combined. But here is the context. They have a backlog of demand for the data center business of around $250 billion US, which just shows that demand that they're having to service, hence the CapEx spend. On the cloud unit at Alphabet, they saw growth of almost 50%, 48%. So the cloud business is growing very well. They have Gemini that's now being used by more than 750 million people. That was as of December. And again, the TPUs, the chips they're producing that are being used by companies like Anthropic, so they have that contract there as well. And this is a company, don't forget, Alphabet, that is now supplying AI to Apple. So yes, there's a bit of downward pressure today. Maybe the focus is on the CapEx spend, but longer term, there are a lot of drivers for Alphabet, many would argue, in terms of the analyst community, that could keep things going forward on the AI front for this company.
Yeah, it even broke out the numbers for Gemini Enterprise. It said it now has more than 8 million paid users, and it only launched 4 months ago. Tom, I want to move to the memory problems, because Qualcomm and ARM were also hit by this concern that there's a memory shortage and it's spreading.
Yeah, and because of that memory shortage and because of those memory chips are being diverted to those data centers, because of that AI demand, there's going to be less memory available for the makers of smartphones. We're going to be particularly seeing that in China, according to executives from Qualcomm. So that was the drag there, and certainly the stock under pressure on the back of that expectation that, quite simply, there will be fewer smartphones being shipped because of the memory shortage, and therefore fewer and less demand for Qualcomm's processors. Qualcomm, of course, has been trying to pivot to the AI data center story itself, and so into the future, there is a view from some analysts out there that it's still quite well positioned for the upside on the AI story, but the focus right now is on the fact that there are going to be fewer smartphones, much less demand, it seems, or at least less demand for their processors. One silver lining may be that the focus from the smartphone makers is on the high end of the smartphones, so they're going to be focusing on the most expensive models, so better margins for companies like Qualcomm. That could be something of a silver lining as we look at the shifting supply dynamic in terms of memory that's being diverted into data centers and away from smartphones.
It's a Techapalooza week. We have Amazon reporting after the bell today. Tom, what should we be looking for now that we know what's going on at some of the other tech companies?
Yeah, and look, Amazon's stock is what? It's barely moved in the last 12 months or so. I think down about 2%. The focus, of course, will be on both CapEx for Amazon, but also on AWS, on cloud and CapEx. Two familiar themes, of course, Vonnie, for you. So in terms of AWS, the expectation is you're going to see growth of about 20% or thereabouts, 21%. I think the expectation story is going to be there again for Amazon. So expectations are going to be pretty stretched in terms of what they can do on that front. So it may be for Amazon they're going to have to come through with a very solid beat to really propel the shares in this environment. But we'll see. AWS has been performing relatively well, and we'll see if that continued growth comes through. And then how much are they spending in terms of CapEx on their own data centers, and how much they're spending on the build out and design and research and talent to build out their own AI inferencing chip as well. That may also be something that is scrutinized in these earnings.
Well, we'll see how forgiving investors are today. Bloomberg's Tom McKenzie, thank you so much. Turning to politics now, President Trump telling NBC News that he has a fresh warning for Iran's leaders.
I would say he should be very worried, yeah, he should be. As you know, they're negotiating with us.
I know they are, but the protesters have said, you know, where are the Americans? You promised them we would have their back. Do we still have their back?
Well, we've had their back, and look, that country's a mess right now because of us. We went in, we wiped out their nuclear. So if I didn't take out, you know, we have peace in the Middle East.
Are they trying to restart the nuclear program?
Well, I heard that they are, and if they do, and I let them know, if they do, we're going to send them right back and do their job again.
Joining us now from Istanbul is Bloomberg's Patrick Sykes. Patrick, we do have confirmation from the Iranian side that talks will go ahead now Friday in Oman. Will anything but nuclear be on the agenda?
That is still the big question, I think. Officially, Iran is saying that it's exclusively about nuclear. They've, on the record, ruled out any discussion of missiles, and we assume the position's the same with regard to militias in the region. But we did have from the US Marco Rubio overnight saying that that had to be part of a deal. So the rhetoric for now is suggesting that there's still some ambiguity about the exact scope of these talks. That, of course, comes after we had the back and forth, the change of location as well. Initially, they were going to be in Istanbul. Now, as you say, the plans for Oman. So still a lot of ambiguity around them. And I think among analysts, that doesn't really bode well for the chances of a diplomatic, at least immediate diplomatic solution.
Well, we did have a spokesperson for Iran's foreign ministry saying Tehran is, quote, realistic in its approach. What does that mean out of Iran? Realistic in what way? That maybe this is just an opening gambit and it will consider putting other things on the table? Or that it's not expecting too much from the United States in the way of sanctions relief?
I think the latter to a great extent, right? Iran has been burned from the experience of the nuclear deal initially, with Trump backing out of that back in 2018. And then remember back in June, these same people were in a room negotiating about the same issue, Iran's nuclear program, when Israel began that 12-day war. So they also, there's very little trust on both sides about sincerity of the other party on the other side of the table. So for sure, they're realistic about that. I think for Iran as well, the priority is sanctions relief. That's what they've said, right? So I think if we're going to see any movement, we might expect to see it around the nuclear program. After that war and the US intervention that Trump mentioned in your clip, a lot of that, the material, the program was buried or effectively stopped. So perhaps moving on that wouldn't be quite so big a compromise for Iran to make now. But the red line for them so far is still this question of the right to enrich uranium. And that for the moment seems to be a red line that's holding. But perhaps there's compromise on the nature of nuclear enrichment and so on.
All right, Patrick, thank you so much. That is Bloomberg's Patrick Sykes. The European Central Bank set to keep interest rates on hold at its meeting today. Bloomberg's Lizzie Burden joins us now from Frankfurt. So if we already know that we're very likely to get a hold, Lizzie, what should we be looking for out of any statement and any comments from the President?
Well, Vonnie, it's been an eventful start to the week for all of us, but the ECB expected, as you say, to stand pat through it, and the expectation is they're going to be on hold since last summer for not just this year but next year as well. That's the expectation among economists and traders, and the growth figures just gone for the fourth quarter kind of give cover for the Governing Council to do just that. But you'll remember all of that hype around hikes not so long ago, even if it feels like a long time ago, after the commentary from Isabel Schnabel on the Governing Council and the market reaction to it. Well, that's faded because, first of all, we've had the inflation undershoot. Secondly, we've had the euro touching briefly last week $1.20, and that is, of course, an important level psychologically. We had the Vice President, Luis de Guindos, last July saying that's the level that complicates things for markets. And we've had the Bank of France Governor, François Villeroy de Gallo, saying that they are going to be factoring currency moves into their thinking about monetary policy. Because, of course, potentially it could dampen exports and it could make that inflation undershoot more persistent. But the third thing that they're going to be thinking about round the table here today is, of course, the geopolitics and President Trump's threats of tariffs on those nations opposed to his Greenland plans. Yes, he walked those tariff threats back, but the trade uncertainty lingers over the euro area economy. So all of which to say, these are downside risks, Vonnie. I wouldn't expect Christine Lagarde to be talking hawkishly today. I was speaking to Martin Kocher, the Austrian central bank chief. He says that they need full optionality retained in case they need to react at some stage. So I would expect her to stick to that language around a data-dependent meeting-by-meeting approach.
All right, Lizzie, thank you so much. Lizzie is in Frankfurt, and we'll have live coverage of ECB President Christine Lagarde's news conference later on today. That's Lizzie Burden there. Now to other top stories trending on the terminal this morning. Underperforming HSBC bankers can see little or no bonuses potentially, taking a Wall Street-style eat-what-you-kill approach to pay. According to sources, underperformers may be nudged towards the exit after bonuses are paid in the coming weeks. The bank is in the midst of a major restructuring. Fresh political risk in the United Kingdom is knocking the pound and longer-term bonds. The gap between 2- and 10-year gilts hit its widest since 2018. Sterling was the worst-performing currency among peers. The moves come as doubts build over Prime Minister Keir Starmer's grasp on power. And Shell fourth-quarter profit missed estimates. The energy giant saw weak oil trading performance and its struggling chemicals business hit. Shell is maintaining its quarterly share buyback of $3.5 billion. Coming up, Maersk shares are slumping on the shipping giant's uncertain outlook. Our interview with the CEO next. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. Earnings season is here.
Earnings season is upon us.
Can they surpass expectations?
Bloomberg is first to break the numbers.
Taking a look at Starbucks.
Meta with the outlook.
eBay also reporting earnings.
More earnings to get through.
With the smartest insights.
You start the year at 22 times forward earnings. You're just going to have a more sensitive market.
We're probably going to have another good earnings season.
And our conversation continues here on Bloomberg.
Continuing coverage on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Maersk shares are lower by about 5.5% now after reporting its latest earnings. CEO Vincent Clare says the company could face challenges with the reopening of Red Sea routes. He spoke with Bloomberg's Guy Johnson.
When you look at 2026, is still the big amount of uncertainty that there is around a couple of key fronts. And it all revolves around shipping rates, so the prices that we will be able to take. After a few years following COVID of bumper profits and historically high freight rates, we're seeing a normalization now with big investments in tonnage coming online ahead of supply. And as you mentioned, the Bab el-Mandab Strait reopening. And we expect more and more services to go through the Red Sea again, which will free further capacity. And we expect will create a pricing environment that will be under pressure for the shipping division. So that and the uncertainty that there is around the timing of how this is going to play out means a pretty large range, as you said. The rest of the business, though, continues to progress. Underlying demand for the services that we provide, whether it is in shipping, in terminal, or in logistics, remains strong. There's good opportunities for growth. There's good opportunities also for further margin progression. The one thing that is a big question mark is the freight rate environment, the pricing environment in the shipping.
Okay. And that's going to be determined by, amongst other things, the Red Sea, as you say. What's your level of confidence that the Red Sea is going to continue to reopen? We've got Iran-US talks taking place over the next few days. Huge amounts of tension in the region. We've got a carrier group from the US that's just arrived. What is your level of confidence that that Red Sea story is going to evolve kind of as anticipated right now?
Yeah, so I think let me start with the situation in Gaza, which clearly is making progress. We've seen the reopening of Rafah, and we seem to be moving into the next phase of the reconstruction there. So clearly the temperature has come down, and there has not been any attack for quite a few months now. That's why we have re-announced after a few trials and a few ships sailing through the Bab el-Mandab Strait. We have announced that we are going to have services now returning permanently through normal sailing routes. The first two with a date on them. The next two have been singled out, and the dates will be communicated shortly. So that will actually put a significant amount of our deployment back through the normal sailing routes. And we do this because we actually believe that the direction of travel, first of all, today is safe. And second, we believe that the chances that this will continue to move in that direction are much higher than the opposite. Now, as you rightfully point out, there is also a new situation playing out between the US and Iran, which we're following very closely. And we're going to act very prudently. If this was to evolve in a negative way, we can undo some of the decisions we have made so far. But overall, after a few years of absence from the Red Sea and sailing through the Suez Canal, we believe that the time has come now. The conditions are in place for a return.
Maersk CEO Vincent Clerc speaking there with Bloomberg's Guy Johnson. Coming up, the latest on SpaceX's plans to go public. More on that, and a look at what else is making your headlines in your front page news. This is
Bloomberg. And now stories to the International Space Station.
Like ourselves, and then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
This is Bloomberg Brief. I'm Vonnie Quinn in New York. Time now for your front page news. First up on the Wall Street Journal, SpaceX is looking for an early boost for its shares after its IPO later this year. According to the Journal, advisors to Elon Musk have reached out to major index providers for guidance on getting included in the indexes sooner than usual. The process typically takes several months, even a year after a public debut. Inclusion, of course, unlocks access to retail and institutional capital. Next up, the Washington Post is reporting the Supreme Court has cleared the way for a California voting map that bolsters Democrats. It's a major victory for the party as it looks to offset a nationwide push by Republicans and President Trump to redraw congressional maps to gain advantage in this year's midterms. The ruling will remain in effect while a lawsuit challenging California's map works its way through the courts. And finally, the New York Times on that call between President Trump and China's President Xi Jinping. The Times says the lengthy phone call covered a range of issues, including Iran, Ukraine, and soybeans. Mr. Trump described the call as, quote, excellent, long and thorough. The Times says a description from Chinese state media was much more forceful and suggested the issue of Taiwan was front and center. And those are your front page headlines. Let's take a look at markets, because that two-day rebound that we saw for precious metals has now been firmly arrested, and we are seeing volatility once again, with silver down 11%. In fact, silver volatility is approaching a record. Gold down 2%, still at the $4,800 mark. And then some strength to the Bloomberg US dollar index. We're seeing weakness, particularly for the yen, ahead of the weekend's elections. We're going to be speaking with Kit Jukes about currencies in a moment. Let's take a look at futures, though, because a tough round of tech earnings, investors really punishing the likes of AMD, Qualcomm. S&P futures are pointed higher. We'll see if that stays through the day. We have Amazon later on. Bitcoin still trying to find a floor, $71,500 now, and that 10-year yield at 427.56. We are seeing the 2-year yield drop and a steepener trade on, with the 30-year yield just rising ever so slightly. Coming up, we're going to be looking at dollar pressure with Kit Jukes, Societe Generale's chief FX strategist. That's next. This is Bloomberg.
A cidade estava sitiada.
Isso ao começo eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. The global tech sell-off stalling potentially as silver and gold continue their downward slide. Investors punishing Alphabet on its capex plans, ARM and Qualcomm on their forecasts. Amazon is on deck today. And oil drops as Iran confirms Friday talks with the United States, easing immediate risk of military strikes. That said, oil still above $64 here in New York. Now look at that, we have a turned around picture. So futures pointed firmly higher. This after a pretty major sell-off yesterday. The Nasdaq really erasing all of its gains for the year in yesterday's session. It was down 1.8% at the close. The Russell 2000 is continuing on its merry way. It's the leader this year, and I guess it aims to remain that way. If we look at bonds, we are seeing a steepener trade in place. We did get the refunding announcement. It shows the next round of Treasury sales is pretty back-end loaded, so we have the 30-year yield above 4.92, but that 2-year yield is lower now. It's at 354.71. And let's take a look at metals, because we had that 2-day arrest in the slide, even a rebound for silver and gold. Well, the drop has resumed. Silver down is more than 11%. Its volatility approaching a record. Gold down another 2.2%. And the US dollar index, even though we're weaker generally, that dollar index is higher today versus the yen and a couple of other currencies. So for some stocks to watch, let's get to Chloe Melly now in London. Chloe.
Good morning, Vonnie. Alphabet is weaker this morning because of those big spending plans. So the capital expenditure forecast came in way ahead of what analysts and investors had expected. And the reaction has been a little bit mixed. Some are saying that this is good news, a sign that the company is committed to and confident in AI, whilst others are saying that this massive spending spree might be perhaps a cause for concern. And so while that might be the case, this is actually a cause for celebration for AI infrastructure stocks. So those are the companies that make AI gear, companies like Broadcom, which is moving higher this morning because companies unleashing this AI spending is going to be beneficial for those companies. And so we are seeing the likes of Broadcom, Marvel Technology, Applied Materials, all moving higher this morning in pre-market trading. And finally, we've got Elf Beauty, which is also, well, actually, let's go first to Broadcom, Marvel, Applied Materials, as I was mentioning. And then finally to Elf Beauty, which is also in the green this morning after boosting its profit guidance. It seems that it has made one particularly good move, which is the acquisition of Rhode, the skincare and beauty brand from Hailey Bieber. The strong performance there is going to be driving those prospects for the company going forward, and it is up more than 8% in pre-market trading.
Chloe, thank you so much. Chloe Melly there. The Bloomberg Dollar Spot Index headed for its first back-to-back gains in almost a month, but it's generally at its weakest level in nearly 4 years. Kit Jukes says it's thanks to the relative weakness of US rates and the impression that President Trump would welcome and continue to welcome a weaker dollar. Kit Jukes is Chief FX Strategist at SocGen, and he joins us now. So Kit, is the direction of travel fairly set? What would arrest this decline in the dollar, this weakness that persists?
It's a fight between two forces, really, in the sense that the US economy is still outperforming everybody else. The market is pricing in rate cuts that might get rates down a little bit towards neutral, but nothing more than that, because there's a desire for lower rates, but probably the inflation and growth outlooks don't really support it. The other side of it is just the will of the president, or the will of the president and the Treasury Secretary to have a weaker currency, because they believe that'll help them rebalance global trade. And that's a more complicated issue. You can see the political risk. You can measure the political risk now dragging down the dollar at the same time as on mornings like this morning when the markets are nervous and risk off. You can see the dollar rising on those. So we're in a tug of war. That means the euro-dollar exchange rate, which drives DXY to a large degree, is in a pretty tight range. So not doing anything very exciting. And then you've got all sorts of other currencies moving much more dramatically. I think at some point, I don't always think that the economy is going to win. And if the US economy doesn't run into a recession, we'll have a stronger dollar before the end of the year. But right now, it's a tug of war.
Kit, what do you make of the Kevin Warsh pick? Assuming that he does become Fed chair, is it for certain that he's going to cut rates? I mean, President Trump thinks so, but there does seem to be some kind of an impression out there that he could surprise the president.
Well, he doesn't get to decide on his own. There's a whole FOMC out there, lots of other people, and history says that once you get a new chair in, the process kind of has an impact. It's hard for one person to force everybody else to go along with them when you have a vote every time. So I don't think that'll stop the first rate cut. That one looks kind of more straightforward, just in a process of normalization. But if we were to see tariff-induced inflation coming through, import prices coming as inventories of pre-tariff stocks run out, and so Americans start paying more for goods, I think it gets difficult. If we continue to see GDP growth strong, kind of regardless of what's happening with the labour market, it gets more difficult. So it's okay for now, and one rate cut, fine. I think it gets tougher after.
Kit, you mentioned, the euro and the ECB obviously making its decision today, likely to stay pat and so on. Is it comfortable with its level of rates here and with the relative strength of the euro?
The ECB is not comfortable with the strength of the euro because in real effective terms, it's got very strong, partly because it's got so much stronger against the Chinese yuan. And if you sit around in Europe, you see an increasing number of Chinese cars, Chinese-made cars, have arrived in Europe. So they're not at all comfortable. They're getting downside surprises on the inflation data at the moment as well. But they are getting some upside surprises in growth, particularly in Germany. So I think they're in a, they're kind of okay in their mindset, but they don't want the currency to go higher, and they might start saying something about it quite soon.
Interesting. So you think there could be some kind of verbal intervention. Kit, we also, speaking of, have had some turbulence, let's say, with Japan, and we get those lower house elections this weekend. The yen has been weakening since it hit 152 in late January. Do we get more turbulence that filters through into the broader markets out of all of the ructions that are happening politically in Japan?
Well, I think we'll have clarity on the politics, or we should have, after the weekend, and that comes down. But we won't have clarity on policy. The markets are concerned that the original Abenomics plan was to get out of the funk the economy's been in with a fiscal boost and to get growth to then start getting the debt to GDP rate down. Unfortunately, the debt to GDP rate now is much higher than it was then, and markets are worried that if you tried to go for that again, it could backfire. Restoring confidence in debt sustainability in Japan's probably the most important thing for turning the currency around. And I don't know how you do it quickly. That's really the problem. You have to win over confidence gradually, that people stop worrying about the long end of the yield curve and other things that show that. So I think it's likely to be quite bumpy. We're also so far away from any kind of sensible equilibrium for yen crosses for the yen in general that it's kind of nuts at the moment. The Korean won looks like it's stabilizing. The yuan isn't going down anymore, and the yen is on its own, sort of cast adrift.
Kit, as you look out through the year, we have the RBA already kicking off its hiking cycle. It's the first major central bank to do so. But generally, it's going to be a long year, right? And the US market is still looking for 2 rate cuts and so on. All of this could change multiple times. Where do you see the points in the year where we might see some turbulence, some difficulty, some tantrums, some jitters, let's say, in either the rates or the currency markets?
I think the first half of the year is where things are difficult, in the sense of, and it's this conflict between, let's call it geopolitics and economics. Then that needs to sort of settle itself down so we understand what we're doing. We're just reacting to headline after headline after headline after headline at the moment. Then we can get back to the economy, and that's more tricky still, just because, for example, I don't know, if we were to have a labour market report this week, I wouldn't know what to do with it, because it's decoupling from the economy at this point in time in the US. So it's going to be difficult, but I think we should settle down to relative growth, relative rates being more important at the back end of the year.
All right, Kit. Well, lucky for you, we don't have that data this week, but we will have it next week, apparently, on February 11th. Kit Tukes, always a real pleasure speaking with you, SocGen's Chief FX Strategist. Thank you. Now to other top stories trending on the terminal this morning. Underperforming HSBC bankers could see little or no bonuses this year. The bank taking a Wall Street-style eat-what-you-kill approach to pay. According to sources, underperformers may be nudged towards the exit after bonuses are paid in the coming weeks. The bank is in the midst of a major restructuring. Fresh political risk in the United Kingdom is knocking the pound and longer-term bonds. The gap between 2- and 10-year gilts hit its widest since 2018. Sterling was the worst performing currency among peers. The moves come as doubts build over Prime Minister Keir Starmer's grasp on power. Meantime, the Bank of England is expected to leave interest rates on hold when it releases its decision today. The central bank expected to wait for more evidence that inflation is under control, despite rising concerns about its labour market. Coming up, President Trump has a fresh warning for Iran as talks are now set for tomorrow. More on that next. This is Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
We have 2 crises, 2 essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
I would say he should be very worried, yeah. He should be. As you know, they're negotiating with us.
I know they are, but the protesters have said, you know, where are the Americans? You promised them we would have their back. Do we still have their back?
Well, we've had their back, and look, that country's a mess right now because of us. We went in, we wiped out their nuclear. If I didn't take out, you know, we have peace in the Middle East.
Are they trying to restart the nuclear program?
Well, I heard that they are, and if they do, and I let them know, if they do, we're going to send them right back and do their job again.
President Trump there sending Iran a fresh message during his interview with NBC News. Diplomatic talks between Washington and Tehran are set for tomorrow. Joining us now from Washington is Mika Solner of Bloomberg Government. What should we be hoping for out of these talks, Mika?
Yeah, these talks are going to be very critical right now with both countries, the U.S. and Iran, coming in with very different expectations set. This is going to be the first time that the U.S. has really engaged in negotiations since the U.S. military bombed Iran's nuclear program, essentially. And tensions are very high right now between the two countries, with President Trump really escalating rhetoric and threats against Iran since they have cracked down on protesters on the ground too. So I think that we're going to see the White House and President Trump come in very bullish in these talks too.
We also have tripartite talks, a second day of tripartite talks going on in Abu Dhabi with Ukraine, Russia and the US. What should we expect out of those talks? And, you know, are we any closer to a breakthrough?
Yeah, this has been a strong frustration point for the White House, I would say. I know that Caroline Leavitt this week said that the president has been increasingly disappointed, but not surprised by Russia's actions against Ukraine. You know, I think that we are going to see more in terms of the concerns about a potential arms deal with the expiration of a critical.
Think we may be frozen there. That is Mika Solner in Washington, D.C., and we're always very grateful, Mika Solner of Bloomberg Government. Turning to tech, sell-off in tech stalling now as shares of Alphabet fall in the pre-market after outlining an ambitious capital spending plan to win AI customers.
Revenue from AI solutions built by our partners increased nearly 300% year over year, and commitments from our top 15 software partners grew more than 16x year over year.
Joining us now is Bloomberg's Matt Bloxham of Bloomberg Intelligence. So, Matt, I mean, you know, it's a one-day move in the shares. We shouldn't read too much into it. But is there a problem with Google having a $185 billion CapEx spending plan?
There is, if that revenue doesn't keep growing at a kind of rapid rate. I think that's the big question people have is what is the return on this investment going to be and how quickly is it going to be coming through? I mean, they're kind of, personally, I think they're doing the right thing because, we've seen recently Meta plan to double their capital spending in 2026. There is still very much a land grab going on out there for data center capacity, power, chips, and if you're not in that game, then your kind of mid to long-term outlook is severely impeded. So I think they have to spend, they have to match their big rivals, and they have to figure out ways to kind of make that investment pay off. And actually, when you look at the operating results of Google, they're doing a pretty good job. I think the core parts of their business, which is essentially their ads business, which is 75% or so of revenue, grew faster than expected. That's been the area that not so long ago people were worried was going to be really hit by the AI revolution, and they're doing a great job of integrating their Gemini product into traditional search and keeping that ad machine going. And obviously the other bit of their business that's really important is cloud. That also beat expectations. And so they're delivering on the operational side. They just need to keep that momentum going to make people feel comfortable that big investment is going to pay off.
And shares are up 72% year over year, so we should have that context there as well. Now, Qualcomm and ARM, a fresh concern here that this memory shortage is spreading. Why did the two companies give off that impression?
Yes, obviously we've been talking for a few weeks now about how the memory shortage is impacting supply, particularly for smartphones, and also pushing the costs up. And when you look at the overall smartphone market, that means the outlook for sales is falling, and it's much more skewed towards the high end. And that's obviously an incredibly important market, particularly for Qualcomm, but also ARM. So they're both delivering fairly muted outlooks, and certainly for Qualcomm, the forward guide for the quarter missed expectations on revenues by as much as 9%. So the slowdown in smartphone shipments is becoming a reality, and that's definitely going to impact both of these companies' momentum in 2026.
Now, Amazon reporting after the bell. It's going to be a big one. What should we be watching out for, Matt? Where could it surprise us?
Yeah, it's a big business. I think the big focus is really going to be again on their cloud business and the extent to which they continue to see strong momentum in that business and how much of it is pivoting towards AI-powered revenue. The other area that's grabbing more and more attention is their ads business, which is turning into kind of a huge business in its own right that's kind of rivaling both Meta and Alphabet. And so I think there'll be a lot of focus on that part of the business too.
All right, Matt Bloxham, thank you so much. Matt Bloxham of Bloomberg Intelligence there. Private equity firms KKR, Blue Owl, Ares, TPG, they're all reporting before the opening bell today, as of course they're getting caught in the software rout. For some of what to watch, we're joined now by Bloomberg Deals reporter Crystal Seam. So Crystal, give us just a broad picture. What are we expecting in generally from the PE firms reporting this morning?
Yeah, Vonnie, so we have quite a few private capital firms reporting before the bell today, like you said, KKR, Blue Owl, Ares, TPG, and obviously the key metrics that everybody always looks for are fees growth, fee margins, and AUM growth. But what you're highlighting here is that they have all been through quite a few weeks of rough patches in terms of stock price. Blue Owl in particular, stock's been down 50% in the past year. And if you look at the S&P, which is up like 12%, 14% in the same period, it hasn't really done so well. And that is largely attributed to the tech sellout, given how many of these big tech LBOs that these funds have funded in the 2021-2022 era.
Yeah, it's for sure that we're going to hear a lot of questions on the conference calls about that. What could be the potential impact of this week's AI-fueled rout here?
Yeah, so actually our colleague in New York, Olivia Fischlow and Laura Benitez, has wrote about it, this phenomenon. They call it SaaS apocalypse. Basically, a lot of these software SaaS companies are going to be impacted by AI. And when those deals were done, when those LBOs were done, very little impact of AI were being talked about. And these private capital firms had done a great role in funding these takeovers. So we'll be closely watching what management in these firms are going to say about tech, about AI, about the impact of AI in tech. That is going to be a very, very big focus. And other than that, the one thing that I am particularly watching is any comment on private capital firm consolidation, so M&A of these big firms. It's been well talked about that, Blue Owl has been very acquisitive over the years. This big combination between them and Dial, anything to come after that is also a big focus.
Yeah, I mean, will we get a picture after all of these conference calls and everything everybody says today of the health of the industry in general? Because some of these firms, are in different sectors to others, right? They're not all direct competitors in parts of their businesses. So, you need sort of a broad idea of the health of the industry first before you can dive in, right?
That's true. So they all focus on slightly different things. For instance, Blue Owl is a little bit more exposed to the private equity market because they actually take a lot of GP stakes in various private equity firms. So how private equity impacts them most, but all of them actually have quite similar investment strategy where they do private credit. Some of them have more real estate. So it is going to be a very complex earnings result. So it will take us some time to look through it.
All right. Well, we'll see if that SaaSpocalypse phrase continues to hold water after today's conference calls. Crystal C, thank you so much. That is Bloomberg's Crystal C of our deals team. Coming up, we'll get you set up for your trading day with more earnings and central bank decisions. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazlida Amin in Davos, Switzerland, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. Now a look at what's ahead today. So we have the Bank of England rate decision. That's at 7 a.m. New York time, along with a news conference, of course, from Governor Bailey. Plus the ECB rate decision. That's at 8:15 a.m. Eastern. President Lagarde's news conference at 8:45 a.m. And the big one, we have Amazon earnings out after the market close. Plenty of earnings throughout the day, though, including the private equity companies before the market open. Let's take a look at your macro setup for this Thursday trading day. So we had 2 days of a return to form, if you like, for the precious metals. They were higher in the last 2 days, having sold off. Well, that sell-off has resumed once again, and silver has given up the 2 days of gains that it fought so hard to have in the last 2 days. Still at 78.57, which is still elevated relative to recent times, but that volatility in silver is really elevated. In fact, it's very close to a record. Gold as well, down 1.8%. Wouldn't necessarily call it a slide, but it's definitely giving back some of those 2 days of gains that we saw. Still close to $4,900 an ounce, though. The Bloomberg Dollar Index up about 0.2%. Back-to-back days of gains, but it's generally weaker. You heard Kate Jukes earlier saying, look, when it's going to be a risk-off environment, when the market is a little nervous, you will see days of gains like this. And of course, we have Japan elections at the weekend, and that yen is very much weaker. Of course, the euro trading in a range today as well. Now, let's take a look at futures. They are pointed, well, they have erased those gains now. It seems like U.S. markets are trying to figure out a direction after a major sell-off, particularly for the Nasdaq yesterday, erasing its gains and putting it into negative territory for the year. Crude coming off a little bit, but if you look at New York crude, that $64 is elevated relative to recent levels. And there's not that much happening in yields, but what is happening is a steepening of the curve. We're seeing the 2-year come down and the 30-year go a little bit up. That is it for Bloomberg Brief. Surveillance is next.
The game here is understanding. These digital assets have the ability to change the payment landscape of the world, and we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading cryptocurrencies. What we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoins?
We could. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need, because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersecci in Davos, Switzerland, and this is Bloomberg.
The
This is an environment of winners and losers.
The sum total in our mind is that people are cautious with regard to technology.
There is anticipation of disruption.
AI is creating a major disruption.
The real asset bubble is still in front of us.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday after a two-day tech rout, Alphabet topping estimates and announcing a monster year of capex following a $1 trillion wipeout in software stocks over the past week. Embattled private market firms are lining up to report quarterly earnings. Aries, coming up this hour.
Yeah, and it just actually dropped. And what you're seeing, and we'll dig into the numbers, of course, is that the earnings per share came in lighter than expected at $1.45 versus the estimated $1.68. Look, we could break down all the numbers. What people are going to be looking for is A, exposure to software, B, ability and willingness to continue to finance the capital expenditure boom that we're seeing from the likes of Google and Meta and everybody else. Ultimately, we are entering a new phase of the tech cycle, which hinges on the leverage and the willingness to provide that from the credit market.
Well, let's talk about the capex from Alphabet. Check out these numbers, up to $185 billion. So take 26 and compare it to the last 3 years. It's more than that. It's absolutely ridiculous. And compare it to something like this. Let's go through the numbers in the UK. The borrowing of the UK and the debt market over the last 12 months, basically the capex projected from Alphabet over the next 12.
Yeah, what you said this morning before the show is that ultimately some of these tech companies are entire countries unto themselves. We've seen that with a market cap, for example, of NVIDIA itself, which is essentially the entire economy of a couple big European countries. So you start looking at this and you start understanding how this can dwarf all other narratives. There is a real question, though, with Google. Yes, their free cash flow does finance a lot of this, but not enough of it anymore, because suddenly the business model is changing, and that's what some of these numbers really do highlight.
These numbers contribute to a decent slice of US GDP. A range of estimates out there, but JP Morgan Asset Management saying that roughly 40% of the US GDP growth through the first 3 quarters of last year came from tech capex, and those numbers are rising, not falling.
And that's why actually there's a lot of consternation around all of this spending, because the spending is going to the GDP, the US economy, but are the jobs still coming with it? And there is that disconnect. You know, the president was asked about this in an NBC News interview. Apparently he doesn't really use ChatGPT or Claude, but he said it's not going to take jobs. And he talked about the internet and past revolutions we've had in this country and how actually it's been a productivity growth.
It's an uncomfortable but relevant question. Even if we had the jobs number tomorrow morning, got to wait a few days, but let's say we got it. Kit Chicks of SocGen, catching up with Vonnie Quinn in the last hour. If we were to have a jobs report on Friday, I wouldn't know what to do with it. That's the problem right now for market participants.
We got ADP numbers yesterday. No one knew what to do with them. We've gotten a lot of data, and nobody understands exactly whether it is good or bad or what we're looking at, because ultimately you're seeing wage growth in certain areas, not so much others. You're seeing healthcare gains, you're seeing education gains, but you're not seeing places that typically fuel the economy. What are we looking at? This is an economy in flux, and people are just saying, you know what? We're going to ignore it and do what? Buy gold, buy silver, sell silver. It feels like there's a real turn amid the uncertainty.
I can't keep up with silver. Last time I looked, we were selling silver. Yes. That might change in the next 5 minutes or so. New schedule for the data. OK, so for payrolls, no longer tomorrow. That's going to drop on February 11th. For CPI, that report's going to come on February 13th. We'll keep going through the schedule later this hour, but that's the latest for jobs and for CPI. If you're just joining us, welcome to the programme. Futures basically unchanged, but as you all know, beneath the surface, some vicious moves we need to get through this morning. Coming up, we'll catch up with Seema Shah of Principal Asset Management as AI fears rattle markets, Ed Mills of Raymond James as President Trump intensifies threats on Iran, and Mark Mahaney as Alphabet plans to double capex this year. We begin this hour with stocks struggling to stabilise following 2 days of tech losses. Seema Shah of Principal Asset Management writing, AI's productivity and economic benefits remain more prospective than proven, underscoring the importance of diversification. Seema joins us now for more. Seema, welcome to the programme and good morning to you. The sell-off in tech, is it a problem for tech investors or a problem for the market?
Good morning, John. Well, I mean, I think it's a problem for a bit of both. I think the good news is that there's other opportunities out there. But before I go there, I mean, I think we have seen this build up. The shift has been building up for the last couple of months. I mean, in Q3, Q4 of last year, the narrative around tech and AI was really about questioning of valuations, about bubble, the capex spend. And now you're seeing it shift even further, so that there's not just questions about valuations, but it's actually the models. Can they actually deliver? Which part of the market could they cannibalize themselves, etc.? So increasingly for investors who once upon a time could see this as a one-way trade, this is really about dispersion and understanding not just balance sheets, but what is the model, how exposed are they, etc. So I think for that reason, it makes sense that investors start to think about where else can we go. And the good news is that it's a strong macro backdrop, not just in the US, but globally. And that means that there are other opportunities. And certainly we are seeing clients increasingly ask the question of where else can we go?
Well, let's start with the US and then we can turn to the international story. Equal weight yesterday, all-time highs. Bank stocks, regional players, just short of a record at the close. Bank of America, 5-day winning streak for Bank of America. What is happening elsewhere in the market away from the technology story?
Right, so we've seen this broadening out of earnings growth. We've seen a number of sectors really performing well. And I think that's backed up generally by this strong economic backdrop that we're all talking about all the time. That resilience is playing through in cyclicals, but it's interestingly, we're also seeing in areas like consumer staples. So clearly AI beneficiaries, cyclicals, and areas of the market that maybe hadn't performed well in the run-up over the last couple of years. So I think there's a number of narratives going on. And so investors are increasingly wondering, which ones do we want to pick?
Seema, I wonder how much this is technical as well as fundamental. Yes, there have been some reasons for there to be this incredible violent rotation that we've seen under the surface for the past couple of days. But how much of this is leveraged funds getting blown out or some sort of massive technical shift that's happening in algorithmic trading strategies?
So essentially, there's always going to be some kind of concerns into that level of technicals and how much that is playing out in the background. But to my mind, actually, a lot of this is driven by fundamentals. I mean, there has been, just on the tech story, there has been indiscriminate selling. So there's going to be areas of the market which are opportunities. But I think a lot of this is a fundamentally driven narrative shift, which is causing this shift to come through.
How much do you see this as continuing to support the overall index? John was pointing out that the equal weight of the S&P 500 had just reached a record high. You're actually seeing more gainers than losers. More than 350 of the 500 members of the S&P 500 gained yesterday, which is one of the biggest going back. I mean, how much is this sustainable if you don't have the leadership of some of the tech giants?
Right, the arithmetic isn't great, right? We need almost those big tech companies to be performing well and delivering in order to get those big gains. Is why the 7,000 level just seems to be so difficult to pass for the S&P 500. We should, as you said, we've seen a lot of other companies doing fairly well, but it's certainly, as we're looking out as a full year for the S&P 500, we're not expecting very significant double-digit gains. Certainly less than what we've seen in recent years, because without that tech drive, the maths is just more challenging.
Seema, you talk about how the true balance remains in having that exposure internationally. Where do you like?
Well, I think there's opportunities everywhere. And I think, as I said before, the global macro picture has improved. We still think that the US is one of the strongest. But certainly in Europe, across Asia, there are opportunities. So, for example, within Europe, the valuations are slightly more attractive than the US. It's not very significant. They are slightly more attractive. But we've seen this pick up in earnings growth. So areas that we continue to like, European banks, European industrials, some areas there. And then in Asia, what has been interesting is that up till this point, the interest in Asia has been, again, about tech, but because it's been trading at cheaper valuations. So I think there's certainly some assessment to be made there. But even from a China macro picture, we're, for example, expecting a bottoming out of the property market woes. And that should really feed through not to just the China fundamental story, but across to other parts of Asia. So, and then, of course, emerging markets, given the generally the weak dollar story. So we don't just have to focus on the US, and it's not about saying, get rid of all of your tech exposure by any means. It's about that kind of balance and diversification within the portfolio.
Well, Seema, let's stick on that word, diversification. If I'm buying South Korean equities, and the Kospi, by the way, has been on a wild ride, as you know, over the last week, am I getting real diversification or a different flavour of the tech story?
Right, and you're getting a bit of a different flavour. So there's diversification against US tech, but it's not really diversification against the tech story. Now, the Asian market, the Asia tech market, does look slightly different, so there's going to be some beneficiaries on there. But certainly, we want to be looking at other sectors as well. So this is a big story of not just country, it's asset class, and it's also sectors, to try and get that bigger picture, but also to really benefit from the cyclical upswing. It's not just about avoiding, it's also about benefiting from areas that should actually do really well in this environment.
Seema, as you know, software in this country and worldwide has been absolutely hammered. There's a real margin profit risk that we can discuss. I actually want to talk about the financial risk associated with it and the divergence we're seeing on a morning like this morning between a company like Ares Management and what they're telling you about the business and what you're seeing in the stock. The stock year to date is down by 15%. They've been hammered recently, along with the likes of Blue Owl, TPG, KKR and Apollo. What you're hearing from company management is that we're seeing robust investor demand across all three of our channels continuing. We expect another year of fundraising could match or exceed our record levels from 25. What they're saying is right now they don't have a problem in the business. Do you see any financial risk building?
Well, I mean, at the moment, look, investors don't want to touch anything which has exposure to software. And unfortunately, that is a problem for these companies today. And that indiscriminate selling means that some of these are getting pulled down. There are risks, of course. We know that just looking at private markets, that there are risks lurking there. And suddenly these are such big players that we want to be kind of following that story really carefully to make sure this doesn't become something which is a real sustained selling pressure and then become something which is a little bit more systematic.
Seema, as an investor, does that make you more concerned about going into, say, even the investment grade corporate bond market, considering that a bigger and bigger proportion of it is going to come from some of these hyperscalers and some of these big tech companies? I mean, we talk about how there is a shift in the cycle and the business model. It is being financed by leverage.
So I think there are certainly some concerns. And just like we would do in the public market space for credit, we would be trying to differentiate between the sectors, which are the companies, what are their exposures, what are their safety levels. And I think that that's exactly the same for private markets. It always has been, certainly a little bit more so than now. I mean, one of the areas that we do like, for example, is direct lending. There's typically higher quality. You have more exposure to things like utilities. So I think there are areas, but just like in public markets, it really does require a deep analysis to know exactly what you're getting into.
Hey, Seema, it's good to hear from you. Thank you. Seema Shah there of Principal Asset Management. Big focus of the market over the last week. In fact, the last 5-6 months. The perspective and real disruption you're seeing in the software space. I mean, we could talk about the threat to margins and to market multiples on that part of the stock market. But it's also the financial risk associated with that and the exposure that many of these firms are carrying.
And Ares actually in their earnings reported and laid out exactly how much software exposure they had. They said that software represented about 9% of its total private credit assets, but they also went on to say that all of their software companies had continued to increase their earnings faster than the overall loan book. So again, it goes to this question of, do the fundamentals justify the financial response?
There's a difference between what you're hearing about the business, what they're telling you is on the loan book, and what investors are worried about right now. And that's the issue, I think, for a lot of people, that these stocks are being used as proxies just to kick around the story on any given day. And the management teams are coming out and trying to tell you that actually they're aware of the risks and this is how they're building or not.
Yeah, ultimately, how do you counter a story that is in faith and belief? It goes to the whole DeepSeek moment, as Anne-Marie was talking about yesterday. It goes to this question of how much people are just so worried about the disruption of any given software in an instant, in a way that things are developing outside of their expectations.
Equity futures on the S&P just about unchanged, but there's nothing boring about this market over the past few days. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Is Vonnie Quinn. Hey, Vonnie.
Good morning, John. Yeah, technology stocks tumbling for a second straight day as the AI-fueled sell-off from software stocks spilled over into the broader market. The Nasdaq 100 index experiencing its biggest two-day rout since October. Weakness in software stocks pointing to lingering fears of disruption by newly released tools from Anthropic. Alphabet shares down in pre-market trading after it reported fourth quarter earnings. The Google parent exceeded projections for quarterly revenue and outlined an ambitious capital spending plan. The tech giant is leveraging its growth to build out the data centers and infrastructure needed to lead in the AI age. And shares of Qualcomm and ARM also both lower in early trading. The semiconductor company signaled that a shortage of memory chips will crimp growth in the electronics industry. A shortage that is likely to persist, with Intel's CEO sharing suppliers have not told him things will improve for the next 2 years. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. More from Vonnie in about 30 minutes' time. Up next on the programme, a fresh threat towards Iran.
I would say he should be very worried. Look, that country's a mess right now because of us. We went in, we wiped out their nuclear. Think of it. If we didn't take out that nuclear, we wouldn't have peace in the Middle East.
That conversation up next with Ed Mills of Raymond James, live from New York City this morning. Good morning.
is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Equity futures this morning bouncing back by not even 1/10% on the S&P 500. On the Nasdaq 100, the biggest two-day decline going back to August. We're higher this morning, so far at least, by 0.16%. Under surveillance this morning, a fresh threat towards Iran.
I would say he should be very worried, yeah, he should be. As you know, they're negotiating with us. And look, that country's a mess right now because of us. We went in, we wiped out their nuclear.
So that's the question. If we wipe them
we
out,
have peace in the Middle East.
Yeah.
If I didn't take out their nuclear, think of it. If we didn't take out that nuclear, we wouldn't have peace in the Middle East because the Arab countries could have never done that. They were very, very afraid of Iran. They're not afraid of Iran anymore.
So here's the latest this morning. The president issuing a fresh threat against Iran. Crude prices easing, though, as both sides confirm talks this coming Friday. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome to the programme. I think a lot of this has been confused over the past week. I want to get back to basics. What's the objective for these talks in the next 24 hours?
Yeah, hey, John, good morning. Well, it depends on who you ask because it appears that both sides have been trying to shift the format of how these talks are going to take place. We know that Iran has now asked for these discussions to be in a bilateral format focused solely on its nuclear program, as President Trump went on in that interview to say that the U.S. has caught wind that Iran is trying to rebuild after those strikes that we saw last year. With that said, the U.S. wants these talks to expand beyond that. They want this to also include Iran's ballistic missile program, as well as its support for proxy militia groups in the region. And we heard from the Secretary of State, Marco Rubio, yesterday, who said that those top issues have to be on the table in order for there to be real progress. Now, with all of this said, as you heard, President Trump is maintaining that all options remain on the table, even as we see diplomacy moving forward for now. But I will point out that our own analysts at Bloomberg Economics assess that they see a U.S. strike on Iran as highly likely and that these talks could really just be a stalling tactic. John, with that said, though, they also say that while the oil markets are watching this closely, if the U.S. does follow through with military action, that doesn't necessarily mean that we will see a disruption when it comes to oil flows because there is just so much of a range of possibility on the table of what the aftermath could look like, including whether or not Iran retaliates in a symbolic way, for example. So, John, with this said, at this point, anything could really happen.
It's Tyler Kendall down in Washington. Tyler, thank you. To build on that, Ed Mills of Raymond James writing this. U.S.-Iran deal-making appears active and sincere, but the U.S.'s demands will be a high bar for Tehran to clear. Ed joins us now for more. Ed, welcome to the programme. Let's talk about those U.S. demands. What are they?
Well, they don't want any reactivation of the nuclear program, as Tyler highlighted, any support for those proxy groups. President Trump wants essentially probably regime change, which is part of the high bar that we think that is unable to be cleared. Here at Raymond James, we consistently get questions about this. But one thing that we have highlighted consistently on a lot of these high geopolitical risks out there is that they have been coming fast and furious, oftentimes unprecedented, but often without a huge market impact. So from a market lens, this here kind of is important, but maybe not as important as other geopolitical events related to Iran have been over the last decade or two.
Ed, what do you think the tolerance the president has right now in terms of how long he's willing to let the talks go? Because we have seen the Iranians change the tenor of the talks and also the location of the talks.
I think he's open, but I don't think he has a huge tolerance here. I think there's two things. When we look back to kind of the kind of attack on Iran last summer, the president outlined kind of some clear issues. He gave a deadline, the deadline passed, and he gave the order to strike. I think we could see the same thing here, Anne-Marie. What I've seen kind of consistently from this president, though, is that he will only strike, take a military action if he thinks that he can have a quick win, as well as the response is not going to get him entangled into something deeper. And so to me, that's one of the big debates here. Is there something that he can do here that he views is that quick win, that he can send that message to the regime, that he can get that activity or that response that does not involve the loss of U.S. lives? If he has that on the table, he absolutely takes that. If he doesn't, that's where he might pause and give a little bit more leeway to these talks.
Well, Ed, what would you characterize as a quick win? Because the Iranians say that if there is an attack, this could be a regional conflict, a bigger one.
Yeah, so I think that the two examples that I would give is the kind of the assassination of Soleimani back in 2020, where that was a clear, kind of concise military action. The attack on the military or on the nuclear bases last summer. You could probably kind of look to that in a pattern in terms of the way in which he was able to capture Maduro without the kind of loss of U.S. lives. He looks at a lot of these military engagements as, is there something specific that is significant but quick that he can do? And then we look back to what happened after Soleimani, after those nuclear strikes. Iran did respond, but they responded in a way that was not escalatory, in a way that was almost symbolic, that allowed us to move on. And I think that's actually part of the reason why the markets have not responded, is they are used to accustomed to this quick win attitude that Trump takes to some of these foreign policy engagements. As long as that stays in place, that's where the market does not necessarily react to these events just yet.
We were talking to Terry Haynes yesterday about how this is a president who can chew gum and walk at the same time and deal with international and domestic at the same time. The international is just getting more and more active, even as we focus on some of these domestic issues. We also had that call between Xi Jinping yesterday and President Trump, a number of headlines coming out of it. What did you take away from that? This trip by President Trump to China in April, then the promise that by the end of the year, Xi Jinping would be coming to the White House.
Yeah, so it's basically our base case. We had last year kind of the meeting between Trump and Xi in late October, which laid out kind of these two kind of home and away meetings. What we've heard from our contacts is that President Trump has sent a message to his administration: do not do anything that is seen by China as escalatory or punitive to them. We look at the tariffs that came out on semiconductors, the tariffs that came out on critical and rare earth minerals, those were essentially a punt. And the semiconductor tariffs were a punt until April. What we expect as these two leaders get together is kind of some fanfare, some announcements that sound bigger than that they are. But there is generally a desire between both Trump and Xi to contain this relationship because they don't want the fight. Because if we look back to last year, as we entered the year, there was a lot of escalation, and some of this was mutually assured destruction. They don't want to go back to that. They don't want to go back to the restrictions on rare earths. China doesn't want to go back to some of the restrictions we were putting on airplane parts and chemicals, because both economies cannot work unless the other economy provides them with some critical components to their supply chains.
And does this mean that we can avoid new tariff headlines for at least the next 4 weeks?
I will never say that. The reality is that both Trump and Xi like to escalate to de-escalate. And so my base case, as we get closer to those April meetings over this next couple of weeks or months, is we will always have a new tariff headline as a way of getting negotiating position. China's actually done this probably better than anyone else. As we go back to those October meetings, Xi kind of announced a whole series of new restrictions, only to take those off during meetings. And Trump was able to say, hey, I got Trump, Xi to take all of these things off that he didn't actually want to do. He just wanted to have something that he could negotiate away. So I'm always telling clients at Raymond James, watch for that escalation, because they want the opportunity to de-escalate during the meeting and not actually give up something, but sound as if they gave up something.
Oh, diplomacy. Ed, thank you, sir. Ed Mills of Raymond James. So many of these readouts are dressed up in diplomatic language. I actually thought the Chinese readout of that call was really important. On the margin, that was a more assertive Xi Jinping on the issue of Taiwan. And I wonder if that's going to be a feature of the talks in April.
This is what people are most concerned about. That's why everyone's watching this. That's why people are looking at TSMC moving some capabilities over to Japan. How much is China trying to say, get out of our territory?
And they've already have a détente when it comes to trade. So for Xi Jinping, this is really important, especially what's going on with the military. A massive purge in the top brass in China.
Up next on the program, we'll catch up with Mark Mahaney of Evercore as Alphabet plans to double CapEx. Plus, Yahira has your morning movers. Chip stocks looking to cash in on massive AI spending.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Headline just crossed in the Bloomberg terminal. Bitcoin breaking below 70K for the first time since November 2024. Bitcoin down by more than 40% since the highs last October. It's been a bit of a crash, and I think we can call it that, together with the moves in precious metals. Not a great morning so far if you're long silver or long Bitcoin. We'll get to that in just a moment. Equity futures on the S&P 500 just about positive, up by 0.05%. Suffering the S&P from a two-day tech rout, but elsewhere, the equal weight, record highs. The regional bank stocks in the last 24 hours, very close to all-time highs. I've talked about the run that we've seen in stocks like Bank of America, JP Morgan. The banks are having a really decent run, and it's not just the regional players anymore. Pushes back against this idea it's the whole market. I'm not sure anyone really shares that idea right now. It's very, very much concentrated in software stocks, and that bled to some of the chip names yesterday too.
This is a market of dispersion, and dramatic dispersion that we haven't seen in many years, and it's the reason why you're seeing winners and losers, violent rotation away from some of these tech stocks. What this market is screaming is not the collapse of a market or a collapse of an economy. It is screaming this is a new phase of the tech cycle, and this is a new phase of the economic cycle. A lot of these stocks that are doing well signify economic growth is accelerating, not decelerating.
LSM manufacturing was really strong earlier this week. Services was okay, but okay is good enough at the moment. And the yield curve's picking up on the story. 2s versus 10s, the steepest since 22. 2-year bond yields this morning, 355, 10s, 427.36. And I imagine that's breathing some life into the bank names too.
To me, this is one of the most interesting stories. And as you just mentioned, you've got the steepest yield curve in the United States going back to 2022. How much is this part of the rotation? And this really stems from Kevin Warsh and his nomination, this idea he would potentially lower interest rates and allow growth to take off on the long end. How much is that fueling some of this rotation that's under the surface? Some people are talking about
What
that.
they say, rates dovish and balance sheet hawkish.
Exactly.
Something like that might speak to some of the move at least. You like that?
It's beautiful.
That's the yield curve. Okay, let's get to precious metals. I don't know what hand signal to do for that. Maybe it's not good for TV. Silver, down by 10% this morning. Silver, even with this move, is still up on the year by 10%.
Yeah.
It has been a wild ride for precious metals. Gold this morning down by about 1.6%.
People want these precious metals to be the haven that treasuries used to be, and so much money is funneling in that you're getting volatility that is almost unprecedented and is likely to continue just because there's so much interest in an alternative to U.S. treasuries, but there isn't the same liquidity in some of these precious metals.
All these market events building over the past few weeks has been phenomenal. Just fascinating to watch how it's cascaded through financial markets, deleveraging in things like Bitcoin, precious metals, software stocks, and the market, the overall index on the S&P 500, still within a couple of percentage points from all-time highs. Futures this morning just about unchanged on the S&Ps. We count you down to the opening bell with your morning movers. Here's Yahara Anand. Hey, Yahara.
Hi, John. We start with our big story. Alphabet shares are falling 3.3% in the pre-market as investors recoil at the price tag of the AI arms race. Up to $185 billion is what it plans to spend this year. That is double last year's level. But reading through analyst notes, many see this as strategic and even encouraging to the AI story. But no doubt it is an eye-popping number that is taking time to sink in. But it is welcome news for our next names. The spending spree is lighting up the AI chip makers. Broadcom up 4.5% in the pre-market, and it is leading the gains, and that is because it is Google's partner when it comes to TPUs, the specialized chips used to run AI models. NVIDIA also up 1.25%. AMD up 1.4%, catching a break after yesterday's brutal 17% sell-off. And we end on Broadcom and ARM. Both stocks are plunging in the pre-market after issuing a warning about memory shortages hurting the smartphone market as the chips get increasingly diverted to AI data centers. Qualcomm issuing a tepid forecast saying that supply constraints, especially in China, will lead to fewer phones being made, and that means costs will be higher and demand might weaken. ARM's also facing similar issues, so its forecast came in lighter than expected. John?
Yahara, thank you. Thanks for the update. More from Yahara in the next hour. On our radar this morning, Alphabet exceeding fourth quarter revenue estimates and outlining an ambitious capital spending plan. Google's parent company expecting CapEx to reach as much as $185 billion this year. Elsewhere, silver falling sharply. A record-breaking run comes to an end. The precious metal sinking as much as 17% on the session. The latest slide wiping out a two-day recovery with the market grappling extreme volatility. And President Donald Trump acknowledging that Kevin Warsh knows his role as Fed chair.
Does your new Fed pick understand that you want him to lower interest rates?
Oh, I think he does, but I think he wants to anyway. I mean, if he came in and said, I want to raise them,
if he said that, he wouldn't have gotten the job.
He would not have gotten the job, no.
The president adding there is, quote, not much doubt that the Fed We'll be lowering interest rates.
Somebody could say, well, doesn't this show that the Fed lacks the same independence? Have you been listening to President Trump all this time? Of course he would say that. He wants this Fed to cut rates and thinks that this has been an incompetent Fed for not cutting rates. The bigger story is what we were just talking about, the yield curve, and what that's saying, which is that people believe that Kevin Warsh will cut interest rates. Longer term, however, this could lead to higher rates on the long end, especially if you have quantitative tightening, and that ultimately is the question in markets.
Trump is just saying the quiet thing out loud. Everyone knows that to get the job in front of this president, you have to show up as a dove. You can't show up as a hawk. I think it was also a little bit more interesting what Trump said about the Fed in general. That might become a problem when Kevin Warsh goes in front of the Senate Banking Committee. He says, I mean, in theory, it's an independent body. So Kevin Warsh is going to get a lot of questions about Fed independence when he goes in front of senators.
When is he going in front of senators?
We don't know. When the DOJ investigation to Jay Powell gets wrapped up, and the president said this week he is going to let the investigation continue to the end. He's not going to get involved, which means we could be here for months.
Tom Tillis isn't the only Republican on the Senate Banking Committee who's raising issues about this. There have been others also who have raised issues and said that, look, this is not legitimate prosecution. So there is more pushback to the president building under the surface.
There isn't a date on the calendar just yet. Let's put it that way. Let's get back to our top story on Wall Street. Shares of Alphabet trading lower as the hyperscaler plans to double capex spending on AI. Mark Mahaney of Evercore has an outperform rating with a $400 price target on the stock. I'm pleased to say that Mark joins us now for more. Mark, good morning. I just want to focus on that number, $185 billion. How does a company spend $185 billion when for some countries that's the budget, that's government spending? Mark, how does a company put that money to work?
I like the way you set that up. So they're doubling their capex spend from last year. About half of that is going into servers and half of that is going into land, buildings, et cetera, property, plant, and equipment. But half of it's just going to servers. So this company has got very aggressive AI expansion plans. Now, they do have lots of ways to monetize this. They do have a cloud business that grew almost 50%, and the backlog for that cloud business grew 100%. So that's a direct monetization path, very similar to what Microsoft and AWS have, Amazon have. But it also has other ways, too, as they continue to use AI to improve their ads business. That's search, that's YouTube. It is paying off. You're seeing this acceleration in search revenue growth. I mean, they're growing search faster now than at any point in the last 4 years. And I think in part, AI has helped them do that. It's helped them create a better search experience. Anybody who uses Google will agree to that. You know, over the last year or two, the Google search experience has improved, and it's also made the product, the platform, better for marketers. So they've been able to prove ROAI, ROAI. They've been able to prove that, and they're asking investors to help them double down on the bet. I think we're going to shake around here a little bit. That was an eye-popping number. You're absolutely right. But I think a lot of investors are going to give them the benefit of the doubt because they've got a pretty good track record over the last year.
But they don't have a track record being a real estate company, Mark. And that's kind of what I want to get into here. They are now an asset-heavy business, and they used to be asset-light not too long ago. So they don't have a history of running the business this way. And what I'm trying to understand from someone like you who understands the inner workings of an Alphabet, how has this company changed the way it operates to get to this position it's in at the moment?
Well, I think the big change here, I guess, over the last 10 years has been the growth of Google Cloud. And this is still a minority of their revenue. Off the top of my head, I'm trying to think. They're doing like 70 billion run rate off of a company that's doing 200, 300 billion run rate. So whatever, it's about a quarter of their revenue now comes from cloud. Now, cloud is an intense, capital-intensive business. Microsoft knows that, Amazon knows that, and Google is learning that too. So part of it is that the business has changed, and cloud is a much bigger part of both its revenue and its profits. They reached record high 30% margins for their cloud business in the most recent quarter. So that's probably one of the biggest changes. But AI, make no doubt about it, in order to really succeed at AI and at the platform, at the size of this platform, a Google, a Meta, an Amazon, a Microsoft, you need an enormous amount of compute power to serve all the applications that they have that have over 1 billion users. I think it's about a dozen applications that they have that have over 1 billion users. And anyway, those are table stakes now. I think they can get a good return on it, but it's an extremely expensive proposition. Gen AI has made running these businesses at scale with improvements much more expensive than traditional search, but it's a dramatically better product.
But Mark, just to build on what John's talking about, it's one thing to look at these companies as innovators of new tech products. It's another to view them as massive asset managers of sorts that actually go out and choose winners and losers in the infrastructure space, in exactly what types of compute will be necessary, not tomorrow, not the next day, but in 2 years, 10 years, when you talk about what is necessary in terms of rejiggering some of the chips that get older. How do you pick the right management teams for this when you're comparing, say, a Google versus a Microsoft?
Well, it's wonderful that you've got management teams with this much tenure. I mean, I'll give Google a lot of credit on this. The very first time I saw Sundar Pichai present at a Google I/O, their annual developer conference, this was 8 years ago. His principal topic was AI. So Google's been chasing AI, investing in AI, deploying AI throughout its platform, throughout its applications for many years now. There was a huge debate in the market a year ago as to whether they'd missed the AI train, they were going to have their lunch eaten by ChatGPT. All of that turned out to create this wonderful, what I call DHQ, dislocated high quality opportunity for Google shares and investors a year ago. By the way, I don't think that's the case now. There are other stocks that I prefer to Google here. I think at 30 times earnings, you're kind of at a peak multiple. So you're a high quality earnings compounder, but I don't think you're not a re-rater from here. So the risk reward isn't as attractive on Google as it was at any point in the last kind of 2 or 3 years. But that said, it's still a high quality company. And look, generative AI requires a major step up level in investment. You mentioned chips. One of the most interesting things about Google is they've fully integrated up and down the tech stack. Now they have their own chips, TPUs, tensor processing units, and that's given them a cost advantage. So not only do they have the best large language model, the best frontier model out in the world, arguably, they also have, they're there with the they're there at the application layer. They're there with one of the best cloud services, and then now they have the infrastructure underneath it, including the chips. I mean, that's one of the reasons the stock is re-rated so.
Mark, it seems like you don't necessarily agree with the argument going forward that there is some sort of, I think that we might have lost him, actually. I think that he might have frozen. Anyway, it's really interesting to me that we're looking at a situation where people are questioning any kind of investment, John, right now, with the $185 billion being thought of as negative, when, say, 2 years ago, that would be viewed as a vote of real confidence in the path ahead, especially given the fact that they delivered across the board. They had actually a bonanza of an earnings report.
And never mind 2 years ago, 12 months ago, there were people who were sitting around this table questioning, and we were having the conversation that this company might be dead, facing existential risk. And then the next 12 months, it added $1.46 trillion in market cap in 12 months and rallied by more than 60%. The turnaround in this story at this company in the last 12 months, I think, has been amazing and deserves its own case study. It's not only surviving through fantastic cloud revenue, but also their own product. Their own product has surpassed expectations as well in a way that is so different to the way we discussed this company 12 months ago. And this has consequences for how we discuss the story now in software stocks. And Chris Verona, I thought, did a fantastic job of this, of Strategisch yesterday. 12 months ago, Google's dead. 12 months later, it's added $1.46 trillion in market cap and some. And I think we have to bear that in mind when we talk about various software companies being left for dead as well this morning.
That's the reason why you see people say, look, this is a time to make money, right? This is a time to identify the ones that still have staying power and have accuracy levels that cannot be replicated by ChatGPT or by Claude. Look, going forward, this is a period of massive disruption. People can't imagine it going forward. There's a real question here of who the winners and losers are. It is notable that spending more is not a recipe for being rewarded in markets right now. It might be down the line, though.
But 3 years ago, to Mark's point, Gemini was having this code red moment, the way OpenAI is having that moment right now. I would argue potentially the biggest risk right now for Alphabet and the biggest headache is the regulatory environment. You even had the DOJ in some states this week coming out and saying they don't really like the remedies when it comes to Chrome, and they actually want more difficult remedies placed on Google.
Have you seen the new Anthropic commercial?
I love it.
Taking on ChatGPT.
Oh, it's hilarious.
It's so funny.
I mean,
they're kind of
the
crushing
advertisement?
it.
You know,
It's expensive ad,
kind
but
of
it's
feels
funny.
like what communicating with that product feels like at the moment.
Well, that's part of the problem, and that's part of the reason why Anthropic is going to try to eat their lunch and say, look, we're not going to have ads. They're going to have ads, but if you want your personal advice interrupted by ads, go for it. Question is, how do you make money? And that's going to ultimately become a problem down the line.
Futures just about unchanged this morning on the S&P 500. Let's get you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. President Donald Trump warning Iran's leaders the U.S. could take military action against Iran if it doesn't reach a nuclear deal on its nuclear program. The president saying the Iranian foreign minister should be, quote, very worried. According to a White House official, the U.S. and Iran still plan to meet in Oman on Friday. Meta reportedly telling staff members its next-gen large language model known as Avocado is, quote, its most capable pre-trained base model to date. According to the information, Meta sent an internal memo saying it had already completed pre-training, an initial phase in the development of AI models. A federal watchdog is investigating if Nike discriminated against white workers. The Equal Employment Opportunity Commission probing if the sportswear giant's DEI objectives led to decisions in hiring and layoffs that unequally impacted white employees. Nike is the biggest company to be targeted by the agency for its diversity practices. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next on the programme, AI eating into business.
When you think about things like software, for instance, is it a vertical software or is it some low-level horizontal software where it's easy to change and therefore the AI could lead to a big erosion in your business?
Up next, we'll catch up with Paul Goldberg of Bloomberg Intelligence, live from New York City. You're watching Bloomberg TV.
Players is back to take a look under the hood.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
The S&P 500 held back by a two-day tech rout over the previous two sessions. Equities bouncing back by just 0.1% on the S&P. Likewise on the Nasdaq 100. On the Russell, small caps higher by about 1/3%. Under surveillance this morning, AI eating into business.
There's definitely more risk in certain industries. There's no question that you have to think about some of the lower value IT services businesses. And when you think about things like software, for instance, is it a vertical software that is sort of the system of record for a business that is very hard to rip out? Or is it some low-level horizontal software where it's easy to change and therefore the AI could lead to a big erosion in your business?
Private market firms have been absolutely hammered over the last week or so. Blue Owl, Ares, KKR, we've all seen the moves. Massive moves lower, down by 10-20% over the past 5 or 6 months. Now we hear from the management teams. And I want to talk about that right now with Paul Goldberg of Bloomberg Intelligence. Paul, welcome to the program, sir. We understand how the stocks have moved. Can you walk us through what the management teams are saying about the underlying business?
Good morning, Jonathan.
they're still a little bit early. Blackstone actually reported, you just had a clip of Jonathan Gray. They actually reported last week, so they didn't really talk much about this subject at a call. The rest of the calls are actually starting this morning. Ares reported earlier this morning. KKR literally just crossed the wires. Ares made the disclosure that software is about 6% of their assets, total assets, less than 9% of their credit assets. They're the largest credit, one of the largest credit managers. So they don't see the particular risk there. They have been investing heavily because it's a very profitable and well cash flow business. So it's good for them in terms of the alignment with the investment portfolios. But they also always invest with this sort of a mode. So what Jonathan Gray was just saying about the low-level software versus highly specialized software, this is usually what they go after, something that has data or a network embedded into those software programs. And if they're lending, it's usually the senior and secured loans. So those are safer loans. They're more comfortable with those investments.
Paul, this all makes a lot of sense. Why are stock investors not buying it? You've seen all of these stocks absolutely hammered over the past year, over the past 6 months. KKR coming out just now reporting that they have total operating earnings that exceeded expectations, and yet you see this ongoing route. What will it take for investors to be convinced?
I think more transparency. Private equity, private credit, they inherently private. They don't disclose enough information, so the investors can't watch the valuations and things like that day to day. So anything that comes up as a risk always batters into the stock. So if you go back 3 months, everybody was worrying about overinvestment in AI. And these managers are very heavily invested in the infrastructure, so they were getting hurt there. Meanwhile, you see the asset inflows, organic growth in double digits. You see fees and fee-related earnings growing in solid double digits. M&A and IPO market is opening up, so more realizations, more fees related to those realizations coming to the managers. So the environment is actually somewhat better.
And Paul, what you're seeing is a little bit of disclosure. We heard from Ares earlier this morning that they have about 9% of their private credit portfolio currently in software-related stocks, 6% of their overall assets. I do wonder whether any of this skepticism among broader investors will crimp the ability of some of these private credit managers to invest and continue to finance some of these ambitious projects by the hyperscalers.
I really don't think so, because they do have the infrastructure, and especially when you talk to largest managers like Ares, KKR, or Blackstone, they're the guys who can do multi-billion-dollar checks. The smaller managers cannot, and the public markets often cannot offer the structure that these managers are. So I believe that they can actually provide something unique for that market, longer-term structures, asset-backed kind of financing that you don't typically get from a public market.
Hey, Paul, good to hear from you. Paul Goldberg there of Bloomberg Intelligence on some of these moves we're seeing from some of these names. Blue Owl's down 19% year to date. KKR's down by almost as much. These are 20% moves after they were already hammered through much of last year as well. The fears around software are legit. People are worried about margins there and profits. The disruption is real, not just prospective. And the next leg is to find out who's got the exposure. What you've heard from management teams so far this morning, it's so far so good. I'm not sure that's going to put these fears to bed, though, because we talked about this earlier. This bucket of stocks is being used as a proxy to trade this story, and that's been the story of the last 6 to 12 months.
And that's the reason why it's unclear what they could actually say in some of these earnings calls. I do wonder if you're going to see a shift among investors to prioritize liquidity after having private credit and private assets in general all the vogue. What you don't know is what's punishing these stocks, the lack of transparency. So suddenly you have to wonder, do you end up with a lot more transparency and private credit starts to look that much more like public counterparts?
And your last question to Paul was fantastic in terms of if these companies are doing so poorly in the software, is it going to mean that private credit is not going to go out and go acquire or invest in these software companies because the pushback they're getting in their top line on their stock trading?
Coming up on the program, we'll catch up with Tom Kennedy of JP Morgan Asset Management, Chris Casso of Wolfe Research, and Jordan Rochester of Mizuho. The second hour of Bloomberg Surveillance, up next.
Used to be one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something. Now though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the US or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
The U.S. is in some sense unique. It remains a very dynamic economy.
I think the economy, even though it's not accelerating, it's still pretty good. The labor market is soft.
If you have a job, the economy moves forward.
We think we're set up for a very strong year of growth, and that will come with it labor market strength.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. Your scores look like this. Following a 2-day tech stock rout, we've got futures up by 1/10% on the S&P, on the Nasdaq 100 higher by 0.08. Later on, another tech test. We'll get Amazon earnings after the closing bell. Going to sound a little bit like Jerry Maguire, but show me the money. $185 billion of capex we could see from one company alone for the year ahead.
Yeah, show me what that money buys, I think, is also the question. What exactly are they going to do with it that's actually going to lead to the results that people are hoping for, which is the same kind of growth that they've already experienced with a very different business model. That's ultimately what's getting priced into markets as people reassess what these tech companies are going to do. There are going to be winners and losers. Right now, it definitely is a sell first, ask questions later in the software area. At the same time, there's something else else going in the tech names. And it really is this question of how they're going to spend effectively and get that kind of growth.
The context is incredible when you look at this spending. It's basically the total sum of the 3 years combined, or as Jonathan said, the entire debt market when it comes to the United Kingdom. But the CEO yesterday, Sundar Pichai, continuously tried to reassure investors, we need this money. These costs are necessary for us to continue. And remember, Gemini 3 years ago, people were saying code red when it comes to Google. They were under threat from OpenAI, and now they're the ones that are out front.
Yeah, just to clarify that, this is basically how much the UK borrowed in the debt market in the last 12 months. And when I ask the question, how does a company spend $185 billion? This is not how this company used to be run. The turnaround in Alphabet over the last 12 months is amazing. The rally we've seen of more than 60%, $1.5 trillion in market cap added to a single name in the last 12 months.
They have performed incredibly well. They've gained more than 70% if you look at the total return over the past 12 months. They've done a really good job at diversifying away from just cloud computing, although really expanding that, but also getting into the chip sales business and providing that to Anthropic. A bigger question here, though, you ask, what's it going to be spent on? They specified, this is all that they specified, new infrastructure, research, and talent. So is everybody going to get $1 billion payout? Is that research going to be sending a spaceship up to the moon to try to figure out how to create data centers? I mean, exactly what is the next step? And I think people want to understand that. That said, the ripples that you're seeing in Google this morning are nothing compared to what you're seeing in some of the other shares that are getting absolutely hammered, and it is coming off a pretty high base.
We'll all take a $1 billion payout, won't we? You know, I'd take that check tomorrow.
You know, I welcome the invitation to accept
negotiation.
that. Yeah.
Absolutely. The Bank of England with a decision out just moments ago. I wonder if this is in our future over at the Federal Reserve. A decision to hold interest rates at 3.75%, a 5-4 vote. And based on the communication we're seeing from the Bank of England on Threadneedle Street this morning, it looks like they're going to have a rate cut at some point in the near term. But ultimately, is that a little flavour of what we could see from the Federal Reserve later this year, that kind of dissent at that kind of level?
Well, maybe Kevin Warsh will get everybody together and have everybody get some sort of consensus. But you're right. How much are we going to see an incredibly fractured Federal Reserve? Do we hear explanations for why? Because I bet from the Bank of England, you're going to hear some explanations from why from each of the individual members. My guess is that under a Kevin Warsh Federal Reserve, there might be a little bit more of a muted explanation.
Our colleagues in the UK are going to take you through the news conference in the next hour, so stay tuned for that. Right here in New York, we'll continue our coverage of what's happening in financial markets worldwide. Coming up this hour, we'll catch up with Tom Kennedy of JP Morgan as AI disruption ripples through markets, Chris Casso of Wolf Research as Alphabet ramps up spending, and Jordan Rochester of Mizuho on the relationship between President Trump and his Fed chair pick. We begin this hour with stock steady with the Nasdaq 100 losing year-to-date gains in just 2 sessions. Tom Kennedy of JP Morgan Asset Management writing, this is an example of how selective you need to be as the market now moves into a new phase where AI disruption is becoming more and more evident. Tom joins us now for more. Tom, good morning. Good to see you. What a mess in software.
Yep, that's right. I mean, I loved this chart from Mark Murphy, our software analyst. He goes, it's going to be at least a few years before we can prove that AI will not disrupt software. So this madness of what we're experiencing, in his view, feels like it's going to be around for a while. I just love that gem from Mark. Outstanding.
That's a massive problem. So if we have to question the multiple on some of these names because we don't think the recurring revenue is as predictable or the margins might be under threat, is that a story that stays isolated to that group of names, or is it something that bleeds out to the rest of the market?
You're talking about how much capitalization is being added to certain of these tech names over time. This disruption from this technology is happening way faster than anything we've ever seen. Like, we say that a lot, but this is the discussion you guys were just having is emblematic of how fast this is.
One input from Anthropic. Bank.
And if you start to play with these tools, you can see how powerful they can be. And now software is the idea of the moment, but business services is the next discussion. The media is the discussion after that. There are ripple effects, John. So my point to say, this is the moment, and we're squeezing that balloon here. Something else will move there.
John was talking about how some of the private credit managers who have been at the epicenter of some of these investments, or believed to be, potentially, have been really beaten up. You've seen the likes of Blue Owl and Ares and KKR, all of which are reporting this morning, see massive drawdowns so far this year. I'm just wondering, do you think that private credit is the epicenter?
Private credit is just getting discussion points now, but I think rightfully so. When you look at the numbers, direct lending versus its public market equivalent of leveraged loans. Tech is 20+% in private credit, only about 15% in the leveraged loan market. Then you move to business services, 20% of private credit is in business services, and in lev loans, it's about half that, 10%. So there is a concentration risk here for AI disruption. That discussion point's just happening. Is the disruption big enough to move that far up in the capital structure, I think is the question. And the market doesn't really know. You made the comment in the last hour, transparency. We're going to get tons of transparency. You're going to have to defend what you own and what your exposure risk is, even though we don't know exactly what the disruption will be. I think we all assume it's coming.
We saw Ares disclose this, that they have 9% of their total private credit assets related to software, 6% of their total assets.
Yeah.
You're not seeing a big move in the stock. Why is that not enough? Why is it not enough if some of these fund managers come out and say, look, this is what we have. We're good. We're the cleanest shirt in a dirty laundry.
Not to speak to Ares directly, but I think as an industry, we need more transparency into that industry. And at JP Morgan, we're talking so much about public and private and how they're going to integrate each other. Transparency is the thing that's going to integrate. So I think what the market is forcing private credit managers to want to do is to show what you own and push it out there. It's going to take more time and more than just a quote about what the percentage is.
Do you stay away from private credit and private assets for the most part, or do you move away from them in this environment?
I don't see how, let's be honest, there's no way you can move away from private markets. This is the market that is growing. This is where supply is coming. So as wealth accumulates naturally, this is going to be a part of a portfolio. However, when you look at private credit, you have to look at what you're getting in the risk reward. Right now, the spread between leveraged loans and private credit is the tightest yield we've seen in the post-COVID era. So you're not getting that much compensation to go from public to private. And at the same time, leverage has accumulated in the private space. So the compensation you're getting for that next incremental piece of leverage has come down. So I think the real conversation is, which one do I want to own? Again, when we look at our consumer data, we think the economy is in really good shape. So you want it. You can have extended credit. It's just which one do you want and how much risk are you willing to take?
Do you think private equity now needs to stay away from software?
That's going to be really hard to do. The private equity market owns a lot of software, and we haven't had the liquidity profile for them to exit those. So I think it's might be easy to say, I want to hold off on that, but you have a lot of that already, so you're going to have to deal with it.
You run real estate investment strategy at JP Morgan. Let's spend some time on that. $185 billion of capex from Alphabet.
Yeah.
How much are these players in your world now?
This is the single most defining moment in real estate we've seen in a couple decades. Looking backwards, John, what did America do? We built warehouse and logistics spaces so stuff could get put in that box and delivered to your house.
Consumption.
As fast as possible. And now we live in New York, you can get things to your house in 2 hours. But what's being onshored and the needs of these businesses is completely different than a logistics business. So again, looking backwards, we've only added 350 million square feet of manufacturing space in the last 20 years. It's nothing. But now you want to onshore a business that needs a lot of power, specific type of space, and an expertise that is only in specific areas. So this supply of commercial real estate does not exist. We need to build it. A lot of this money that you're talking about from these hyperscalers is going to the infrastructure. And in our portfolio, we own product that is high-powered and in good location. In the last 12 months, we've seen total returns for that property north of 10%, compared to a logistic and warehouse space, about 2%. This is defining, this is a new phase for commercial real estate.
Can you talk us through who has the expertise, who has the capacity to be doing this? Because one thing we tried to achieve a little bit earlier was trying to understand who are the management teams driving this? Who's signing the checks, spending this money over at Alphabet? How is this getting done?
Yeah, the infrastructure build-out is mostly built around the consumer of AI. The obvious ones are robotics, aerospace and defense, pharmaceutical. So that's where the expertise is. Where do those firms really exist? For the most part, they're in Southern California, parts of Texas. But what we're seeing is interesting is now they have to move out of those areas into other places. Why? Where is there power in this country that they can get access to? Certain places you want to build a manufacturing plant that needs high power, you call the grid operator, they say, no, thank you. We don't have power for you. So you have to move elsewhere. So you're getting concentrated pockets in Southern California, parts of Texas, Southeast, and this new one you guys are going to talk about a lot is in the Midwest. So legacy types of manufacturing.
I keep thinking about the pictures of computers in the 1950s and 1960s, and they took up an entire room.
Yeah.
And now this is the same thing, my phone. And you start wondering, at what point will the technology be moving so quickly to render a lot of this real estate and infrastructure obsolete? How do you prevent against stranded assets, given how quickly the technology is moving and has to move in order to fulfill all of the promises and lofty goals of artificial intelligence?
Yeah, I think that's a real risk. I think what we're hearing from the hyperscalers, though, is they need this infrastructure, and they will spend whatever it takes to get there. And the offshoot of that is commercial real estate and manufacturing. I think this tech risk is there. I think for the most part, the tech risk is in a data center, though. If you look at a manufacturing property and then compare it to a data center, the data center might be commercial real estate, but 2/3 of the value is in the tech and the hardware to make it operate. So it has tech obsolescence. A manufacturing property can be retrofitted into something else. But something you're hitting on is different. When you walk through these onshored critical industries that I'm talking about that need this high power, it's not a car plant. It's a bunch of people looking at screens, maybe making a little widget that's going to go to Mars. Like, it's a different type of manufacturing. So it is different. But again, the clientele that is going to work in that box is very different too. They want to live near all the amenities that we care about. So it's a very unique property, but this is a defining moment for commercial real estate.
So let's put some money to work. Where's the opportunity for you and the team at the moment? Where would you deploy capital?
JP Morgan is hyper-focused on real assets as a way to diversify. I think in the media we talk a ton about gold. Investors can only own so much gold. So you have to look for other things. Infrastructure has been a play that we're focused on. In our JP Morgan Infrastructure Fund, we do not own data centers. Doesn't mean we never will, but we're trying to diversify the tech trade. And I think, you look at all these outlooks from Wall Street, they're all telling you the same thing. Tech's going to change the world, and it's all the same trade. So we're trying to diversify. And commercial real estate is the best way to diversify. It is Main Street America. It has gone through a repricing, and we've only seen 2 other material repricings like this. Both times you had a 10 to 15-year bull run, and you had 4 or 5x your money over that period. This is the new diversifier, and I think you're going to see just about everybody pivot towards that.
That's the pitch. Tom, it's good to see you. Thank you, sir. Appreciate it. Tom Kennedy of JP Morgan Asset Management. Elsewhere, equities doing okay, positive by 0.2% on the S&P 500. With an update on stories worldwide with your Bloomberg Brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump says immigration enforcement in Minneapolis needs a softer touch, saying he personally decided to pull 700 agents from Minnesota. That still leaves about 2,000 federal agents in the Twin Cities area. White House border czar Tom Homan promising a shift to more targeted enforcement. The Trump administration hosting a critical minerals summit yesterday. The EU, Japan and Mexico each agreeing with the United States to set up new policies, including price floors, to help solve critical mineral supply chain vulnerabilities. The U.S. is seeking to create stable investment conditions and reduce reliance on Chinese supplies of critical minerals. Bitcoin slumping below $70,000, falling more than 42% from its peak last October. According to data compiled by Bloomberg, investors pulled out over $272 million worth of U.S.-listed Bitcoin exchange-traded fund flows this week. The crypto market has lost over $1 trillion in value since its October peak. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie later this hour. Up next, big techs, big spending.
There's a digestion period around this spend and the implications in terms of free cash flow. I think this is very positive for the AI ecosystem overall, that this cycle is very much still intact.
Chris Casso of Wolf Research joins us next, live from New York City this morning. Good morning.
astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Stocks are positive across the board on the S&P, up by 0.1. Likewise on the Nasdaq, up by 0.2 on the Russell. Tech very much in focus. Under surveillance this morning. Big techs, big spending.
There's a digestion period around this spend and the implications in terms of free cash flow. I think this is very positive for the AI ecosystem overall, that this cycle is very much still intact. You have to think about this as a cycle that's almost 5 to 10 years in building relating to the CapEx spend, and the revenue streams are just starting to flow through.
Planned CapEx at Alphabet, as much as $185 billion this year. So for 26, that's more than the previous 3 years combined. Who's it helping this morning? Chip makers, NVIDIA, AMD and Broadcom looking to cash in. NVIDIA this morning up by more than 1%. Joining us now to discuss is Chris Casso. He covers semiconductors for Wolfe Research. Chris, welcome to the program. Let's talk about where we were yesterday before we get to where we are this morning. Yesterday, it felt like at one point that maybe the pain in software was beginning to bleed into hardware, into things like chips and semis. Chris, how insulated are they from developments elsewhere?
Well, that the pain in software bleeding into chips doesn't make a ton of sense to us, because the stocks that we cover, the semiconductor stocks, are enabling the disruption that's happening or is potentially happens. So we've been pretty positive on this, and particularly in the part of the space which has underperformed over the last 6 months, which is the chip makers themselves, the NVIDIA, AMD, Broadcom. What we've seen is the suppliers to the chip makers, like memory and semi-cap equipment, has actually done very well. But NVIDIA has underperformed, and that's kind of where we've pivoted a bit now.
Chris, when Alphabet comes out and says we're going to spend as much as $185 billion this year, who gets that money? Who wins it?
Well, Broadcom would be the biggest supplier to Google. They do the chip that is Google's TPU chip, which is their custom chip for AI. So Broadcom is the biggest beneficiary of that. But we've also saw big spending for Meta as well last week. This is not just a Google trend. This is an overall trend.
How much does this really indicate that they're going to be willing? I'm talking about Meta and Google and others who are the buyers of the NVIDIA products, of the AMD products. How much are they willing to continue paying up? Is this a margin story that could potentially be crimping some of the dynamism in terms of the share performance?
Well, first, with regard to the spending, there's been concern about, can the spending continue? Can it grow from these levels since, really 2023 when ChatGPT came out, and now Google is spending more than the entire industry did back in at that time. So that's one part of it. Where I think investors have actually been a little more comfortable, and Google's had a good run. Meta was up on that earnings report despite the big capex. Is that the customers of the companies I cover are actually starting to monetize this now. So you're getting some monetization in exchange for this very high spending. So I think the fact that the customers of the companies I cover are actually making money on this gives us more confidence that the spending will in fact continue.
How much is Google stealing NVIDIA's lunch, especially given the fact that the TPU is considered a more efficient way to play the AI game for a lot of different customers?
Well, TPU that Google provides has been successful for some time, and they still buy a lot of NVIDIA chips. And most of those chips go into their own cloud, where enterprise customers will come to the Google Cloud and they want to use NVIDIA. And because NVIDIA is the industry standard, Google has to do that. Where Google uses TPU more significantly is in their own internal workloads. And in that, the way we look at the market is that market is considered kind of out of NVIDIA's available market. What's changed over the last couple of months is that Google has also started inviting some customers, like Anthropic, for example, to come onto their cloud and use TPU, which has expanded the market some. But in general, our view is that the vast majority of this market is still NVIDIA's domain because it's the most flexible. They have the software support. It's very hard for other customers to kind of get off of NVIDIA. Google is a bit of an exception, and it's a big exception. But for the most part, this is still going to be a majority market for NVIDIA.
Is that going to change, though, in the future at some point where NVIDIA's biggest competition is actually going to be Google?
Well, and the question is, so who else is Google going to be able to sell TPU to? So Google is a significant part of the market, but will they start selling it to others? And our view is that perhaps some, and the Anthropic deal is one example of that. But Google is not likely to sell TPU to Amazon. They're not likely to sell it to Microsoft. If you're an enterprise customer doing work on even the Google Cloud, you still need NVIDIA because NVIDIA has the software support. They support all the frameworks. So I think there is a competitive threat. I think it's baked into the cake right now, and I don't think that competitive threat gets much more significant. Now, one of the other factors is that everybody else is also trying to do their own chips. Meta has their own chip. Amazon has their own chip. And right now, the size of those chips is much smaller than where NVIDIA and Google is right now. If those chips kind of have their TPU moment and get larger, then that becomes a bigger threat. But so far, we haven't seen that.
Oh, sorry about that. So basically, if Google is ahead of Meta and all these others that are making TPUs, who do you think is the most competition when it comes to Google? Who's right behind them in the race?
So probably the other company that's doing their own that is probably closest would be Amazon and their Trainium chip. And so far, it's been somewhat successful, but nowhere near as successful as Google. So I'd say that would probably be the next one that we'd be watching.
Hey, Chris, it's good to hear from you. Thanks for joining us. Chris Casso there of Wolf Research on some of the chip players. It makes a lot of sense. Chris is right. Ultimately, if these companies are coming out spending loads of money, they're going to spend it with many of these players. He's also right to point out that if disruption is that real and successful right now, then what are they going to be spending money on? Chips and these chip providers.
So that's the reason why they should do well, except that there has been this rotation away and people are worried about some of the performance. AMD, they came out. They actually had good earnings.
Hammered.
They got absolutely hammered. The worst one-day sell-off going back to 2017. Why? Because it wasn't quite as good as people were expecting. So the bar has just gotten so high, even for these names, that even a wonderful result doesn't necessarily assuage some of the biggest skepticism.
In just a moment, we'll pivot and talk about central banking with Jordan Rochester of Mizuho. We'll talk about central banking on this side of the Atlantic. This is happening right now in the UK, boosting bets on easing for the Bank of England. Maybe as soon as March, we could see that rate cut. There was a vote a little bit earlier, a decision to keep rates unchanged on hold. The vote, though, 5-4. And the language clearly steering us towards a rate cut in our future, saying that interest rates are likely to be reduced further. And we raised the question as to whether we'd see that kind of division, that kind of split on the FOMC later this year under new leadership.
We're already seeing the beginnings of it, right? I mean, 3 governors dissenting is a significant kind of shift from what we have seen in the past. Is this normal? I think that this is really the key question. Is this normal at a time of economic disruption when you're potentially at a pivot point in the economy and people don't know where it's going? Is it normal to get a dissent in terms of opinion? Or is it a sense of the deep divisions and the fractured nature of this Federal Reserve in this particular era under a potential Kevin Walsh?
I think you're probably right to say maybe normal, absent a crisis, at a perceived turning point, which is maybe where we are at the moment in the global economy. We're down about 0.75% on sterling, cable at 135.55. Up next, Jordan Rochester of Mizuho from New York City. You're watching Bloomberg TV.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
At the surface level on the S&P, things haven't been too dramatic. Beneath the surface, vicious moves. Tech stocks, software names, absolutely beaten up and hammered over the past week or so. S&P 500 futures this morning rolling over. We're down by 0.25%, now down by another third on the Nasdaq, following the biggest two-day rout since October on the Nasdaq 100. The losses continue to build. The Russell also turning negative in the past 30 minutes or so. We're down by about 0.2%. We've talked a lot about this throughout this morning, that away from big cap tech, away from software names, what you've seen is an equal weight back at all-time highs. Regional bank stocks just short of a record at the close. Taking some life from this, better economic data, a better outlook, and a yield curve that's at its steepest levels, 2s versus 10s, that we've seen going back to 2022.
So is this a bad picture or a good picture from an economic perspective? It has been good. Question is, will the economic data ratify it? We don't get an answer with respect to the main jobs report. We do get some other peripheral data. And so far, it's been relatively mixed, John.
We're getting some of that data right now. Let's cross over to Mike McKee for more. Good morning, Mike.
Good morning, John. Well, I got bad news for you, Lisa. The Challenger report is out, and it is a pretty dismal one. 108,435 job cuts announced in the month of January. That is the highest January total since 2009. As far as the numbers go, it's up 205% from December. There were 5,306 employers announcing hiring plans, and that is the lowest January total since 2009 as well. So some particularly bad news on the Challenger front. We don't usually talk about it, but sometimes lately when Challenger has come out, we've seen big market moves on the pessimism about what it might mean for the economy. Who cut the most? Well, transportation was the biggest, and that was largely due to UPS announcing 30,000 job cuts, followed by Amazon and there's 16,000. But healthcare, which is an unusual one to be in this category, was also big. The caveat, as we always mention with Challenger, is these are announcements, not actual job cuts, and some of those job cuts don't get carried out. So we'll have to see how this is reflected once we get into the jobless claims numbers and once we get into the payroll numbers, which is now next Wednesday.
Mike McKee, thank you, sir. We'll catch up with Mike again in about 60 minutes' time when we get those jobless claims numbers. A lot of that concentrated in just a couple of names.
Almost half of all the job cuts that were announced last month were tied to 3 companies. This really highlights just what we're talking about. Amazon.com, UPS, as Mike was mentioning, and Dow, which also announced a pretty significant broad-based cuts. It raises a question. Is this signal or is this noise? Is this a couple of companies that are shedding workers after building out their workforces dramatically over the past decade? Or is this a signal of more to come? Right now, again, it adds to the noise. This has all been so muddy. It's very difficult to get a real clear read at a pivot point.
Kit Duke, SocGen, we talked about him a little bit earlier. Even if we had the payrolls report tomorrow, I wouldn't know what to do with it. That was Kit Duke of SocGen earlier on this morning. Lots of people feel that way because that's been the story of the last 12 months. I mentioned JP Morgan pointing out that 40%, roughly 40% of US GDP growth in the first 3 quarters of last year came from tech capex. So when Alphabet comes out and says, guess what, this year we're going to spend as much as $185 billion, what do you trade on? That or the jobs numbers that Mike McKee just went through?
So far, people have been trading on that, not necessarily the jobs numbers that people are looking at. At the same time, we got yesterday ADP data. It came in below expectations. People dismissed that and looked at ISM services that came in stronger than expected. But if you look under the hood, the employment component actually missed expectations. So it's unclear what we're seeing. And right now, people are just focusing on the tech companies first and foremost because of the scope of the money that they have to spend.
There is a weight to the tape this morning. In the last 10, 15 minutes or so, we've rolled over. We're down about 0.4% on the S&P 500. You'll notice yields are pinned at the front end of the curve, down about 2 basis points to 353. We'll stay on top of that for you. Let's get you some single names with your morning movers. Here's Yahara with more. Hey, Yahara.
Hi, John. Alphabet's $185 billion spending spree is lighting up the AI chip makers, though we are losing some steam here, as you just said. We are seeing Broadcom leading the gains up 2.75%, and that is because it is Google's partner for TPUs, which are the specialized chips used to run AI models. NVIDIA also in the green. AMD up now just 0.2%, though it did have a very brutal sell-off yesterday, down 17%. Meanwhile, we are seeing Snap shares rising in the pre-market, up 0.8%, also losing steam here after the picture social media company did beat on sales and posted a surprise profit. It posted fourth quarter earnings of 3 cents a share when analysts were expecting a loss, and part of that was because of the number of users willing to pay for a spruced up app, jumping 70%, and that spurred an upgrade by analysts over at B. Riley. And we end on Estee Lauder, close to wiping out all of this year's gains, now down nearly 14% in the pre-market after the company's new annual guidance came in below expectations at the midpoint range. But despite that, the company did beat on earnings thanks to high-end skincare like La Mer, but the bar was high, as Lisa says, and it wasn't able to clear it, so it is getting punished for it in the market.
Yahara, thank you. Thank you very much. I love Chris Harvey over at CIBC, just published. Market is selling off, sort of, but not really. Down 0.5% yesterday. It's worth highlighting that we were only down 0.5%. But when you drop 0.5% and the moves are that vicious beneath the surface, 0.5% feels a whole lot more painful than maybe it is.
Well, because it's not 0.5% if you have a tech-concentrated portfolio. It's down some 10%, even 20%. I was looking at some of the single names that, just looking at the drawdowns based on the past 52 months. Duolingo. Do you like Duolingo? I like Duolingo. It's down 78% from its high in the past 52 weeks. I mean, it just gives you a sense of how significant these drawdowns are.
You've got to play with Duolingo a little bit more often, clearly.
I mean, I probably should get on my streak. Yeah, my kids all do it.
What language? What are you playing with?
Well, Spanish.
Okay, good
My
for you.
mom's learning Korean. She's learning Arabic.
Is she actually learning Korean, though? Or is she just sort of like gamifying the language and she can answer the questions well?
What is learning a language in the modern era?
Can she communicate in Korean?
Yeah, but she's excited.
Okay.
She does these things. But I mean, I can't. And then the accent is
Neither can I. I'm certainly not judging. Just wondering if the product works or not.
Really? Okay. Do we even need it if we could all just have translators in our heads?
I don't know why we're talking about Duolingo. Stocks down by about 0.5% on the S&P 500. Session lows. We'll stay on top of that. On our radar this morning, Alphabet looking to double its AI capex this year to as much as $185 billion. The ambitious spending plan aiming to leverage its revenue growth to build out data centers and infrastructure. Elsewhere, the Trump administration pitching price floors for critical minerals and U.S. private equity investment. America committing to a $100 billion lending authority for critical minerals and a nearly $12 billion stockpile in an effort to reduce reliance on China. And finally, Treasury Secretary Scott Bessent set to return to testify on Capitol Hill today after a fiery House hearing just yesterday.
So I ask you, Secretary Bessent, will you be the voice of reason in the administration and urge Trump to stop waging a war on American consumers and on housing or affordability and putting the economy at risk? Yes or no? You don't have to explain.
Representative Waters,
will you be the voice? Will you be the voice? Can you shut him up?
Bessent testifying that he believes the Federal Reserve has lost the trust of the American people by allowing inflation to get out of control.
This was fiery, and that wasn't even the most fiery moment. The other one was from Representative Meeks from New York, where I believe an F-bomb was dropped at one point.
What was that about?
This was an incredibly contentious hearing, and the Treasury Secretary also came back every single time. At one point, he said, "Can you maintain some level of dignity?" He hit back to some of these individuals. Under his breath, he said, "Well, the questions need to be serious for me to give you a serious answer." It potentially, when it goes to the Senate, will have a little bit more decorum, but I'm not sure.
Did we learn anything? I'm serious. Like, was there any news value whatsoever from this?
Didn't we have this conversation yesterday about this?
We could have it next week.
Well,
we could have it after tomorrow's or today's hearing.
He said some stuff things that we've been talking about on this show. He once again reiterated that the U.S. has a strong dollar policy. There was some things you can glean and learn into, but yeah, this is obviously everyone just making campaign videos.
That's not the hearing that Chair Hill would like to have, I imagine. I'm not sure why that descended into such a farce.
There's actually really interesting questions to be answered.
Yeah, obviously.
Honestly, what does a working together look like between the Treasury and the Fed? What does he see in terms of exactly how the U.S. takes stakes in companies? How does some of these reserves actually function? These are the questions that actually would have market ramifications. Instead, we're stuck with other things.
Maybe someone will ask him a little bit later. I won't hold my breath.
I was about to say.
But we'll see. Let's stick with the central bank. President Donald Trump emphasizing the litmus test for his Fed chair nominee.
Does your new Fed pick understand that you want him to lower interest rates?
Oh, I think he does, but I think he wants to anyway. I mean, if he came in and said, I want to raise them,
if he said that, he wouldn't have gotten the job.
He would not have gotten the job, no.
Jordan Rochester of Mizuho writing this: how long until Trump turns on Kevin Walsh too? Jordan joins us now for more. Jordan, welcome to the programme. Are you suggesting he will, and why?
No, I'm not suggesting he will. We're just pointing out that the last time he chose a federal chair was Jerome Powell, and it took about a year from saying he was his pick to calling him clueless. So Kevin Walsh has to walk a pretty tight tightrope here. The data over the next month or so, I think, will be pretty darn strong. I think we're starting to see the fruits of Scott Bessent's efforts, which is the One Big Beautiful Bill. We're starting to see a big pickup in manufacturing. We're starting to see that data surprises scream higher in the US. So for the next few months, it'll be a difficult environment to be too dovish, is the sort of view from here. Things might change by June when Kevin Walsh takes over in his first meeting. But if Chair Powell is still there, if there isn't a majority agreeing to cut rates, then it might not be Trump turning against Walsh, but it might be Trump putting pressure on the other members of the FOMC instead.
Jordan, the market has a really interesting response to the Kevin Walsh nomination. It is that at the front end, you're going to see rate cuts, and at the long end, you're seeing yields bleed higher because they do believe that that the economic data is going to be strong and that you are going to see some persistent inflation. What do you think a Kevin Walsh Federal Reserve will do, and how will they respond to long end rates that are going higher?
Well, I think the interesting thing about Kevin is he talks about the need to get away from this swivel chair sort of narrative, the sort of backward-looking monetary policy that we've had from various central banks, where it's all about being data dependent. And the problem with being data dependent is each non-farm payrolls report, whether it's hot or cold, completely changes the narrative for market pricing. And it has felt like monetary policymakers have kind of blown with the wind on that. So just any small beat in non-farm payrolls has completely changed what we needed to price in for the year end. Kevin wants to move away from that sort of data dependence and be more forward looking, and is talking about AI being a big disinflationary force, especially in the services sector. And that means instead of using the last couple of months of data to justify a decision, you use your foresight and your forecasting skills to say, look, inflation might be high today, but we think it's going to be much lower next year or the year after. Therefore, we're going to go ahead and cut rates. But that's a big change in reaction function. It means that markets will not react in the same way to each non-farm payrolls report and CPI release like they used to. It actually suggests lower volatility, but things will still develop as we'll see.
What I'm trying to say, Jordan, is if you have a Fed chair that's saying, OK, we can cut rates because there is this greater efficiency and you get this sort of disinflationary boom that people are hoping for, how does he respond to a long end of the yield curve that disagrees with him, that seems to be moving in the opposite direction?
Well, it's also his views on the balance sheet that will contribute to that view, where it's not really disagreeing with him. It's more about the demand-supply dynamics. And Kevin also talks about a smaller balance sheet, and there's a large amount of U.S. Treasuries in that balance sheet, as well as MBS. If he's talking about shrinking the balance sheet, that means more supply for U.S. Treasuries. So it does mean a steeper curve. But what I will say is on the street, it seems a near unanimous consensus of strategists pushing for steepeners, for the curve to steepen. That is higher yields in the long end, so your sort of 10-year, your 30-year. Everyone seems to have the same trade on, so therefore it's not moving as quickly. In fact, it's flattened slightly over the past couple of sessions. So for the time being, Kevin will take comfort in that the market's not moved too much, but we'll have to wait and see. I just don't think he will reduce the size of the balance sheet that quickly. And I think that's a consensus as well. And therefore, we don't need to worry about it too much. But rising US yields on the back of rising US growth, which is what we're talking about right now, it's not the end of the world. It's actually a good thing.
Jordan, we heard from the president saying he wouldn't get the job if he didn't want to lower interest rates. And you outlined how Kevin Warsh thinks about this. But do you think he can convince the rest of the committee more than just Steve Myron?
Now, when the boss is there, things might change, and other members of the FOMC might start to see to his way of thinking. I think a lot depends on whether Powell gives up his position or not as a board member. If he was to bow out, then I do see perhaps a move towards the Kevin Warsh view of the world. But if Powell is still there, arguing against rate cuts in June, that's where we could see one of the first sort of dissents against the governor since the time of Paul Volcker.
Jordan, final question for the two people that know what Aston Villa is. Top 4 finish this year?
Fingers crossed. We're third at the moment. We didn't play so well against Brentford, but we've got a couple of sort of fixtures coming up where I think we're going to have a good win. Top 4 is the ultimate aim. We're not going to win the league, but Champions League is on the way.
Jordan, thank you. Appreciate how sincerely you responded to that question too. Jordan Rochester there of Mizuho. Jordan, thank you very much. Let's turn back to this market. Equity session lows rolled over quite aggressively in the last 30 minutes or so. We're down 0.6% on the S&P 500. You'll see in the bond market, yields started to roll over as well. So we're down a basis point or two, particularly at the front end of the curve. Two's down to about 3.53. Hard to pinpoint one thing. This has been accumulating. We've seen it in software stocks and the risk aversion building there. Bitcoin with a break of 70K a little bit earlier on in the session too, and then that headline at about 7:30 Eastern time on the amount of job cuts we're going to see from certain companies to start the year.
The pillar that's been upholding this market, at least at the index level, has been the promise of stronger growth. When you get a challenge to that from these challenger job cuts, no pun intended, that really raises questions. And I think on the margins, people are looking at this and saying, okay, if you have a pretty fragile labor market with not a lot of give, what do job cuts like this really translate into when people have a hard time getting a new one on the other end?
You can understand why people are bullish about the outlook. There's 3 pillars for that. Fiscal policy, tax refunds, monetary policies, the rate cuts we've already had. And then you've got this additional layer. The fact that you've got a handful of companies going on a monster spending spree, the likes of which we've never seen in economic history. Alphabet coming out with $185 billion, tops maybe, for the year ahead. And other companies are going to follow. That's why the bulls are so bulled up, because in their view, the reason they have this really bright, optimistic outlook for the US economy, there are 3 pillars that are hard to fight.
They see the 1990s all over again, and they want to get in on it, especially if it's 1996. The problem is, do you get the jobs that come with that, and can the consumer keep upholding this type of nirvana? And that, I think, is still, it really remains to be seen.
Stocks are softer. We're down by 0.6% on the S&P. With an update on stories worldwide with your Bloomberg brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. U.S. companies reporting the largest number of job cuts for any January since the Great Recession in 2009. According to data from Challenger, Gray and Christmas, January job cuts rose over 100% year over year. The report also showing hiring intentions sliding to their weakest total for any January since 2009. Shares of Shell trading lower. Europe's largest oil company missing on fourth quarter profit due to lower crude prices and weak oil trading. Shell maintaining its quarterly share buyback of $3.5 billion, even as lower crude prices weigh on plans to boost investor returns. Peloton share is lower in the pre-market as well. The company reporting weaker than expected revenue forecasts for its fiscal third quarter, disappointing investors who hoped a recent hardware revamp would help spur a long-promised turnaround. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Appreciate the update. Thank you very much. Up next, surging expenses.
In order to really succeed at AI and at the platform, at the size of this platform, a Google, a Meta, an Amazon, a Microsoft, you need an enormous amount of compute power. I think they can get a good return on it, but it's an extremely expensive proposition.
Up next, we'll speak to the Bill himself, Dan Ives of Wedbush from New York. You're watching Bloomberg TV.
The problem we've got as an industry is when the government's overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulators.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Live from New York City, here we go again. We're down by 0.5% on the S&P 500. The Nasdaq down by 0.9. Under surveillance this morning, surging expenses.
In order to really succeed at AI and at the platform, at the size of this platform, a Google, a Meta, an Amazon, a Microsoft, you need an enormous amount of compute power. Those are table stakes now. I think they can get a good return on it, but it's an extremely expensive proposition. Gen AI has made running these businesses at scale with improvements much more expensive.
So here's the latest this morning. Big tech ramping up spending plans as a global slump in tech rips through markets. AI fears wiping out about $1 trillion in software stocks over the past week. Dan Ives of Wedbush writing, we believe the market is baking in a doomsday scenario for software companies in the near term, which we believe is extremely overblown. Dan joins us now for more. Dan, good morning.
Great to be here.
Where's the black tie?
Look, given futures, I was thinking maybe wearing like a blue suit but again,
we're close. Look, you say a doomsday scenario for software stocks. Some people might say, actually, this is the most optimistic outlook for the AI theme, the fact that this is happening.
Look, I think, in my view, the view that software is dead, do not enter zone because of AI, I think is wrong. Because if you look, is it a headwind for Salesforce, for Adobe, for ServiceNow? Of course. But what's factoring in here is basically a structural breakdown of the sector. I mean, you'd have to assume that numbers
Adobe Acrobat Studio is all new. What can PDF spaces with AI do? Do your marketing tasks in one spot. An AI assistant. Show me what you got. AI breakdown.
The UK stands apart as a place to do business, not because of one advantage, but many working together. business.gov.uk/.
Review with NBC News, but first a look at the job.
News when you want it with Bloomberg News Now. I'm Karen Moscow. We want to get to President Trump's wide-ranging interview with NBC News. But first, a look at the jobs market this morning. U.S. companies announcing the largest number of job cuts for any January since the depths of the Great Recession in 2009. That's according to data from outplacement firm Challenger Gray and Christmas. It showed companies last month announced 108,435 job cuts, a 118% increase from a year earlier. The report also showed hiring intentions slid 13% from a year earlier to 5,306, marking the weakest total for any January in the firm's records back to 2009. President Trump has given a wide-ranging interview ahead of Super Bowl Sunday. In the conversation with NBC News, the president said he personally decided to pull 700 federal agents from Minnesota amid the uproar over 2 American deaths in Minneapolis.
I learned that maybe we can use a little bit of a softer touch.
The president said he's not happy about the killings of Alex Preddy and Renee Good, and ICE isn't either. A Quinnipiac poll shows 63% of voters think the administration has not given an honest account of Preddy's death. President Trump also warned Iran's supreme leader he should be, quote, very worried ahead of high-level talks on its nuclear program tomorrow. And he touched on his hour-long call yesterday with Chinese leader Xi Jinping.
Had a lot of topics. We talked
What's
about
the most important topic? Is it chips? Is it the wars in Ukraine? What is going on?
I would say the economy, the relationship that we have with China.
The president told NBC's Tom Lamas it's important both leaders have a good relationship before he visits China in April. President Trump also said he would not have picked Kevin Warsh to lead the Fed if he wanted to raise interest rates. The president was asked what he thinks about Fed independence.
In theory, it's an independent body, but I think, I'm a smart guy. I know the economy better than almost everybody.
And in the NBC News interview, President Trump said he plans to stay out of the fight between Netflix and Paramount's Skydance over Warner Brothers Discovery. And he said if he wins his $10 billion lawsuit against the IRS and the Treasury Department over an unauthorized release of his tax returns, he'd donate the proceeds to charity. Now to the latest on the search for NBC Today show host Savannah Guthrie's mother. The network talk show host has sent a public message to her mother's kidnapper, saying that her family is ready to talk but wants proof that she's alive.
We live in a world where voices and images are easily manipulated. We need to know, without a doubt, that she is alive and that you have her.
And Nancy Guthrie was last seen Saturday around 9:45 p.m. when she was dropped off at home by family after having dinner. It's Election Day in northern New Jersey. Voters in the 11th Congressional District will decide which candidates will compete in April to finish the term vacated by Governor Mikey Sherrill. The special primary election has a crowded field of 11 Democrats. The winner will face sole Republican Joe Hathaway, who is the Randolph mayor, in the April 16th special general election. Polls close at 8 p.m. In other news this morning, Ukraine is asking the U.S. for more weapons to force Russia to end the war, and Bloomberg's Amy Morris has more from Washington.
Ukrainian President Vladimir Zelensky says President Trump is looking to stop the war by way of compromises, while Russia's Vladimir Putin is trying to force Ukraine to abandon all of the eastern Donbas region. Zelensky told a French TV station that, quote, Putin is only afraid of Trump. He says Trump can exert pressure through sanctions, the economy, and with weapons. A Ukrainian delegation is currently in Abu Dhabi, taking part in the U.S.-brokered trilateral negotiations that also include Russia. Zelensky says their priority is to end the war. Amy Morris, Bloomberg Radio.
Thank you, Amy. The Bank of England came within a vote of cutting interest rates as policymakers split 5-4 in favor of holding at 3.75%. This after its updated forecast showed inflation falling below target, growth slowing, and unemployment rising. Governor Andrew Bailey was once again the swing voter, choosing to leave rates unchanged this month, having cut at the last meeting in December. He said in the personal statement explaining his decision that, quote, my central outlook is aligned with the staff's view of weaker demand. Barrick Mining named interim chief executive officer Mark Hill to lead the company as it announced plans to spin off its top North American gold assets in an initial public offering. NASDAQ futures, they are currently higher after the index erased its gains for the year over the past two sessions. Traders are weighing whether the flight from tech has been excessive amid concerns over disruption from artificial intelligence, lofty valuations, and vast capital outlays. This morning, shares of Alphabet are down 3%. The Google parent did top quarterly revenue estimates, but said capital spending on AI will be significantly higher than anticipated. Begin more with Bloomberg technology host Caroline Hyde.
They are dialing this up because they must feel, must be taken that they've felt from the market, you've got some bandwidth to do this right now. Because what we've heard time and time again, think of Microsoft's numbers, is that their issue isn't one of demand, it's one of supply.
And that's Bloomberg technology host Caroline Hyde, who says Alphabet's capital expenditure could come close to $185 billion this year. That compares with the almost $120 billion that analysts had expected. Shares of Qualcomm, they're down almost 12%. The chipmaker's revenue forecast was weaker than expected. Bristol-Myers Squibb forecast 2026 sales and profit that beat Wall Street expectations. It's a sign the company's newer medicines are helping stem the losses from its older drugs that are losing patent protection. Silver plunging once again, and we get the very latest of Bloomberg's John Tucker. John.
The white metal wiping out a two-day recovery with investors looking for a bottom at this point. This follows a record-breaking rally that appeared to run too far too fast. Silver has retreated by more than a third from its all-time high on January 29th. Investors have built up large positions in the precious metals, and further fuel is added by heavy inflows into ETFs. In addition to silver, gold lower, it fell toward $4,900 an ounce. And let me toss this in. Crypto winter, that continues. Bitcoin falling below $70,000 for the first time since November of 2024. In New York, I'm John Tucker, Bloomberg Radio.
All right, John, thank you. And checking spot silver this morning, it's down about 12%. It's $77.46 an ounce. Bitcoin this morning at $69,600. S&P futures, they're up 0.1%. Dow futures are up almost 0.2%. NASDAQ futures up 0.1%. 10-year Treasury yield, it's at 4.27%. That's news when you want it with Bloomberg News Now. I'm Karen Moscow, and this is Bloomberg.
And coming out with up to $185 billion of capex for the year ahead.
They also came out with a 48% increase in terms of their use and sales of cloud computing. This is a huge boon for that whole unit. What can Amazon say? Hold my beer. We're going to invest $250 billion. I mean, and how does the market respond to it? Right now, any massive capex plan is being penalized in the market, regardless of the success of prior performance. And that, I think, has been a theme throughout. People are wondering whether the multiples have to change in a new era for technology.
Things were fairly steady until about 30 minutes ago, at least on the session so far. Then this headline dropped. Challenger job cuts for the month of January. The most to start any year since 2009. And when you talk about 2009 and jobs, at least at the start of that year, that's not a good story to tell.
And the actual number is pretty significant considering the fact that we're not creating that many jobs every single month. It's 108,000 jobs plus. However, and there is an asterisk here, we already knew about a significant proportion of these job cuts. About half of them account for 3 companies that have already announced job cuts. That, of course, has to do with Amazon, UPS, and Dow. So is this a question of the market just trying to look for good and bad news and resetting? Or is this actually a worry that a lot of these people won't be able to find other jobs? I'm not sure I totally understand this market response this morning because, again, a lot of this was already known.
Well, I wonder if the market's also leaning heavily on this because we're not going to get the jobs report this week. We have to wait for next week. But these announcements were big when they came out. Amazon, 16,000, UPS, 30,000. This is what Challenger had to say about it. They're talking about how basically means that for going into 2026, this is what companies are signaling. Employers are less than optimistic about the outlook. And we've continuously seen that when it comes to consumer sentiment as well.
We've talked a number of times about how some of this has cascaded through financial markets over the past few days, from software stocks into private market firms. Just eyeballing numbers from TPG quickly. A number of names caught up in this rout over the last week, and for that matter, for these names over the last 6 to 9 months. And when you eyeball the numbers, Lisa, there's nothing of concern, at least for now. We've heard from them, we've heard from others in the last couple of hours, and that's the distinction I think you need to make. The communication from management teams at this firm, these firms at the moment, seems to be things are okay. The worry is they won't be further down the line.
Just taking TPG, just to put some numbers to what you're talking about, they're looking at fee-related earnings in the fourth quarter of $326 million versus an estimate of $246.8 million. Significant beat. A significant beat in terms of revenue. Almost $100 million more than expected in terms of what they delivered. And yet people are not convinced. There is an existential fear that business models will be so profoundly disrupted that asset prices will go to zero. And that is currently what's being priced into a whole host of different software stocks
Not
right now.
seeing that in their earnings, at least not now. Equity futures near session lows, down by 0.5% on the S&P. Coming up this hour, we'll catch up with Lisanne Saunders of Charles Schwab, assessing the software sell-off. Pooja Kumar of TD Securities with a rate decision looming from the ECB. And Abigail Watt of UBS breaking down the latest jobs data. We'll begin this hour with stocks adding to losses following the Nasdaq 100's biggest two-day drop since October. Lisanne Saunders of Charles Schwab writing carnage in software stocks likely tied to the nature of speculation in the AI space. Headlines and even a slight change in the narrative can result in fierce moves. Lisanne joins us now for more. Lisanne, we have seen some fierce moves. Welcome to the programme. We've seen them in precious metals, massive deleveraging there. We looked at Bitcoin earlier on this morning, a break of 70,000, software more recently hammered, private market firms too. Is there a common thread to the deleveraging we've seen in each individual pocket of the market?
Well, I think the deleveraging piece, John, is an important part of it. When you look at how much leverage had built into things like the gold trade and the silver trade, and then the fact that you had the CME raise margin requirements, that pushed a lot of speculators out fairly quickly. There was deleveraging there. Anytime you have margin issues, raising of margin requires margin calls, that has feeders into other high momentum areas. I really think one of the threads, too, is that rotation is the new momentum trade. So there's a lot of money positioned to find not just the shiny new object, but what's the dull new object, and kind of chase that rotation. And I think we stay in that environment probably at least in the near term.
How much confidence can we take, Lisanne, to your point, from the moves we've seen, an equal weight, record high, regional bank stocks just short of all-time highs? How much weight can we put on that?
I think the broadening trade has legs because there's fundamental underpinnings to it. It's not just a rotation trade, but when you look at the direction of travel, you look at the earnings growth rate, say for the cohort that is the Magnificent Seven, and you compare it to the other 493. The growth rate for the Mag 7 is still higher than the other 493, but the direction is what matters, and the direction is heading down a bit for the 7, up a bit for the 493. You're seeing it down the cap space where you've actually got not just a positive trajectory in terms of earnings growth at higher levels for an index like the Russell 2000, but a little bit more stability in that outlook as opposed to high estimates and then they get pulled down when you're in earnings season. So I think there are fundamental underpinnings. The build out of AI adding to the benefit of the more cyclical areas, be it energy or industrials and materials, that helps to explain the broadening out trade outside of the US, because many of those more cyclical areas is what dominate their economies as opposed to tech having been the dominant force in our economy. So I think it's a meaningful shift that probably will continue.
Given this meaningful shift that a lot of people are pricing into a number of different assets, how do you take into consideration an announcement like what we got today from Challenger Gray and Christmas, with the greatest number of job cut announcements in a January going back to 2009?
Well, Lisa, you were right to point out a little bit earlier that there's a concentration there in terms of a small number of companies. But I think this is it's a potentially important data point here if it's not a 1 month blip, because much has been discussed about the low hiring, low firing kind of backdrop. Obviously, ideally, if that's going to break, it breaks by higher hiring. But if it starts to break in the other direction, I think that changes the narrative around the employment picture. It may also change the narrative as it relates to Federal Reserve policy. So if you wanted to put something on maybe the bullish for the market side of the ledger, you could point to that. I think it's too soon to tell. But you guys also pointed out earlier that in the absence of the jobs report, which of course we'll only get a few days delayed, we put more weight. And when you look at the ADP data, too, there was meat in there. Smaller companies really under pressure. The only place where job growth is robust is in those more defensive areas like health services and education, with the biggest drawdown coming in professional and businesses services. That ties into where you're seeing weakness in Challenger.
This seems like a really muddied moment, and I really just want to lean into and pair this idea with the leverage trades that you see unwinding and this comment that you made that I think is fantastic, which is rotation is the new momentum trade. Do you see a potential at which you start to fade some of this broadening out in the near term, not the long term, because the momentum gets ahead of itself? I mean, is that sort of the recipe for 2026, is to sort of fade the extremes as this rolling ball of cash just keeps going to different sectors?
100%. And I think there's a healthy underpinning when you have sort of excess get healed. Valuation excess, speculation excess, via a process of rotation. I think that's an easier to stomach kind of healing of those excesses than if the bottom fell all at once. For instance, the NASDAQ at the index level has only had a 4% drawdown, maximum drawdown so far this year. But the average member within the NASDAQ is down just under 20%. So you've had sort of this internal bear market. It just happens through a process of time. I think probably most investors would choose that kind of 20% drawdown versus the index coming down 20% all at once. So it's painful if you're caught on the wrong side of the proverbial trade, but I think that's a healthy way to go through a process of healing some of this excess, particularly on the speculation side.
Lisanne, always a clinic. Thank you. Lisanne Saunders there of Charles Schwab with some great stats and some of the notes they put out. Check this out. This is from Lisanne and the team. Only 18% of the S&P 500 constituents have outperformed the index over the past year. That's up to over 50% in the last month. There's been a big shift in this market beneath the surface.
It's amazing to see the headline number down just a bit, and more than 350 of the 500 member stocks of the S&P index actually gaining on the day. It just shows how different the nature of this market is. And as Lisanne says, if you had to choose one, you'd rather this to sort of be a blow off top than one that looks like Armageddon on the headline level.
This has legs so long as the economy holds up and the data looks good. And that's kind of what Lisanne is getting at for the year ahead. The other point I would point out as well, and I think this will resonate with you, just that layer of financial risk that you have got to appreciate, that there is a channel for this to go bad. That if we are right, the way the market's pricing software stocks, which is pretty dramatic, and some people think, many think, it's overextended. But if they're right about that, then there will be losses on a lot of loan books at many of these private market firms. And that's a layer of financial risk that is difficult to price.
It's difficult to price because people don't understand how systemic private credit firms and private asset managers really have become, especially given the fact that they still play a role in financing the build-out going forward. It is not like the role has ended. It also is instrumental in providing the financing for all of these data centers for some of not just the hyperscalers that have money, the Googles, but the ones that have not, which is Oracle, right? So these are some of the questions that people have going forward.
Futures down by 0.5% on the S&P 500. With an update on news worldwide with your Bloomberg Brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. So, U.S. companies reporting the largest number of job cuts for any January since the Great Recession in 2009. According to data from Challenger Gray and Christmas, January job cuts rose more than 100% year over year. The report also showing hiring intentions sliding to their weakest total for any January since 2009. President Donald Trump warning Iran's leaders the U.S. could take military action against the country if it doesn't reach a deal on its nuclear program. The president saying the Iranian foreign minister should be, quote, very worried. According to a White House official, the U.S. and Iran still plan to meet in Oman on Friday. Shares of Qualcomm and of ARM are both lower in early trading. The semiconductor companies signaled that a shortage of memory chips would crimp growth in the electronics industry, a shortage that is likely to persist, with Intel CEO sharing suppliers have told him things will not improve for the next 2 years. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next on the programme, the morning calls, plus the latest rate decision from the ECB. Pooja Kumra of TD Securities joins us to break it down. From New York City this morning, good morning.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot. Very, very strong alignment.
3 revolutions in 1.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
In Q3, Q4 of last year, the narrative around tech and AI was really about questioning of valuations, about bubble, the CapEx spend. And now you're seeing it shift even further, so that there's not just questions about valuations, but it's actually the models. Can they actually deliver? This is really about dispersion and understanding not just balance sheets. It makes sense that investors start to think about where else can we go?
That was Seema Shah of Principal Asset Management joining us a little bit earlier on this morning. In the equity market at the moment, we're down by 0.5% on the S&P, and the Nasdaq down by close to 0.8. That's the price action. Let's get you some morning calls. One stock in focus, Alphabet. First up, Oppenheimer, raising its price target to 360, saying benefits from AI are still in the early stages. Barclays also upping its target to 360, the firm saying Alphabet's AI story is in its full flex mode. And finally, JP Morgan raising its price target on the tech chart to 395. The firm believing the doubling of capex comes from a position of strength. The stock is down right now by 4%. It's quite a move in the pre-market.
Yeah, especially given the capex, the capital, the market capitalization of a share like this. Look, right now the market is not rewarding capital expenditure. It is important to note, though, Alphabet is up 66% in the past 12 months.
Yep.
So this decline looks like peanuts compared to the 17% decline that you're seeing in the likes of AMD. So it's all within perspective. Nonetheless, it is notable.
The Nasdaq futures down by 0.8%. That's the big story in financial markets. Want to head over to Frankfurt, Germany. The ECB with a rate decision just moments ago. Lizzie Burden has the number. Hey, Lizzie.
Hi, John. Yeah, the ECB has held rates as expected by traders and economists, as they're expected to, not just this year, but next year as well. Officials saying that they're in a good place when it comes to the economy. Let's see if they hold up that line at the press conference with Christine Lagarde in just under half an hour's time. But they have reiterated the language that they're not pre-committing to a particular rate path, that they're going to be data dependent when it comes to making these decisions. If you remember, the fourth quarter GDP print was better than expected, so that really gave officials cover to stand pat here, John. And you'll remember that there was all of that hype about hikes towards the end of last year, started by comments from Isabel Schnabel. The market latched onto it, but it's faded away because you've had inflation undershooting the target, euro strength actually touching 120 last week, and then, of course, the tariff threats from President Trump over Greenland. But since all of those things appear to be temporary, the inflation undershoot thought to be temporary at least, the euro rally fading somewhat, and President Trump walking back his threats, what they want is to keep full optionality. That's what officials have been saying to me, and that's what it appears they've done today.
Lizzie, can we finish on one of those things you mentioned? Just unpack the move in the euro. Briefly through 120, euro dollar this morning at 117.99. There was one central bank official on the governing council out of Austria that pushed back a little bit after we drifted past 120 in the past few weeks. Lizzie, unlike Chairman Powell in the news conference last week, will President Lagarde engage with the conversation about the FX channel?
She's certainly going to be asked about it. The Bank of France Governor François Villeroy de Gallo was asked about it, and he said that the currency moves are a factor in the monetary policy making. And if you go back to comments last July, the Vice President, Luis de Guindos, said that 120 is the level that makes policy making more complicated, and as you say, they went through that level. The problem is that when you have such euro strength, of course it could dampen exports, it could make that inflation undershoot more persistent, but I'm sure the way that Christine Lagarde is going to frame this is they will mind what happens with the euro. They're not targeting it directly, but they see it as a channel that perhaps could affect the inflation path, and therefore they keep it in mind when they're setting rates.
Lizzie with the latest in Frankfurt, Germany. Lizzie, thank you. The ECB keeping rates unchanged. To discuss, Pooja Kamrat of TD Securities joins us now for more. Pooja, welcome to the programme. The topic of the FX rate. This is something that Chairman Powell battered away in the news conference last week. Is it something that Christine Lagarde will engage with?
Well, she will get a lot of questions on it, but I don't think that she will be able to engage much on this front. I think just to give some context, when we got our last forecast in December, ECB was looking for Euro USD to be around 116 for 2026 and 27, and we've already broken that range. And that really tells you about March forecast. We'll need to see more downgrade on headline inflation at least.
Well, let's talk about headline inflation. So we've got inflation basically around 2%. In the Eurozone at the moment, Pooja. When you look at the balance of risk, just how balanced are the balance of risks around that 2%?
I think downside risk, and that I think that is key for markets right now, whether you look at inflation, whether you look at the currency, the oil market, as well as financial conditions. They are basically making the inflation target much more risky. But what we are also seeing on the other hand when it comes to Europe is the domestic resilience factor. And that was actually is visible in the PMIs as well as growth indicators, which have been much stronger than what we as economists have expected for 2025 on it. So I think that is one of the key things that ECB likes to linger on, the core strength that is still there. And, the German fiscal bazooka is something that we will start seeing more in 2026 as well as 2027.
I'm guessing, Pooja, this is going to be a pretty uncomfortable news conference for Christine Lagarde, because a lot of the questions have to do with things that usually central banks don't like to address. In the statement that the ECB put out, they said that the outlook uncertainty is mainly due to trade and geopolitics. What is the ECB's reaction function to, say, a currency that goes up to 122, 123? I mean, there are all these questions that ultimately they should be answering. So what do you expect them to say in terms of what the ECB's reaction function is?
Unfortunately, we might just get a boring answer saying that they don't focus on FX. But I think we also need to see the FX level with respect to how conditions in Europe are right now versus 2010 and 11, where the FX was very key because we were in the deflationary era. I think if you look at even the ECB's review, they have very vocally told us that they're less reactive to downside risk to inflation, but more towards upward side. So as long as the domestic resilience story is strong selling point for ECB, they will try to avoid talking about FX. But the moment that gets dwindling, or you see financial conditions tightening because of maybe this AI sell-off, I think that's where it's hard for ECB to ignore all the market indicators. And you can see markets are through options, trying to play, a possible cut by ECB, even though they do not think it's likely.
In the United States, there's a feeling, and Kevin Warsh really articulated this, that you do get growth, and it has been strengthening, but it's going to be disinflationary because of the technology and because of how our artificial intelligence is increasing efficiency. Is there a similar type of discussion at the ECB to uphold the economic growth long enough to allow people to get jobs at a time where otherwise they might be losing them, given the efficiencies that artificial intelligence are creating?
So AI is definitely a risk for all countries, but one thing that we are seeing in Europe, which is basically unique as compared to US as well as in UK, our labor market is still holding up well, and so is the service sector when you look at the PMI. So maybe the AI bubble has not reached Europe that big as compared to what it is in US and UK. So they are a bit more sheltered, but it's all markets are connected after all, and I think if it affects US, it will affect Europe. So to say if US has to go big on cuts, I don't think that ECB will not be able to cut in that circumstances.
Pooja, going back to Lisa's point, though, with the statement saying the outlook is uncertain due to trade and geopolitics, code word probably for Trump. But what about China? How does the ECB address what is going on in terms of China basically being a disinflationary force onto the continent?
Definitely a risk, something that they are looking at, and especially given the fact that we are seeing a lot of China direct, indirect exports being sent to Europe. So that is one of the key things that they are looking at. And, you can see that Europe structurally is trying to actually get out of just pure export-based economy to more investment as well as infrastructure-based economy. So in short, they know they cannot beat China no matter what they do. The German export industry is not as competitive, and so they are looking more to dwell inside via the infrastructure and investments.
Pooja, appreciate you weighing in. Thank you. Pooja Kumar there of TD Securities, highlighting the downside risk to the inflation outlook over at the Eurozone, which is interesting at a time when Germany's ramping up government spending because of A, what you pointed out, the overcapacity out of China that the Europeans now have to eat because the US has put the walls up, and B, the fact that we've seen the euro rally back up to 120. Now, we've backed away, as Lizzie indicated, but I do wonder, and I imagine if the ECB wanted to, they can, because they often do. Will she engage in that conversation in the news conference in 20 minutes' time?
Some engagement or running some sort of interference just verbally in terms of the currency. I wonder how much they're growing increasingly worried about the disinflationary impulse, because it's coming from China, it's coming from the currency, and frankly, it's coming from AI. And a lot of the investment, it's going to military and other things that don't necessarily have any kind of inflationary pressure on the economy.
Will we get a Kevin Warsh endorsement as well from Christine Lagarde? Governor Bailey's just gone there, right?
Yeah, he welcomes the nomination of Kevin Warsh as the Fed
chair. It's pretty
chair.
long, isn't it?
Is this potentially a problem for President Trump?
Prime Minister Carney,
that all of the establishment
for Warsh, if he's trying to shore up the MAGA base.
He's got a lot of endorsements from establishment figures in the past week. Coming up next on the programme, the latest round of jobless claims set to cross. We'll catch up with Abigail Watt of UBS to break it down. That data is just around the corner. If you're counting down to the opening bell, as we all are, 60 minutes away, we've got futures down at session lows. Negative 0.6% on the S&P. On the Nasdaq, we're lower by 0.8. Challenger job cuts, not a great read. The worst start to the year since 2009. Yields lower at the front end of the curve by 3 basis points, 2s to 352.
know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Jobless claim data just moments away. Equity futures on the S&P negative by 0.6%. On the Nasdaq 100 down by 0.8. We're down by 0.6 on the Russell also in the bond market. Rallying at the front end of the curve. Yields down by about 3 or 4 basis points now. 351.82. Risk aversion really building in the last 60 minutes or so off the back of Challenger job cuts data. The worst start to the year since 2009. With additional data is Mike McKee. Good morning, Mike.
Well, this isn't going to make anybody happy either. A big jump in jobless claims last week to 231,000. The initial claims 4-week moving average is at 212,000, and the continuing claims number rises as well to 1,844,000. So jobless claims up last week. Now, the caveat, as I mentioned, there was a caveat with the Challenger numbers. There's always a caveat with jobless claims around this time of year because we're still trying to get settled out from the holidays. But if this is any indication of where we're going, it might be the start of a new trend that you do want to worry about or at least keep an eye on. Let's just mention Challenger again. We lost 108,435 jobs in January, at least according to the job cut announcements. That's the most since 2009.
Mike McKee, thank you, sir. Mike McKee breaking down jobless claims numbers. Level and then change. As a level, 231 is not something you'd be typically concerned about, but the change gets your attention, particularly in the context of the conversation we've already had this morning about the Challenger job cuts.
That really is the key. It sort of builds on the news that we already had been hearing, which was the greatest number of announced job cuts for a month of January going back to 2009. Then you look at the jump up both in the initial jobless claims and the continuing claims, and it becomes significant. A real question here about why these jobs are being released or why people are being laid off. People blaming Amazon, UPS, and Dow. One thing that Neil Dutta over at Renaissance Macro pointed out is that when you look into the details of the Challenger job cuts, the reasons for the layoffs are all talking about closing, economic conditions, restructuring, and loss of contract, not necessarily artificial intelligence. So challenging some of the more sanguine reads on what we got earlier this morning.
Push it through the market, particularly through bonds. We're down by 4 to 5 basis points at the front end of the curve, through the belly of the curve. Twos are down by 4 to 5 at 350, just about holding on to that level right now at 351. Abigail Watt of UBS joins us around the table. Abigail, good morning. Good to see you. Starts to feel a little bit more real. Is it more than just a handful of companies? Is something else happening here?
Yeah, look, I think the one thing I would caveat is when we look at the initial claims data, we've been waiting to start to see this beginning of a seasonal uptick that you tend to see in January. This is a period where you do tend to see initial claims starting to move a little bit higher, and we're a little bit behind kind of where we have been in previous years. So in previous years, you would have seen this eking higher coming a little bit sooner. So I think potentially the kind of jump higher today is a little bit maybe of catch up. Just, you know, we would have typically begun to see this move higher sooner, essentially. So I think this is something that we would typically seasonally see. I think one of the things that I would note in the kind of job cuts data is obviously they're very seasonal. You do tend to see a lot of kind of job cuts in January. When we seasonally adjust it, it still is a relatively elevated January increase, though. So I do think that's important, and I think it's important, as we mentioned just there, this idea of what is driving those job cuts. I think when we look at the distribution of the reasons, I mean, we've had a lot of questions from clients around how much are you seeing AI feeding into the weaker labour market, and is this an AI story? And when you look at those job cut numbers, AI job cuts don't look to be leading the reasons for kind of why people are shedding labour.
We've seen some pretty bullish outlooks for the next 12 months or so. Easing fiscal policy, tax refunds, the rate cuts we've already had, the massive spending coming from big tech. Is it a jobless GDP growth figure? What is it?
So we are expecting that you see kind of the labour market continue to look relatively weak through the first half of the year. We do think that the unemployment rate will continue to eke higher at this juncture. We have it peaking in the summer, so we do have it pushing up to 4.6 by June. And then we actually think you see a little bit more of a normalisation, a little bit more of a strength in the labour market. And I think that's partly because one of the things that we've seen through 2025 is a relatively narrowly driven growth. And I think one of the questions is kind of if we do see this kind of fiscal policy support coming through, it's a little bit more kind of distributed. Does that then help broaden the base of growth a little bit? And I think with that broadening, you could potentially see a little bit more of a broadening in labour demand, because I think one of the things you have seen in the employment data is kind of relatively narrow drivers. Look at healthcare and social assistance driving much of the gains in employment through 2025. And I think, we would expect that you need to see kind of a little bit of a broadening out in terms of the base of the strength of employment data.
I'm struck by the absolute numbers, which aren't that high in terms of the jobless claims. At the same time, are some of the job losses more punitive this time around in a low hire, low fire dynamic because it is so much harder to get a new job?
Yeah, I think you are seeing, I think when people talk about the labour market, we're talking about a little bit of a lack of dynamism, right? This idea that it is taking people potentially a little bit longer to kind of transfer back into the labour force. I think that is part of the story, but I think in terms of kind of the low hire, low fire, I do think, we have seen the kind of pace of job cuts has been running a little bit above kind of where we were in 2019 already. Like, I'm not sure that this is a significant shift in terms of the dynamic there. I do think you're just seeing general weakness, I would say, in the labour market when you look across the metrics. That's kind of how I would read the labour market. I'm not sure that this jump in claims this morning or the kind of new number from Challenger is a significant shift. I think it's a continuation of a weakness that we had already been seeing in the data.
The noise is getting a lot louder, partly because we're not getting a lot of other data points. We're not getting non-farm payrolls until next week. We're going to get CPI, but later in the week than we normally would have gotten. How differently are you looking at some of the data that used to be the gold standard going forward, given how messy it is and how difficult it is to really understand this pivot point?
Yeah, look, I think there's a lot of kind of interpretation and care that needs to be taken when looking at the data just now in the US. I think one thing I would note is, the January employment reports have always been a very difficult thing to read. You have the benchmarking process taking place. You have new methodologies being brought in for various components. And in particular this year, the residual net birth death adjustment, which is a big part of kind of what actually is adding jobs in the figures, is being revised, and that methodology is going to change. So I think it's very difficult to get a good read on the labour market, I think, from a January employment report. And I think this one could be one in particular that is hard to kind of carry forward. And then I think, if we think about the inflation data, I think one of the things we've seen there is certainly that you've seen a shift higher in, the number of imputations that are having to be done. And you're also seeing a shift higher in the number of series that the BLS are not able to publish. So because they don't have sufficient data. So I do think there are sampling issues that are taking place in the inflation data as well. And then you add on top of that the government shutdown, right? So I think there's a lot of difficulty in reading, I think, the trends. But I don't think it's to say that it's not useful or it should be dismissed. I just think you have to kind of look at trends, right? You have to look over a longer period. You have to look in more detail, I think, and kind of really read the data with care. Maybe more than you used to.
Abigail, thank you for breaking it down. Thank you very much. Abigail Watt there of UBS, following the wrong kind of upside surprise on jobless claims. 231, the estimate 212, the previous number 209. With an update on stories worldwide, including that and more. With your Bloomberg Brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. Yeah, recapping the data we just got. US jobless claims coming in hotter than expected last week at 231,000. That was well above expectations and marks an overall increase of 22,000 from the previous week. Continuing claims coming in at just about $1.84 million, and that was just under estimates. And recapping today's central bank decisions, the ECB leaving its benchmark policy rate unchanged at 2% for a fifth straight meeting, as was widely expected. Elsewhere, the Bank of England also held rates steady in a split 5-4 decision. The bank's forecast showed inflation returning to the 2% target in April and then falling below for much of 2027. Bitcoin has slumped below $70,000. That's falling more than 42% now from its peak last October. According to data compiled by Bloomberg, investors have pulled out more than $272 million out of US-listed Bitcoin exchange-traded funds this week. The crypto market has lost over $1 trillion in value since its October peak. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Crazy start to the year in financial markets. Equities near session lows, down by 0.5%. We'll break down some of the massive moves we've seen in software stocks with Abby Yoder of JP Morgan Private Bank up next on the program. Live from New York, you're watching Bloomberg TV.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. I'm not here to say what I would and wouldn't do in the future. But the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. But that's where I'm at today.
The world's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazlida Amin in Davos, Switzerland, and this is Bloomberg.
The opening bout just around the corner. Equity futures pulling back by 0.5% on the S&P 500. The Nasdaq down by 0.7%. Bouncing just a little bit, but you know the story of the last week or so. Hyperscalers continuing to report massive AI spending as software stocks get absolutely hammered. Abby Yoder of JP Morgan Private Bank saying CapEx growth will likely continue during this period and beyond, both to improve model accuracy and then to sustain user traffic. Abby joins us now for more. Abby, good morning.
Good morning.
Let's talk about these moves. You've got some great stats. Is this crash level stuff? in some of these names.
I mean, this is remarkable. To your point, I mean, there are so many superlatives that we could go through in terms of oversoldness. And I think the biggest one that stands out to me is 2 years ago, software was the largest industry in the S&P 500 and is now the fourth largest at less than 10% of the index, which is just remarkable. And I think, you know, it's a broad-based move and some of it is justified, right? But there is a sentiment overhang just generally speaking, and some things are just being thrown out in, you know, in conjunction with and might not be justified in our view. But it's very, very tricky, and you have to be very picky in terms of your exposure when you're thinking about going in. And that doesn't mean that sentiment's going to change overnight, right? We're going to need to see some proof of revenue acceleration from some of these companies to get a validation that it is worth stepping back in.
The narrative has changed so quickly. If you think about where we were 12 months ago, we discussed this earlier, Google was dead. Yes. Google's now $1.5 trillion bigger, and now at the start of 26, software is dead. Is this narrative going to move just as quickly?
Well, that's the thing. I think there's this element of leapfrogging, right? It's not even just like semis versus software. It's like, which camp are you in terms of your exposure, in terms of like which, you know, private market or private company are you most exposed to? And I think that's going to change, right? Because these models are going to leapfrog. But it is interesting that this spend is increasing at the rate that we're seeing, right? I think there's an element of, okay, and there's always been this element of the big guys can compete because they have the capital to do it. But this is just becoming astronomical in terms of the numbers and the change, and it's just becoming very evident that there needs to be this continued spend. And earlier in the week, when semis were under pressure, we were kind of like, as a team, thinking, why is this happening? It's very clear to us that spend needs to increase, and from an infrastructure standpoint, that should benefit the semiconductor companies.
There is a theory that if you have this kind of spending, it's throwing good money after bad, and at a certain point, it's all going to come crashing down, and it's not going to necessarily lead to the same kind of profitability as it has in the past. You reject that. You think that actually this just leads to even more capital expenditure down the line. Why?
I mean, luckily, I think I trust these decision makers to a certain extent, right? They're really the ones at the hands of this and know what's happening, know how transformational this is. I think there's probably, you know, a happy medium in terms of like the disruption it causes from a jobs perspective. But I do think that they're just going to need to continue to build upon this, you know, the productivity, the capabilities of these models. If the fear is that it's going to be as prolific and disruptive as it is, then I feel like there just has to be more money that goes behind it, right? It's only been 3 years. It can't just happen, you know, overnight, it feels like.
How, as an investor, do you decide which management teams at different tech companies are spending this money wisely and spending this money in a pretty, I don't know, prolific and unnecessarily so way?
I think, you know, historically what you would do is you would look at past, you know, precedent of how dollars have been spent. Has it been productive? And I think there's an extrapolation there. But then again, at the end of the day, I think that narrative has kind of shifted too, because some of those companies that had historically misspent, you know, billions of dollars are showing real ROI on this, right? So there is an element of, okay, you know, you can use past as prologue and use it to think about how you can maybe judge the dollars that are being spent. And I think that no matter what, all of these companies are going to spend some of this money unproductively. Like that's part of probably this build out. But I do think, you know, seeing that ROI, seeing the different business models that are benefiting is changing the narrative around, okay, in the past, maybe this company has misspent, but now it seems like they're spending correctly, they're right sizing, and you're also seeing a return on investment already.
You say they're getting all these questions about software from clients.
Yeah.
What if Anthropic posts something about, I don't know, editing a book? What is going to be potentially the next leg to fall? Could we see more of this happening in the market?
Well, that's the thing. I mean, it started obviously with software and, you know, the business services oriented companies because it seemed like it was in the legal realm and, you know, in the consulting realm, let's call it. But it spread so much wider. So, you know, I stay very close to the healthcare space, and that it spread to, you know, contract research organizations within healthcare, right? 10% down on that day too. So it's spreading beyond that. And that's the kind of the point on sentiment, right? They're trying to dispute a negative. Right? That's very, very difficult, and it takes a very long time to do that. And again, like, I don't know. I think you're going to have to basically wait. You know, it feels like DeepSeek and Liberation Day are happening at the same time right now. and so I think
they had a baby.
Yeah, and in 1 month. And then, and what really helped get us through those downturns last year was getting to earnings season and seeing a real, you know, enhancement in terms of what they were doing from a profitability perspective. I think that's probably going to be the same case this year.
Which sectors are you more comfortable in? We came into the new year and I think you added industrials into the mix as well, stayed with financials. What are you more comfortable in at the moment?
I mean, I think there's an overhang in financials right now as it relates to a regulatory perspective. If you do have, this really, focus on affordability going into the midterms, we have this, floating 10% credit card cap that I think has really weighed on what was otherwise pretty good earnings, right? It was kind of, completely dismissed at that point. But you did get some news last night that the stress capital buffer for these banks is going to remain the same. I think that's a net positive as we move through the year in terms of the deregulatory agenda. And if this really is going to be, you're seeing all of these cyclical sectors do really well, with this cyclical upswing and this M&A cycle and this, industrial capex, like who's going to fund that? That's going to be the banks, right? So I do think there's a lot of tailwinds that come through in terms of the financial sector as well.
Abby, it's good to see you.
You too.
Hold on tightly. We've got more to go. This is quite a ride. Another 11 months.
Deep Seek, Liberation Day. What else do we want to put in there?
Crazy.
I mean, it's been a long year already.
Abby Yoder of JP Morgan Private Bank. Abby, thanks again. Thank you very much. Welcome to the programme, everyone. If you're just tuning in, counting you down to the opening bell, about 40 minutes away. We've got equity futures near session lows, negative 0.6%. The ECB news conference is underway in Frankfurt, Germany. Christine Lagarde has taken to the podium, so let's take a listen to what she's got to say.
2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it, in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release available on our website. And I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. So looking at the economic activity first. The economy grew by 0.3% in the fourth quarter of 2025, according to Eurostat's preliminary flash estimate. Growth has mainly been driven by services, notably in the information and communication sector. Manufacturing has been resilient despite the headwinds from global trade and geopolitical uncertainty. Momentum in construction is picking up, also supported by public investment. The labour market continues to support incomes, even though demand for labour has cooled further. Unemployment stood at 6.2% in December, after 6.3% in November. Growing labour incomes, together with a lower household saving rate, should bolster private consumption. Government spending on defence and infrastructure should also contribute to domestic demand. Business investment should strengthen further, and surveys indicate that firms are increasingly investing in new digital technologies. At the same time, the external environment remains challenging, owing to higher tariffs and a stronger euro over the past year. The Governing Council stresses the urgent need to strengthen the euro area and its economy in the present geopolitical context. Governments should prioritize sustainable public finances, strategic investment, and growth-enhancing structural reforms. Unlocking the full potential of the single market remains crucial. It is also vital to foster greater capital market integration by completing the Savings and Investments Union and the Banking Union to an ambitious timetable, and to rapidly adopt the regulation on the establishment of the digital euro. Looking now at inflation. Inflation declined to 1.7% in January from 2% in December and 2.1% in November. Energy inflation dropped to minus 4.1% after minus 1.9% in December and 0.5% in November, while food price inflation increased to 2.7% from 2.5% in December and 2.4% in November. Inflation excluding energy and food eased to 2.2% after 2.3% in December and 2.4% in November. Goods inflation edged up to 0.4%, whereas services inflation declined to 3.2% from 3.4% in December and 3.5% in November. Indicators of underlying inflation have changed little over recent months and remain consistent with our 2% medium-term target. Negotiated wage growth and forward-looking indicators, such as the ECB's wage tracker and surveys on wage expectations, point to a continued moderation in labour costs. However, the contribution to overall wage growth from payment over and above the negotiated wage component remains uncertain. Most measures of longer-term inflation expectations continue to stand at around 2%, supporting the stabilization of inflation around our target. On the risk, the euro area continues to face a volatile global policy environment. A renewed increase in uncertainty could weigh on demand. A deterioration in global financial market sentiment could also dampen demand. Further frictions in international trade could disrupt supply chains, reduce exports, and weaken consumption and investment. Geopolitical tensions, in particular Russia's unjustified war against Ukraine, remain a major source of uncertainty. By contrast, planned defense and infrastructure spending, together with the adoption of productivity-enhancing reforms and the adoption of new technologies by euro area firms, may drive up growth by more than expected, including through positive effects on business and consumer confidence. New trade agreements and a deeper integration of our European single market could also boost growth beyond current expectations. The outlook for inflation continues to be more uncertain than usual on account of the volatile global policy environment. So inflation could turn out to be lower if tariffs reduce demand for euro area exports by more than expected, and if countries with overcapacity increase further their exports to the euro area. Moreover, a stronger euro could bring inflation down beyond current expectations. More volatile and risk-averse financial markets could weigh on demand and thereby also lower inflation. By contrast, inflation could turn out to be higher if there were a persistent upward shift in energy prices, or if more fragmented global supply chains pushed up import prices, curtailed the supply of critical raw materials, and added to capacity constraints in the euro area economy. If wage growth moderated more slowly, services inflation might come down later than expected. The planned boost in defense and infrastructure spending could also cause inflation to pick up over the medium term. And extreme weather events and the unfolding climate and nature crisis more broadly could drive up food prices by more than expected. So looking at financial and monetary conditions. Market rates have come down since our last meeting, while global trade and geopolitical tensions temporarily increased financial market volatility. Bank lending rates for firms ticked up to 3.6% in December from 3.5% in November, as did the cost of issuing market-based debt. The average interest rate on new mortgages, again, held steady at 3.3% in December. Bank lending to firms grew by 3% on a yearly basis in December, after 3.1% in November and 2.9% in October. The issuance of corporate bonds rose by 3.4% in December. According to our latest bank lending survey for euro area firms, demand for credit was up slightly in the fourth quarter, especially to finance inventories and working capital. At the same time, credit standards for business loans tightened again. Mortgage lending grew by 3% after 2.9% in November and 2.8% in October, in response to still rising demand for loans and an easing of credit standards. So to conclude, the Governing Council today decided to keep the three key ECB interest rates unchanged. We are determined to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. Our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it, in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. And in any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. And we are now ready to take your questions.
First question goes to Alex Weber of Bloomberg. Alex, please.
Thank you very much. Good afternoon. My first question is on the risk assessment. Given the events of recent weeks, including new tariff threats by the US, would you say that inflation and economic risks on both sides have become more pronounced again, and has the ECB's good place perhaps become a little less comfortable? And then I'm also curious how you discussed the euro's exchange rate this week during your meeting. Has the recent appreciation against the dollar perhaps increased any concerns in the Governing Council that inflation might turn out lower than expected?
Well, thank you for your two questions. Let me first of all mention to all of you that the Governing Council took a unanimous decision to keep the rates at their current level unchanged. In relation to our risk assessment, you will have seen that we take a one hand, the other hand approach, both in relation to activity and in relation to inflation. And if you look at the balancing act between the two, we are, as I would call it, in a broadly balanced situation when it comes to risk assessment. And some risks have ticked up, others have ticked down, but on balance, taking the various specific elements that we make sure we list in a rather exhaustive way, we believe that we are in a broadly balanced situation at the moment. So, on the exchange rate, because I know that this is a question that has been on the mind of some, I just want to remind you, and this will not come as a surprise, that we do not target an exchange rate in terms of policy target. But we also recognize that it is important for growth and inflation outlook, both. So for that reason, we always keep a close eye on exchange rate developments, and the Governing Council discussed this matter today. Now, what we observed collectively is that the dollar has depreciated measurably against the euro, but not in the last few days, but since March 2025. That's when you see the significant change at the time. And in the last few weeks, actually since the summer, it has fluctuated within a range. And whether you look at the euro-US dollar, whether you look at nominal effective exchange rate, the story is the same. So, as a result of that observation, we concluded that the impact of exchange rate appreciation since last year is incorporated in our baseline. Okay? But of course, as I said, we always monitor whether the impact is passing through as expected and how it affects our reaction function. That's the analysis that we conducted. So it's a topic that we touched, that we explored, and our conclusion is as I have just described. I would also observe that the current range within which the euro relative to the dollar is evolving is very much in line with the overall average of that exchange rate between the euro and the dollar for as long as the euro has been around.
Next question for Annette Weisbach of CNBC. Annette, please.
President Lagarde, I have two questions. A, on the role of the global euro.
Global
euro.
Yeah.
You wanted to push the importance of the euro globally. Don't you have to take into account then also a stronger euro towards the rest of the world? My first question. Second question is, there are reports that you're looking into repurposing the swap lines, so enlarging the liquidity pool which is available of euro also beyond its current purpose, in order to also enlarge the importance of the euro. So perhaps you can tell us a little bit more about those plans, also in light of the fact that the independence of the Fed is actually currently questioned by the markets. Thank you.
So your first question, thank you very much for both. Your first question has to do with the international role of the euro. And it is a point that I made about a year ago and that we collectively as Governing Council feel strongly about. Second observation, it is not because you have an international currency that plays a global role that it necessarily implies that it is, quote, strong, unquote, relative to others. There is currently a currency which is playing that role, but it does not necessarily come together with a currency being, as a result, strong. There is no fatality, if you will, or correlation between the two, being a strong international currency and being appreciated relative to other currencies. So first observation. Second observation, I have said in the past, in that speech which I think I gave in Berlin, if I recall, that for a currency to play an international global role and to be powerful as a result requires a few other elements that build over the course of time. And it clearly goes with a reliable environment, a safe environment, where the rule of law is known and respected. I have no doubt about that particular aspect as far as the euro and the euro area is concerned. It requires a strong position relative to the rest of the world, and there are clearly investments that are flagged in our monetary policy statement, particularly in relation to defense and infrastructure, that go in that direction, but where clearly work has to be done. There is a third component which is also improving and has continued to improve recently, which is the capacity to trade with the rest of the world. And I would regard both the Mercosur, the EU-India trade agreement, subsequent trade agreements in Australia and other corners of the world where the Commission is doing hard work as other components that are necessary for the currency to be strong. So, yes, not necessarily aligned with an appreciation of the currency, and 3, more work needs to be done in those various directions. One of the attributes of a strong currency is to be the provider of liquidity. And while we are tied to the monetary purpose of what we do in terms of liquidity, and we have to constantly assess the proportionality of what we do, it is a fact that we are looking at our liquidity framework and that the repo line, to be distinguished from the swap lines, the repo line are in progress in terms of reframing them, opening up the access and making them more attractive to other national central banks outside the euro area and outside Europe. So this is in the works, and I hope to be able to announce a bit more in a few days. Thank you.
Next question to Francesco Canepa of Reuters. Francesco, please.
Good afternoon. So my first question is about the balance of risk. You said it's broadly balanced. Could you give us some of the flavor of the discussion, because I don't see it in the opening statement. And the second question is about the good place. Are we still in a good place?
Thank you very much. Yeah, you will have noted, because you are an avid reader of our monetary policy statement, that we no longer state in the monetary policy statement whether the balance of risk is whether the risks are broadly balanced or tilted to the downside or tilted to the upside. We did that during the period of COVID, because we thought it was good guidance to have at the time. Now what we do as a policy and as a general practice that we have not moved since COVID is we list the upside and the downside risks component, both in relation to growth and in relation to inflation. And then it's not for you to actually second guess. There is a debate that goes on in the Governing Council, because it's always question of judgment and collective approach to those risks and the range of the risks, the extensiveness of the risks, and that is debated. What I can tell you is that we are not seeing a reduction of the range of risks. But when I think of geopolitical risks, for instance, it's ebb and flow. When I look at uncertainty about tariffs, it's up and down and out and back. And that has been going on for quite a few quarters, actually. So no reduction of the range, but equally the sentiment around the table of the Governing Council that it's broadly balanced. Now, are we still in a good place? I would certainly argue that we are in a good place, and inflation is in a good place. Now, 2 words of explanation, because some of you might be riveted to the January data point, and I would like just to remind you that our good place is a factor of whether we are convinced that we will reach our medium-term target of 2%. And we cannot be hostage to one data point. I've said that many times. We cannot be hostage to one reading of inflation, which is set to vary over the next months. If you look at, I'm happy to go down into what's underneath, but this, 1.7, there are multiple causes, and in the monetary policy statement, we take really good care of saying what has gone up, what has gone down. You have a bit more of one category versus the others. So as a result of that, we have this particular reading. But some of them are idiosyncratic and will go away. There is a significant component on energy, which has gone from minus 5 point something, which has gone to minus 5 point something, and which is largely a base effect from last year's energy costs. But it is also a fact that inflation is moving gradually down to our target, and we see it at target in the medium term. And I would add one thing, because you didn't ask me, but no, I'll wait until somebody asks me.
Aude Kersulek of BFM Business, please. Aude.
Good afternoon, and thank you for taking my question. Under what conditions of inflation undershooting would the ECB consider easing monetary policy? How long and how far below 2%? And on another subject, in the US, Kevin Walsh has been nominated to chair the Federal Reserve. Former central banker McCartney called it a fantastic choice. Do you share that view, and have you worked with Mr. Walsh before?
So on Kevin Walsh, yes, I have known him for a long, long time. Back in the financial crisis days, where he was in public service, and I was Minister of Finance at the time. So we go back a long way, and I very much welcome the announcement of his appointment. Now, I just want to take you back to the undershooting. We have projected undershooting in 2026 for a long time. And if you go back to our September projections, for instance, which were the last projections conducted by the ECB, we had actually this 1.7 and the 1.8 for the entire year. So this was changed and moved up in December. In a way, we are going back to the track that we had anticipated, and this is also what markets and economists are anticipating. But if you look at our, medium-term target, which is what we rely upon, we are at 2% in 27, 2% in 28. I'm myself particularly attentive, as you know, to services. Services is declining a little bit. I'm also very attentive as a result to wages. We have the wage tracker, which seems to guide us towards more growth moderation. We will have more data and intelligence coming out of the March exercise, but there is nothing that is really changing the baseline at all. And we, as I said, be looking at all data, not one single data point.
Olaf Storbeck of the Financial Times, please.
Thanks for taking my questions. My first question is on kind of making sense of the mood music in the monetary policy statement. Some analysts noted that it seems to have a bit of a hawkish subtext, because you're kind of emphasizing the positive elements and kind of also emphasizing that inflation is on track to meet your target. Would you share that view, that it's kind of, well, more hawkish than dovish? My second question is on core inflation, which has fallen to, I think, the lowest level since October 2021, and is also below the ECB's Q1 forecast. Does the governing council see this as a good development, as it kind of suggests inflation is coming down further and quicker than potentially expected, or is this seen as a rather kind of negative trend because disinflation might be stronger than you want it to be? Thanks.
Thank you for your two questions. So on your first question, I would like to mention that our monetary policy is in good shape. And it's in good shape because it is agile, and it is prepared to do what is necessary in order to reach our medium-term 2% targets in a symmetric way, as we decided in our strategy assessment determination back in July 2025. So I'm not trying to characterize the hawkishness or the dovishness. This is something that you enjoy doing, and that markets look at very attentively. But we are data dependent. We will decide meeting by meeting. We are not rate path predetermined. We do not give forward guidance. We are in this world of significant uncertainty, where geopolitics developments determine a lot of developments, and that's what we're going to continue doing. Core inflation, you're right, it's one of the underlying inflation elements that we consider. That is one which has gone from 2.4 to 2.2. We're still at 2.2, by the way. And I think that it's following a path that we had anticipated, that we are pleased to see is taking us to targets. I would like to emphasize one element, which you will allow me to pick up because I think it might be interesting. As you probably know, the leaders are meeting in a week's time to examine competitiveness, reforms, and hopefully to accelerate the process. So in our monetary policy statement, as you well know, we always have this paragraph, which has slightly evolved over the course of time, in which we stress the urgent needs to strengthen the euro area and its economy in the present geopolitical context. And you generally look at this paragraph and say, okay, still the same thing. So what we decided to do in anticipation of that meeting on the 12th of February is to actually give our checklist to the leaders. So I will send it to each of the leaders of the European Union, to the President of the European Commission, and to the President of the European Council. And this is our checklist of what we regard as very much likely to enhance growth, to improve productivity, and to really unleash the talent of Europe. We're not, shooting above our range, but we believe that whether it's the savings and investment unions, the digital euro and the tokenized wholesale central bank money, the deepening of the EU single market, the fostering of innovation and protection of open strategic autonomy, or simplifying legislation and strengthening core institutional framework, on these 5 accounts, we hold views. We cannot deliver it all. We are delivering monetary policy and compliance with our mandate. But we strongly feel that significant reforms have to be either deepened, accelerated, in order to deliver on what is the potential of Europe. So that's something that I thought I would mention.
Stefan Reccius of Handelsblatt, please. Stefan.
Thank you. Good afternoon. I have a follow-up on the global euro debate, in particular with regard to Eurobonds. So you checked a few items that you think are important, but what about common defense spending as a critical element in this regard? Is it sufficient in terms of a global euro, or should the EU be even bolder when it comes to Eurobonds and making it a permanent feature of a euro safe asset? Thank you.
Well, thank you for your question, and it is definitely part of our checklist.
And now Chelsea Dolani of the Wall Street Journal. Chelsea, please.
Thank you for taking my question. Today's statement talked about the low employment rate, but if you look at some of the other indicators of labor market resilience, they seem to be telling a slightly different story, things like labor demand, hiring intentions, vacancy rate. So I'm wondering how you're balancing these different signals. Is the labor market potentially weaker than it may appear based on the unemployment rate? And I also wanted to ask about AI. I think you've mentioned a couple times that we are seeing this benefit of AI investment in Europe, but I think in the global context, there is this concern that Europe's falling behind, whether that means adoption or data center investment. So I was just wondering if you could shed a little more light on what the benefits we are actually seeing in terms of the economic impact in Europe and how that might impact broader growth.
Thank you for your 2 questions. So, on the labor market, we are seeing, first of all, a lot of the data that we get on labor and the labor market in its various dimensions, you referred to vacancies and rotation, are a bit backdated. So very often in January, we look at data that we get from the third quarter, some of it from the fourth, but it's generally with a lag. What we are seeing is increased participation in the labor market. We are seeing slightly lower unemployment, 6.2 coming from 6.3. We are seeing vacancies that are growing more moderately than we had in the past. And it's a labor market that is still active. As I said, where unemployment is almost at rock bottom. So we will continue to pay close attention because obviously it has an impact on particularly the wage negotiations that we pick in our wage tracker to try to understand where salaries, where the drift is going, which is the difficult part to determine, where the one-offs are likely to arise as well. So that's what I can tell you about the employment. But we're certainly not saying that the labor market is in difficulty. On AI investment, you know, one of the good news story as far as the European economy is concerned is that while the net export activity and contribution to growth is on the decline, the domestic market is responding strongly. Consumption is improving a little bit, but not much. But investment is the big story. And whether you look at public investment, particularly in defense and infrastructure, and as a result, well, I'll come to that in a second. Construction is also a derivative of infrastructure investment. But it's not just the public sector, it's also the private sector. We see significantly higher number in terms of private sector investment. And that is particularly the case in what I used to call ITC or ICT, which I think we have to be a bit more granular about because it's AI related, but it's everything having to do with AI. So it's not just AI, it's the infrastructure that comes with it. So construction of data centers in the pipeline and going through the process of licensing and authorization. It's software, it's hardware, it's a lot of investment that is coming out of that particular segment. The really interesting thing from our perspective is how it will impact productivity and how it will contribute or not to inflation, depending on the level of improved productivity. There is a little bit of that, but it's going to take a while to unleash.
Thank you. That concludes our press conference today. So we will see each other again, if you want, on the 19th of March. And up until then, all the best. Thank you very much.
That was ECB President Christine Lagarde speaking in Frankfurt. Now, we're looking at a market that has come down substantially since jobs numbers came across the ticker. The Challenger job cuts, a report that we don't always pay very close attention to, showed that January was the worst month for layoffs since 2009. It was also the worst month for hiring since 2009. But that doesn't really bear through when you look at the initial jobless claims. Initial jobless claims came in higher than they were previously at 231,000. That's a rise of 22,000. Also higher, far higher than the survey, which was 212,000. But it's not the same thing as the worst since 2009. So let's talk about the labor market and the stock market with Empower Chief Investment Strategist Marta Norton right now. Marta, these drops, well, first of all, good morning.
Good morning.
And thank you for joining us. These drops that we see in futures and will no doubt, at least for a while, carry through into the cash trade are on the fear of the labor market dropping. But is that really necessarily a horrible thing for equity investors? Because then the Fed would cut, right?
Right. I think that's the upside of a weaker labor market is those cuts feel sooner and maybe more significant than they were previously. But of course, I think what the equity market really wants to see is that Goldilocks scenario where we're not seeing the worst amount of cuts since 2009, but we're seeing a little bit of weakness, just enough weakness to get those cuts to come through, but nothing that says something negative about the economy. And so that's the needle I think the equity market wants to thread.
At the same time, you're seeing bond market yields are falling substantially. Front end of the curve or something like 5 basis points, so that's definitely leading the way. It does feel like correlations have been very strange, I guess, over the past couple of days. It's like gold and silver are going up and down. Equities have been hurt. Bond markets have been floating or doing their own thing or reacting.
Yeah.
Is there something to this? Just to the past week of what we've been witnessing in markets?
Well, I think when we just cast our gaze back to all of 2026 and the month and odd days that we've had here.
That's it?
So long. But there have been so many outside factors and left field developments. We have the geopolitics angle. We have a new Fed chair announcement that's finally come through, and folks trying to get a sense for what that means, both for interest rates near term, but also kind of structurally, how is the Fed going to behave with a different philosophy guiding it. We have the AI theme, which a lot of us were looking to earnings to reignite the AI theme, which had taken a back seat. And now it's just a whole new narrative around AI. Disruption, and also CapEx is no longer all to the good. So I think there's just a lot of shifting sands right now.
Yeah, I mean, obviously the Google CapEx news is before the jobs number, the big story of the day, probably still is, right? They're going to spend $185 billion. But they also had an increase in revenue beyond what the street expected. They had real growth in cloud, I think like 48%, right? Which makes Microsoft look pretty weak. So they are showing a return on the CapEx that they spent last year. And it seems like they need this hardware spend to differentiate themselves from the software side that everyone's so worried about.
Yeah, it seems as though, and a lot of folks are talking about this splintering of the Mag 7 or a splintering of the AI A-list. You have certain companies that are able to spend big but also monetize it, and that's a little bit more in favor. And then you have the folks who are spending big and saying, trust us. And I think that's becoming a dichotomy that the market's watching. But in my eyes, that means there's opportunity there.
Yeah, trust us. How far does that go? Marta, stay with us. We just got to get a check on what markets are doing just moments away from the start of trading, Matt.
Right now at 9:30, when the market tells you what it really is thinking, we are looking at futures that are substantially lower than they were before the Challenger numbers came out, off 0.75% on S&P futures, NASDAQ futures down almost 1%. You hear and see the opening bell, Bob ringing that at the New York Stock Exchange. I guess he's a discount furniture salesman. And then at the NASDAQ market site, you've got Icon Therapeutics ringing the opening bell. The important thing to do is look at what's going on in the cash trade as we see real worries about the employment picture, and to Marta Norton's point, some concerns about the CapEx picture as well as Google ramps it up.
It was stunning numbers from Google. 185 billion. I mean, that's huge. I think it's a 55% increase from what they've spent in the past. And there has been this question, is that rewarded or is that a bad thing? And at the moment, it's a decline of 6.4%. The figure was 70 billion more than analysts expected for their capital expenditures. You pointed this out, Matt. It doesn't matter that their cloud business did well. Revenue there was up 48%. There's some real fears in this market. Qualcomm, you can also see that here, down 9%. They gave a disappointing revenue forecast for memory chip supply. It's weighing on its smartphone business. The CEO also warning of rising prices for phones. So another day. Yesterday was AMD. It's time for Qualcomm in terms of chip makers getting hit.
Yeah, we should point out that, Google has done incredibly well before this point, right? They're up over the last 5 years. They've tripled. They've done better than all of the other Mag 7 stocks, except for Nvidia, which obviously has gone far higher. And so I guess investors are taking a little bit of that profit off the table. Hims and Hers reportedly launched a copy of the Wegovy weight loss pill starting at $49. I guess I imagine that's a monthly price, which compares to $150 at the lowest end for the starter dose of Wegovy. So that sends shares of Novo Nordisk as well as Eli Lilly down. And I think it's so fascinating that they managed to get a copy of the formula for the pill so quickly. Like Novo Nordisk just put it out.
The other thing I don't understand, I'm going to have to ask Katie Greifeld about this, is how are compounding pharmacies still allowed to do this? I thought they could in the past because there was a shortage. I didn't know there was still a shortage and they can still make compounding medicines.
I guess there are no rules anymore.
No rules. Get your shot.
Nothing
get your
matters
pill.
now.
Correct.
All right, really interesting story. Obviously not nearly as big and important in the market as Google and the tech sell-off that we've seen. in software has been pretty amazing. In fact, in the iShares Tech ETF, the software ETF, we've seen $1 trillion of selling in the past few days. Still with us in Power, Chief Investment Strategist Marta Norton. And Marta, you touched on this at the top, which is concern about disruption, concern that AI will be able to do for you, if you're a large company, what Salesforce does for you.
Right.
Then you no longer have to pay CRM.
Right.
How seriously do you take that?
I think we can't ignore that. I mean, Sundar Pichai, right? AI is more transformative than electricity or fire. We can't ignore the idea that there could be permanent disruption based on how AI develops. But as I look at the severity of the sell-off and everything that's declining in unison, it's hard not, as a price-conscious investor, to look at this and say, what's on sale? What's getting thrown away with stuff that is legitimately damaged? And so I think if we look at the software space, we really should be looking at it and thinking, okay, losers, winners, and survivors, and really focusing in on those last two categories to determine, are there opportunities here?
This is the iShares Expanded Tech Software Index, so you can see what's happened to it. Down 25%, lost quarter of its value in the past 6 months. By the way, this leads me, Marta, to a question I've been asking a number of people. What do you suppose are the most important moats? Like, if you're a company, especially a software as a service company, is it the data you have access to? Is it your relationship with customers? Is it your integration into their systems? Like, what's the most important thing so that you can judge if they're truly going to be damaged, or maybe you pick them up on the cheap?
Yeah, I think switching costs are really key here. So if you're really embedded, you've got your tentacles everywhere, you've got the data, you own the workflows. Maybe you are a company that someone can replace, but it's a lot harder to do that than if you're skating along the surface, providing an application that just rides along. So I think that is one way to distinguish between those winners, survivors, and losers. And there are some companies that are a mix of both, right?
True. I have to say, though, it's not just tech that's sold off. Obviously it has. But the other thing that's happened is the equal weighted measure of the S&P 500 has been hitting new records. So while tech has been falling, other things have been rallying. And it's also risk, it's momentum, it's growth, it's those specific strategies that worked really well last year that have stopped to work.
Right.
So along with the tech issue, is there just a structural change happening in the market too?
Well, it does seem as though momentum is shifting. It was favoring, the tech area of the market. It's now shifting to favor the broader market. And I think the rationale for that, when you look at, the cyclical recovery, the stimulus that's out there, the earnings kind of closing the gap between Mag 7 and everyone else, I think those are all forces that are shifting the market. But what I would argue is sometimes people add to that list valuation, and they say things outside the tech area are just more compellingly priced. And when we look at valuation, we don't see that as an argument, which would suggest to me that there is some risk that if there's an outside factor, even this broadening out trade could suffer. So that's why challenger job numbers matter.
Right. I mean, and we'll look for confirmation, obviously, of that in the data. We have Michael McKee coming on at the top of the hour. But I think it's interesting. Jefferies put out a note saying that they've never seen this kind of negative sentiment in any group, speaking about tech stocks, and that we may be due for a vicious rally because 73% of software stocks are in oversold territory, and 45% of all tech stocks are in oversold territory, which is shocking at these index highs, right?
Yeah, I can't not return to that point that there's opportunity here. And I really think that if you're just playing the momentum trade and you're just running the narrative, you're going to miss a pretty good investment opportunity. AI is a theme that we know is going to dominate, and so we want to find ways to get invested in it at better prices. And this is one of those times to look for those better prices.
Where do you find that? Is it the large cap hyperscalers? Is it some of the smaller software names that have been hurt? What are you looking at?
So I think you have two starting points. I do think you can look at the Mag 7. I think you look at that splintering, and you look at members of the Mag 7 that are delivering, but their valuations don't suggest as much. So that's where I would start with that group. And that keeps you in the epicenter of the AI trade. And then I would also look at software. I mean, the decline has been so sudden, so severe. You do have to do that due diligence, and you have to do that filtering. But I think there are opportunities there.
Earnings still across the board look so strong. I think a lot of people are expecting 14% gains on S&P 500 earnings this season. Have you been impressed by what you've seen so far?
A few things jump out to me about earnings season. Yes, it's delivering, right? But the market reaction, the market interpretation of earnings has been super fascinating. There does seem to be a winners and losers element to how earnings season has behaved. If you deliver according to quiet expectations, you're rewarded. If you disappoint, even if you met the hard numbers, you're punished. And it's that extremity in the reaction function that I find so fascinating.
Got to watch the whisper numbers.
That's right.
Yeah, I mean, this market is a great example of just big reactions to the likes of Google today. Marta, we're going to have to end it there. So wonderful. Please come join us again in studio. It's been so nice to have you here.
My pleasure.
That's Marta Norton of Empower, the Chief Investment Strategist. Let's get a check on those markets because I want to show you these big moves. The breadth is pretty even. The breadth was actually really good yesterday when we sold off. I think more than 360 stocks were gaining to the upside. But just the size of the moves is pretty remarkable. Broadcom is up 3.5%. Netflix is up 3.6%. J&J 1.4%. I mean, these are some pretty chunky moves in some pretty big stocks. You're also going to see that to the downside, too. We were just talking about Alphabet with Marta. 4.3% is the decline in Alphabet. It hurts. That's exactly right. 10 points down, nearly 10 points for Amazon. Microsoft also down 2 points, 2%. Eli Lilly down 5.3%. I guess there is also this concern filtering through pharma about hims and hers, about making very, very cheap Wegovy pills. So only 3 indexes are higher. And they are very much so the safety ones. It is consumer staples, it is healthcare, and it is utilities. Google not helping with tech and with communication services down there, consumer discretionary, materials, energy. It had a really good session yesterday because oil prices were higher over Iran fears. They're lower this morning. Matt, it's an ugly session, I have to say, for big cap companies, and it's kind of like a textbook risk-off kind of day. Yeah, it is really interesting. I was just looking at the Mag 7, as Marta pointed out. You look at the Mag 7 and how those giant hyperscalers have performed, for the most part, hyperscalers year to date. Microsoft is down 16% and change already, and we're only at the beginning of February. So really interesting stuff. Coming up, we're going to talk to the CEO of Ares, Mike Arrighetti, is in the building to discuss earnings and the inflows that they've seen, as well as private credit loans in the software space. This is Bloomberg Open Interest.
Players is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'll still be driving some.
Yeah. Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
There is a concentration risk here for AI disruption. That discussion point's just happening. Is the disruption big enough to move that far up in the capital structure, I think is the question. And the market doesn't really know. You made the comment in the last hour, transparency. We're going to get tons of transparency. You're going to have to defend what you own and what your exposure risk is.
Thomas Kennedy from JP Morgan this morning talking about AI concerns bleeding into private capital. Ares assets under management, meanwhile, reported earnings climbed to a record $622 billion in the fourth quarter. The firm's assets grew by 29% in 2025, driven by inflows for its U.S. direct lending business, which, by the way, hit a record. Ares says just 9% of its private credit book is tied to software. We'll get into all of that, and please say joining us is the Ares co-founder and CEO, Mike Arroghetti. Mike, thanks so much for joining.
Good to be here.
That, by the way, wasn't like a direct, like, now time to defend yourself.
Jump in.
No, but this is the thing, because I want to talk about the record flows, because if you believed what was happening in public markets, what was happening to Ares stock, the BDCs, it's like private credit is left for dead, everything is horrible. But here you are attracting a lot of capital. What is the narrative getting wrong?
There's a huge disconnect, and I think that the narrative is wrong in many respects. It's not to say that people shouldn't be focused on AI, but you have to be thinking about opportunity and risk. I don't think it's as binary as the way that the market is interpreting it. If you look at the traded markets, don't know how it looks this morning because I've been dealing with earnings, but the public equity indices for software were down 20 to 22% through this period. The broadly syndicated loan index that tracks software exposures down 2%. So at least in the traded markets, they're doing a very good job of differentiating between equity exposure, down the capital structure, and credit exposure, up the capital structure. A lot of this private market discussion, I think, is missing the very simple point that these loans are largely senior secured loans. Now, people have different exposures to different types of companies. Senior secured loans, 30% loan to value in very mature enterprise software businesses with 75% or so of the capital structure owned by institutional equity or corporates. So I think the first thing that people just aren't understanding is how senior and safe a lot of these companies are. The second thing they're probably missing is, at least in the Ares portfolio, where our exposure is pretty small relative to our AUM base, it's about 6% of our total AUM. EBITDA margins are in excess of 40%. Cash flow is growing at double digits. Stream yields on our loans are somewhere between 10 and 12%. We have a weighted average maturity of 3 to 4 years. So even in a world where AI disruption happens in a portion of the portfolio, these are high free cash flow, high returning. And so I think what the market is missing is how attractive these loans have been and how difficult it will be to actually displace.
By the way, there must be a lot more attractive things out there now with assets selling off. Like, could this even be an opportunity?
Yeah, and that's why I said it's not binary and it's not as linear as people think. So if you're going to underwrite a narrative of AI disruption, you also then have to say, well, what does that mean for the productivity and margin improvement in the rest of your book? So that means that EBITDA is going up, free cash flow is improving, your general book is deleveraging. For companies like Ares, who don't own these assets directly and just make fees off of these portfolios, if AI implementation accelerates, that's a huge catalyst for growth in our digital infrastructure business, our renewable energy practice. So I think what they're missing, too, is how well hedged a lot of these private markets companies are to this, AI revolution that we're going through.
I want to step back and, Danny is living this private asset story every day, and I've become like a permanent tourist here. So I'm trying to really get my head around
To be clear, we're all tourists, like, except Mike. Just
well,
to be very
exactly.
clear on that.
That's why we have people like you on. So what I keep hearing is that the spreads between the broadly syndicated, like leveraged loan market and private credit are getting tighter and tighter. And I'm just trying to understand if leveraged loans are like SOFR plus 400 and you're SOFR plus 600, is that the right price, or is it?
So generally speaking, if you're talking private credit specifically, broadly syndicated loans relative to private corporate loans over time typically trade in a range of 150 to 300 basis points of premium. And it contracts and expands depending on base rates, economic environment, so on and so forth. We are still generating 150 to 200 basis points of excess return in this market. And when I remind people, it goes back to this kind of narrow lens that people are talking about private markets. Spreads are tight everywhere. They're tight in the high yield market, they're tight in the loan market, they're tight in the high grade market. So it's difficult to just look at private credit and say spreads have tightened in private credit, therefore it's not attractive. You mentioned our earnings. When you look at our flows, the sophisticated global institutional investor community is seeing that. So when you look at the dollars that are flowing into our private credit product, it tells you something completely different. They're not worried about credit performance. They're looking at the data broadly, and they're saying, I need to capture that excess return right now because spreads, in fact, have tightened.
By the way, doesn't that make you want to buy your shares and shares broadly?
I'm quite a large shareholder.
No, I mean the fact that you're seeing, so the evidence is investors are still saying, that's an attractive product, I want access to that. Yeah. But the equity market is saying, wringing its hands and selling the stock.
That's why I work in the private markets.
Yeah.
Right? I mean, the markets trade on momentum. There's a lot of forces in the public markets that are not tethered to fundamentals. So if you look at, again, the earnings, we're coming off of a record year sequentially. We just declared a 20% forward increase in our dividend. We have 5-year guidance out that says that we're going to grow earnings, 16 to 20%, and our dividend 20% plus. That's not a stock that's supposed to exhibit that type of volatility, but it does, and that's okay. But it is interesting to hear you say that, because for folks in the private markets, we don't really understand that. The way that the headlines and the narratives and the momentum whipsaw these markets is just not something that we experience.
By the way, no one does, right? Academic studies that look at big swings in stock markets.
Are you saying that the market is not efficient?
Show that 85% of the time there's no reason, right? So
no, it is true. I have to say, one of the other sort of things that's lobbed at the industry, which maybe has some reason to it, is just rates are coming down, so the ability to outperform is also narrowing, and just returns for the entirety of the industry, kind of what Matt was talking about, start to collapse. And then you get this scenario where a lot of money is coming in because of the push to retail, and so you just have to be like the biggest platform you can. That fees are really low, and the only way you outperform and please shareholders is just becoming as large as you can, and returns stop to matter.
That's a lot to unpack.
I realize that. So but is there any merit to this idea?
No. So size drives performance in private markets. So this is another disconnect for people who live in the public markets, because at a certain size, you see that performance diminishes in public markets. In private markets, value is driven through your ability to source, develop, structure, and manage esoteric investments, companies, buildings, infrastructure assets. It's very resource intensive to do that. And so the larger you get, the higher the likelihood that you can actually capture whatever excess return in alpha is in the market. So not surprisingly, the markets are consolidating because the investor community is seeing these aggregated benefits of scale. We're not experiencing fee compression. If you were to look at our fee rates over time, they've been largely consistent in and around 1%. Mm-hmm. The private markets are expanding now into lower return, lower fee product like high grade fixed income. So not surprisingly, you will see that expressed as fee compression. But if you were to really parse it asset by asset, when you're down the capital structure and you're delivering excess return to people, the fees have been quite steady.
By the way, on consolidation, just in the past week, it's been almost breathtaking. You have KKR announcing they're buying Arctos today, CVC buys Marathon, EQT buys Collar. There's a lot. Yeah. There's a lot. What is behind that? Is it what you're talking about? Is it stress? Is there something different?
It's not stress. It's opportunity. The structure of the market is changing. And you've seen this broadly in financial services over time, right? So There's concentration at the top of the commercial banking industry. There's concentration at the top of the investment banking industry, insurance. And the reason is there's efficiency in the investment and portfolio management process you get from scale. The investor community, so if you were to go talk to the large pensions and sovereigns, they're consolidating their capital with fewer global managers. And there are huge investment benefits that we get by aggregating all of that knowledge and information that we get around the world. So if you're a mid-sized or smaller manager like an Arctos or a Marathon, there's going to be huge value unlock for you as an investor to align to a broader platform. You'll probably have easier access to capital.
So are people pitching you every day to try to get you to buy them?
Yeah, look, I think we've been acquisitive. If you look at our historical growth, we've been 25% of our growth has come from M&A, and we've probably made what we would call a transformational acquisition, whether it was in secondaries or wealth or Asia credit. That's been, pretty breakout for us, and I think that's still part of our future.
No one's looking to buy you, I would guess, because you're, too big, too successful, and too young, right? A lot of the guys who are selling are
there's a
generation older than you.
There's a succession story to some of this M&A, which is, and Ares is similar. We've been in business for 30 years. We were all a lot younger, and you get to a place where you have to put your platform in a place where the legacy is intact. There's a sustainable wealth opportunity for the generation of leaders below you, and that's kind of what drove the IPO wave 10, 15 years ago. And now you've got founders who are in their 60s and 70s that are looking to, solidify the business. So there is definitely something to it, that's just a timing and succession.
But you and I are quite young. We're the same age. We're the same age.
Weeks like this are making me feel a little bit older, but yes.
How hard is it to keep talent in this market right now? How focused are you on that? And how is your succession planning looking like? Not that you need to go there now, right? But how are you doing at bringing up the younger?
I'd like to think that we're an employer of choice. We've talked a lot about our culture here, and I believe that our culture is highly differentiated, and it's actually one of the reasons why we've been able to grow as quickly and consistently as we have. And part of the reason the culture is so strong is all of my co-founders and partners that I started the business with are still in management. And we've developed and mentored and grown 2 or 3 generations of future leaders at the firm. So we have very low turnover, I think very high engagement, and we've done succession well. I've been the CEO for almost 10 years now, and it's hard to believe, but we had a very smooth transition from Tony Ressler, my predecessor. I just promoted 2 of my longstanding 30-year friends and partners to co-presidents. So I think good public companies and good public company boards are always going to be focused on succession, but I think it's something that, despite our youthful age, we're still focused on.
Mike, we only have a minute. I'm just curious about younger talent, because there does seem to be angst. You're coming from the banks, you're steeped in models, and all of a sudden, maybe technology can do the work of that.
I think it's a big issue, and some of the disruption that we're feeling this week is you see tools that come out that, rather than be perceived as supplementing the work that you're doing, it feels like it's going to replace, and that can be very scary. Everything that we're deploying now is being deployed to enhance the work that's already getting done. So we hope that we're hiring young people that know how to think systemically, know how to think critically, and then when we give them tools to maybe take some of the more mundane tasks off their desk, that they can actually elevate more quickly. But I do think long term, the type of talent that we're going to be looking for may change, right? We're going to need to find people who can really synthesize information quickly and think more broadly versus the typical model of the first 2 years you're in front of your computer for 24 hours and you're grinding out models. That is definitely going to be a big shift.
Mike, this has been such a fascinating conversation.
Yeah,
Thank you so much for joining.
Guys,
it's always wonderful to have you. Please come back again soon. That's the Ares CEO, Mike Arigati. And later today, I'm going to be sitting down with KKR and Arctos. That deal we were just talking about, that will happen at noon Eastern. Coming up, we're going to talk with State Street's Mariah Wade.
cidade estava sitiada.
Isso, ao começo, eu também não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
On the hour, your home for original reporting.
I'm Deborah Rodriguez. Russia's defense ministry has released a video showing a group of newly freed Russian POWs boarding a bus in Belarus territory after a prisoner exchange with Ukraine. It comes amid word from the Pentagon the U.S. and Russia have agreed to reestablish high-level military-to-military dialogue following Ukraine peace talks in Abu Dhabi. The BBC's Sarah Rainsford reports from Kyiv.
President Zelensky said, look, Russia is not winning on the battlefield, and if it wants that land through military action, it will take Russia 2 years at the current rate, and it would cost 800,000 more dead soldiers. So he's making the point that, Russia's pressure is one thing in words, but in reality on the ground, although there is progress by Russia moving forward extremely slowly, it's costing hugely. And President Zelensky is saying to Ukraine's Western allies, give us more support.
Hundreds of friends and neighbors gathered inside an Episcopal church in Tucson last night for a vigil for their neighbor, Nancy Guthrie, a mother of Today Show anchor Savannah Guthrie.
I do believe in the power of prayer.
We wanted to show the support that Tucson has for her in the community.
The 84-year-old's been missing since last weekend. Correspondent Jonathan Vigliotti is in Tucson.
Analysis continues. The FBI looking into the IP address of that email. There's also just a lot of question about what other lines of communication were opened up in that letter. It does not appear to be that there is a way for the family to reach out to the abductors at this hour.
President Trump standing behind his Homeland Security Secretary a day after his border czar announced 700 federal immigration agents and officers would be leaving Minneapolis.
Are you going to relieve Kristi Noem of her duties? No. Oh. I said, why would I do that? We have the strongest border in the history of our country.
He spoke at a prayer breakfast today. The British Prime Minister is apologizing to Jeffrey Epstein's victims for choosing Peter Mandelson as UK ambassador to Washington. Those files released last week showed Mandelson maintained his friendship with Epstein after he was convicted of child sex offenses. PM Keir Starmer.
Sorry that so many people with power failed you. Sorry for having believed Mandelson's lies and appointed him.
Mandelson claimed he barely knew Epstein. Pizza Hut fan, it'll be tougher to find a pie.
Pizza Hut!
The chain is closing about 250 stores across the country because of slow sales. Dow down 297 in early trading. This is CBS News. A one-time breakfast favorite is going away.
Minute Maid helped make orange juice a year-round morning staple back in 1946 when it began shipping cans of frozen juice all over the country, and it was popular for decades.
On a morning like this, you're not focusing on the fine points of frozen orange juice.
But now the brand's parent company is halting sales of frozen juice concentrates in the U.S. and Canada, saying it wants to focus on the fresh juices that customers now prefer. Minute Maid's frozen juices, including several varieties of OJ, lemonade, and limeade, will be discontinued by April. Steve Kathan, CBS News.
Now, back to the pie shop. Ryan Izquierdo brought a few of the 90 frozen iguanas he collected in frigid Florida to his favorite pizza place in Pembroke Pines. They tossed up a special of the day.
What do we think?
Unbelievable. The iguana meat, that's the tail meat. Very, very good.
They call it the Everglades pie. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube. And you can also find all of the video at the Bloomberg Video Hub. Just go to Bloomberg.com/videos, and that's where you find all of Bloomberg's video stuff, including all the live feeds from Bloomberg Radio and TV. Some cool stuff out there. Coming up, we're going to check in with Ira Jersey, Bloomberg Intelligence Chief Interest Rate Strategist, get his thoughts on the Fed. Mr. Besson has got some comments out there in the marketplace because he spoke before the Senate Banking Committee, so we've got some news there. Walter Todd, President, Chief Investment Officer, Managing Director, Greenwood Capital, to discuss his market outlook here. Mandeep Singh, Global Tech Research Head at Bloomberg Intelligence. We can talk to him just broadly about Alphabet, but then also broadly just about this tech sell-off we're seeing here, particularly on the software side, really has some more legs. The NASDAQ off another 1.3% today. So we got a lot coming up on the stock front, on the eco front. We had some jobs data, too. We'll get to that. A lot coming up here in the next 2 hours. Scarlett Fu and Paul Sweeney. This is the Bloomberg Intelligence Program. Let's kick it off with John Tucker and a Bloomberg Business.
All right, guys. This Bloomberg Business Flash brought to you by IBKR. In 2025, IBKR retail clients averaged a 19.2% return, beating the S&P 500 17.9%. The broker you choose matters. Visit ibkr.com/2025. We're data dependent, so let's start there. We have this weaker data. Earlier, we got the jobs numbers, which were pretty weak. Right now, the job opening labor turnover survey, which I'm told by Mike McKee is kind of important. Anyway, coming in at 6.5 million jobs openings. The expectation was for 7.25, so some weakness there. Stocks lower, renewed wave of tech selling. Alphabet right now, that is down over 4%. And That's because they're spending oodles and oodles of money. And where do they spend all that dough? You have to look to Broadcom. That's where a lot of it goes. They are up right now. Broadcom, AVGO, those are up 2.2% of those shares. Meantime, Dan Ives at Wedbush Security says the tech sell-off should attract a round of buying.
We are going through almost like a mini DeepSeek moment from a year ago relative to tech. Gut check moment, what's happening. But I believe that you're starting to see what I think are going to be huge opportunities.
Right now, the NASDAQ 100 down 332 points. That's a decline of 1.3%. The S&P 500, 75 points lower. That's down 1.1%, 6807 on the index. And the Dow Jones Industrial Average also falling. That is down 402 points. So that is a decline of just about 0.8%. Let me finish up with him and Hers Health. They're going to start offering copies of Novo Nordisk's new Wegovy pill at an introductory price of $49 a month. Reuters says the compounded version of the treatment made from the same active ingredient as the one from the drug maker Novo. ADRs right now, they are down over 7%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Scarlett and Paul.
All right, John Tucker, thank you so much. We appreciate that. Scarlett Fu, Paul Sweeney, live here in our Bloomberg Interactive Broker studio, streaming on YouTube and streaming on Bloomberg.com/videos. So we are all over the place out there. Let's take a look at some of the stocks on the move today. We can do that with Bloomberg's Alexandra Semenova.
Semenova.
Why did I have a brain flash there?
Guys, we have to start with Google parent Alphabet. John just mentioned that a lot of investors are upset about that big CapEx number, but there are a lot of positives in this report. Despite the stock slumping today, the company topped projections for quarterly revenue, specifically for its Google Cloud revenue jumped 48% to a whopping $17.7 billion. That handily beat Wall Street estimates. Gemini, its artificial intelligence model, it is also rapidly reaching new users. And then here's the number that is making traders upset. CapEx will reach as much as $185 billion this year, compared to roughly $120 billion that analysts were expecting. Their expected spending for 2026 altogether will also total more than what the company spent in the prior 3 quarters. But CEO Sundar Pichai is saying that this is necessary, that they're already seeing that spending actually be monetized in their AI endeavors. And then Jefferies analysts also point out that AI is paying off for Google.
I'm old enough to remember when companies actually got rewarded for taking their AI CapEx up.
Yeah, not so much anymore. I loved what one trader said, that this was Alphabet's mic drop CapEx. Because the number is so mammoth. What else are you looking at, Alex?
Yeah, I'm also taking a look at shares of Estee Lauder. Looks like they're down 20% right now. Wow. Really tough day for the company. It boosted its outlook, but it just wasn't enough for investors who were expecting more from its turnaround effort, helmed by their new CEO, Stephanie Della Favre. Sorry if I'm mispronouncing her name. The company narrowly beat Wall Street's expectations for revenue and adjusted earnings per share in its most recent quarter. That was lifted by growth in skincare products, including La Mer and The Ordinary. People were also buying their fragrances from Tom Ford and Le Labo. It also narrowed its outlook range for net revenue growth in the current fiscal quarter ending June. It now forecasts 3% to 5% growth. So solid numbers, just a really high bar, as we're seeing with a lot of companies this earnings season.
John Tucker, you have to invest in your face. I mean, I learned that from Alex Steele.
Let's see. Yeah, who said that?
There's actually
obviously I have not invested.
There's a great article. I don't remember who published it, about how because millennials can't afford homes, they're actually investing in skincare products and self-care.
Okay.
Affordable luxuries,
yes,
because homes are not affordable at all.
Okay.
All right, let's move on to another household name.
Yeah, we have to end on a high note. So many negative news today, but some positive news from Hershey. They offered a better than expected 2026 outlook. Just taking a look at the stock right now, shares are up about 7%. They said that higher prices and new products are set to boost performance. The company sees adjusted earnings per share of about $8.20 to $8.52, and sales gaining 4% and 5% in 2026. They have, of course, been impacted by tariffs and higher cocoa costs, but chocolate makers did get a little bit of reprieve when the president said that he will not issue reciprocal tariffs on cocoa. Hershey also said that cost pressure from commodities and tariffs is set to be better this year, so they're going to spend more of that money on advertising.
All right, good stuff. Alex, thank you so much. Alexandra Semenova. She is one of our cross-asset reporters. She's covering equities at the moment, and she is here with our market drivers. And for more conversations like this, subscribe to our Stock Movers reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. The top story on Top Worldwide right now, Paul, is about the Winklevoss's Gemini to cut 25% of its workforce and wind down operations in the UK, European Union, and Australia. And there's a lot of data of late that shows, certainly anecdotal data, that shows that companies are slashing workforces.
Well, you know, the Challenger job cuts, 108,000, biggest since 2009 for the month of January, at least. Anna Wong said, don't worry about it. That's just a handful of companies and kind of targeted. So don't worry about it. So I don't know.
Not great news that you're looking for a job out there.
Yeah.
All right, Ira Jersey is Bloomberg Intelligence chief U.S. interest rate strategist, covering the U.S. economy, covering the Fed. And Ira, we got a lot of data today, certainly on the labor market. You had the Challenger job cuts that Paul just mentioned. We had JOLTS for the month of December, which showed a weaker than expected read in terms of job openings. And we also have initial jobless claims as well. How does it all add up? What is the picture that all this data is painting of our labor market?
Well, it continues to paint the picture that there's not a lot of firing and also not a lot of hiring. So the JOLTS data that just came out a few minutes ago showed that the quit rate continued to be around 2%, but the firing rate was 1.1%, which is basically where it's been for the last 6 months or so. So there's not a lot of people getting laid off. And yeah, you know, I agree with Anna. The 108,000 Challenger job cuts is not good, but at the same time, it is a handful of companies, and you're not looking at small businesses laying off a lot of people at the moment either. So the thing is, this might just be kind of a one-off. Now, you know, the risk is, and this is one of the reasons why we're in the camp that the Federal Reserve later this year will have to cut interest rates a bit more than the market's priced, is because I think that this labor market continues to deteriorate. There is going to be, you know, I think some margin pressures on some firms. They'll want to take advantage of productivity gains, and in doing so, like, even if they don't fire anyone directly, they're probably not going to hire, and overall that means the unemployment rate should go up, because believe it or not, the workforce is actually going to be growing thanks to Gen Z joining the workforce.
Hey, Ira, Treasury Secretary Scott Bessent is actually testifying right now as we speak, Senate Banking Committee in Washington, D.C. And he's taking a lot of time here to talk about Fed independence, that the Fed should be independent for monetary policy. He believes in independence, but also accountability. And then he says when the Fed delves into other areas, that impinges independence. So spending a lot of time in his early prepared remarks talking about the independence of the Fed. In the marketplace, is there a perception that the Fed has become less independent over the years?
Well, not necessarily over the years. I think certainly since President Trump started his second term, there's been a fear about Fed independence. And I think Mr. Bessent's not alone in his thinking that, hey, the Federal Reserve should have a relatively narrow mandate. I think the issue, and we have to go back and remember that during the financial crisis 15 years ago, you know, Congress was very slow in dealing with a lot of the problems with the housing market and with the overall financial market, and so the Federal Reserve had to step in. I think some of the changes that occurred with the Dodd-Frank legislation, some changes to the way that the Federal Reserve operates today, does make them slightly less independent, but also have to coordinate with Treasury on a lot of things. So a lot of the things that we saw, like the bank term lending program that happened after SVB a couple of years ago, you know, that was done in conjunction with the Treasury Department. So the Fed wasn't taking any credit risk. The Treasury took the credit risk, but the Federal Reserve administered the program effectively. So I think that there's that he's right, that, you know, if they should probably have a narrower mandate, but at the same time, when they're the only game in town and everyone, you know, doesn't want the financial world to just completely disintegrate, the Fed has to step in sometimes, or at least have the ability to go to the Treasury like they did during the SVB period.
So in the end, this testimony that the Treasury Secretary is providing to the Senate, how does that change anything?
I think it just gives a little bit more clarity what the administration is thinking in terms of, any kind of Fed reforms. And Kevin Warsh is certainly someone in the Bessent camp, right? That the Fed should have a narrow focus on monetary policy and not overstep its bounds, not use the balance sheet too much and too frequently. I think that Bessent here is just aligning with what Kevin Warsh has said in some of his recent testimony.
All right, Ira, thank you so much. Ira Jersey is our chief U.S. interest rate strategist here at Bloomberg Intelligence, giving us the summary here of the latest labor market data and Bessent's comments. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash as stocks continue to drop. All the major averages down over 1%. Let me start with Bitcoin, continuing its big slide. Right now, $67,000 per token. When you think crypto, maybe you also think of the Winklevoss twins. Now comes word their crypto exchange, Gemini Space Station, plans to cut up to a quarter of its workforce. They're also going to wind down their operations in the UK, European Union, and Australia. And just getting word of this one, Rio Tinto and Glencore, the big miners, they are, according to our sources, going to walk away from their merger. That's according to people familiar with the matter. We'll bring you details as soon as we get them. Estee Lauder, the worst performing stock right now in the S&P 500, down close to 20%. McKesson, the best performing stock in the index, that's up close to 17%. This is the healthcare supply and pharma company boosting its earnings forecast for the full year. And yes, maybe use this as your coat rack. Peloton, tumbling the most in more than 2 years, providing a weaker than expected revenue forecast for the fiscal third quarter. And we checked out, you know what? You know who's going to start trading today? Bob's Discount Furniture.
Yes.
They became a public company. Shares being traded on the exchange,
What's the
New York
ticker
Stock
for that?
Exchange.
BOBS.
BOBS.
Okay.
Come on. Bob's, they raised $331 million in their initial public offering. So we'll keep an eye out for that one.
So that's not an AI play. So there you go.
Who knows? A bed with an AI, whatever.
I know.
S&P 500 down 88. The Dow down 535. And the NASDAQ 100, 389 points lower. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Scarlett and Paul.
All right, thank you so much, John Tucker, with our Bloomberg Business Flash. We are looking at a down day in equities. The S&P 500, the Dow Industrials, the Nasdaq, all down by at least 1.1%. The Russell 2000 also lower, although I should mention outperforming the major large cap indexes. So is the rotation trade still intact? It certainly feels like the software scare continues right now, with the Nasdaq losing the most ground, off by 1.8%. Let's bring in Walter Todd right now. He is president and chief investment officer, as well as managing director at Greenwood Capital, joining us from Greenwood, South Carolina. Walter, what do you make of this software scare? Is it justified, or is this people just getting out, not bothering to really do the work, but focusing on kind of the AI negative headlines?
Yeah, well, good morning. Thanks for having me from snowy South Carolina here.
जी देखो क्रूड ऑयल में कोई सपोर्ट यहाँ पर बन नहीं रहा है मेरे अकॉर्डिंग तो अब अभी ठीक है ये भी सपोर्ट है ठीक ठाक ही है मतलब लाइक कोई बहुत ज़्यादा स्ट्रांग भी नहीं है बहुत वीक भी नहीं है बट मैं कोई ऐसे यहाँ पर बाइंग नहीं एक्सपेक्ट कर रहा हूँ मतलब एक्सपेक्ट नहीं कर रहा हूँ इन द सेंस अपने साइड से नहीं ले रहा हूँ ठीक है मेरे लिए एक सपोर्ट नीचे दिख रहा है मुझे 5330 315 के अराउंड एक अच्छा सपोर्ट है ऊपर कोई रेजिस्टेंस भी शो नहीं कर रहा है कुछ स्ट्रांगली ओवरनाइट कुछ हुआ होगा तो गैप डाउन में आई डोंट नो फॉरेक्स चार्ट में बट फॉरेक्स में कुछ खास एमसीएक्स में कुछ खास मुझे दिख नहीं रहा है इन्वेंट्री आने वाली देखते हैं नेचुरल गैस की अभी कोई ट्रेड नहीं चल रहा है आज कोई ट्रेड नहीं लिया क्रूड ऑयल नेचुरल गैस में कुछ भी नहीं नेचुरल गैस भी देखोगे रेंज बना के बैठा हुआ है मॉर्निंग से अपनी फर्स्ट 15 मिनट की कैंडल के अंदर ही लो पे बाइंग आ जा रही है हाई पे सेलिंग आ जा रही है लेट्स होप कुछ अगर फॉर्म करता है इसमें भी रेजिस्टेंस सपोर्ट थोड़ा दूर ही है सो अभी कोई ट्रेड नहीं है अगर हो किसी ट्रेड में तो अपना ट्रेड का ध्यान रखना लेट्स होप कुछ सेटअप बनता है आज नहीं तो कल देख लेंगे कोई सुनिए के लिए मेरे साइड से कोई ट्रेड नहीं है प्राइस नीचे अगर आया तो हो सकता है जो नीचे का सबसे लोअर लेवल बनाया हुआ है 5330 315 वो हो सकता है आने वाले टाइम में टेस्ट कर ले एक बार वहाँ टेस्ट करने चला जाए के इन्वेंट्री आने वाली है गाइस 3 मिनट में नेचुरल गैस इन्वेंट्री इज देयर इन 3 मिनट टाइम फ्रेम बाकी नीचे एक 5530 वाला लेवल भी ठीक ही है। एंट्री है इन 30 सेकेंड्स। क्रूड ऑयल नहीं, नेचुरल गैस की इन्वेंट्री फोरकास्ट देखोगे लास्ट वीक -242 बुलियन था, इस बार -379 बुलियन एक्सपेक्ट कर रहे हैं लास्ट टाइम से, और कम ये डेटा एक्सपेक्ट कर रहे हैं। तो फोरकास्ट के अकॉर्डिंग अगर डेटा कम ही आता है 379 बुलियन से तो इट इज़ बुलिस। तो फोरकास्ट तो प्राइस के लिए बुलिस है। देखते हैं एग्जैक्टली डेटा बुलिस आता है या फिर बेरिस आता है। बुलिस आने के लिए प्राइस को 379 बुलियन -379 बुलियन से ज़्यादा आना होगा, तभी बुलिस होगा। अदरवाइज पेरिस भी हो सकता है, या पेरिस ही लग रहा है। गैप डाउन ओपनिंग है, नेचुरल गैस गैप डाउन ओपनिंग। इक्वल टू हाई विद दैट, या पेरिस है 379 बुलियन से ज़्यादा आ गया, -360 बुलियन, माइनस का साइन भी है। सो नेचुरल गैस इन्वेंट्री इज अ बेरिस फॉर नेचुरल गैस प्राइस एज पर द डेटा। प्राइस को डाउन तो जाना चाहिए, लेट्स सी डाउन जाता है या फिर पहले रेजिस्टेंस को हिट करने जाता है ऊपर। फोरकास्ट के अकॉर्डिंग डेटा नहीं आया, अपोजिट आया फोरकास्ट के। सो नेचुरल गैस इन्वेंट्री इज बेयरिश फॉर नेचुरल गैस प्राइस। लेट्स सी कितना इम्पैक्ट डालता है डेटा। बहुत ज़्यादा डिफरेंस नहीं है वैसे, ध्यान रखो ना, ठीक है। 360 बुलियन और 379 बुलियन ज़्यादा डिफरेंस नहीं है, ओनली 29 बुलियंस का ही डिफरेंस आया है। तो उस वजह से कोई बहुत बड़ी कैंडल सडनली नहीं बनी है। डिफरेंस बहुत ज़्यादा होता तो ज़्यादा बेटर था। जैसे लास्ट वीक देखोगे 242 बुलियन से 379 बुलियन का डिफरेंस आया था, तो एक मोमेंटम हुआ था। बट लेट्स सी, ओवरऑल नेचुरल गैस इन्वेंट्री इज बेयरिश फॉर नेचुरल गैस प्राइस। आज और कोई डेटा नहीं है। क्रूड ऑयल में भी देखोगे ओपन इक्वल टू हाई है कैंडल, कोई ट्रेड नहीं चल रहा है, ठीक है। क्रूड ऑयल में एक पॉइंट ऑफ इंटरेस्ट रहेगा यहाँ पर अभी, जब तक ये रेंज है। को भी देखोगे वापस उसी लेवल पे आ गया, गोल्ड उतना नहीं गिरा है। सिल्वर क्या डबल बॉटम बनाएगा 4 आवर टाइम फ्रेम पे? सिल्वर के चार्ट को देखोगे एक डबल बॉटम भी बन सकता है और एक बड़ा हेड एंड शोल्डर भी बन सकता है। फॉरेक्स चार्ट को देखोगे ना, $74 के नीचे चला गया है अभी तो ये। खैर ये बड़ा ही इंटरेस्टिंग पैटर्न बन रहा है यहाँ पर, अगर सक्सेसफुली क्रिएट हुआ। 4 आवर टाइम फ्रेम सिल्वर चार्ट का पैटर्न अगर देखोगे, मार्केट ने एक हेड एंड शोल्डर पैटर्न की तैयारी कर रखी है। अभी ब्रेकडाउन तो नहीं हुआ खैर, बट लुक्स लाइक हेड एंड शोल्डर पैटर्न। बट हो सकता है यहाँ पर मार्केट उसको काउंटर करने के लिए डब्ल्यू भी बनाए, ठीक है। डबल बॉटम बना नहीं है, याद रखना। डबल बॉटम तब बनता है जब मार्केट ये इस तरह से ब्रेकआउट करता है, उसमें भी रीटेस्ट करेगा तब कंफर्मेशन मिलती है। अभी तो यहाँ पर सिर्फ एक सपोर्ट है, उसकी वजह से प्राइस होल्ड कर रहा है। ठीक है, अप्रॉक्सीमेटली $70 का लेवल आ रहा है। अगर सक्सेसफुली ब्रेक डाउन करता है तो फिर एक्सपेक्ट करेंगे कि इतना मोमेंटम, सॉरी बाइंग की साइड नहीं, सेलिंग की साइड है। अप्रॉक्सीमेटली 40% और गिर जाए यहाँ से। मुझे लगता तो नहीं इतना गिरेगा, मैक्सिमम यहाँ से 30% ही दिखता है नीचे डाउन। 30 to 35%, $49-50 के नीचे जाना मुश्किल है। वहाँ पर वो मल्टी ईयर का एक ब्रेकआउट का रीटेस्ट ही पेंडिंग है ये। ठीक है, वो भी लगभग $47 $48 के आसपास ही है, विच इज़ कंपलसरी है अगर इस रैली को कंटिन्यू करना है, बिकॉज इसको चेकआउट करोगे तो ये एक कंप्लीट राउंडिंग बॉटम है, ये भी एक राउंडिंग बॉटम पैटर्न है। तो ये जो बाद वाला राउंडिंग बॉटम पैटर्न बना है दैट इज़ कंप्लीट राउंडिंग बॉटम पैटर्न, और इसका सीधा ब्रेकआउट होकर गया है। इसमें कोई रिटेस्ट नहीं हुआ है, ना फ्लैग बना है और ना हैंडल बना हुआ है। ये राउंडिंग बॉटम भी कह सकते हो आप, क्योंकि इसका ब्रेकआउट नहीं हुआ। तो दिस होल एरिया इज कंसिडर अ फ्लैग। तो ये राउंडिंग बॉटम विद फ्लैग, जिसको हम फ्लैग एंड पोल पैटर्न भी कहते हैं, तो उसके अकॉर्डिंग तो ब्रेकआउट हो चुका है, और उसके अकॉर्डिंग मार्केट ऑलरेडी मूव्ड वेरी हाई। यहाँ से चेकआउट करोगे तो लगभग ये 2000% दिखाता है ओवरऑल। नॉर्मली प्राइस उतना ही मूव करता है जितना यहाँ से यहाँ तक डिस्टेंस है। तो इसको अगर चेकआउट करोगे विच इज़ अप्रॉक्सीमेटली, इसका बॉटम कहाँ पर है, इसका बॉटम विच इज़ अप्रॉक्सीमेटली 1200 to 1400% रिटर्न, इतना मिलना चाहिए। तो अगर आप ऐसे चेकआउट करोगे तो इतना रिटर्न अभी मिला ही नहीं है, अभी सिर्फ 250% रिटर्न मिला है। तो वो बड़े वाले हेड एंड शोल्डर पैटर्न को कंसिडर करें तो मार्केट को तो काफ़ी ऊपर जाना चाहिए। ठीक है, राउंडिंग बॉटम पे इस फ्लैग एंड पोल पैटर्न के अकॉर्डिंग अगर देखा जाए, जो ब्रेकआउट हुआ है 1000% भी अगर देखोगे दैट इज़ टू हाई, लाइक $400-500। तो उसके अकॉर्डिंग तो रैली अभी बहुत बड़ी बची है। ठीक है, बट ये दोनों ही, ये हेड एंड शोल्डर पैटर्न, राउंडिंग बॉटम पैटर्न प्लस ये हैंडल पोल एंड फ्लैग, इसका भी एक रीटेस्ट यहाँ पर, और ये जो स्मॉलर वाला लेवल है इसका भी रीटेस्ट, क्योंकि इसमें भी अगर चेकआउट करोगे इसके बॉटम से तो ये भी अप्रॉक्सीमेटली 250-300% रिटर्न अप्रॉक्सीमेटली दिखा रहा है। उसके अकॉर्डिंग भी देखोगे तो लगभग मार्केट अभी सिर्फ 150% ही गया है। अगर 250% भी जाता है तो दैट इज़ अराउंड $167। तो रैली काफ़ी पेंडिंग है एज पर द पैटर्न। ठीक है, एज पर द पैटर्न, नॉट एज पर माई एनालिसिस। पैटर्न के अकॉर्डिंग देखोगे तो मार्केट को दोनों ही, इन दोनों अगर पैटर्न को सक्सेस तक पहुंचना है तो प्राइस को काफ़ी ऊपर जाना चाहिए लॉजिकली। वो अभी तक अचीव नहीं हुए हैं, बट उसके लिए मार्केट को रीटेस्ट करना ज़रूरी है, तभी ये बेस बन सकता है। क्योंकि विदाउट रीटेस्ट करने गया तो फिर ऐसे गिरेगा कि वापस संभल नहीं पाएगा। बेस्ट के सिनेरियो रीटेस्ट करने आए इस लेवल के आसपास, तो उस हिसाब से देखते हो तो मेरे अकॉर्डिंग अच्छा है अगर फॉल हो जाए यहाँ से 4 आवर टाइम फ्रेम पे, जो ये हेड एंड शोल्डर पैटर्न है उसके अकॉर्डिंग, और प्राइस एक बार इस रीटेस्ट को करने आ जाए, एक्यूमुलेशन के लिए काफ़ी अच्छा जोन रहेगा वापस से। तो उसके अकॉर्डिंग अगर चेकआउट करते हो तो ऑलरेडी ऑल टाइम हाई से सिल्वर 40% तो गिर ही चुका है। ये हेड एंड शोल्डर में और गिरता है 60%। आई थिंक जो पैराबोलिक ये रैली आई है, कुछ इस तरह से, तो ध्यान रखना इसका $70 इंपॉर्टेंट हो गया है अभी। 2-3 दिन रैली करी वापस लोअर एंड से $70 के लेवल से अगर चेकआउट करोगे अप्रोक्सीमेटली 30% वापस से उसी जगह पे वापस आ गया। एसबीआई का देखोगे तो और बुरी हालत है वहां पर तो। ठीक है, जिन लोगों ने यहाँ बॉटम पे कहीं बाय करके रखा होगा या फिर जो ऊपर से कहीं एक्यूमुलेट करके बैठे होंगे इन एरिया पे, आई होप वो लोग निकल गए होंगे। नहीं तो अगर ये पैटर्न, क्योंकि ये ऐसा पैटर्न नहीं है कि ये 15 मिनट या 5 मिनट या 1 मिनट पे बना हुआ है, 4 आवर टाइम फ्रेम में स्ट्रॉन्ग ही है। ये लेवल पे जिस तरह का एक्यूमुलेशन हुआ है, अगर ये होल्ड नहीं होता है तो $70 के नीचे 4 आवर टाइम फ्रेम पे प्रॉपरली ब्रेकडाउन रीटेस्ट हो गया, मान के चलो सीधा सीधा $70 के नीचे, दो कैंडल एक के नीचे क्लोज हो गई, तो आना चाहिए प्राइस को फिर। ठीक है, फॉरेक्स चार्ट के अकॉर्डिंग प्राइस को फिर क्या लेवल था वो, ठीक है 70, हाँ $70 के नीचे दो 4 आवर की अगर कैंडल एक के नीचे क्लोज होती है तो फिर ये जो नीचे का रीटेस्ट लेवल है, मैं एक्सपेक्ट कर रहा हूँ इसी को कि प्राइस फिर उस लेवल तक गिरे, अराउंड $47 to $49। दैट इज अ सेकंड बेस्ट लेवल टू बाय। वैसे तो इसके नीचे भी एक लेवल है बट वो तो काफ़ी दूर है, वहाँ तक तो आ गया तो फिर तो पता नहीं रिवर्सल कब देगा। दैट इज़ अप्रॉक्सीमेटली $36। ठीक है, वहाँ तक मैं भी एक्सपेक्ट नहीं कर रहा हूँ दैट अगर वहाँ तक गया तो ऑलमोस्ट 75% फॉल कर जाएगा प्राइस। ठीक है, हिस्ट्री में हुआ है ऐसा, नहीं हुआ है, बट इतना मुश्किल लग रहा है अभी कि $74 तक आएगा। बट ये लेवल मुझे लग रहा है हो सकता है देखने के लिए मिले $47 to $50। जो नीचे वाला लेवल है 35 वाला, वो जो हेड ये मैंने अभी आप लोगों को दिखाया था ना पैटर्न 1 मंथ में, ये जो बना हुआ है, ये राउंडिंग बॉटम विथ हैंडल, इसका रिटेस्ट जोन है। ठीक है, वैसे तो इसका भी रिटेस्ट हुआ नहीं है बट मुझे इस रिटेस्ट ज़्यादा स्ट्रॉन्ग लग रहा है, क्योंकि अगर ये गलती से इस वाले 32 वाले लेवल पे आ गया तो ये रिटेस्ट फेल हो जाएगा। उस केस में ये जो रैली है ये लॉजिकल नहीं बनेगी, विच इज़ अनलाइकली। इतने साल एक्यूमुलेट किया है 2010 से लेकर 2025 तक, 25 के बाद रैली दी है, 14-15 साल का एक्यूमुलेशन ऐसे तो किया नहीं होगा इन लोगों ने। ये दोनों ही रिटेस्ट जोन है 47 to 49 और नीचे 30 to 35, तो ये दोनों ही अच्छे जोन है एक्यूमुलेट करने के लिए। बट आई एम एक्सपेक्टिंग 46, 48, 49, दैट विल बी बेस्ट वन। सिर्फ राउंडिंग बॉटम पैटर्न का रिटेस्ट, और दूसरा वाला जो नीचे लेवल है वो हेड एंड पोल एंड फ्लैग, राउंडिंग बॉटम और ये फ्लैग। ठीक है, फ्लैग थोड़ा सा अजीब सा लग रहा होगा बट वो फ्लैग है, ध्यान रखना। फ्लैग क्योंकि पर्टिकुलरली किसी एक तरह का फ्लैग नहीं होता, ऐसा भी फ्लैग हो सकता है, ऐसा भी फ्लैग हो सकता है। ठीक है, ये दोनों की रिटेस्ट जोन है वो 4 आवर टाइम फ्रेम के अकॉर्डिंग भी परफेक्ट बन रहे हैं। तो दीज आर द टू लेवल्स आई एम एक्सपेक्टिंग प्राइस अगर फॉल करता है $70 के नीचे। और ये लेवल भी ऐसा नहीं है $70 में दूसरी बार आ रहा है, ध्यान रखना, यहाँ पर प्राइस बहुत बार एक्यूमुलेट करके गया था ऊपर। अब एक ही चीज़ है जो उसको बचा सकती है, वो है ये $91 के ऊपर अगर ब्रेकआउट कर दे वापस से डबल बॉटम बना के। लेट्स सी क्या होता है। पूछोगे तो आई एम वेटिंग फॉर कि मैं एक्यूमुलेट करूं वापस, अगर $47-48 पे आए तो। यहाँ पर जो लोग बैठे हुए हैं अगर $70 के आसपास, अपना एसएल स्टिक रखना हो। एक के नीचे अगर 4 आवर की दो कैंडल क्लोज होती हैं $70 के नीचे, तब तो मेरे अकॉर्डिंग निकलना चाहिए, क्योंकि यहाँ से गिरेगा तो 30% हो जाएगा पोर्टफोलियो, विच इज़ नॉट गुड एट दिस लेवल ऑब्वियसली। ठीक है, एक चीज़ थोड़ा सा मुझे ठीक लग रही है, जो लाइक मैं सेटअप्स देखता हूँ उसके अकॉर्डिंग प्राइस ने एटलीस्ट 4 आवर तक, ठीक है, उससे छोटे टाइम फ्रेम का मैंने नहीं देखा अभी तक, बट 4 आवर 1 डे 1 मंथ 1 वीक, इसमें यहाँ पर कोई भी रेजिस्टेंस, मेजर रेजिस्टेंस क्रिएट नहीं हुआ है, विच इज़ अ गुड साइन। क्योंकि अगर ये इन हाई लेवल पे कुछ रेजिस्टेंस बना के गिरता तो फिर प्राइस जब वापस जाता तो वो बहुत ही स्ट्रांगली हिट करके वापस जाने में प्रॉब्लम क्रिएट करते हैं। तो अभी तक इस लेवल तक तो मुझे इस पूरी सेलिंग में कहीं पर ऐसा कोई मेजर रेजिस्टेंस नहीं दिखा जो मार्केट को कभी अगर प्राइस रिवर्सल मारता है तो बहुत स्ट्रांगली अपोज करेगा। हो सकता है अभी बना दे तो अलग बात है, बट अभी तक मैंने तो नहीं देखा है। ठीक है, चार्ट पे तो मुझे नहीं दिख रहा है, विच अ गुड साइन बाय द वे। कभी प्राइस वापस बुल मार्केट में जाएगा तो अच्छा रहेगा सिल्वर के लिए। तो लेट्स सी $70 ब्रेक करता है या नहीं करता। बाकी मैंने आप लोगों को मॉर्निंग पे भी वो कमेंट सेक्शन में डाला हुआ था, चाइना का एक ट्रेडर था, ही मेड $3 बिलियन इन सिल्वर गोल्ड ट्रेड। 2022 से वो लॉन्ग था गोल्ड में, उसने अभी प्रॉफिट बुक किया है, एंड देन ये जो सिल्वर का टॉप बना था उसके आसपास उसने सिल्वर को शॉर्ट कर रखा है। थोड़ा बहुत उसको लॉस तो हुआ है, नॉट एग्जैक्टली टॉप पे सेल किया होगा ऑब्वियसली, है पहले थोड़ा बहुत सेल किया होगा, बट ही स्टिल इन दैट ट्रेड, वो अभी भी उस ट्रेड में बना हुआ है एज पर द ब्लूमबर्ग एनालिसिस। एंड स्टिल दैट पर्सन, क्या नाम था उसका, बियान जिमनिंग, जिमनिंग, बियान जिनमिंग। लार्जेस्ट नेट शॉर्ट पोजीशन सिल्वर में बना रखी है उसने, अभी लगभग 450 टन्स ऑफ सिल्वर, या फिर इसको आप कह सकते हो 30,000 कॉन्ट्रैक्ट सिल्वर में शॉर्ट करके बैठा हुआ है पर्सन। बताओ, लास्ट जितना भी उसका अभी तक फॉल आया है, ही मेड अराउंड 2 बिलियन युआन, $288 million। शोल्डर विल बी डिजास्टर फॉर सिल्वर डेफिनेटली अगर ये सक्सेसफुल हुआ। वही $70 ही मुझे लगता है, $70 के नीचे एक कैंडल क्लोज हुई तो ये ब्रेक डाउन ही हो जाएगा लेवल, देन इट माइट एक्ट लाइक एज रेजिस्टेंस। कंफर्मेशन चाहिए, फेक ना हो सिर्फ, कई बार फेक ब्रेक डाउन भी हो जाता है। For right shoulder it has to go up first to $100+ before falling, $100+। क्यों? Why is that? Because of this? प्रॉपरली फॉल नहीं किया बिकॉज इस $100 के मार्क से गोल्डन रेशियो वहां से नीचे नहीं आया, इसलिए कह रहे हो क्या? और तो कोई लॉजिक ऐसा है नहीं इसमें, यही एक लॉजिक बनता है। सो या इट माइट पॉसिबल $100 के आसपास जा सकता है। नहीं नहीं, ऐसा कोई कंपलसरी तो नहीं है कि आपका राइट शोल्डर हायर होना चाहिए टू लेफ्ट शोल्डर, वैसे यहाँ पर है ऑलरेडी जितना मुझे दिख रहा है। यहाँ पर वैसे राइट शोल्डर ऑलरेडी लेफ्ट शोल्डर के कंपैरिजन में ऊपर ही है, ठीक है, बट ऐसा कोई रूल नहीं है कि ये देखो ये लेफ्ट शोल्डर है, राइट शोल्डर इसके ऊपर ही बना हुआ है वैसे तो ऐसा कोई रूल नहीं है कि राइट शोल्डर ऊपर ही जाएगा, नीचे भी हो सकता है। हाँ बट ये एक लॉजिक हो सकता है इसके पीछे कि प्राइस को अगर देखोगे लास्ट स्विंग एरिया से जो लेटेस्ट स्विंग एरिया बना है, यहाँ तक अगर देखें पॉइंट ए से पॉइंट बी तक प्राइस जो फॉल किया है उसके अकॉर्डिंग प्राइस को अगर थोड़ा एग्जैक्ट रिजेक्शन लेना है तो गोल्डन रेशियो से मार्केट नॉर्मली रिजेक्शन लेता है, तो माना जाता है कि दैट इज़ अ वेरी स्ट्रॉन्ग रिजेक्शन। आप कह सकते हो थोड़ा सा रह गया गोल्डन रेशियो से, $92 के अराउंड हाई बनाया है, गोल्डन रेशियो स्टार्ट फ्रॉम 96 टू 102, तो वो एक लॉजिक हो सकता है। ठीक है, उस केस में सबसे ज़्यादा लोग ट्रैप हो सकते हैं बिकॉज अभी तो ऐसा लग रहा है कि हेड एंड शोल्डर बनेगा, बहुत सारे लोग फिर यहाँ पर जब ये प्राइस ऊपर जाएगा इसके ऊपर ब्रेकआउट करेगा $90 के, $92 के ऊपर, तो बहुत सारे लोग यहाँ पर बुलिश हो जाएंगे, वो सोचेंगे डबल बॉटम बन गया चलो वो बाई कर लेते हैं, वो बाई करेंगे यहाँ पर ब्रेकआउट पे, फिर रीटेस्ट में और बाई करने की सोचेंगे, ये रीटेस्ट को फेल करके ऐसे छोटा सा ये बना के गिर सकता है। दैट इज़ बेस्ड ऑन द ट्रैपिंग, ठीक है, जो हो सकती है बेस्ड ऑन द चार्ट पैटर्न, ठीक है। नहीं तो अभी तो सभी को दिख रहा है ये हेड एंड शोल्डर बन रहा है, अगर ये ब्रेक डाउन हुआ तो हर कोई सेल ही कर देगा, तो ट्रैप कौन होगा? करेक्ट। सो यहाँ पर हो सकती है ट्रैपिंग कि प्राइस यहाँ से हल्का सा मोमेंटम अपसाइड की ओर दे, वापस 100 to 100 डॉलर $2 तक जाए, ब्रेकआउट पे लोग बाई करें, फिर रीटेस्ट के लिए आए, रीटेस्ट पे और लोग बाई करें, और फिर ये ऐसे ब्रेक करके बड़ा फॉल कर जाए एम पैटर्न बना के। नॉर्मली ऐसा देखने के लिए मिलता है कई बार, यहाँ पर हो सकती है मैक्सिमम ट्रैपिंग, ठीक है। बट सबसे सिंपल तो ये है कि ये डायरेक्टली ब्रेक डाउन कर दे, इतना बवाला ही ना हो, समझ रहे हो? क्योंकि देखो ये चार्ट मुझे दिख रहा है, आपको दिख रहा है, तो जो लोग बना रहे हैं उनको भी दिख ही रहा होगा, वैसे कोई बनाता नहीं चार्ट को, ठीक है। दैट इज नॉर्मल प्राइस एक्शन। सो सभी सेल कर देंगे यहाँ पर कि यार चलो ये तो हेड एंड शोल्डर है, ये तो गिरेगा ही गिरेगा, शॉर्ट कर देते हैं। सभी शॉर्ट कर देंगे तो फिर फायदा कैसे होगा जेपी मॉर्गन जैसे लोगों को? तो दो पॉसिबिलिटी है, मैं तो वही कहूँगा $70 के नीचे एक कैंडल क्लोज हुई तो यहीं से सेलिंग आ जानी चाहिए मेरे अकॉर्डिंग। $70 के नीचे एक 4 आवर की कैंडल क्लोज नहीं होती है, तो ये है सपोर्ट अभी भी, और मोस्ट प्रोबेबली अगर यहाँ से पुल बैक आता है तो फिर अगर प्राइस को उनको एक्चुअल में बेरिस करना है और नीचे जो रिटेस्ट जोन है यहाँ तक जाना है, तो फिर ट्रैपिंग यहीं बन सकती है इस तरीके से, और तो कोई ऑप्शन है नहीं। बाकी देखोगे सिर्फ ऐसा नहीं है, सिल्वर और गोल्ड फॉल किया है ऑलमोस्ट, लाइन जैसी लग गई है, आप चेकआउट करोगे कंटिन्यूअसली पिछले साल से बिटकॉइन गिर रहा है 2025 से, सेकेंड हाफ से आई थिंक कंटिन्यूअसली बिटकॉइन की फॉलिंग स्टार्ट है। ऑल टाइम हाई जो बिटकॉइन ने बनाया था उसके बाद से मार्केट बिटकॉइन का रिकवरी नहीं कर पाया है, अब तो 70,000 के नीचे ट्रेड कर रहा है, तो बिटकॉइन कंटिन्यूअसली फॉल कर रहा है अपने ऑल टाइम हाई से, एक बार भी बड़ा पुल बैक नहीं दिया है, तो इट इज़ फॉलिंग फ्रॉम सेकेंड हाफ ऑफ अगस्त, सेकेंड हाफ ऑफ 2025 2025 एंडिंग से आप कह सकते हो, फिर मेटल्स फरवरी मेटल्स ने फॉल करना शुरू कर दिया है, साथ साथ एआई से रिलेटेड जो स्टॉक्स हैं वहाँ पर भी फॉल देखने के लिए मिल रहा है। कल नेट यूएस मार्केट में जो हुआ, बड़े बड़े शेयर गिर गए, सो लाइन लगी हुई है। अगर अभी वापस मुझे लगता है एआई से रिलेटेड जो स्टॉक्स हैं या जिनका इम्पैक्ट पड़ता है उन कंपनीज पे, अगर वो फॉल करते हैं तो मुझे लगता है थोड़ा और हो सकता है सिल्वर मेटल्स मार्केट सब गिरे सभी, ठीक है। सिल्वर थोड़ा ज़्यादा गिर सकता है बिकॉज रेशियो वाइज देखोगे गोल्ड के कंपैरिजन में मोमेंटम भी ज़्यादा दिया है सिल्वर ने, तो सिल्वर गोल्ड बाकी मेटल्स भी हैं, कॉपर जिंक एल्यूमिनियम, सब में एक फॉल देखने के लिए मिल सकता है उस केस में। बिटकॉइन बिटकॉइन कहाँ तक जाता है, तो बिल्कुल अपने ऑल टाइम हाई से बिल्कुल सिल्वर की कॉपी जैसी बना दी है, 50% करेक्ट हो गया, ऑलमोस्ट 46 एग्जैक्ट लिखा हो गया, तो पिछले कुछ टाइम से ऐसा लग रहा था लोग बिटकॉइन से पैसा निकाल के गोल्ड और सिल्वर में डाल रहे हैं, हम गोल्ड और सिल्वर में भी सेल कर रहे हैं, तो डाल कहाँ रहे हैं पैसा, पता नहीं। इंडियन मार्केट का देखोगे वही हाल था। एफआईज फिर सेल करके चले गए 2000 करोड़ अप्रोक्सीमेटली। डीआईएस ने आई थिंक 1000 करोड़ की बाइंग करी है। इंडियन मार्केट में भी स्टिल ओवरऑल देखोगे तो एफआईएस तो वापस आ ही नहीं रहे, पता नहीं। कल आई थिंक बाई करी थी एफआईएस ने 2000 करोड़ के आसपास, 2000 या 3000 करोड़ के आसपास शेयर्स बाई करे थे। डीआईएस ने भी आई थिंक 2000 करोड़ के आसपास बाइंग करी थी, बट अगेन आज से फिर से सेलिंग स्टार्ट हो गई। टीसी का ट्रेंड शायद 50,000 तक। मंथली में तो मुझे उसमें कोई सपोर्ट दिख भी नहीं रहा है बिटकॉइन में। स्मॉल टाइम फ्रेम पे जरूर होगा, मंथली टाइम फ्रेम पे सपोर्ट भी नहीं है नियर बाई, तो हो सकता है 50,000 तक चला भी जाए। गोल्ड सिल्वर सेल करके नेस्डैक मैग्निफिसेंट 7 को शॉर्ट कर रहे हैं। हाँ, लेकिन मैग्निफिसेंट 7 को नेस्डैक को अगर मान लो 7 लार्जेस्ट कंपनीज हैं उनको शॉर्ट करके वहां से, हाँ ये भी हो सकता है, करेक्ट। मतलब एआई बबल है क्या सच में? अगर मैग्निफिसेंट 7 टॉप 7 कंपनीज जो यूएस की हैं वहां पर शॉर्ट सेलिंग करनी शुरू कर दी है गोल्ड और सिल्वर से पैसा निकाल के, तो इसका मतलब तो यही है जानबूझ के शॉर्ट सेलिंग कर रहे हैं। एक तो है कि अपना पैसा जो प्रॉफिट बुकिंग है वो करके निकाल रहे हैं और पैसा साइड में रख रहे हैं कहीं लगाने के लिए। गोल्ड सिल्वर से पैसा अगर निकाल के शॉर्ट सेलिंग कर रहे हैं, मतलब शॉर्ट सेलिंग के लिए पैसा ज़्यादा चाहिए, इसका मतलब दे नो समथिंग। जानबूझ के प्राइस को गिराना है, इसका मतलब इन्वेस्टिंग नहीं कर रहे हैं। अवेलेबल है तो लॉन्ग टर्म में जॉब बच जाएगी, हाँ ये हो सकता है। एक पॉजिटिव न्यूज़ ये हो सकती है। बट अभी एक थोड़ी देर पहले न्यूज़ आई थी, वो भी मैंने शेयर करी थी। ओपन एआई ने एक प्लेटफॉर्म रिवील अवील किया है कंपनीज के लिए, जो डिप्लॉय कर सकता है एआई कोवर्कर्स, इट जस्ट लाइक एआई एजेंट्स। आई डोंट नो कितना इफेक्टिव होगा, बट अगर ऐसा होता है तो देयर इज वेरी हाई चांसेस सॉफ्टवेयर की फील्ड्स की जो जॉब है उन पे एक रिस्क आ सकता है। बस अब कोई वॉर वगैरह ना हो, अदरवाइज बहाना चाहिए मार्केट को गिरने के लिए, मार्केट गिर ही जाएगा। कल के दिन अगर मान लो यूएस ने अटैक कर दिया ईरान पे, इजराइल यूएस ने मिलकर अटैक कर दिया ईरान पे, या फिर चाइना ने अटैक कर दिया ताइवान पे, ये दो मेजर फ्लैश पॉइंट हैं। रशिया यूक्रेन वॉर तो मुझे लग रहा है ख़त्म ही हो जाएगी अब। आज जो कमेंट आया था यूक्रेन के प्रेसिडेंट जेलेंस्की की ओर से कि जो अभी मीटिंग हुई थी तीनों की, रसिया यूएस और यूक्रेन की, बहुत ही कंस्ट्रक्टिव मीटिंग है, ये उनका स्टेटमेंट था। सो वो तो मुझे लग रहा है वॉर ख़त्म ही हो जाएगी। आज भी डाउन है, कल भी डाउन था, आज भी डाउन हो गया वापस। स्टैक भी कुछ ज़्यादा ही नहीं गिर गया। नैस्डैक भी देखोगे ऑलमोस्ट 7% फॉल कर चुका है अपना ऑल टाइम हाई से। अपना इंडियन मार्केट अभी इतना फॉल नहीं किया ऑलमोस्ट। 1% फॉल किया था, 7% रिकवर किया, नाउ 3% लॉस पर है ऑल टाइम हाई से निफ्टी फ्यूचर गिफ्ट निफ्टी। डोनाल्ड डक भी थक गया होगा उसका भरोसा नहीं सर, वो कभी भी कुछ भी कर सकता है। आज ट्वीट करेगा मैंने ईरान पे अटैक कर दिया, ईरान वाले कहेंगे हमने स्ट्रेट और हॉर्मोज चोक कर दिया, जो करना है कर लो। क्रूड ऑयल पहुंच जाएगा वापस 7,000 8,000, इक्विटी मार्केट वैसे ही गिर जाएगी, नेचुरल गैस के प्राइस भी ऊपर। लेट्स सी, आई थिंक फ्राइडे को है ना, कल है शायद, आई थिंक यूएस और ईरान की मीटिंग है ओमान में, देखते हैं कल कुछ कमेंट आएगा। मीटिंग भी ऐसे दिन रखी है उन लोगों ने, टुमारो आई थिंक, फ्राइडे है, 2 दिन मार्केट वैसे भी क्लोज है। मीटिंग का टाइमिंग भी डोंट नो, मोस्ट प्रॉब्ली इवनिंग तक शायद मे बी कुछ अपडेट आ जाए, वहां से कुछ कंस्ट्रक्टिव निकल के आता है तो बढ़िया है। मंडे को फिर मार्केट मुझे लगता है थोड़ा सा ब्रीथ ले सकता, कुछ कंस्ट्रक्टिव नहीं निकल के आया तो देयर इज अ चांसेस प्राइस फिर फॉल कर सकता है उस केस में। ये आई थिंक मेरे को जहाँ तक याद है थोड़ी देर पहले अनाउंसमेंट आया था that there is a meeting between Iran and USA in Oman, which is held in Turkey, I think, last time. Israel Prime Minister Netanyahu, Egyptian army is growing stronger. We have relation and interest with Egypt, so we must keep a very close watch and prevent excessive buildup. Netanyahu on Iran Foreign Affairs and Security Committee discussion highlights. Netanyahu said a critical mass is forming to overthrow the Iranian regime, but it's unclear if it will succeed. He stated Israel is prepared to deliver a very hard blow against Iran far beyond June conflict. Netanyahu noted uncertainty over Trump's ultimate action but emphasized close coordination with him at all levels.
You can go and sleep. We have quarters prepared for you. I said, no, I don't have to sleep. I've been on a plane sleeping for 20, I mean, I'm sleeping the plane. I don't sleep on planes. I don't like sleeping on planes, you know. I like looking out the window watching for missiles and enemies, actually. But he said, sir, we have a place prepared for you and we can meet after you've rested. I said, no, let's go. You can go and sleep. We have
to give away. So I'm asking you, Prime Minister Starmer, I shouldn't have said what I said. Your testicles aren't on back order from Amazon. I take it back. Please do the right thing here. If you're determined to give away these islands to Mauritius, which never owned them, which inevitably is going to help China, if you're determined to divest the people of the United Kingdom of these islands, please sell them to the United States. I will sponsor the legislation happily, enthusiastically, to appropriate the money to do it. And then the United Kingdom can be out of the picture, and the United States can continue to control one of the mightiest and most important military bases in all of human history. So I'm asking
time now, Mike, so that's not new. I guess what's different this time is just the momentum. It's persistently to the downside for Bitcoin. Bloomberg News writes a story about how Bitcoin's dropped below 70,000 and now below 68,000 is coming as forced deleveraging accelerates. What does that look like? Can you just walk us through that?
Scarlett, I love how people dig into the weeds. I look at the macro. And there was one Bitcoin in 2009. Now there's 28 million. The problem is there's things like Shiba Inu still worth $3 billion. And then there's Dogecoin still worth $15 billion. There are numbers on the screen that track nothing. I think from the future, we're going to look back at this is the tulip purge. We need to purge all this stuff and get to a base. But you can only do that when you get the stock market at 2 to 2.3 times GDP. To me, that's what's happening. We're reverting all that. And the bottom line is, look at it somewhat politically. I think the Trump administration might realize, yeah, if we run it hot, that means inflation and we're not going to get elected. If we get a little bit of correction in beta and maybe the stock market drops 10%, everything will work out. We'll get deflation, the Fed will ease, interest rates will drop, yields will drop, and energy will drop. So the key thing that's also happened this year is we've never had gold and silver rally at this velocity with stock market volatility this low, and they are too expensive. I think what's happening now is they told us the stock market volatility is just going to revert a bit. And just to end with this, 180-day volatility on the S&P 500, it's still near an 8-year low. It's got to go higher.
Silver. Boy, it was 121 just a cup of coffee ago, as Tom Keene would say. Yeah. We're now at 74 and change, down 15% today. Is silver typically less speculative than, say, gold?
Oh no! See, it's called the devil's metal for a reason, but typically trades, Paul, at 2. I know you're lining me up for that quote, but it typically trades at 2 times the volatility of gold, and it's the lesson with silver is you never buy it when you can make statements like I did last week. It was the most expensive ever versus copper and crude oil. I'll never be able to say that again the rest of my career, I don't think. And the key thing about silver is it can easily get back to 50. And it's still somewhat expensive. People point out supply and demand. There's always supply and demand. But when prices shift this exponentially, we're going to get massive supply come on, and we're going to hear a lot. The word we'll hear in silver next year is thrifting.
Oh boy. Okay, we're ready for that. I also want to get your take on, the cold snap, and that's kind of an understatement that we're seeing in the Northeast, and certainly in the Southeast too. Florida has seen a bitter cold period, and that is of course damaging the state's citrus crop. What does this all mean in terms of the soft ag prices that we're seeing?
Well, it's not going to be too much for the soft ags. I think more of corn, soybeans, and wheat. And only if it's going to maybe imply some sort of a drought coming on for the summer, and that's part of the bear market. Look at corn. It tried to get above 5 last year, about this time of year, and now it's pushing towards 4 because we have so much supply. Same with soybeans, massive supply out of Brazil. But when you say cold weather, Scarlett, what's been really impressive this year usually means natural gas. This is a really cold winter. It's a second cold winter in a row, despite global warming. Natural gas popped in January, and now that front contract's running below 4. It can easily get below 3 because the lessons in natural gas is every time it gets above 5, the U.S. producers bring on a lot more supply and push the price back lower. And now they have a little more incentive from our current administration to bring on that supply and help supply the world with energy. And the key thing to remember is the U.S. now, what's shifted from the past, is a net exporter of crude oil, natural gas, LNG. In the past, we were a net importer. So we are now the price maker in energy on a global basis.
Well, for Mike, he's down in Miami. This weekend, sunny to partly sunny. Highs in the low to mid 70s. That's not too bad. I think Mike can handle that. Mike McGlone, thanks so much for joining us. Senior commodity strategist, Bloomberg Intelligence. He's down there in our Miami Beach office here. Lots of earnings coming out across the tape this week. One of the busier weeks out there. One of the names is Peloton. Boy, they can just not seem to get any positive momentum going in that business. It kind of for me at least, I'm like, does this company need to be public? It seems like they should maybe be a private company, but I don't know.
What did everyone call it? The most expensive coat rack?
Coat rack. That's right, exactly. Geetha Ranganathan, she covers Peloton as well as all of the media and entertainment names for Bloomberg Intelligence. What's the story this time, Geetha, with Peloton? They just reported some results.
Yeah, Paul. So they had their biggest product refresh ever in their history last fall. They had this huge price increase that they implemented across all of their subscription offerings. And even with all that and the benefit of a holiday quarter, they basically disappointed on the sales number. And, you have them kind of making all of these, taking all of these cost efficiencies. You have a lot of cost cuts. They are definitely making good progress when it comes to profit. But boy, the top line is just not moving, and that's really causing a lot of fear among investors.
And we always introduce you, Geetha, as our media and entertainment analyst here at Bloomberg Intelligence. Peloton makes exercise bikes, but for a while it was trying to frame itself as a media company. How reliant is it on that software, on the media side of its business?
Oh, it absolutely depends on the content, Scarlett. It is the content that gave it its cult following, that gives it all of those sticky, affluent customers. The problem for Peloton right now is they're just not able to move the needle. And yeah, you have all of these new features that they're adding. I mean, you have all of these AI-powered features. They've added it to their entire product lineup. They're allowing you to kind of integrate all of your health data from like Garmin and basically making it really, really comfortable for the user, but those are all really just incremental. They are not transformational. And basically the company just coming out and saying that, the upgrade cycle that they were expecting from the existing customers just hasn't happened. You're absolutely right that this is a content company in many ways because, it relies on the content, but it also needs the sales of its hardware to happen in order for people to get access to that content. And that just is not taking off.
Have you ever used Peloton before?
We have a Peloton in our house.
Yeah.
And
do you follow any of the
Karen from the Jersey Shore rides it every single day, rides the bike and the treadmill thing in our home. you can't hide them. We don't have a basement.
If you can now take a $45 pill from him and hers,
Exactly.
why would you need all this
even
stuff?
More so, you need to keep tone up when you're losing weight, and so they do the weight program. So we use it, we have it, we use it, but they're just not monetizing us. So Geetha, real quickly, this is almost a time now, a 1.9 billion market cap. Are people calling for this company to go private, to be sold? I mean, it doesn't seem to work as a publicly traded company.
Yeah, it doesn't, Paul. And, there's been so much of chatter about whether an Apple or an Amazon should buy this company. Nothing, of course, has materialized. There's also been, constant rumors about private equity maybe kind of coming in, milking it for whatever free cash flow they can get. But again, nobody really knows what's going to happen here.
All right. So I guess I just don't know. What's interesting, because some of the trainers, they have huge followings on social media, and they're selling stuff like crazy. So Geetha, does Peloton get any of the, their employees, social media side hustle revenue at all?
No, not really. I mean, it's just, I guess it's good for the brand, but that's about it.
All right, Geetha. I don't know. It's interesting. That's a lost revenue stream there, I think, from the company. So
you just look at a chart, and it is incredible.
Yeah.
The high was on December 2020.
Yep.
$167.
Yep.
Now it's at $4.57.
There you go. Geetha Ranganathan, she covers all the media stocks, including Peloton. Well, earlier today, the Bank of England came within a vote of cutting interest rates and predicted inflation will fall below its target. A closer than expected decision that revived hopes of a move next month. Bloomberg's Francine Lacroix spoke to Governor Andrew Bailey following the decision about what's in store for March. Here's some of that conversation.
Well, you may have seen it in my submission of my paragraph in the minutes. I said that I will be, I said that I think there is, a prospect of, some further cutting interest rates. And I said, I think in my last sentence, I said I'll go into each meeting asking myself that question. So, look, I think, going into March 50-50 is not a bad place to be in that sense, because in a sense markets are asking themselves the same question that I'm asking, or perhaps they're just working out what question I'm asking and, in a sense, following that. But yeah, I think that's a reasonable question to ask, because look, we've had good news. We think inflation is now going to come down to target sooner than we thought it would. I think this spring sometime. But the real question now is it going to sustain? Is it going to be sustained there? Because that's our job, and that's all to do with underlying inflation. And that's where I certainly think that we do need, we need some more evidence base to mount that. But that's the question we'll be asking ourselves.
Why have you dropped the word gradual from your formal guidance? It had been there for quite some time.
Well. I think for a couple of reasons. One, because we've made a lot of progress. And the second one, which is closely related actually, there does come a point, if we don't get any more shocks in the world economy, that's a big if, but we don't, these are the things we don't know about, so we can't in a sense factor the things we don't know about in. So let's assume that's what the forecast is, we've published is really based on. Then I think we are now getting towards what I might call that neutral level of interest rates, where it will sustain inflation. It's the rate that will sustain inflation at the target. We don't know it. We don't know exactly where that is because it's it's a good concept, hard to translate into any precise practice.
But are we close?
Well, in a sense, we must be getting closer, but I think we are closer. So, I think the change of language is really to change the language a bit to this language we've used a few times about, it's a closer call at this point.
When you look at the shocks, I mean, you said today that the global economy has just been pretty good at weathering some of the shocks.
Yes.
But is it that we could see less shocks, or is that we're just much more adaptable?
We never know what shocks we're going to see by definition almost. No, look, I think it is interesting that the world economy has been more resilient to all the uncertainty we've had over the last year. Then I think if we go back to the conversation we were having this time last year, actually, when we were doing this report this time last year, our concerns about how the world economy was going to be affected by the news that at that point was beginning to build up, it has certainly turned out to be more resilient.
So is the domestic political uncertainty now more of a concern or an uncertainty?
Well, look, I don't comment on politics in this country. I think the important thing for the UK economy now is that it does appear that macroeconomic policy is doing its job. I think we've got a much more stable prospect ahead. And I think the challenge for the UK economy, as I said earlier now, is that I think we do need to address the supply side of the economy to raise the potential growth rate, because that's really the important thing now.
All right, that was Bank of England Governor Andrew Bailey speaking with Bloomberg's Francine Lacroix. The Bank of England did not cut rates today. It was a 5-4 decision, but maybe opening the door for March, so we'll stay on top of that. Right now, let's get a little bit of a reset here in these markets, which are moving. Go to John Tucker on the Bloomberg Business Flash.
And moving lower, this Bloomberg Business Flash, Paul, brought to you by Golden Crest Metals. Inflation, tariffs, volatility have some investors turning to gold for stability. To get a free gold and silver information guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. This is a renewed round of tech selling in particular, and it's leading to a risk-off mood overall in the markets. Right now, you have 10 of the 11 major industry groups in the S&P 500. They are down. 322 stocks in the index, lower 185. They are higher right now. The S&P 500 down 78 points. There's a decline of 1.1%, 6804 on the index. The Dow Jones Industrial Average is down 519 points. That's a 1% decline. And the NASDAQ 100, 304 points lower. This is a decline of 1.4%. And where is the money going? Well, it's hard to say at this point. Dollar DXY, that is actually higher, up 0.2%. The economic data that we got this morning shows some continued weakness in the job market. 10-year yield right now, that is down 7 basis points. We're at 4.20. The more policy reactive 2-year yield, that is close to 7 basis points lower, and that is at 348. And Bitcoin right now down close to 7%, under 6,800, 67,600 per token. Silver, 13% lower right now at $75 an ounce. And gold also down 1.7%, $4,870 an ounce. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Scarlett.
Hi, John Tucker. Thank you so much. Appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. Also, streaming live on Bloomberg.com/videos. That's where you find all of the Bloomberg video content, including this radio simulcast here. John Tucker reporting markets are moving to the downside again today, led in part by this rotation out of some of those tech names that have been driving the market so much higher here. Where do we go from here? Let's check in with a professional, Anna Rothman, Chief Executive Officer, Grenadilla Advisory. She joins us from Cleveland, Ohio. Anna, what do you make of this sell-off in the markets, particularly in the tech-heavy NASDAQ?
Yeah, I mean, this is a continuation of software sell-off ever since Claude came out, I guess in January 15th with Cowork and now with Legal. I do think that some of the sell-off is overdone because if you think about enterprise software, there's so many different kinds. Right now it's sell everything just in case. And then I think the markets will take the time to really figure out where the pressures really would be. I mean, think about Salesforce. It is entrenched into the businesses and processes of a lot of companies. It's going to be very difficult to take that out and have companies that are very used to using a software get rid of Salesforce and apply Claude, for example. I mean, it's just way too early at the moment, and stocks look pretty attractive.
When you look at the earnings season, you characterize it as brutal. What are investors learning this earnings season from companies?
Yeah, it's been brutal because the price action for the most part has been on the downside, right? So what are we learning? AI spending is just going to get bigger and bigger. I mean, why are we even surprised anymore that companies are going to come out and up their spending beyond our expectations? Google, for example, last night, I mean, I think we were expecting somewhere around 120 billion. They came up with a top of 185. I mean, it's huge. But if you also think about it, these larger hyperscalers, they've been around for a long time, and AI is relatively new. And I know Google's been developing AI for a long time too, but for them, it was an existential threat. Just about 6 months ago, we were talking about replacing Google search with ChatGPT. So it makes sense to me that they're willing to spend a lot of money because some of this is a defensive move as well as trying to capture the AI market.
Anna, is it realistic or unrealistic for the market to ask for return on investment on this AI investments?
Yes, but not right now. I think right now we're still in the frenzy point. I mean, we have to spend a lot of money to get the infrastructure going. And frankly, return on investments is going to take a long time. And also, we have to ask ourselves the question of what does return on investment look like? Going back to Google last night, I mean, the CEO was saying, we are seeing some return on our AI investment. And what that means is, with the search engine, there's the AI overview and the Gemini, as well as their data centers, and cloud infrastructure. They are seeing an uptick. And as investors, we have to sort of accept that as the beginning of what might be what we're expecting as ROI.
As much as we look at the ROI or think about the ROI of these big tech companies that are spending so much on their AI build out and investors are selling first and asking questions later, you've seen a lot of demand for Oracle's credit this week. All these big hyperscalers are spending so massively on AI and they have to use debt to fund a lot of it. Do you see any discernment taking place within the credit market for big tech bonds?
And part of that, I think, is just if you look at the cap stack, debt sits above equity. So equity can sell off sentiment based, but credit is going to be fine. I know that credit has been on the news a lot. And lately, not just cockroaches, but lately it's been surrounding software. I do think that fear is overdone. Without credit, as I said, AI spend is just going to get bigger. It's going to be almost impossible. We were expecting a lot of these hyperscalers to actually just spend cash. And sometimes that's not the best idea. Sometimes you have to reserve cash for other things. And so borrowing actually makes a lot of sense. And the reception of the debt actually tells us that there's a lot of excitement still, despite the equity market sell-off.
Yeah, Scarlett, we had Rob Schiffman on earlier today on Bloomberg Surveillance. He covers the credit side of technology, and he said the credit market is completely comfortable with the tech story, loves it. Spreads are very, very tight. The demand for these new issues is just, 4, 5, 6 oversubscribed. So from his perspective, and he says, credit people are smarter than equity people. So he said, don't worry.
He's a little biased, of course.
He
but
is,
yeah.
exactly.
But something did happen with equity investors where they woke up this week and realized, wait a minute, not everything's going to be okay.
Anna, are you participating or should we be participating in this rotation trade a little bit out of technology, out of some of the higher multiple stocks into some of the more value oriented, maybe even small and mid cap? Is that a strategy for 26?
Well, I manage a balanced portfolio, so there's been some rebalancing here. And naturally, because of the sell-off, the rebalancing has gone into tech rather than out of tech. And I do think that the sell-off has been pretty continuous and it's been pretty steep. So those stocks actually look pretty attractive to me rather than selling at a low point. I mean, when Palantir, I know the valuation is super high, but when it drops by, I think it's like 7 or 8% today, along with dropping yesterday. I mean, those are some fear-driven, emotion-driven sell-offs that doesn't make any sense to me from a logical, fundamental perspective. And so it's more attractive rather than running away from it due to fear.
All right, Anna. Thank you so much. Really appreciate it. Anna Rothman, Chief Executive Officer, Grenadier Advisory, joining us via Zoom from Cleveland, Ohio here. So again, definitely some movement out there in the marketplace, particularly in the NASDAQ here. Another area of movement is in the world of luxury. Estee Lauder put out some results. Market doesn't like it. The stock's down 22% here. Let's check in with Deb Aiken. She covers all the luxury good companies for Bloomberg Intelligence. She's based in our London office. Boy, what did Estee Lauder have to say here that so spooked the market, Deb?
I think that, if we think about 2 years where they've been turning around the US, and all of a sudden for the Americas, they came in flat with the US doing a little bit better, but the LATAM side pulling somewhat on results. And the expectation for Q3 and Q4 is quite subdued. A better 4Q to come. So this was a 2Q report where actually they beat on the top line, they beat a little bit on margin, and they raised their EPS, but it all kind of EPS sits mid or 4 cents below mid consensus range on EPS. So although it was a beat, it wasn't transformational. And so we have the Americas. We have also the fact that Europe is a little bit kind of stabilized, subdued. And then when you think about the China market, which was one of their big transition markets, they are expecting for the second half mid-single-digit growth. They've had some good mid-growth in the first half, but you still have a big issue with travel retail. So when you consider North America and what's happening with department stores and them transitioning there to about 30% of the portfolio overall and into more multi, and then you have some retailers in travel retail out of China, actually changeovers in retailers, which is conflicting and causing issues with their supply chains. It isn't an easy story for the next few months ahead. And the stock rallied massively ahead of results, up 30% over the 3 months.
Yeah, and if you expand that to over the past 12 months, the stock had surged 80%, more than 80%. So
Absolutely.
there's a lot built into the optimism here with this new CEO. Is the worst then behind the company, Deb? I mean, given what we heard, sure, the results were not good enough to keep the stock moving higher, but have the restructuring costs really been priced in and it's sunnier skies ahead?
I think so, yes, but I don't think it's going to be as quick as some expected. If we think about the market overall, the beauty market, and what the CEO said, and he reiterated it, they're looking for about 3% growth in the beauty market this year, and others such as L'Oreal will say that the market should grow around 4% plus, and that's because L'Oreal and some others have a higher exposure into high-end fragrances, which are faster growth, versus Estee Lauder. But aside from that, you probably get that, the idea from Estee Lauder for the full year is 0 to 3% on constant currency. And they're hoping to get to the top end of that, but that would mean that they're kind of running a little bit behind the market still. But that's because they have high travel retail and not so much exposure as peers on the fragrance side. So where valuation sits right now, it's built in expectation that this 1.2 to 1.6 billion restructuring cost, which is on track, does come through, and that everything cleans up through fiscal 27. The company is shifting to annual estimates only, which I think the US market in particular won't like. Guidance only, to try and prevent volatility. But when it isn't a clear road ahead, that's often needed to be able to really understand quarter by quarter what's happening. So I think there are pros and cons to this company overall, and I can understand why it's down today.
What is Estee Lauder saying about the market in China? And what are they saying about Chinese consumers in general? Where are they shopping? Are they coming to Europe? Are they coming to the US? Are they staying in Japan and China?
Japan, no. China, South Korea is taking some share and some kind of domestic move out of China. There's a little bit of transition into Europe, but overall, the way that Estee Lauder used to account for their travel retail in Europe, and they shifted it so it's separated, with China separate and then Asia. And within Asia, you have the travel retail business. So it's very clear what's happening over there. So China is picking up its mid-single digit growth, but it's still down where it was versus 2 years ago. There's still a lot of repair to do, and that's the story from so many of these companies. But certainly for Estee Lauder, and I think we'll feel a bit of this pain also for L'Oreal, they have high exposure to travel retail in China, and that isn't coming back. Hainan is solid, Macau not so much. The Chinese aren't shopping in Japan, partly because they're asked to shop at home and because there were big comps from 1 or 2 years ago. And particularly for Estee Lauder too, in Americas, they've already done so much with third parties, which I should mention, on digital with Amazon and others, and they're going to be comping against that as well. So it makes it hard there.
Gotcha. Deb, thank you so much for joining us. Deb Aiken is our luxury goods analyst joining us on the latest from Estee Lauder. The other thing about Chinese consumers is that they're increasingly using and going to homegrown brands.
Are they? Okay.
Yeah, because it's a patriotism thing, it's a nationalism thing, so there's all of that to consider as well. All right, Bloomberg Intelligence has a lot more coming up. Be sure to explore our live streaming news and interviews, all our Bloomberg TV shows, documentaries, reporter analysis, and more, all in one place. Check out Bloomberg.com/videos. From New York, this is Bloomberg Intelligence on Bloomberg Radio.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. So, yeah, tech is setting the risk-off tone for markets today with yet another sell-off. You have 10 of the 11 major industry groups in the S&P 500 lower. Interestingly enough, Strategy, the worst-performing stock in the NASDAQ 100, down over 11% right now. It's a Bitcoin treasury company. Bitcoin right now, that is down over 6%, under 68,000 per token. Now, among the most active shares of Google parent Alphabet, that's down 3%. They are planning, among other things, record spending in the race to win more AI customers. And the big beneficiary of all that spending, that would be Broadcom. So let's go to Broadcom. Those shares right now, they're up close to 4%. Tom Kennedy at JP Morgan says the AI disruption trade, you know what, probably isn't over.
It's going to be at least a few years before we can prove that AI will not disrupt software. So this madness of what we're experiencing feels like it's going to be around for a while.
And right now, the NASDAQ 100, 207 points lower. That's down to 0.8%. So we're pairing some of the earlier losses. The S&P 500, 61 points lower. That's down 0.9%. The Dow Jones Industrial Average, 465 points lower. And apparently they couldn't agree on a price. Rio Tinto Group walking away from talks to acquire Glencore. The potential deal was the latest in a series of attempted takeovers among the top miners in the world. According to Palo Alto Networks, an Asian cyber espionage group has spent the past year breaking into computer systems belonging to governments and also critical infrastructure organizations in more than 37 countries. They use that access to spy on emails, financial dealings, communications about military, as well as police operations. You know, where does this end? We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Scarlett.
All right, good stuff. Thank you so much, John Tucker. I've been looking at the Philadelphia Semiconductor Index, which tracks chip companies, and it's had a brutal couple of days. It's rebounded today off a one-month low, but you look inside the index, and Qualcomm is the biggest loser in that group, down more than 7% at the moment. Kunjan Sobhani is our senior analyst on semiconductors. And Kunjan, when you look at Qualcomm's results, Qualcomm is primarily making chips for smartphones. And this forecast that it gave is not so great. What does that tell us? Is that more a case of, you know, supply chain issues, or is there just not so much demand for new smartphones?
No, it's nothing to do with demand. There's two factors here. One, for Qualcomm, this year was a unique year where most of their Android handset makers, so think of Samsung, think of Xiaomi, Oppo, Vivo, launched their phones earlier than they used to. So remember, the handset business is a very seasonal business. So you have up quarters when the phones are launched and really down quarters. So in the nutshell, a lot of that revenue was sort of pulled ahead of time. That's why what you saw is they beat so strongly in the current quarter. So the flip part of that is the next quarter, which is a trough quarter, is going to be even a worse trough. On top of that, what's happening is, as we are all aware of the memory crunch happening because of HBM memory in data centers and the rising memory cost, that's freaking out the Chinese OEMs, which Qualcomm is now really disproportionately exposed to compared to all other handset semis. So the guys like Apple and Samsung are probably doing fine. They have their ability to get access to memory and procure memory ahead of time, but the smaller players are not as sophisticated. So those players are freaking out, and they basically have decided we are going to stop ordering a lot more chips, and we're going to clear out what we have in our inventory. And that's why what we're seeing is basically the memory impacting Qualcomm's guidance.
All right, so we step back from some of the chip makers and their earnings. I'm thinking AMD, and that's soft again today. Qualcomm here. What are some of the takeaways from an industry perspective are you chatting about with clients?
Yeah, so you mean, you know, the sort of the software meltdown is the fever is spreading a little bit into semis. I would not say as broad strokes. This earnings season, what we are seeing is if companies didn't come out and blow the quarter out of the results and for their outlook, they are basically getting punished. A lot of that has to also take into context. A lot of these companies in the last 6 to 7 months have seen significant rallies because a lot of good expectations, especially for the AI names like AMD, be being priced in. So the market is now in the mood where if you're not showing me real excitement, you're sort of being ready for a little bit of a pullback.
Right. They call it a show me kind of market environment. So our colleagues will be speaking with the CEO of Qualcomm, Cristiano Amon. How would you grade his performance so far, Kunjan?
Well, look, he's doing everything right. It's just the company is in a tough spot. Investors have been wanting them to diversify away from handsets for many years now. And since he's been the CEO, that's what his primary objective has been. They're making good strides on the auto and IoT. In fact, both of those segments had much better than expected results and outlook. But when you still think about the company now, even 3-4 years down the road, it's still majority significantly a handset revenue company. So until the revenue exposure of handsets doesn't get to at least 50% or lower, I think that sort of headwind on the company impact from handsets is going to continue. And I think Cristiano just has to keep doing what he's doing and ride this out.
So, Kunjan, I know most of or much of the selling in the tech space is in the software space, not in your chip sector. But when you talk to investors, when you talk to clients, how do you feel? What's their mood over the last week or so? Do you feel like they're just kind of selling in a panic, selling because, hey, I've got such a big gain, I'm taking something off the table, my fundamental view of AI has changed? What's the tone?
I don't think the fundamental view has changed. I think a couple of things. Once you said if whatever is happening in the other sectors will impact this sector as well, right? Because there is some definitely that risk of profit taking. Also remember, getting into this year, a lot of investors in my sector are trying to reposition their books, right? They're reevaluating. Last year in semis was like, look, everything was doing great. AI is helping everyone. I think now it's becoming a more of a stock pickers market in the sector where people are really focusing deep and thinking which guys are going to be the real winners, and let's focus on them. But let's get off or at least take some profit off the other folks, which don't seem to be the top number and 1 and 2 in the areas that they're playing.
You mentioned earlier how Cristiano Amon, the CEO, is trying to diversify Qualcomm to not rely so much on smartphone makers as its main line of business, as it tries to get into the AI data center business and make chips that would compete with NVIDIA. What kind of capex do you anticipate Qualcomm will have to commit to?
Yeah, so Qualcomm predominantly is a fabless semi company, so they don't have or would not have a significant capex like you hear from other AI hyperscalers. They would have to commit to significant OpEx, which is R&D dollars, if they are going into a new line of business where they need to develop newer chips, newer programs. They have acquired a company recently to do this, so they have spent some capital there, and I think they will have to really boost up their R&D, which is their OpEx spending, to compete with the likes of NVIDIA.
All right, Kunjan Sobhani, senior analyst on semiconductors for Bloomberg Intelligence, joining us from the San Francisco office for Bloomberg Intelligence. Right now, Cristiano Amon, Qualcomm CEO, speaking with Bloomberg Television anchors Ed Ludlow and Caroline Hyde. Let's listen in.
That memory supply constraints could push prices higher, which in turn would weigh on the handset demand. Joining us to discuss is Cristiano Amon, Qualcomm CEO. Cristiano, good morning. Thank you for coming back to Bloomberg Tech. I give you that what's happening in memory is completely outside of your control, right? But the forecast for the current period of sales up to $11 billion. I suppose one way of looking at it is how much better would that have been were the market not so constrained by the supply of memory right now, but also the pricing pressure that supply deficit puts in place?
Yeah, look, it's a very interesting situation. In one hand, I'm incredibly happy with the business. Like, everything is going well. Demand is strong. Macroeconomic indicators are good. Demand for handset is strong. We had like a record quarter in Q1. We saw all of our customers reporting sell-through data better than expectations. But then the industry is now defined by the availability of the memory that is going to be available for consumer electronics. And it creates, a sudden change in how OEMs look at their build plan. And they say, look, I have to size the size of the market, not based on demand, but the memory that I can get for consumer electronics. And that what makes it like this unique period. Go ahead.
Let me jump in, but you know, within that market, there are some specific interesting case studies, right? The premium segment is good, like from a demand side, particularly in China. So usually, like in any hardware environment where you're supply constrained but demand is high, like that's a good thing. And increasingly, like think about the content in the phone that you provide. How can you kind of navigate this to your advantage?
Yes, and that's a great observation. That's why I think there's a lot of, unnecessary, speculation right now. Here's what's going to happen. We saw this with COVID. OEMs, the first thing they're going to do, they're going to prioritize premium and high tier, because those are more resilient, I think, to price increases. We are going to see probably adjustment in prices on handsets, and because demand is strong, it is very likely that the premium and the high tier is going to be less impacted than the mass tier on phones. And we have seen that the premium tier continue to expand regardless. Over the several years, the premium tier is expanding, and we're more concentrated on the premium and the high tier. So your theory is 100% correct. All that happened is OEMs had thinking about a particular size of the year. That got resized by the memory availability. They're adjusting their build plans, and we're going to see how this is going to play out in the next few quarters. That's really the story.
So
the good thing is demand is high.
So the second quarter chip sales guidance was what worried people, but third quarter, fourth quarter, it's going to play out over that time frame, do you think?
It's one thing that I carefully worded, I think, during our earnings call. I said the memory availability and pricing will be the defining factor for the size of the handset market. And we talk about the size of handset market because we have visibility of the whole market because of our licensing business. But now we're going to see how this play out. And I'm a little hesitant to make a very definitive prediction on how this is going to play out in Q3 and Q4. But the pandemic was a good proxy when we have something like that and we have a semiconductor shortage. We saw that the premium tier has been more resilient, and we're going to be working with our customers as they move the roadmap to kind of those type of devices.
And now you control the controllables. And those controllables have been diversification. In many ways, this speaks to why you've been focusing in on new areas of growth, whether it be autos, whether it be connected devices, whether it be the future of robotics, whether, of course, it be AI. Cristiano, how much can you accelerate there to make up for the handset issues?
Look, it's not, hopefully it's not lost on people that we had another record in automotive. We had actually a record in the company in Q1. And not only we continue to be satisfied with the direction the company is going on diversification, we added new things like robotics. For example, we had a record in automotive. A couple of things that happened in the quarter that are very, very important. One is we announced a broad partnership with Volkswagen Group across all the brands to build, the Snapdragon digital chassis for Volkswagen. We saw the launch of the RAV4, one of the top-selling cars in the world for digital cockpit. And IoT is growing. We enter robotics in a short period of time with some major customers. So we're excited about that. The fundamentals of the company are actually incredible, and we're just navigating to another phone cycle.
Cristiano, second consecutive quarter where automotive is above $1 billion. And I remember over years us discussing what was a backlog in automotive, right? Apply that story and that experience to your hopes in data center. You've told us when this will happen and who it will happen with first. But how do you see that translating from your order backlog to revenue growth and hitting milestones like $1 billion quarter? Yes,
we restated the data center will start showing up in fiscal 27. We have been talking for a while that the data center is going to change. It's going to go from the current focus on training into inference. We have been saying, I think before it was popular, that a different architecture will be required. I think the post-GPU architecture. Interesting that the Grok development is kind of validating that. And we're getting a lot of good feedback. We have a new architecture, including for memory. We don't need HBM, which is causing all of this memory situation. And we have been very encouraged by the traction we're getting. So it's going to be material in 27, and we are going to provide a lot of details in our upcoming investor event.
Just broadly, how are you thinking about the actual consumer right now as well, Cristiano? Just briefly.
Yes. So phone is a great proxy for consumer. Macroeconomic indicators are strong. Consumer demand, very strong. One of the things I said in the earnings call, sell-through data on phones, and we have visibility because of our licensing business, exceeded all expectations. Phones are getting off the shelf. So it's not a demand issue. It's just a memory supply issue.
Qualcomm CEO Cristiano Amon, we so appreciate you joining on this day after the earnings. Stay well. Meanwhile, that does it for another extraordinary edition of Bloomberg
Very good. That
Tech.
was Cristiano Amon, Qualcomm CEO, speaking with Bloomberg Television's anchors Ed Ludlow and Caroline Hyde about their quarter and about the business. Big earnings after the close today. We're going to hear from Amazon.com to get a preview of what we might hear from the big retailer and cloud computing company. We do that with Poonam Goyal, senior U.S. e-commerce and retail analyst for Bloomberg Intelligence. Poonam, what do we expect to hear from Amazon tonight?
So we think on the retail side, the results should be solid. We're expecting a high single-digit online sales gain. We think the holiday season was very well received by consumers. They chose Amazon first. On the cloud side, just after the results we saw from Alphabet Google last night, I think the anticipation was for strong results. We expected 20% plus growth rates on the revenue side. That's FX neutral. But after what we saw yesterday, I think the expectations has risen. So we're looking for a bigger beat. We're looking for good CapEx numbers, at least intact, if not higher, for 2026.
The stock's down a couple of percent year to date, down maybe 4 or 5% on a trailing 12-month basis, really not participating in this market rally. What do you think the concern is there for Amazon these days?
I think there's really two big concerns. One, can they catch up in the AI game? We know that they're working or trying to work now with ChatGPT, OpenAI, to really find a place for them there. We don't know whether that will materialize, but that's clearly a concern. The other, on the retail side, I think while Amazon continues to take share and is the choice when it comes to online shopping, is consumer demand going to hold up for the rest of the year? Will Amazon be able to play in the agentic commerce space as well as the others? And can it continue to offer its advantage of logistics as others kind of start to creep into that space with the 2-day delivery? So same day is, where Amazon is leaning harder.
So to what extent is AI, or is Amazon incorporating AI into the shopping experience? We're hearing more and more of that in your industry.
Yeah, I think they're doing a lot of work on AI, specifically with Rufus and Alexa Plus. You probably heard yesterday they rolled out Alexa Plus to all Prime members. So I think these are two mediums in which they can make shopping more conversational, make shopping more personalized, and really integrate with the consumer to think what they're thinking and get them the answers faster so they can hit the buy now button sooner.
Nobody makes it easier to buy than Amazon. That app is awesome. Knows how to separate you from your money. Poonam Goyal, senior U.S. e-commerce and retail analyst for Bloomberg Intelligence, getting a quick preview of Amazon results that are coming after the close tonight. It'll be a bellwether name as it relates to the cloud business and the AI spending and AI development. Certainly one of the key issues for this market right now. The S&P selling off here by 0.75%. Same for the Dow. The NASDAQ is down 415 points. That's 1.8%. Yields, they're coming in sharply. 10-year treasuries in 6 basis points to 4.21%. All right, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up in just a moment. Again, the sell-off continues across the board, red on the screen here. Even in the commodity space, we've got gold is down 70 points here, just under $4,900 per token. Bitcoin down 6%, 68,000. 100. How about that? More coming up. This is Bloomberg. Good morning.
This is CBS News on the Hour, your home for original reporting.
I'm Steve Kathan. Authorities in Arizona plan to publicly update the investigation into Nancy Guthrie's disappearance in about an hour. Last night, daughter Savannah Guthrie and her siblings asked for proof of life from anyone who might have abducted the 84-year-old woman. CBS's Andres Gutierrez is in Tucson.
Investigators were back out there yesterday afternoon with canines combing through the home, as well as documenting some other evidence that may have missed the first time around. And that is because there may have been a tip or a lead that may have drawn them back to the home to go and recover additional pieces of information.
New development today is the last U.S.-Russia nuclear arms agreement is expiring.
The U.S. has announced that it's going to reestablish direct military-to-military talks with the Russians, which the U.S. halted just before Russia invaded Ukraine. Now, these kinds of high-level and consistent contacts are meant to avoid any conflicts or misunderstandings about military actions.
That's CBS News contributor Beth Noble. The White House says more will be revealed later today about President Trump's online medication marketplace. Trump spent part of the morning at the National Prayer Breakfast.
The president announced May 17th will be a day of prayer on the National Mall.
We're going to rededicate America as one nation under God.
Trump also announced
the Department of Education is officially issuing its new guidance to protect the right to prayer in our public schools. That's a big deal.
The president called the protesters who disrupted a church service in Minnesota bad people. Michael Wallace, CBS News.
In Mississippi and Tennessee, CBS's Katie Weiss reports tens of thousands who still don't have power days after a strong storm may need patience lasting into next week.
For a lot of people, the power companies are not wanting to give as many estimates. Some of the smaller power companies are being very transparent with their customers, explaining, look, it might be up to another 7 to 10 days.
There's an investigation in Arizona where a public safety helicopter crashed while responding to a shooting involving police. KPHO TV reporter Gibby Parra.
While they were assisting this active shooter situation here in Flagstaff involving the Flagstaff police and law enforcement here in the area, that's when that helicopter Ranger went down, unfortunately killing both the pilot and the paramedic that were on board.
The government says job openings fell to the lowest level in more than 5 years, 6.5 million. Wall Street, right now the Dow is down 385 points. The S&P is down 54. This is CBS News. Bonus. A member of music's fifth dimension has died.
Lamont McLemore and his R&B group won 6 Grammy Awards, including Record of the Year twice. The first for 1967's Up, Up and Away. The second for the 1969 mashup from the musical Hair that spent 6 weeks at number 1. His family says Macklemore died at his home in Las Vegas after suffering a stroke. He was 90. Deborah Rodriguez, CBS News.
Minute Maid helped make orange juice a year-round thing in 1946 when it began shipping cans of frozen juice all over the country. Now the brand's parent company is stopping sales of all frozen juice concentrates in the U.S. and Canada, saying it wants to focus on the fresh juices that customers now prefer. Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
Democrats detailed their demands. Welcome to the Thursday edition as Chuck Schumer and Hakeem Jeffries send Republican leaders the 10 restrictions they want to see for ICE, with just over a week now to the next likely shutdown of the Department of Homeland Security. We're going to walk through the list with Bloomberg's Mike Dorning from our Capitol Influence team. Bloomberg's Tyler Kendall is going to bring us inside the Senate hearing room, where Secretary Scott Bessent is testifying today and answering some tough questions. And we're going to play the politics of the Super Bowl later on with our political panel. And as Bitcoin falls out of bed, we'll spend some time with Mike McGlone at Bloomberg Intelligence to see just where the floor might be. And that's where we start. Maybe we should call it the floor with Charlie Pellet. He's got his eyes on the markets at World Headquarters in New York. What's going on here, Charlie?
Well, right now, we're looking at a broad-based sell-off. We've got to begin with Bitcoin. Bitcoin, you alluded to it. Right now, Bitcoin taking out 68,000. 67,798 right now on Bitcoin, down 6.7%. Our Mike McGlone, Miami Mike's going to have a whole lot more on Bitcoin coming up here on Balance of Power. But right now, the Dow, the S&P, NASDAQ, all in the red. We are well off session lows, but still sizable losses for stocks. S&P right now at 68.26 on the S&P. That is a gain now of 56, a loss right now of 56, down 0.8%. We've got the Dow down 388. Dow Industrials down 0.8%, while NASDAQ lower by 218. The NASDAQ Composite Index down 1%. The Mag 7 Index, the Bloomberg Mag 7 Index down 1.5%. Our Russell 2000, or the Russell 2000 Index, down now by 0.7%. The VIX holding above 20, 10-year 4.21% with a 2-year 3.49%. Spot gold right now, we do have spot gold trading lower as well. Silver down 13%, 76.55 on spot silver. West Texas Intermediate crude down 2.6%, 63.46 now per barrel of WTI. Bitcoin bears repeating. Bitcoin now down by 7.1%, 67,530. We are seeing another day of selling in tech stocks, specifically software firms, chip makers, and all things relating to AI. Marta Norton is Chief Investment Strategist at Empower, and she was a guest this morning on Bloomberg Open Interest.
I really think that if you're just playing the momentum trade and you're just running the narrative, you're going to miss a pretty good investment opportunity. AI is a theme that we know is going to dominate, and so we want to find ways to get invested in it at better prices. And this is one of those times to look for those better prices.
Alphabet, after earnings, It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the rout deepening on Wall Street. Tech and crypto are sliding. The Dow, the S&P, NASDAQ, all in the red. We're off session lows, but still looking at a 1% drop right now for the S&P 500 index, down 70, 68.12. We've got the Dow Jones Industrial Average holding just above 49,000. The Dow now lower by 0.9%, down 456. NASDAQ hard hit, down 264, down 1.1%. Google, Alphabet after earnings, down now by 3.4%. The 10-year, 4.20%, with the 2-year, 3.48%. Spot gold down $90 the ounce, 48.72 now, down 1.9%. Silver plunging another 13%, 76.43 on silver. West Texas Intermediate crude down 2.5%, 63.54 a barrel. And Bitcoin now down by 8%, taking out the $67,000 level. Bitcoin right now at 66,740. Our Mike McGlone, Miami Mike's going to have a whole lot more on crypto and the sell-off in commodities, specifically gold and silver, coming up in just a moment right here on Bloomberg. New York's pension funds are questioning Palantir Technologies over its business dealings with U.S. Immigration and Customs Enforcement and the Department of Homeland Security. New York City's 5 systems hold shares in Palantir worth $457 million. Palantir today selling off by 5.1%. Again, recapping here, Bitcoin down now by 8%, S&P down 0.9. Balance of power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
With the news, Charlie, thank you so much. Mr. Pellet will be back in about 20 minutes with another read on the market. So, yeah, we just gave up 67,000 again on Bitcoin. Wow. Down 8%. Shares of Mr., the company we used to call MicroStrategy, by the way, reporting after the bell now, it's just strategy. Maybe tomorrow we'll be calling it Strategery, because right now it's down 13%. That's a $112 stock? I've got to, hang on, look back at this. This thing topped out at $455 in July. So if you'd been listening to Mike McGlone, and I know this could be painful, if you bought near the top, listen, I'm sorry, this is breathtaking. We've done a full round trip since the Trump election. And I'll point you, by the way, to, there's an ETF everybody's talking about, the institutionalization of crypto and all the rest of it. There's an ETF that's short Bitcoin. And yeah, it's up and to the right. BITI is the ticker, the opposite of BTC. But again, Mike McGlone's been talking about this for months. When Bitcoin was around 100,000, remember what he said? Take a zero off it. Does that mean we have another one? We got 50 grand to go here? Miami Mike McGlone, the smartest guy in the room today, is with us live from Bloomberg Intelligence, our commodities senior analyst. And Mike, when you start breaking through technical levels like this, how do you find a floor? What is going on right now?
Hey, Joe. Well, a little trick I learned in the trading pits. You look for a significant mean from a significant period of time, and that's 64,000 from the year 2024. 2024 is going to go down in history as a paradigm shift, because that's when Mr. Trump flipped. That's when we had ETFs launched, and that is also when we had the halving. So that's the highest volume price. That's basically the mean and median and mode from 2024. So I think it's good support. I think we're going to eventually break through there. So I look at that as a speed bump. It's sport. It holds for a little while and eventually gets below. But the key thing is it's dragging everything with it now. I mean, risk assets.
Yes. Is this retail bailing on Bitcoin? These are people who piled in after Trump got elected? Or do you have a sense of what's driving this undertow?
I think it's everything, Joe, and I think what happened is when Mr. Trump flipped, that flipped the whole narrative of the space. It was, I called it a Faustian bargain. It helped him get elected. A lot of crypto money helped get in there. But the people who were in the space from the beginning, they call them the OGs, it shifted their mantra, because before they were getting away from the system, and now if you're invested in space, or if you're actually buying anything cryptos, you're supporting the Trump administration officials who are heavily invested in the space, which I viewed as, okay, that ended it. And the key thing also, it kicked in the speculative frenzy, and one thing it added was massive supply. So there was one crypto, 2009, it was Bitcoin, and now on CoinMarketCap.com, there's 32 million. It's unlimited supply.
Unlimited supply. I thought the halving was the whole point, though, that the halving would control the supply and support the price. What did I not understand about that?
It's like the movie Fantasia with the Sorcerer's Apprentice when Mickey Mouse creates the spell and doesn't know how to stop it, and all the broomsticks, he can't stop it. That's what happened, unlimited supply. But I'm glad you mentioned MicroStrategy because the anecdotal is very entertaining. There's only one stock in the history of my career that two fathers asked me to ask their sons to sell, and that was MicroStrategy.
Wow. So what the heck is Michael Saylor going to say after the bell? I was just reading on the terminal. His cost basis is around $76,000. What does a company do when it's leveraged like this?
They get stopped out. So MicroStrategy is probably heading towards 100 minimum, potentially going to go under. I think Bitcoin this year is going to drop to 50 at minimum. And the bottom line is, here's one key thing, Joe. There's so many other cryptocurrencies, like Dogecoin is one of them. Dogecoin is still worth $15 billion. It was launched as a joke, and it tracks nothing. That's got to be purged. We've got to just take that off down to zero.
Wow. Producer James is listening intently here. Look, you were a bull. You were a crypto bull at one point, Mike McGlone. When you're talking about something with no intrinsic value, how do you establish a bottom?
Well, exactly. We'll figure that out the hard way. But it was Michael Saylor really accelerated my bullishness in 2020. Bitcoin was around 10,000. He jumped on board. I'm like, oh, thank you, because I was very lonely being bullish, and that's what you want to be, is lonely when you're bullish an asset. It did a 10x, and he double dared the market by making fun of Mr. Trump for not being invested. You never want to mess with the market gods. He did, unfortunately. I know Michael well. I'm fortunate as a strategist. I like to say, yeah, you just don't want to sell a risk asset like that after it goes up too much, and you don't want to buy it after it goes up too much, and that's what happened.
Oh, I wonder if he's going to announce more purchases after the bell here. 75 degrees in Miami. I salute you, Mr. McGlone. A great American. Thanks for the insights here, and we'll just be tracking this. Let's stay in touch with Mike as this either goes lower or finds a bounce at some point. Hey, you want some bright side? The all-time gain on Bitcoin is still over 14,000%. But of course, you would have been buying at the equivalent of about $400 at that point. Back to politics here in Washington, although the crossover with the financial market is severe today as Scott Bessent endures a second day of testimony on Capitol Hill. Senate side today, this one's seen as a little more important because the banking committee, these are the folks who are actually going to be choosing or confirming or not the next Fed chair. Spent some time with Elizabeth Warren, not a fan of the administration or the secretary or the president or the president's pick for Fed chair or the policies that are being discussed in many cases today, but got into the issue of affordability. Let's listen.
Senator, it may be a bit nuanced for you, but what President Trump is referring to is the media saying that the affordability crisis was generated by this administration when it was you and President Biden who destroyed the buying power of the American people. So there is an affordability crisis, and you were front and center in it.
So let me make sure that I understand. Donald Trump is not saying that affordability, what's happening to families right now, is a hoax?
He is saying that trying to lay the blame at this administration rather than the Biden-Warren economy is a hoax.
A hoax. That's the magic word that the president has used so many times. That kind of back and forth continued with Democrats, Republicans. Look, you can pretty much preview how these things are going to go. Congratulated the secretary on his good work. In the room for much of this, and she's been talking to the members of the banking committee on their way in and out. Let's go to the Dirksen Senate office building, right? We're going to ground here on Balance of Power with Bloomberg's Tyler Kendall. She's been there for the balance of the morning. Tyler, how's it going?
Yeah, hey, Joe. Well, you said it, this marked the second day of Treasury Secretary Scott Bessent's testimony here on Capitol Hill. Yesterday was in front of the House Financial Services Committee, where it was notably contentious. But as you just heard with the Treasury Secretary's exchange with the ranking member on this banking committee, he had some pretty contentious and fiery rhetoric during this appearance as well. And actually, it was later in that exchange with Elizabeth Warren that we got one of the first big headlines out of his testimony, which was when she pressed him about whether or not he could confirm if a potentially confirmed Kevin Warsh as Fed chair would be shielded from criminal prosecution if he did not lower rates. And Treasury Secretary Scott Bessent said that that was ultimately up to the president. This comes after yesterday he told the House Financial Services Committee that he couldn't weigh in on whether or not the president has the authority to remove a member of the Federal Reserve Board over a policy difference, saying that he's not a lawyer and ultimately this needs to go before the Supreme Court, as we are currently seeing play out when it comes to the case against Fed Governor Lisa Cook, though that is, of course, the case in front of the Supreme Court isn't necessarily about policy differences, but rather those allegations of mortgage fraud. But Joe, the Fed chair, potential Fed chair, was really at the center of the discussions today because, as you well know, this is the committee in everybody's sights. This is considered to be essentially the gatekeeper for that nomination of Kevin Warsh to be the next Fed chair. Senator Tom Tillis, who has been on this program before, is still threatening to block that nomination until the legal matter against Jerome Powell is resolved. And I have to say, I've been running around interviewing a lot of the Republicans on the Senate Banking Committee today, and we're starting to see sort of a pattern emerge, if you will. A lot of them are telling me that they want to see this investigation wrapped up quickly, and that they themselves do not think that Jerome Powell committed a crime, because we have to keep in mind that the investigation against Jerome Powell right now has to do with allegations that he misled Congress. He misled this very committee, the Senate Banking Committee. Some of the most prominent comments that I got included from Senator Kevin Cramer, a Republican on this committee, who said that this is a waste of time and it is unnecessary, and he just wants to see all of this move along so that they can get Kevin Warsh confirmed when Jerome Powell's term ends in May of this year.
Sounds like you're in a high traffic zone there, Tyler. My goodness. Just to be clear, I know you bumped into Tom Tillis a little while ago, of course, looming large over this confirmation process by way of blocking it. Did he give us any sense that he's changing his tone on Kevin Warsh? And of course, I ask you that by way of his opposition of the criminal investigation into Jay Powell.
Nope, Joe, I asked him. He said right now it is still this binary decision, in his words, that the administration needs to drop its Department of Justice investigation into Jerome Powell, and then he will look at the nomination, any nomination. We know that he's expanded this when it comes to if the president has the opportunity to appoint anybody else when it comes to the Federal Reserve. I also asked him if he's been in touch with the administration on the matter. I'm very curious what perhaps those backroom negotiations may look like, and he told me that he hasn't. He said that he has been absolutely clear and that he doesn't see room for negotiation. He is going to hold his position firmly when it comes to this. Also asked him if we can expect the Banking Committee to even set a confirmation date. I've asked a few of the senators here to see if we could get a hearing even on the books when it comes to Kevin Warsh, and nobody seemed to have an answer, and we know that that is going to have to be that first step. Republicans hold a 13-11 majority on this committee, so it really only takes one to block that nomination from getting to the full Senate floor.
Well, we're still waiting for a date. Tyler, thank you so much. Just stopping traffic in the hallways for us. Look at that. Tyler Kendall outside room 538, Dirksen Senate Office Building. That's the real thing. We'll assemble our political panel next, only here on
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. First day of trading for Bob's Discount Furniture. Stock off and running. Little change right now. Went out the gate at $17. Right now, looking at a quote of $17.01. Bob's did raise $331 million in its IPO. Ticker for the stock, BOBS. We've got the Dow, the S&P, NASDAQ well off session lows right now, but still looking at a down day here. The tech rout goes on with the S&P at 68.41, down 41 right now. Drop there of 0.6%. The Dow down 284, decline of 0.6%. NASDAQ down 148. NASDAQ lower now by 0.6%. The Russell 2000 index down 0.6%, with a VIX holding just above 20. 10-year at 4.21%. The 2-year 3.49%. Gold selling off down 1.8%, 48.75. Silver down by 12.8% right now. Spot silver at 76.84. And Bitcoin, just talking with our Mike McGlone about that. Bitcoin down 7.7%, holding just above 67,000 right now at 67,075. So a down day for the Dow, the S&P, and NASDAQ. Wall Street, meanwhile, continues to speculate about what Kevin Warsh, as chair of the Fed, will mean for the path of interest rates. Blake Gwynn is head of U.S. rate strategy at RBC Capital Markets. And on surveillance this morning, he was asked about a Warsh Fed.
You know, I think there's a lot of questions about what he's really going to be able to get done on the rate side. Obviously, he must have at least kind of committed to cutting. We heard as much from Trump yesterday, who said, yes, I am under the impression that he is coming in and cutting rates. Wouldn't have got the job if he didn't say that.
Kevin Warsh of RBC Capital Markets interviewed on surveillance, and you can hear more of that conversation on the Surveillance podcast. Peloton Interactive shares are plunging now by 23.9%, the most in more than 2 years, after the company provided a weaker than expected revenue forecast for the fiscal third quarter. Novo Nordisk lower after Hims & Hers Health launched a cheaper copycat version of Novo's new weight loss pill. Again, recapping the Dow, the S&P, NASDAQ, all declining off session lows. S&P down 0.6%. Bitcoin plunging by 7.8%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Balance of Power continues right now. And once again, your host, here he is, Joe Matthew.
All right, Charlie Pellet, the great Charlie Pellet, carrying the weight of earnings season on his own shoulders, walking us through earnings every evening here, and it's going to be another doozy after the bell with Amazon. Charlie's like the George Atlas of financial news, the whole thing on his back. Some things are going up, you know. Can I say something nice about the market? McKesson is higher. Big earnings report, stocks up 16%. They do exist. And we'll have to take a look at the equal weight indexes after the bell, because the RSP, the equal weight, actually hit an all-time high yesterday. This has been a very tech-focused sell-off here. Costco's moving higher. Broadcom has caught a bid. So has Micron. Who knows? We could be in a different world by the end of the day here, and maybe Amazon will change the tune. Yeah, look at that. James put in a couple more tickers. NVIDIA, and that makes sense, too. If Google's spending too much money, somebody needs to take that money, and that would be NVIDIA. Up a bit here, less than 1%. Meta crawling higher, up almost 2%. As we gear up for the Super Bowl, everybody keeps asking me what I'm going to be doing for the Super Bowl, and I'm the type that stays home and watches it on TV. You might be one who wants to be around other people, where it gets loud, it gets the beers going, pretend you're tailgating. A lot of people, of course, watch the game for the commercials, and advertisers are well aware of that. We're looking at the ratings from last year, 127 million, I think, and this is what a couple of politicians are trying to seize on. And as we prepare to assemble our panel, this is going to be really something, because if you're James Talarico running for Senate in Texas, you're spending $100,000, kind of a big deal to run an ad in the Super Bowl here, and it only runs in the Houston market. That's why it's not millions of dollars. KPRC, those watching locally will see the Talarico ad surrounded by the Clydesdales and the GoDaddies and all the rest. But imagine 127 million people seeing this ad from a senator they probably never heard of from the state of Maine. Let's watch and listen.
Senator Susan Collins to the rescue. Susan helped introduce legislation that protects firefighters and first responders from cancer-causing forever chemicals in their equipment, because their job is dangerous enough. Call Senator Collins and thank her for protecting Maine's first responders.
Put down that beer and call Senator Collins and thank her. I beg your pardon? Not the Clydesdales, the Collins. This is an 8-figure ad buy, according to the scoop in Politico, to boost her name recognition in what they see as one of the Republican Party's biggest must-win Senate races. If you didn't see that, if you're listening to Bloomberg Radio right now, and for that I salute you, this opens up with like video of firefighters charging into a burning building, and then it resolves to a smiling Susan Collins. Will she be in the commercial reviews the next day? We assembled our political panel to start diving into the ad buys because this stuff is fun and there is strategy around it for better or worse. Bloomberg Politics contributors Rick Davis and Adam Hodge are with us. Rick is our Republican strategist and partner at Stone Court Capital. Adam is managing partner, Bully Pulpit International, our Democratic strategist. Rick, I know you throw a Bafo Super Bowl party. What do you do when the political ads come on?
Get some more dip, refresh the beer, make sure the chicken wings are still hot. No, I love the campaign ads. Are you kidding me? They're a part of Americana. And I love Susan Collins. So the more I see her at the Super Bowl, the happier I am. And that is my Super Bowl ad for today's show. Yeah, no, I mean, like you gotta, as you said, 127 million people watching. Some of those are going to be in Maine. A lot of them are going to be donors.
Yeah.
Good for the goose, good for the gander. Donors get attention. You can, hit them next time you see them for money, and they'll say, "Wow, what a great Super Bowl ad you had." So yeah, I think if you got it, spend it. This is coming out of the Thune's, Victory Fund, the Senate Leadership Fund. So it doesn't cost her anything. Just say yes. Keep moving.
Okay. I can only imagine like the MAGA candidates that'll be advertising during the Chris Rock alternate halftime show, Adam Hodge. But an 8-figure ad campaign when you're targeting 49 states that don't matter to you, is it worth it?
No, just to put it simply. I think most people like Rick and myself are going to be getting some more dip or a cold beer and not watching the political ad. But look, Susan Collins is in another fight for her political life. And just this week, Chuck Schumer's Senate Majority PAC announced another $4 million ad buy to go after Susan Collins. So she's got to do what she's got to do to try to keep that seat. And it's been clear that the Trump White House, despite their misgivings about Susan Collins' past votes, are willing to try to help her out. And because they know that if she loses that seat, it's harder for the Republicans to keep that Senate majority. So it seems a little bit like a waste of money to spend a national ad. You're not going to get 127 million people to vote in Maine. But if it keeps the donors happy, keeps the crowd happy, that's fine. They'll probably miss it getting some dip in a beer, just like the three of us.
Well, it's really interesting that we're taking this approach here. I wonder, Rick, what you make of the ad itself. Forget the forum for a moment. Why are we seizing on first responders here? Is this something that resonates in Maine? Obviously, people in Maine know Susan Collins pretty well at this point. What do you think of the approach when you have 30 seconds to work with?
Yeah, I mean, it's a patriotic ad. In Maine, they have a lot of issues with natural disasters. There's some crime. There's a lot of issues related to supporting first responders. Shows her kind of a very soft, tough on crime kind of ad without saying, like, I'm like Donald Trump. So, I think it's actually a very bright ad. Nobody's going to attack it. If they do, they're on the wrong side of the issue, and kind of bulks up her main credential while she's down here in the city of Satan trying to pass, appropriations bills as chairman of the Appropriations Committee. I mean, that is a thankless job to most Mainers. So this is a good, solid get right, especially with white males without a college education who make up the largest group of Republican base in Maine. Make sure she's solid with them. So yeah, I mean, I think it's a good ad, for this period of time where just bulking up on her favorables is part of the job.
Yeah. Well, of course, the city is Satan. Straight to San Francisco. Adam, look, the first votes are going to be in Texas, so I guess it's not a surprise to see James Talrico here as we learn that Act Blue pulled $1.78 billion, almost $2 billion across the platform fundraising for the last calendar year, 2025. Political reports that is up 40% from 2021 totals as we look at an odd year record here. Is it time to start deploying that cash? How close do you need to get to actual voting before you get on the air as you look at the states that are contested around the country?
Yeah, I mean, Joe, that money doesn't do any good if you lose the primary. And so if you've got the cash to spend and you can do it wisely, that's important. And this is the time when you're in that final home stretch until the primary. It's smart to do it in Houston, where he clearly doesn't have as big of a name ID within the Democratic electorate, and he's got some work to do. It's going to be a fiercely contested Democratic primary there, and so if he can spend the money there, I think it's worth it. Now, you're hitting on something there with the massive Democratic enthusiasm that is shown by that insane, off-year fundraising haul. Democrats are fired up, mostly, I think, out of a anti-Trump motivation, given what we're seeing across the country. And they're giving money to candidates. And so the smart campaigns will find a way to use those resources smartly. And not only, find new ads that reach people where they're actually getting their information, getting their news, but also to build a real field organization to get people to the polls for you.
You know more about fundraising than most, Rick Davis. What do you think of this number in an off-election year to pull a record like that?
Yeah, it's a chunky number. Democrats should be optimistic. You compare it to what Trump and the Republicans have brought in, it starts looking like it's coming back down.